Now, the street is reacting to the OPEC and allies, which have increased production by 411,000 barrels per day in the month of July. Well, what the street is celebrating is no surprises there. The number is on the higher side, but this is something that the markets have already worked with. Having said that, we've seen gains also come in because you're looking at Chinese demand expected to be on the stronger side. The first quarter numbers are out, and the global consumption rose by 1.2 million barrels per day. So that has been yet another reason supporting the markets. The gold prices also seem to be trading above 3,300 right now after 2% of decline in the previous week. Silver, in the meanwhile, after closing a strong May up by almost 2%, has started June on a positive note as well. And that's exactly how we're looking at metals as well. So good opening across commodities in Asia right now.
Well, thank you so much for that, Manisha. But in some weather updates from the northeast, 30 people have died across Assam, Tripura, Manipur, Sikkim and Arunachal Pradesh as the northeast continues to reel under heavy rainfall. The Indian Army, Assam Rifles and local volunteers are carrying out rescue operations. Around 1,300 families have been shifted to relief camps as several try to navigate the inundated paths the rain has led to severe waterlogging. Roads were submerged, disrupting daily life and causing distress to residents. Now, the latest IMD warning shows a red alert for the West Tripura region.
And with that, we are absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, kicking off a fresh new week. And it's an important one with lots of news flow as we come into this weekend, but of course also tracking whether after 2 weeks of relative consolidation for larger indices, whether we make a bit of a move or not. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, morning.
Hi, morning Prashant. Morning Nigel. Morning to all our viewers. I have a confession to make. Only 4 hours of sleep. But it was so worth it because of that game last night. Yeah. Mumbai Indians out. But, you know, and I've missed a lot of games because of one reason or the other. I'm not the biggest cricket buff. But just luck, pure luck to watch Shreyas Iyer in top form. What a sublime innings. Beautiful, beautiful batting.
Well, that's right. That innings spells very, very good times for Indian cricket on the whole, with that young man, you know, shouldering the captaincy and also going ahead and playing a knock like that. But I'll tell you what, I'm a little heartbroken today. I would have liked Mumbai Indians to come out on top. But that's
still bleeding blue, Nigel.
That's the way the game goes. So kudos to Shreyas Iyer. Our team maybe better luck next time. They put in a good fight. Maybe a catch or two was dropped at the wrong time, but so be it.
2 new teams in the final for the first time.
Indeed. Who are you going with?
It's going to be a good one. I'll watch this game for sure from start to end.
Prashant, you want to choose a winner between the two?
No, I was watching chess, guys.
Yeah.
Oh, you guys see the Gukesh essentially taking out Magnus.
Wow.
6 rounds.
Yeah.
And, I mean, in Norway, outstanding stuff. And I think we've got the... people have been talking about this for some time now, that who's the successor to Vishwanathan Anand. I think he's very, very young, but I think Gukesh is the answer.
You know, and it's not just the win. It's the manner in which he reacted post the win as well. Just calm, let it soak in. And we saw what the opponent did. I mean, that's the champion in there. But kudos. You know, Indian chess is well moving in the right direction.
Absolutely. And
now markets, are they moving in the right direction?
We'll see. But, you know, let's just take it from the top, right, in terms of what you need to know as we begin another new session. So, essentially, you had, and this is a theme which we've kind of highlighted now for 2 weeks now, which is that maybe we've seen the peak of good news flow on tariffs. I mean, we've seen the peak, and maybe from here, there's going to be a little deterioration. And the last 2 weeks have proven that indeed is the case. Why do I say that? So by the end of last week, news on tariffs, and the graphics will start to come up, has taken a decisively negative turn. Trump accused China of violating the recent Geneva deal, which is, of course, the handshake deal which happened. And it was not a deal. It was basically an agreement to start to talk. China issued a denial that no such thing. Trump then said, I'm sure that I'll speak to President Xi, Chinese President Xi, and hopefully we'll work things out. So this all happened, Friday post-market, around Friday post-market hours. And let's move this along. Yeah, there you go. I'm sure I'll speak to President Xi and hopefully we'll work things out. Then after that, Trump announced a doubling of tariffs on steel and aluminum to 50%. So this is, again, post-market hours on Friday. Over the weekend, what has happened? EU has threatened countermeasures. China said it would take measures as well. So both these came through, and we'll see what happens. So from here, as we go into the next couple of days, that phone call which Trump has said he's going to have with President Xi was going to be something to track, and details out of it. And of course, if there are before that countermeasures from both EU and China, it'll basically take the tension on tariffs, etc., up a few notches. Markets took the bad news on Friday. By the way, the S&P was down 1% at the lowest point, and then it recovered. So, you know, essentially, we kind of took the bad tariff news flow in its stride. The S&P ended flat. The Nasdaq didn't have very much on it as well. So is the resilience on markets underscoring the power of taco thinking? What is taco thinking? I mean, essentially, yeah, I mean, I don't want to say it. That question was posed to the president, and it stands for, it was coined, Trump always chickens out, right? I mean, he'll sort of put something big out and then he'll kind of always walk back. Is that the reason why the markets are thinking, well, this too shall pass? It's possible, and why not? Now, basically that Trump will not follow through on any of his aggressive tariff policies. The S&P 500, and that's a news flow bit of it, right? The S&P 500 closed out May. It was the best May since 1990, with the S&P gaining over 6%. The 10-year yield on Friday was down 2 basis points, nothing very much, 4.4%. The dollar index was unchanged at 99.3. With regards to oil, there is a bit of a move this morning. So OPEC Plus has agreed to another 400,000 barrels per day supply increase. This is in line with expectations. Oil prices, the last I checked, they're on your screen, 2.5% higher after ending flat on Friday, even slightly lower on Friday. As we go forward, U.S. fiscal risks should be in focus. The U.S. Senate will resume discussions about, to pass the Trump's big, beautiful bill. Many are saying, it will not go through in this in the current form. There will be changes made which will bring down the size of what the bill plans to spend, etc. We'll see. Hopefully it will be that. But in any case, the fiscal risk and what's happening to the long end of the bond curve in the US, I think, comes back into focus. Later this week, towards the end of this week, RBI will meet. They're expected to cut rates by 25 basis points. Of course, on Friday, we also had the GDP numbers, which we will talk more in a bit from now, and the numbers were good. Now, US jobs data is the other thing. That's again on Friday. ISM services and global PMI should also be in focus as we go into the next 4 odd trading sessions or so. Just to tie in the levels here, the Nifty actually it held on last week. Nifty Bank, actually 2 weeks now, the larger indices have consolidated. Broader markets have continued to do very well. Immediate support right now stands at 24,692, which is the 20-day moving average. Very near term, 60 points away basically from where we left off on Friday. And then the next support is 24,462. On the way up, we need a break, and we've been sort of pulling this level for about 6 days now, 25,116, to confirm that the market is beginning a new impulse higher. For the Nifty Bank, we saw follow-up gains on Friday. The resistance is at 55,695 to 55,875, and support stands at recent lows of 55,096. So that's the picture as far as the broader markets are concerned. The headline indices go as well. GIFT Nifty will give you a quick sense of how we are starting. Once again, like we've seen for many days now, neither here nor there. Maybe we pick a trend as we start trading. 25 points lower on the GIFT Nifty. Surabhi.
Okay, well, GIFT Nifty down 25 points, but Asia is down a lot more. It's a slam dunk across Asian markets as markets realize that this tariff issue is not going away anytime soon. So markets reacting to the fact that steel and aluminum tariffs are all set to be doubled from the 4th of June. And you can see the sharp knock. The Japanese market led the morning lower. It was down about 1.2%. Now Japan's down about 1.5%. And that cut on the Hang Seng is quite bad. Let's just pull that up. 2.5% lower on the Hang Seng. The mainland Chinese market is shut today for the Dragon Boat Festival. So you're not getting rates out of mainland China, but Hang Seng is a good indicator. A lot of other developments as well. There was this Wall Street Journal article that said that Trump will make use of the Trade Act of 1974. This is a piece that we put out last week itself, the options before him. And it seems like he's willing to explore everything on the table. There's that section 122, which allows a baseline tariff of up to 15% to be set for 150 days. And Wall Street Journal is saying that this is definitely, definitely being considered, whether he does it or not, but it's definitely one of the top considerations. Not just that, we had the agencies over the weekend also report, there was a Bloomberg report suggesting that US will look at much wider sanctions in terms of China tech companies. That's another reason the Hang Seng is down big time today. Let's see what more is coming in terms of restrictions on Chinese tech majors. Then we had the White House National Economic Council Director, Kevin Hesset, saying that Trump and Xi could talk as soon as this week. And that's where the hope is, that they'll speak and they'll, break this logjam. Because after Geneva, nothing has progressed and the chatter has been on the negative side. Hesset says, my expectation is that both sides have expressed a willingness to talk and they'll definitely be discussing trade. Let's see. Coming to our market, so we're gearing up for what promises to be a weak start. Let's see if we indeed get, an opening leg down. Now, the Nifty has been consolidating for 12 straight sessions. Right now, we're about 50 basis points higher than the 20-day moving average, which would be perhaps the first challenge on the lower side today. Let's see how this goes. The critical question is whether this trading range of the market, which is 24,450 on the downside and 25,100 on the upside, this broad 500, 550-point trading band, will it break this week or not? Let's see. Let's talk about flows then. Flows are not a problem at all for this market. Whether it's FPIs or DIs, the money's been coming in. On Friday, however, we had a big net sell number. And there's a lot of block deal action as well. So you have to keep that in mind. 6,500 crores of selling by FPIs, domestic institutions ended up buying over 9,000 crores. But overall, FPI buying in May is still looking very good. It's the best we've seen so far this calendar year at close to 20,000 crore rupees. So let's watch for this. By the way, the flows action in the month of May, 50,000 crores of sales have happened. OFS, PE selling, promoters selling. That's skewing the DI and FII number. Coming to the GDP numbers, that's a pleasant surprise. So macros are in our favor. Fourth quarter GDP beating estimates at 7.4%. It's also a nice pickup from the third quarter. Third quarter, we were at 6.4%. Of course, lower than last year. And the market will like the fact that gross fixed capital formation has moved along very nicely. It's a big, large jump, 9.4%. on gross fixed capital formation, much higher than last year, higher than the previous quarter as well. Construction growth is looking good at close to 11%. Manufacturing is still limping along. It's improved sequentially, but it's still way off from last year's levels. Manufacturing growth of about, just about touching 4.8%. So that's the GDP number. That's the positive. Auto sales are also, there's more positive than negative because the companies that have done well in the last 1 year, they continue to do very well. M&M, TVS Motors. M&M, the PV sales are up 21%. TVS Motors, total sales up 17%. Tata Motors, that's some red. The challenges continue. Sales are down. CVs, PVs, everything's down for Tata Motors. We'll talk about this. And aside of it, last of the earnings season action. So Nykaa is going to be in focus. Nyka's done well. Margins are up almost 100 basis points. Watch for this stock. Apollo Hospitals, we'll talk to the management today as well. Another very steady quarter in line with estimates for Apollo Hospitals. Reddy's is interesting. Semaglutide. There's all talk about these GLP-1 drugs. And now there's a challenge that's come in. In fact, the Delhi High Court has barred Dr. Reddy's from selling semaglutide here in India because the innovator company has taken Reddy's and the partner to court. Watch for this stock as well. So plenty to keep us excited. Macros, micros, stocks, levels. So much going on now.
Well, that's right. On the domestic front, things are looking good. And on Friday, there was an MSCI rejig that took place. That explains why they were selling. Maybe the number's a little bigger than what the, the MSCI rejig was hoping for. But that's one point to put on the table as well. However, domestically, things are looking good. If you look at the GST collections at around 2 lakh crore, you like that. You look at the GDP print, you like that as well. In terms of earnings in the past quarter, I was looking at what Motilal Oswal was estimating and what they were delivered. Well, that as well was fairly good. So the domestic piece actually is looking quite good. And we're bracing for an RBI rate cut. So put all those factors together on the domestic front, actually, things are looking up. The problem is on the globe because there's uncertainty on Trump's tariffs. It'll be interesting to see whether or not he goes the MAGA way, that's making America great again, or he tackle, that is whether he chickens out. And the street will be hoping to see whether or not there is some negotiations out there. But this, this Trump trade tariff problem, that continues to plague the markets a little bit. So we'll have to keep an eye on that. And geopolitical fears as well are back on the table with what we're looking at with regard to Russia as well as Ukraine. For the time being, you have Brent crude prices that are pretty much well behaved, as well as the dollar index is pretty much, in our favor as well. So for the time being, both those two indicators, they're in favor of an emerging market like India. So as I said, domestic piece looking good. The global cues a little bit jittery. One factor that's making me not worry too much on the first day of a new series is that the India VIX cooled off. Yes, we ended lower in Friday's trading session, but when the VIX cools off, that's one comforting sign because otherwise the VIX had moved up a little bit. In today's trading session, we'll keep an eye out on that as well. Moving to what the FIs did, well, they added shorts yet again. They added close to 8,500 short contracts, while the clients, they're doing the opposite. So they added close to 2 longs for every 1 short position. So if you look at the setup as of now, the FI net short positions, well, they have moved to around 80,000 contracts. On the flip side, the clients, they're net long at close to around 60,000 contracts. This is normally an ideal scenario for the markets to move up. But we need some good news. For the time being, the markets are devoid of that good news. So once that good news comes, maybe in fact we'll be able to break past that range. The PCR holding at around 0.7, that's towards the lower end of the range because you've seen call writing come back. 24,800 call, 24,900 call. Both of them were fairly active even in Friday's trading session. The good point is the 24,800 put as well continues to see some writing. So quick range out there. Going by the options data for the day, you don't want the 24,550 odd mark to break on the downside, and the resistance mark at around 25,050. So broad 500-point range. For the time being, the market is lacking that positive trigger. I think we spend some more time in this range.
Okay, we're right in the middle of it. So let's see how this week plays out. Well, let's quickly get you the equity call of the morning. Sanjeev Prasad of Kotak Institutional Equity says the Indian market seems to be stuck between the harsh realities of stiff valuations, domestic growth issues and global macroeconomic headwinds, and the hopes of a recovery in the economy and in earnings. He says the fourth quarter of FY25, the results did not provide much comfort about an imminent recovery. He adds that fourth quarter net profit of the Nifty 50 index increased 3.7% and EBITDA was higher by 9.2%.
Okay, well, let's just quickly run you through what's lined up here over the show, the program, with the next 2.5 hours. So we'll be speaking with Matt Orton of Raymond James Investment on the other side. He's right here in our studios. 8:35, we'll hear from Prakash Diwan for some fundamental stock calls. At 9 o'clock, Sachin Salgaonkar of BofA Securities is joining us from the sidelines of the BofA 2025 India Conference. on trends in the telecom space. 9:20, Pankaj Tibriwala, Vikagai Asset Managers, joins us on markets. 9:30, TVS Motors speaks about the company's growth trajectory in EV manufacturing. Sunita Reddy of Apollo Hospitals will be with us to talk about the numbers which came through. 9:50 a.m. we'll have the management of Mahindra Automotive to talk about the auto sales for the month of May and their outlook going forward. It's the economy. Lata in conversation with CNBC-TV18's Citizens Monetary Policy Committee to discuss what they expect from the RBI later this week. That's the panel.
A lot of stock-specific action to track. Let's run you through our top 10 segment. We're looking at Apollo Hospitals, Vodafone, Nykaa, IRB Infra, and Mazda on Dock. All of them will be reacting to positive news flow. On the flip side, we have Hindalco, Tata Steel, Inox Wind, Dr. Reddy's, and OneSource Specialty Pharma that will be reacting to negative news flow. Let's take that break, come back, get into further detail on all of these names.
Welcome back. So we're gearing up for what promises to be a bit of a challenging start. Asian markets, like we've been telling you, are down, some of them as much as 2.5%. That's the Hang Seng. So what about India in the midst of this global tariff storm? Matt Orton, Chief Market Strategist at Raymond James Investment, is with us in person this morning in the studios. Matt, how good to see you in person.
It's wonderful to see you.
Thank you for coming in. Never a dull moment. So last week we were discussing what are the options on the table, even if the courts try to stall Mr. Donald Trump. And I think he's looking to exercise some of them. So what are you expecting near term? More volatility, but is it still a buy on dips opportunity?
I think so. I'm still quite constructive on where the market goes because we've been able to continually scale this wall of worry. There's been a lot of uncertainty. I'd say this has been one of the most hated rallies that we've had in a very, very long time. And whenever you see a lot of this tariff news come, we know there's going to be tariff uncertainty, but the market is recalibrating to that uncertainty. And when you have a backdrop of really, really strong earnings, good fundamentals, a strong job market in the U.S., and the rest of the world almost bottoming and starting to reaccelerate from an earnings perspective, I think that sets up a really good fundamental backdrop for a rally to continue. So I continue to tell clients, use downside opportunistically, but don't chase the upside because we're going to see a lot of fits and starts to this rally.
Matt, the U.S., what's the view? You know, the consensus still seems to be that maybe money will keep coming out of the U.S. and go into other parts of the world. Would you agree with that? And it's not a sprint, it's a marathon in that sense. What is your reading?
Yeah, you know, Prashant, I think that's a good point. It's definitely not a sprint. And I think where you're most likely to see some recalibration with respect to money coming out of the U.S. is going to be from European institutional investors. So there's been this huge to-do about sell America. And I don't think there's been actually a lot of truth to that. But when you look at European institutional equity investors, they've been very overweight to the U.S. for a long time. And while I don't expect them to sell tremendously from some of their big holdings, the mega cap technology names, I do think there's the possibility for, say, a 1, 2, 3% at the margin change to repatriating those assets back home, especially if some of these tax bills are passed that's tied up in this big, beautiful bill. If that happens and you see that money start to move, that can have a very tangible impact on European equity markets. So that's an area of the world I'm also more constructive on, especially when you overlay that with better fundamentals and a lot more fiscal spending coming from their governments to support stocks.
All right. Hey, Matt, good to have you in the studio, Matt. And you're one of those that I've heard over the last many months who's been very bullish on Indian equities. So where do we stand right now? We have had a good run. I recall when we dipped as well, you said you would be looking to allocate more money. So what do you think? Going by the current valuations, going by the domestic positives that I just highlighted, are you still constructive on Indian equities? And give us a couple of stocks as well. The last time I think you mentioned Jio Financial and Paytm. Anything new?
Yeah, great point, Nigel. I'm still constructive on the Indian markets. I think we might enter more of a consolidation period right now, which is healthy. We've had a 15% rally or so from the bottoms a couple months ago. So that's a really good setup for the markets to maybe take a breather. And as long as you continue to see shallow dips followed by better buying activity, that to me looks attractive. And then you overlay the fundamental picture where you have some of the strongest GDP growth around the rest of the world. That's a really good opportunity with a weaker dollar for money to start moving back into the country. So I have been active on buying some of the dips. My core holdings still remain the same. I still very much like some of the financial names like ICICI Bank, Mahindra on the auto side. But I have been looking more at some of these secular growth trends. How is artificial intelligence being integrated into businesses? How are people leveraging, I'll call it, new consumerism, new trends? Those are global themes that I think are playing out in India. So Paytm is one of those names I like a lot. I think investors think the name's fairly expensive, which it is, but if it can realize some of its growth, I think there's a long runway for further recovery. Some of the names I'm looking at as well that I'm here for the Bank of America conference that I'll be talking to management teams. Infrastructure names like L&T, that one looks interesting. There's been a strong recovery. I've been enthusiastic about their earnings and CapEx and also where they're seeing investments across the GCC. So I think that can be another area of opportunity. And then also looking on the infrastructure side, like in Adani Ports, that name's had a pretty solid recovery. And when I look at the actual fundamentals, earnings have been ticking up. Some of the acquisitions I would expect to be fairly accretive to their bottom line relatively quickly. So I think there's a lot of room to run there as well. So there's definitely opportunities in Indian equities. Again, same as the U.S., don't chase the upside. Wait for that consolidation because there will be opportunities, and these are good long-term trends guiding these names.
Quite interesting. Matt, also, I mean, this week we have the RBI policy, and the broad expectation is that they'll cut rates, and some people say they could cut up to 75 basis points, 100 basis points over the next 12 months, right? You've already liked large Indian banks in the past. How would you look to play this easing cycle in India?
Yeah, this is where selectivity becomes really important because rates coming down could pressure net interest margins for some of the banks. So when you look at a bank like an ICICI, they not only, I think, have strength with respect to their ability to navigate net interest margins based on their loan books and how their deposits are coming in, but they also have a growing private banking business that is higher margin that can offset perhaps some of the weakness you would have from net interest margins. So I like companies that have, I'll say, that balance of exposure and growth to a burgeoning, I'll call it an investor class in India. That's really, really exciting. And you don't have that in a lot of other markets around the world. So that's how I look at the financial landscape right now.
Still liking the big banks like ICICI?
I do. That and HDFC. Those are two of my favorites right now.
Okay. Well, fantastic, James. Thank you very much. Great conversation with you. And, we hope you have a great stay in India. Come back, with lots of ideas. And, of course, we'll keep chatting you once you're done with your management meeting.
Maybe after you do all the conference rounds, we can have you back to get a sense of,
I'll catch you at the conference itself.
Absolutely. That would be great.
Thank you very much, Matt.
Thank you.
What we'll do is we'll take a quick commercial break here. We're going to come back and, I think we have
Top 10 links,
research team standing by. Go on.
Okay, all right. Well, I'll kickstart the action then today because President Donald Trump has gone ahead and announced that he's going to be increasing the tariffs on aluminum as well as steel, which was at around 25%. He's putting it at around 50%. Remember, when it was 25% itself, it didn't make such a big difference to the domestic steel as well as the aluminum players, though Hindalco could be the one that will be signaling out. Let me explain this to you. If you look at steel, the total amount of imports that are imported into the United States is around 28 million tons. That's gross. The net number will be around 16-17 million tons approximately. Aluminium is around 5 million tons approximately. Both those two are gross numbers. What's the fear? Direct impact is very, very minimal because there's very minimal amount of steel as well as aluminium that goes from India to the United States. But if you're looking at steel, then one factor that could weigh is that, there could be some kind of supply and some kind of disruption on that front. And the stock I'll be looking at is Tata Steel Netherlands because it sells close to around 700,000 tons. That's close to around 11% of the steel that it's produced at Tata Steel Netherlands. In the entire scheme of things, it's very, very small. And some part of the steel that is imported into the United States, as Tata Steel has told us, is not produced in the United States. So we'll have to keep an eye out on that. Hindalco, that's the one that could get hit. The good part is the Midwest premium. It was around $500 per ton. It's moved to around $800 per ton. That could move up. The problem is the raw material comes in from Canada. So we'll have to see whether or not there's an exemption. But as per the last con call, they had said that at around 25%, the hit could be $40 million on a quarterly basis of EBITDA. So since it's going to be around 50%, then the hit will be relatively larger. So Hindalco could be the one that gets hit, as of now. But guys, don't rule out some kind of deal before, this gets implemented. So we'll keep an eye on that. Sentiment negative for metal stocks, and Hindalco could be the one that gets harder hit.
All right, Nigel, that's a big story, right? And we'll see how this one goes. Let's talk about Apollo Hospitals, which is the number which came out. And we'll have the management with us as well later. Ekta is here with numbers. Ekta, morning.
Morning. Well, largely an inline set of numbers as the revenue and the margins met estimates. The profit was slightly better. The Q4 occupancy improved to 67% versus 65% year on year. The Q4 GMV for Apollo 24/7 was up 11% to 795 crores. And the 24/7 guidance of break-even is intact, which stands at around Q3, Q4 of FY26. For FY25, the HealthCo and 24/7 margins are 13.1%, but they're expected to rise to 17 to 18% going forward. And for diagnostics going forward, high teen growth in FY26 with 200 to 300 basis points margin expansion expected. So overall, numbers in line and the guidance seems to be quite firm.
All right, Ekta, thanks very much. And that's the conversation coming up. Sunita Reddy of Apollo Hospitals joining us at 9:40 this morning. All right, let's just talk about the next one. Vodafone Idea in focus. Rima is here to tell us why. Rima, morning.
Hi, good morning. Numbers for Vodafone Idea, and it's a muted set. Revenues for Vodafone Idea have declined by 0.9% on a quarter-on-quarter basis, and this compares with about a 1 to 2% growth that peers had. Even losses for the company have widened on a sequential basis and now stand at close to 7,200 crore rupees. The problem is the company continues to lose subscribers. In Q4, the subscriber loss stand at 1.6 million, but for FY25 as a whole, the last 4 quarters, the subscriber loss was in excess of 14 million. The board has also approved a fundraising of about 20,000 crore rupees, which is an extension. They had approved it last year, but they couldn't go ahead and complete the debt fundraising. So that continues. 20,000 crore is what they're raising. Macquarie target price 6.5 rupees per share. JP Morgan neutral. Target price 8 rupees. UBS is more aggressive, and their fair value stands at 12 rupees for Vodafone Idea. But muted set of Q4 numbers, losses widen, and the company continues to lose subscribers.
So existential issues remain around Vodafone Idea. Got it. Rima, thank you very much for that. Let's look at Inox Wind. Vivek is joining in. Vivek, morning. First glance, the numbers look good. You tell us.
That's right. At first glance, especially when you're comparing it on a year-on-year basis in line with its peers, Inox Wind has delivered quite a strong set of numbers. But the one thing that the street will be slightly concerned is the fact that the company has missed its own stated guidance as far as the execution for FY25 is concerned. So that could lead to a bit of tempering of expectations, especially as far as the stock performance is concerned, given the strong outperformance that we've seen. Now, looking at the numbers themselves, the revenue is higher by more than doubled, almost to 1.5 times on a year-on-year basis. EBITDA again 1.6 times on a year-on-year basis. EBITDA margins expanding 19.9 versus 18.7, and profitability up almost 5 times on a year-on-year basis. The order book on a sequential basis has moderated, but the order book continues to remain quite steady at 3.2 gigawatt. FY25 order inflows were at 1.5 gigawatt versus just around 2.4 gigawatt on a year-on-year basis. FY25 execution was at 705 megawatt. The company had earlier guided the street saying that they should be able to achieve 800 megawatt by the end of FY25. So that's a bit of a damper as far as Inox Wind is concerned. However, the company has gone ahead and maintained its FY26 as well as FY27 order execution guidance at 1200 megawatt and 2 gigawatt respectively. So that should lead to a little bit of assuaging of concern. But overall, given the strong outperformance, expect some tempering as far as the stock rally is concerned today.
All right, Vivek, thank you very much. And we'll keep an eye. Now, the next one is interesting and I think will be widely watched in the pharmaceutical space here. Dr. Reddy's and One Source Specialty in focus. Ekta is here to tell us why. Ekta, morning.
Morning. Well, there is a court case, and what has happened because of the court case is now that it's public knowledge that One Source is going to be a supplier for Dr. Reddy's when it comes to semaglutide. But now on to the court case. It's the Delhi High Court has basically restrained Dr. Reddy's and One Source from selling semaglutide in the domestic market. This order is in lieu of a patent infringement suit which was filed against Dr. Reddy's and One Source by Novo Nordisk, which is basically the patent holder of Wegovy as well as Ozempic. Now, Novo Nordisk alleged that Dr. Reddy's and One Source are importing large quantities of semaglutide API into India to manufacture and export formulations, and this is basically not allowed by the Indian Patent Act. The court has not, however, barred these Indian companies from manufacturing and exporting the drug. The next hearing is on August 19th. Now, like I mentioned, a couple of key things from this is that One Source is now a known supplier to Dr. Reddy's. We do understand that One Source is supplying to 20 plus companies. So though, the news is negative, there's a possibility that the stock could probably be in the green because of the kind of potential and the kind of partners that they have for semaglutide. Dr. Reddy's and One Source are now still allowed to manufacture and export the drug. So Canada is one of the biggest markets which is going off patent in Jan 2026. So more than the domestic market, the street is probably going to be looking at the potential for the Canadian market, and hence that is going to be that's going to continue in terms of manufacturing. So that could still be a positive.
Okay, all right, got that. Ekta, thanks very much. Very interesting developments there. We'll watch out for Dr. Reddy's. Back to some of those last earnings of the season. Mangalam's here with Nykaa. Mangalam, is it looking pretty?
It is looking pretty. I'll tell you why. Because this is a sector which has been parched for growth, and in that we have a company which is literally glowing, and the pun is unintended out there. A 24% revenue growth that the company has reported at around 2,062 crores on the top line. Margins have increased by about 90 basis points as well. 5.6% has turned to 6.5%, which implies a 43% growth in the EBITDA. And the net profit on a low base of 9 crore has jumped over 120% and is now at around 19 crore itself for the last quarter. What is the segment that did well for them? It's the beauty segment, which led from the front when it came to growth on the revenue, 25% jump in the revenue and 40% jump in the operational performance. The segments that are doing weak for them, fashion, that continues to grow slower than the beauty vertical, and the EBIT losses also increase. So that is a bit of a pain point for Nykaa. Let's see whether the company comes out of that or not. The others, which is their wholesale business, etc., is consistently doing well with a 150% jump in revenue. And because this is a business which is an investment phase, the EBIT losses continued, but they've narrowed considerably as well. So beauty doing extremely well, firing on both the engines. Until that happens, I think the street will like these numbers. The stock is down 15% from its 52-week high. So see some green on Nykaa today.
All right, Mangalam, thanks very much for that. Now, IRB Infra is the next one we want to focus on. Vivek is here with numbers. Vivek, morning.
That's right. Good morning. So two stocks on the radar. The first one is IRB Infra, which houses the private InvIT of the group. And the second one is the listed IRB Infrastructure InvIT, which is a publicly listed InvIT platform. Now, what is the development that's transpired over the weekend? IRB Infrastructure Trust, part of IRB Infra, has gone ahead and signed a binding term sheet to sell 3 highway assets, and this is to the Public Infrastructure Trust. The enterprise value for this particular deal has been pegged at 8,450 crore rupees. The equity value of the deal is at close to 4,905 crore rupees. The 3 highway assets are Hapur, Moradabad, one in Rajasthan, and the other one at Gulabra. And the assets comprise of a total of 1,800 lane kilometers. So what is it that IRB is saying? How will they utilize the proceeds that they will receive from the public InvIT? The sale proceeds of a little over 4,900 crores will be redeployed towards asset addition of 15,000 crores. Now, just looking at the valuations of the deal, the gross gross toll revenue in FY25 for these three assets was at close to 690 crore. And remember, the remaining life for all of these assets is at 19 years. So the transaction works out to an EV to gross toll revenue, if you're looking at it on an FY25 basis, at 12.3 times, in line with most of the deals that take place in this particular space. The transaction increases the life of IRB InvIT, the publicly listed transform, which currently just had 12 years of remaining life. So that visibility increases. On the other hand, IRB Infra benefits from growth capital that it receives from this particular asset sale.
All right, got it. So we'll keep it on the radar. Vivek, thank you very much for that. Let's now go to RIA to understand what Mazagon Dock said in its conference call. Remember, the stock was hit hard. It was down 10% up numbers on Friday, RIA morning. So what's the takeaway from the conference call?
Good morning, Surbi. So let's take a look at what they've said in the conference call on Friday. First up, they've said that the margins in Q4 were impacted because of higher provisions undertaken for two major projects, which had a total order value of around rupees 3,500 crores. Now, going ahead, they are going to reassess these provisions each quarter, and they will either reverse these provisions or possibly increase these provisions going ahead. Coming to the outlook for FY26, the PBT margin guidance stands at around 15% for FY26, and they're also expecting an 8 to 10% revenue growth, which is subdued compared to the 20% growth that we've seen in this year. Coming to the orders, though, here's where the commentary is very strong. They're expecting these P-75 additional submarines and P-75I submarine contracts to be signed in FY26 itself, and provided both of these contracts come in this year, the order book will reach more than rupees 1.25 lakh crores compared to just about rupees 32,000 crores that we've seen in this year. So the order book will possibly go up by around 3.8 times in this year. So expecting some recovery on the stock based on this.
All right. Thank you very much for that, Ria. Well, let's just quickly recap the top 10 stocks here. So stuff on the positive side are Apollo Hospitals, Vodafone Idea, Nykaa, IRB Infra, and Mazagon Dock, shipbuilders. Well, stocks with some negative red tinge are Hindalco, Tata Steel, Inox Wind, Dr. Reddy's Laboratories, and OneSource Specialty Pharma. Let's talk about the commodity pack as well. So from a stock market perspective, I think Nigel highlighted what's happening with these tariff threats. But underlying base metals, what's happening? What's top of mind? Manisha, morning.
Morning, and thank you for that, Prashant. Well, I'll start with the metals itself. And we've seen a smart rebound come in for the copper prices, not so much for the other metals, but copper and steel, which the markets are looking at right now, clearly have seen some gains continuing into the markets right now. Apart from that, it is the crude oil prices after 2 weeks of decline. Today started with almost a couple of percentage points of gains coming here. The markets are reacting to the OPEC and allies meeting, which was on Saturday, where they have decided to increase production by 411,000 barrels per day in the month of July. It is slightly on the higher side, but it is as per what the street was anticipating. So there were no surprises there, is what has led to that rally come in for the markets there. Same is the case for the precious metal prices also, where we are trading with gains right now. Last week wasn't so great. We saw gold prices go down by 2%. Silver was down 2.5% as well. But for the month of May, both the precious metals have been on the positive side. There is now renewed uncertainty on U.S.-China trade policy. The Federal Appeals Court also has temporarily reinstated Trump tariffs. So all of this seems to be aiding buying in many of these tangible commodities. So a start to a very strong day, by the way. So whether it's energy, precious metals, base metals, all of that trading in the positive.
Okay, all right. Got it, Manisha. Thank you very much for that. So commodities on our radar. We need to take a quick break at this point. We'll come back on the other side. We'll, of course, get down to fundamental stock ideas, some, unique names to focus on today. Prakash Diwan will be with us. And, of course, talk about the good macro cues we've got from the Q4 GDP print.
carefully.
Okay, welcome back. I think we're going to start slightly lower, neither here nor there. But there's good news, and the good news came Friday evening. India's GDP, fourth quarter GDP came in higher than expected, 7.4%. The full year GDP is coming in at 6.5% versus CNBC-TV18 poll of 6.3%. The stronger number has led the market to worry that the RBI may cut rates by only 50 basis points compared to 75 basis points is expected by the market. Well, there's always that. Lata is here with the fine print of the numbers. Lata, morning.
Morning. Well, first up, yes, the expectation for Q4 was 6.85. It came in at 7.4. Full year expectation 6.3, whereas it's come at 6.5. So all that's very good. But you really shouldn't be looking at GDP because there is a huge indirect taxes component, indirect taxes minus subsidies. So that distorts the picture. If you look at the GVA, that also is very good. So even if you, net out the indirect taxes, the expectation was 6.5% for the fourth quarter, and we've done 6.8. So that still looks like a very good number. And within that, the internals, agriculture, construction, all these things, items that have done well are also employment-heavy sectors. So exports again. So it looks like, a larger number of people benefited from the growth number as well. Capex, as you all pointed out, at 9.4% in Q4 is positive. But looking at all this as well, there are still some signs of weakness. See, consumption has grown only 6% in the fourth quarter and 6% in the full year. It's not even in pace with the overall GDP growth, which is why FMCG companies have been complaining that urban consumption is stagnating, and there is no reason to believe that, the Q4 numbers will change their mind. Again, private capex is under pressure. That big capex number is because government invested hugely in March. The March government capex number was so large that has pushed up the number. It's not a private capex effort. And as you go forward into FY26, there is tariff uncertainty, which will mean no CEO will really want to put money when you're not sure whether you will be able to export, how cheap will be the imports. So all that is a problem. Capex, again, could take a little bit of a hit because the fiscal spend is going to go down because the deficit has to come down. So if you keep all this, the FY26 picture is still subdued, which is why I have not got a single economist report who has upped the FY26 number because of the strong FY25 number. I'm just running the numbers for you. Look at that. Goldman Sachs 6.2, Kotak 6.2, ISEC PD 6.3, MK is only 6%, and SBI has a larger range of 6.3 to 6.5. But as you can see, all of them are expecting a softer FY26 compared to FY25, even with that surprise. So I think the Reserve Bank call is not over. Although the market on Friday pushed up yields, fearing that the end repo rate will not be 5.25 but 5.5, I think there are people who will still tell you that no, 5 is still possible.
And this Friday, at least 25 bips.
This Friday is 25. There's only one person in our vote, SBI, who said 50 for even this. But the majority is going with 25. And that, I think, is consensus.
Okay. All right. So let the rate cuts continue. I think that's the call. Thank you so much for that, Lata. Good to get that understanding of the GDP data. Let's quickly move on and welcome our fundamental guest on the show today. Prakash Diwan is joining in. Prakash, good morning and happy Monday to you. Lots to discuss. Auto sales, last of the earnings, the good tailwinds from the GDP number. Actually, let me start with some of the earnings. Let me take up Nykaa with you because Nykaa's numbers look good finally. Do you think there's appetite for these new age platform companies? How do you find Nykaa at current valuations?
Good morning, Shubhi. So, no, I think there's this very clear turnaround in terms of path to profitability and the approach to the business itself. For most of these companies having done enough mistakes, vis-a-vis what the street expectation is. But is Nykaa part of that list in terms of turning around? I think it still needs more time. If you really see what's any of these new age companies where opportunity exists from a defined trajectory on this turnaround, why not a Zomato? Why not a Paytm? These are companies which very clearly have demonstrated that the change is irreversible. Nykaa still needs to the same thing happened with Mama the other day. You had good numbers, but you couldn't sustain. So that's the whole challenge. They'll have to actually establish the trajectory unequivocally, and then probably the market will start wanting to kind of put something. I mean, things have improved, margins have improved, but then they still need to relook at the business model. Why, carry the burden of fashion when it's not doing well for so many quarters? So there are lots of questions that they probably have answers to, but we'll get to see that on the ground and then look at it. But not too excited to buy into it at this point in time.
No, absolutely. Got that. By the way, Prakash, quickly, if you can run us through this. If you've seen the news flow, Ekta highlighted that Dr. Reddy's and OneSource around semaglutide.
Yeah.
That case. Any thoughts there?
No, I think OneSource has been a developing story, if I may use one of your terms, in that sense that it always held a lot of promise, given how it started off and branched off and on the market as well, the way it's been creating its trailblazing kind of moves. I think this verdict actually establishes a lot of things, keeps everything, all the doubts away. And semaglutide as an opportunity is something which, whichever way companies participate, is going to be promising enough. So I don't think these restrictions will not allow them to export. And there's a massive market overseas which they still have accessible. So I am quite positive on that. OneSource Specialty also has other things than this that are very positive. So take a look at it from a constructive two-year perspective. It could definitely surprise the market.
Okay, so that's on Dr. Reddy's. Prashant, just hang on for a second. Need to run through the auto sales, the numbers that we have so far. Then we'll ask you for your take. We have Sudarshan joining in, and the leaders continue their good form. That's the story so far. Mahindra and Mahindra, TVS, again, good numbers coming in, but Sud has all the details. Over to you, Sud.
We still have few companies to report auto sales for the month of May, but companies which have already reported sales, and for them sales are looking largely better than estimates, starting with M&M. Both auto and tractor segments have reported sales better than estimate. Total sales for auto segment were up 17%. SUV sales were up almost 21%. And as far as tractor segment is concerned, here total sales have increased by 10%. Also, companies saying that considering early advancement of monsoon, sales for coming months also are going to be healthy. Coming to Tata Motors, it continues to underperform the peers. Even for the month of May, sales were below estimates. Here, total sales have declined 9%. Domestic sales have slipped 10%. Also, PV sales have fallen 11%. And even CV sales were down almost 5%. Coming to two-wheeler companies, two companies that have been outperforming for the last few months. And even in the month of May, these two companies, TVS Motor and Eicher Motors, have outperformed. So first, talking about TVS Motor, here healthy trend continues. All the segments have registered growth of more than 14%. Total sales were up 17%. Two-wheeler sales have increased by 16%. Even export sales were up 22%. And EV sales were up 50% year-on-year. But for EV sales, companies saying that considering the disruption in the supply of rare earth magnet in near to medium term, EV sales can be impacted. Coming to Eicher Motors, again, here also sales were better than estimate. Royal Enfield total sales were up 26%. And sales for engine capacity up to 350cc. Here sales were up 28%, and above 350cc capacity sales were up 16%. Good part for Eicher Motors is contribution of export has been increasing for the last few months, and even in the month of May, export sales were up almost 82%. One company that has been underperforming is Hero MotoCorp, and even in the month of May, sales for Hero MotoCorp were below estimates. It has seen low single-digit growth for all the segments. Total sales were up 2%. Motorcycle sales have increased 1%. Domestic sales were up 2%, while export sales were flat. So, barring Hero Moto and Tata Motors, all the companies which have reported auto sales for the month of May so far have been better than estimates.
All right, got that. Sudarshan, thanks very much for a neat wrap-up of all the numbers that we've seen so far. Prakash, so open-ended question. I mean, do you see any turnaround stories here, maybe in the PV space beyond Mahindra and Mahindra from a stock buying perspective, beyond M&M, anything else you're looking at?
So, the PV space is anyways very small, given the kind of option that you have. But I would believe Tata Motors, while the numbers have not been very encouraging, could probably see a turnaround because their strategy is to bunch up some of the models that they're launching, the EV launches, and the Harrier is on the anvil. It is likely to kind of, open up a very different segment, better price point, better margins. So things could probably look up, Sudhir, for them as well. Whether you would buy the stock would also depend on a lot of the global cues, which they are more subjected to. But play safe. M&M still has its salience that's unveiling itself. I don't see why that would not kind of deliver the goods. So it's a bet that you would need to kind of take. Look at ancillaries from what numbers are telling you. The next 6 months are going to be very positive for ancillaries. So we'll discuss it at some point. But to answer your question, not buying anything afresh beyond M&M, but I would look at ancillaries very actively in some time.
Give us a name, since you're saying the auto ancillary space. One or two names?
Yeah, so there are lots of them which are positive. But look at a small company like Suprajit. There's something like Talbros. Even a large one like Samvardhana. The other day, the management was on the channel talking about the plans, and things look quite positive. So the reason is different, of course, because it's a global shift that's likely to happen where ancillaries are not as badly impacted as what we thought earlier when the tariff war started. So things could start kind of reviving themselves, and the sales generally, by and large, for most of these companies, the OEMs, have been fairly better than what most people penciled in for FY25 also.
Sure. All right, got that. We'll need to take a very quick break, Prakash. Just bear with us. Take that break, come back, and then technicals as well. Very, very important trading calls coming up with Darshan Sukhani and Mitesh Thakkar in just a bit.
Difficult.
Welcome back. 8 minutes to go for the pre-open session to kick off. We're done about 40 points. Let's get a technical setup going with Sudarshan and Mitesh, who are with us with a sense of what you need to do. Gentlemen, good morning. Great to have both of you here. Mitesh, how are things looking? How are we set up? I mean, last 2 weeks, large cap indices have been consolidating. Broader markets have moved on.
Morning, Prashant. I think, I've been calling for consolidation given the fact that a lot of indicators have turned sideways after that big rally. And therefore, last 1.5 to 2 weeks, the market has, not done much, but been in a range. I think that might continue. What could be the first signal on the upside is the bank Nifty, sustaining above 55, 600, 700 zone this week. I think could suggest that the banks could see a breakout and therefore some kind of positive bias over there. If that happens, then the Nifty will also be positively biased. But that is something which we'll know in a day or two. But yeah, above 55, 600, 700 zones, if we can sustain for a day or more, I think then we are looking at 56,400, 500 in the bank Nifty. But on the Nifty, I think it still looks like a range of about 500-600 points, starting from 25,050 to about 24,550.
Okay, all right. Got that, Mitesh. Sudarshan, morning. Let's get your sense as well. Market's been consolidating. Index hasn't done anything. Do you expect that to change? And do you have a trade either on the Nifty or the Bank Nifty?
Yeah, good morning. See, the index has been moving in a trading range, so it has actually done something. It is telling us that there is no view. Marketmen do not have a view on the index as of now, and that is what we have to understand and follow. It's a wide range, 500 points. So it is not as if you can expect an imminent breakout. Now, anything could happen, but I don't think today is the day when we see a breakout in either direction. That means the Nifty is not giving us a sense of direction. It is moving inside a range where it does not know which way to go. That's a difficult day to trade. That's a difficult period to trade. So the only trade is, because we have seen some rallies, if we see a dip towards the lower end of the range, let's say 24,500 to 24,600, then it's worth buying with a tight stop under 24,500. But that's a big if it comes there, and then we can buy and then keep a stop loss. If it doesn't, I think we should just step aside. That applies to the Bank Nifty. The Bank Nifty has been outperforming, but I do not think it will go away from the index. So for both indices, the trade today is best not to do anything.
Okay, don't do anything. That's the best trade. Got that. Let's also discuss stocks, gentlemen. Mitesh, morning to you as well. What about the stock list today?
Yeah. So I have a mix of buys and sells today. Good morning, Survi. On the buying side is Bank of India with a stop at 119.75, look for targets of 127.5, and Glenmark had some kind of a big move, so buy here with a stop at 1435 for a target of 1500. On the sell side is Asian Paints, keep a stop about 2280, look for targets of 2220. And NTPC is a sell with a stop at 338 for targets of 325.
Okay. And Sudarshan, what about stocks for you?
Well, I still have an all-buy list because there are mid-caps and small caps and even some large caps which are doing all the right things on the chart. So maybe the Nifty correction, the pause we are seeing in the Nifty could only be a correction rather than another decline. That's because of the stocks. State Bank is a buy with a stop under 797. Pidilite Industries is a buy with a stop under 3062. I also have Glenmark, as Mitesh had. It's a buying opportunity with a stop under 1432. And finally, Berger Paints is a buy with a stop under 556. So stocks are mainly for buying.
Okay, stocks are mainly for buying. We'll take a quick commercial break now. I think there's 4 minutes to go for the pre-open session. Sudarshan and Mitesh, thank you very much. We'll speak again in about 10-15 minutes' time. We'll take a quick commercial break here. We're going to come back with the pre-opening rates. We'll also have Sachin Salgaonkar of BofA Securities from the sidelines of their India conference on what his ideas are as far as the telecom space is concerned. Nigel is at the conference and he'll take that conversation forward. We're back in just a bit.
Welcome back. 15 minutes to go, and we are looking at what potentially is going to be a bit of a gap down morning. Just checking the Asian indices again. Let's actually look at that picture, because the last time we checked, some of those regional indices were down quite a bit, and they still are. I mean, the Japanese market is down 1.5%. The Hong Kong market is down about 2.5%. Remember, mainland China is not trading, so that's shouldn't be looking at those rates. They are shut. That's the picture, and we are preparing for a gap down. Actually, on these tariffs, Prakash, Nigel was just telling us before he left for the conference that, Hindalco perhaps could be even harder hit because of Novelis and what happens with operations there. And then, there's Tata Steel. Directly, India doesn't export too much to the US. But there could be second-order impact. And these metal stocks were doing quite well, actually, last week, because the global-facing sectors had a sigh of relief. What would you do with metals?
I think that becomes an opportunity to buy. I mean, see, these tariffs do come with a little bit of indication that there's no sense of permanence. They're just negotiating tactics. They're more work in progress. My sense is Hindalco will get impacted, because out of the aluminium producer, that's the only one that does have some sort of an export, and they've indicated about a 40 million kind of a hit. But then, in the larger scheme of things, there's enough demand for aluminium domestically and in other markets, other pockets. I don't see any reason why that would upset things for a longer-term perspective. So there'll be a blip, but that's an opportunity to buy, in my view. Hindalco is absolutely very strongly poised for so many other factors, and we've discussed this in the past. So I'm quite positive on that. But this becomes an opportunity to buy for long-term investors.
Okay. All right. I'll watch for that. By the way, Prakash, there are two listings today as well. Yes. Leela Hotels and AG's Vopak. Both interesting businesses. Did you like any of these issues?
I think AG's Vopak is interesting. It's a nice, small business in a niche which is not easy to kind of see many players come into. My sense is, given where we are in the global, setup on exports and the way things are looking up for us as an economy, that's a place to be. But Leela, of course, not taking away the fact that it's a great franchise, but you have many more choices out there, as you would know, even within the listed space. In fact, I was quite surprised when I was studying Leela. In the listed hospitality sector, there are more than about 18 companies to choose from. So that's quite interesting. But I'm not a big IPO fan, so I always like price discovery to be more established, more mature before buying anything from a longer term perspective. I'm no hurry to buy anything that you would have to kind of do it on day one. But I'll wait for the listing to happen.
Okay. All right. Got it. Thanks very much for that. Well, as promised, now let's head across to the Bank of America Securities India conference. We have Nigel on ground there, and I think he has with him the firm's APAC region senior analyst for telecom, media and internet, Sachin Salgaonkar. This promises to be a very interesting conversation. Nigel, take it away.
Well, that's right. Thanks a lot for that. I am here at the BofA Securities Conference. And as you said, I have the one and only Sachin Salgaonkar with us. Hi, Sachin. Good morning. Good to have you on the show. And all the best for the conference. Let's focus on three aspects out here. We'll focus on telecom. Then we could maybe touch upon how you see quick commerce pan out. And also basically travel. Let's start with telecom first up. The smallest player among the three, they believe that the prospects are improving. However, the government has been clear with regard to their stance on the AGR dues, as the Supreme Court has been clear. What is your view with regard to how do you see things panning out? Will it be a duopoly market, or do you believe all three players will continue to survive in this market?
Thanks so much, Nigel. In terms of your first question on telecom, look, we do see a scenario where three telcos do exist.
Okay.
For a simple reason that it's very difficult for a telco to go down. Generally see most of the markets in the world, third telco, even with a lower market share, continues to survive. That's because consumers are a bit lethargic. They don't leave the telco. And plus, at some level, there is an indirect help which is coming from the government to the sector, where it doesn't want the sector to turn into a duopoly. Simple reason for that, if a sector turns into duopoly, then at one level, the two telcos may not be able to handle the load of all the 200 odd million users who are, let's say, with the third operator.
Yeah.
And that leads to a cascading infrastructure failure in India. Now, the derivative effect of that is UPI, right? We all know UPI in India literally is working on mobile. Yeah. So if the telco infrastructure crumbles, then it has a negative impact per se out there. Okay. So that's why we are optimistic that India will continue to remain more like a 3 telco player market.
Okay.
The fundamentals of the sector are good. You should see tariff hikes happening out there. And on the back of it, you do see cash flows for the sector improving.
All right. So let's touch upon then the tariff hikes. What kind of ARPU increases are you working with for FY26 and FY27? If you could quantify it.
Yeah. Let's, before answering that, look at how tariff hikes have happened in the past. In the past 6 years, there were maybe 3 tariff hikes. And tariff hikes don't happen every year.
Yes.
So it's not correct to assume that tariff hike is going to happen in this fiscal. We are working with the assumption that tariff hike is going to happen next fiscal, not this fiscal. Having said that, the ARPUs will continue to increase for 2 reasons. Number one, clearly there is a base effect which is moved up. And for some operators who have consumers not on a 30-day pack, but on a 6-month or a 12-year or more like a 12-month pack, you do see the benefit of the last tariff hike is yet to fully come into the numbers. So that should lead to an ARPU improvement. Second, this entire natural upgrade in terms of prepaid move into postpaid or feature phone move into smartphone also adds more like 2 to 3 rupees per quarter, which is roughly 12 rupees. Combination of that, we should see more like a 12% increase this year.
Okay.
And with a tariff hike increase, we should see more like that going to in the range of 18 to 20% next year. Now, another point I want to also flag is look at the magnitude of tariff hike. There's a bit of a base effect. First tariff hike, 40%. Next tariff hike, 25%. Last tariff hike, 15%. So generally, one should assume that the next round of tariff hike may be 15% or lower than 15%.
Got it. All right. So low teens in the coming year and then high teens in the following year in terms of an ARPU increase. Got that. Let's focus on the tower business as well. If you're going to have 3 players, what are the prospects of the listed player? Indus Stars. How do you see things panning out? It's got very high institutional ownership out there. So your take, valuation-wise, if I look at it, the company that's listed here, Indus Stars, in comparison to the globe, well, valuations look pretty okay. The problem is, in terms of the clientele, in terms of how do you see things pan out? Your take.
So I think there are 3 specific things one need to look from a valuation perspective. Number one, number of telcos, number of tower operators in the market. India is a unique case where there are 3 telcos and 3 tower operators. So clearly that means your tenancies are not going to improve in a meaningful manner.
Okay.
That gets reflected into lower multiples. Number 2, I would say the ownership structure. In terms of the tower company you're talking about, and look at the example of what is happening in China also. When the biggest shareholder is also the biggest customer, the market gives a lower multiple to these kind of companies. So versus a global average of 20 times, you do see India tower companies trading in the range of, maybe 5 to 6 times.
Okay.
In fact, India is the only unique market in the world where a tower company trades at a sort of a discount to telco.
Right.
And the third point is where we are in terms of cycle, in terms of capex. So clearly 5G capex, a large part of it is done for India. 6G is some years away. So you don't see that capex upcycle also, and hence from an incremental growth perspective for a tower company, you should not see a strong kind of a growth out there. And also one could assume that the growth slows down going ahead for a simple reason. In the world of 5G, you don't need the traditional ground-based or rooftop towers. You actually need small cells. And small cells are the ones which are not rolled by tower companies, but by telcos.
Okay.
So that kind of a growth is not what a tower companies will capture.
Okay, all right. So you believe that the multiple that it's getting is justifiable in terms of a discount to the global peers. Got that. Let's move to quick commerce then. The competitive intensity, that's something we keep hearing. How do you think our players, are, the listed players are doing currently? And what kind of competitive intensity do you believe? Is it a real threat to the incumbents?
Yeah. First of all, India is one of the unique markets in the world where quick commerce is picked up. And obviously, when you see quick commerce picking up also in terms of unit economics, clearly it encourages competition. So what was a 3-platform market is now turned into 7-platform market.
Yeah.
The e-commerce companies, the traditional retail companies are also sort of, entering into the space. And Nigel, it's very logical to assume that, hey, if I'm incumbent, and the way to find an incumbent platform is to come into that area and give discounts. So as and how you see each platform coming and launching service in a particular area, the only weapon they have is discounts.
Yeah.
And as an incumbent operator, if I don't want to lose users, I'll also respond in terms of giving discounts.
Yeah.
So on the back of it, you do see a phase of a slightly high competitive intensity. When should it normalize? Honestly, no one knows, but our guess is it should be in less than 12 months for two reasons. Number one, most of the players in the space are listed, so you are answerable to your shareholders. So as a result of which, you can't make investments where you don't see ROI from that perspective. And second, more importantly, at some level, people will realize that, hey, where they are gaining traction, where they are not gaining traction. And basis that, they'll take a call where you want to sort of, double click and where you want to pull out of.
Yeah.
So on the back of it, you do see a natural consolidation playing out. We saw it in different sectors also. We saw in food delivery, we saw in the ride hailing, even telcos. So clearly at some level, and higher the competitive intensity, the faster the consolidation, or at some level, less number of players in the sector.
All right, very quickly then, we have just done with the earnings season. Lot of travel theme is what we heard out. And we spoke to Mr. Puneet Chatwal of Indian Hotels and other hotel companies. They are sounding gung-ho about the way ahead. You track a couple of them. I think Make My Trip is one of them that you track. What do you think about the, current travel cycle? That revenge travel seems to have played out post-COVID.
Correct.
But how much more of a, pathway do we have ahead?
A great question. I think a simple way to think about it is this is where we consider a theme coming out of India. India is at a point where China was 6 to 7 years back, wherein the Indian consumer is getting richer. She's been encouraged to travel internationally by multiple countries giving a sort of a visa on arrival. And you have multiple low-cost carriers which is connecting India to multiple destinations. So consumer is looking back and saying that, hey, why should I go to Goa when it's cheaper to travel to a Vietnam or, to that matter, Thailand and so on and so forth. And this is an Instagram culture, right? So we want to travel and we want to post pictures on Instagram. So clearly on the back of it, and especially the Gen Zs and millennials are the ones which are sort of traveling.
Yeah.
In fact, an easy stat is what an Indian consumer family was doing before COVID was more like 1 trip a year. Now that 1 trip a year has been turned into 2.5 trips in a year, where 1 trip is more like a short haul and 1.5 trip is a long haul. And we have OTAs which are telling us that the Gen Zs and millennials are even traveling 6 times or 7 times in a year. So definitely travel as a theme is here to stay. In fact, two simple points also to flag. While we are seeing consumption slowdown across the board, travel is one area where you're not seeing a consumption slowdown. And second is a data point which is coming from China, where in China, which was going through a slowdown phase last year, everything slowed down except travel. Because people want an escape from reality. So people want to travel. So on the basis of it, we remain positive in China. This entire so-called international travel theme continued for 7 years. We are also optimistic that in India it will continue for 5 to 6 years.
Well, Sachin, great conversation. Thanks a lot for speaking to us here on CNBC TV18. I'm a little worried because ARPUs are going to go up. You're saying that, at least 2.5 travel plans in a year, at least 2.5. So it's going to be on us. But great hearing your thoughts.
Sure, Nigel, you can afford it. So thanks. Great having you.
Thanks a lot for joining in. Well, guys, that's it from Sachin. He's given us his views on the telecom space, the quick commerce theme, as well as he believes there's a good runway with regard to travel as well. Back to you guys in the studio.
Thank you for that, Nigel. And very interesting. He believes that the telecom market is not going to turn into a duopoly in India. It will remain a 3-player market. So let's see what happens on that front. Interesting conversation. Thank you very much for that. Quickly, just checking where the market is after the pre-open. So 81 points down. That's where the pre-open has settled. In step with the kind of weakness we're seeing across Asia. Let's quickly go back to our technical experts with some idea. Sudarshan, what's the 9-10 call?
Well, it's Berger Paints. Buy Berger Paints with a stop under 556.
Okay. And Mitesh?
I'll go with the sell on Asian Paints for targets of 22.20.
Okay. All right, gentlemen. Thank you very much for that. Let's also revisit some stocks that are going to be on our radar today. Nykaa is definitely one of them on the back of the numbers that came through. Mangalam, let's quickly recap how the performance was.
Performance, 23.5% growth in the revenues. That implies about 2,061 crores is what the company's reported for the fourth quarter in terms of a top line. EBITDA grows 43%. That implies a margin improvement of nearly 100 basis points. And the net profit on a low base increase from 9 crores all the way up to 19 crores. So that's a 110% jump out there as well. The business was led, as the company had guided in their fourth quarter update, by their beauty business, where a revenue jump of 25% led to an EBIT jump of 40%, and all of that has powered the overall business. Fashion, which was supposed to grow faster, over the last few quarters has continued to grow slower, and that continues this time around as well. 10% growth in the fashion vertical, with EBIT losses expanding from 29 crores to close to 36 crores. The other businesses, that is wholesale, B2B, wholesale and superstore, all of that continues to do well. But remember, that's on a low base. And secondly, it is still in an investment phase, so makes EBITDA losses. Beauty business firing on both engines. The stock 15% away from its 52-week high. See some green in Nykaa today.
Well, Nykaa in focus, and I think the market's in focus as well. 80 lower on the Nifty is what you have. The Sensex is down about 236 odd points. So just about starting, we'll get the big prices, the headline prices, and then we'll go into individual names, individual stocks, etc. So about 1/3% lower on the Nifty, 24,667. The Nifty Bank is down about 0.19, 55,642. The Sensex is down about 1/3. And the small cap index, the small and the mid cap indices, by the way, were up 1.25% and 1.5% respectively last week, Friday to Friday, even as large cap indices were flat. So that's the part of the market to focus on. Small cap index is flattish, nothing on it, and I think the mid cap index will come up on your screens, which will show you where we are at. The mid cap index is down about 100 points, 0.2% lower. So 24,633 is where the Nifty is starting out at. The heat map, the Nifty heat map up on your screen, about 25 odd names are higher. Everything else is starting the day in the red. Surabhi.
Okay, so 120 down on the Nifty, and right now the mid-cap index is fighting back hard to try and at least remain flat. Best case. Let's look at the large cap losers. Apollo Hospitals actually is doing very well on the back of earnings, and remember, we'll be talking to the management in just a bit from now. Lever, Tata Consumer, these are some of the other names that are finding traction. Little bit of a green on Eicher Motors, about 20 bucks higher on Eicher Motors, but then it fizzles out. Let's look at the weakness. It's metals all the way. Those steel and aluminum tariffs going up to 50%. Hindalco is down 1.5%. Tata Steel, JSW Steel. Remember, these companies don't export a lot of metal to the US. But then the second order impact, trade disruption, demand disruption, that's all weighing on sentiment. Tech is also weak. Infosys, HCL Tech, Tech Mahindra, all these stocks are down. Tata Motors is down. It's been another weak month for the company. Sales are down for their CV business as well as their passenger vehicle business. What else? Bajaj Finance, Jio Financial, L&T, Maruti, everything is lower actually. And the banks are not much of a comfort right now. HDFC Bank is about 1% lower. ICICI Bank is down about 0.3%. And State Bank of India is very flat, 0.2% lower. So let's see. Those are the early trends for the time being. By the way, since we're talking about some of the stocks in focus, Masgao Dock, remember there was a conference call. I don't think it's entirely helped matters. Stock is again starting 2% lower. Market not entirely convinced. There were some more names. Nykaa, we were just discussing. The numbers were good, but the market's mood is off today. So 2.5% lower on Nykaa. TVS Motors, good sales numbers, but the stock is quiet this morning. This is after the May sales numbers. Inox Wind is reacting well to the P&L update came in the fourth quarter performance. Those are the early trends. But Prashant, unlike most of last week, I mean, this morning we're seeing some pressure even on the mid-cap index, at the index level, that is.
No, absolutely. And we'll see. When we had weeks of outperformance, right, Surabhi? So I think at that margin, there is that as well. By the way, the Nifty support is 24,692, which we put out. That is the first one. That is a 20-day moving average. That is gone straight away. The next one is 24,462. That is nothing but the low that we saw on the 22nd of May, the swing low, and then the market bounced very sharply from there. That is still some distance away. That's about 100. So, 100 gone to the 20-day moving average gone, and then, 100 more to go for the swing low support, which is 24,462 at this point in time. The Nifty Bank will also come up about 0.4% lower. That's 250 points in terms of a cut. Here, the support stands at 55,096. So we are about 0.75 odd percent away, 0.8% away in terms of the first support for the Nifty. We've kind of stretched and moved, and especially the broader market done very, very well. So must remember that. Niva Bupa, I'm not sure if we highlighted. Niva Bupa is the #1 volume-led loser right now. It's a 11-12% cut on it. 77 million shares, and I think, of course, there's that block which has gone through. Emphasis is down about 5%. Emphasis 24.32 or so on that one. Swan Energy is down about 4%. Zentech, big move of 2.5% lower. There is Indocount Industries, which is coming up with a 12% cut this morning. Again, doesn't come up with volumes at all early on, but it is today, and that's why I'm mentioning it. It's got over 500,000 shares already traded. And a name like Nibe, which is, of course, it's had a one-way move over the years, but Nibe is now down 5%. I think they tied up with an Israeli company in defense, basically. So that's something else which is coming up right now. All right, we'll... sorry, Surbhi.
No, I just wanted to add that in a market which is otherwise down, almost 200 down on the Nifty, the one trend that's building is some sort of a move towards FMCG after a long time. I think this is also anticipation. There's a lot of chatter about maybe finally sales volumes picking up. Look at Britannia, look at Godrej Consumer.
Yeah.
These are the stocks. So consumer is a very... Look at Lever itself, up about 1.5%. So in a weak market, Tata Consumer, Nestle, FMCG is the only green flag for the morning.
Yeah, absolutely. Let's welcome in Pankaj Tibrewal, who is now with us, founder and chief investment officer at Ikagai Asset Managers. Pankaj, good to have you with us here. Good morning. Thanks very much. You've, of course, you turned constructive. The market has become quite constructive as well since then. Where are you at now, Pankaj, in terms of your thinking? If you can get kind of quickly start with that, the context, and then we can get down to what you like, places like Autoanks, etc., which you've spoken about in the past as well. Go on, Pankaj.
Good morning, Prashant. I think the fourth quarter result season just got over, and it's very important to see that we exited on a decent note. And fourth quarter was one of the best quarters in the last year. And clearly, if you look at the top 500 companies, the reported numbers was 14% earnings growth, but there were a lot of one-offs this time. And hence, the adjusted number was about 7.5% earnings growth, which is not bad compared to the previous 3 quarters. And when I decode into 2 parts, which is banking and financial services, which are 92 companies, and non-banking and financial companies, which are 406 companies, the most interesting thing to note is that the non-banking and financial companies, the non-BFSI space, which was seeing very anemic growth, saw a very decent growth in double digits. And most important point is that 75% of our universe, which we track, actually had met earnings expectation or there was a beat. So this was one of the best quarters in the last 4 quarters, which we saw on the earnings growth side. And that's how market have responded to. Going into the next 2 quarters, we believe the base is extremely low. And incrementally, last year, Nifty ended with a single-digit earnings growth. Our belief is the next 2 years' earnings CAGR should be between 10 to 11%. And why we are saying that, Prashant? You looked at the fourth quarter numbers. The most important point was that after a long time, consumption growth is back to 6%. Not a great number, but not a bad number either compared to the previous quarter GDP numbers we saw. And the most important point was the construction and the investment cycle coming about 9-10% growth. Also, we saw that CAPEX numbers were released for the month of March. March alone saw 2 lakh crores plus of government CAPEX. Please put it in context that in 2015, what we spent in a month was the entire year's government CAPEX budget. And what we spent in last quarter of January, March was the entire year, budget for Government of India in 2020. So we have come a long way. And I think that shows that the capacity to spend is there with the government. And in this environment where there's geopolitical uncertainty, global macroeconomic uncertainty, I think the engines of growth are firing. The next few things which we want to understand is that liquidity will be better this year compared to last year, and full marks to RBI to turn themselves pro-growth from the month of January onwards. And today the system is surplus with about 1.5-2 lakhs crores of liquidity, which is very, very good from an equity market and business perspective. The second most important point is the monsoon have come in earlier. Though it's early, but we have to see the distribution, but it's a good news that, again, the monsoons are looking quite good. And the third most important point is that CAPEX and consumption, both incrementally this year, is looking better than the previous year. And the operating word is incrementally better, not amazing. So I believe that incrementally, if you look at things, I think macroeconomic domestically looks good. Global uncertainty will remain. And hence what we are saying that markets will be in a consolidation mode, and it will be a bottom-up stock pickers market as you move ahead.
That's an interesting point. Pankaj, morning. Great to be listening to you today. that both capex and consumption are looking better, but incrementally better. They're not amazingly better. Problem is, when valuations don't move incrementally, they move in gallops, right? They gallop ahead. So that's the problem with our market. But no, jokes aside, I just want to, dive a little deeper into that point. I was just highlighting even this morning, for instance, there seems to be some sort of a, position build-up happening in FMCG stocks. I guess because they're under-owned. They've just not done anything for so long. But just expand on that point. So in this phase, if someone is to make fresh allocations for the next leg of the market, should bulk of that continue to go towards capex-heavy, sectors that have done well, whether it's defense, it's capital good place, etc., or should more of that money be allocated to these underperformers from, say, the FMCG basket?
So the problem, Surabhi, is unique to. It's common to every fund manager. The stocks where earning growth is coming in, valuation is not giving you comfort, and valuations are expensive. Where earnings growth is not coming in, valuations are comfortable, but stock doesn't move. So how to manage that on the portfolio side? I think the way we are adopting for the last 6-12 months have a right balance so that you don't get caught up on the extreme valuation side as well as you don't move into a value trap, because there are market share shifts happening within a sector and within players also. Also, you spoke about consumption as a basket, Surabhi. But look at the staples. They are seeing anemic growth, but there are many categories in consumption which are seeing very strong growth. For example, telecom, I would club it in consumption. Look at the way the telecom players are growing. And clearly, one of the largest players is been a winner for the last few years. Look at the travel industry, hotels, airlines, they all are seem to be doing well. Look at the entire smartphone market now. It's a 3.5 lakh crore market, which a decade back was a very small number. And last year, the liquor market is now bigger than the jewelry market. So there are many different moving parts in the consumption basket also. And I think it will be more of a bottom-up approach in consumption, where growth is coming in and valuations are not so exorbitant expensive to, kind of look into that. On capex, we believe the T&D space is looking extremely good. And what happened in Spain a few weeks back, the outage, I think has taken the world by complete surprise, because the underinvestment in T&D has not only been in India, but globally, because of renewals coming in at a very fast pace. So I think transmission and distribution space will see a lot of investment, not only in India, but globally. And hence, companies catering to that space will see increased order momentum, and probably the runway for growth is very, very high. So I think you have to break down the entire sector into subsectors, go bottom up and choose the best businesses, keeping in mind valuations as well.
Pankaj, the other space is, of course, auto angs, right? I was recalling our conversation earlier, and last Friday we had the management of Samvardhana Motherson. And bulk of the conversation was not about autos, but about consumer electronics and the work they're doing there. And that is the case with so many other auto ancillary companies we speak as well. Not what they're doing in consumer electronics, what they're doing in, say, for example, areas like defense. Just talk to us about that. Are valuations here still attractive? I mean, should one really get some exposure if one does not have? And if you can talk about one or two names, would be really helpful.
So, Prashant, what's happening is that in the auto ang space, there are many companies which are pivoting themselves from traditional auto angs to non-auto. And the reason they are gaining momentum is because they are very, very good on precision engineering. There are few names in our portfolio, for example, Sansera. And just to give few thoughts without, a recommendation on buy and sell or any of these names, that few of these auto ang companies are saying that aerospace, defense, and semiconductor incrementally will become a decent position from their portfolio perspective, which was never the case for last 20, 30 years. And when we speak to the OEMs who are giving them order, and these are large companies, they say that we need to have diversification on our supply chain. For a large part of our last 20, 30 years, the supply chain was dependent on European as well as Chinese suppliers. And both of the places we see that there's uncertainty increasing. And hence we want to have few suppliers from India where They are good on precision engineering, and we don't mind giving them the opportunity. And I think that's the pivot we are seeing, that they will be less cyclical from an auto industry perspective, and the incremental growth will be from non-auto and tech-agnostic platforms. So I believe that there are many opportunities which are not so expensive. And if you take a 3-5 year runway, I think these companies can surprise you in the way the business model is shaping up. So that's one area where we are positive on. The other area where we were very early on is the specialty chemicals. And look at the last fourth quarter numbers. The 19 chemical companies we track on an average delivered 30% plus kind of earnings growth, which was one of the highest among all the sectors. And incrementally over the next 3 to 4 quarters, we believe that the restocking cycle is coming back. Many of the global agro and pharma companies are signing up large contracts with the Indian specialty chemical companies, and hence the runway for growth is becoming clear after 3 years of degrowth. And you have to choose your stocks, whether it be specialty or commodity chemicals. But I think this space is looking ripe for an outperformance this year as you move ahead.
Okay, all right. Lots of ideas there and lots of food for thought. Always great having you on the show, Pankaj. Thank you very much for taking out the time, and we look forward to the next conversation soon. Well, that's a view on the market. The market, by the way, is stabilized. The cut is about 200 points on the Nifty, and the mid-cap index is now trying to fight back into the positive side. So there's a little flash of green. So it's stabilized now. And let's see, the question is whether the buyers now come in and buy the dip. That's already happening in the mid-cap universe. So let's watch for this. Let's move on. Then a big company from the auto sector on the radar now. This is TVS Motors. Restriction on rare earth magnets could bring production to a halt. This is the word coming in from TVS Motors MD Sudarshan Venu. He also adds that there could be cost increases for customers. In fact, Parikshit Luthra caught up with Mr. Venu on a whole host of issues, including some of these trade disruptions. And he also started off by asking him about Norton India's debut and opportunities in the international business. Listen in.
Norton will launch towards the end of this year and will start phasing in the products towards the end of this year and early next year. I think I've mentioned 6 products before, 4 of which will be available for the summer of 2026 in the 4 European markets of UK, plus France, Germany, Italy, and Spain, as also, of course, in India. So this is where I think we are heading towards by starting off with the launch of the 4-cylinder superbike at EICMA. And then we will also share the remaining 3 products soon at EICMA or soon after, which will be available in the market early 2026. They are all in advanced stages of development. I think we have a good leadership team now at Norton with the 2 executive directors, Arnie and Neviho. Supporting them are very good designers, engineers, and a lot of homegrown talent from TVS in India, which I think brings a great mix in terms of the Britishness and the uniqueness of Norton, while leveraging the capabilities of TVS and also offering opportunities for our talent to grow.
Right. So there's a lot of competition in the premium space in India as well, in the 350 to 500cc space. And 650 is a space which Royal Enfield has been leading. Could you give us a sense of where your bikes would be playing, in which segment, and how many bikes will the Indian consumer be able to reach out to in India?
I think we will start, as I said, with the 1200cc superbike. We will have other smaller offerings as well. But we will draw a line on how we ensure we keep Norton Premium, keep it in the luxury space, and offer bikes that are uniquely differentiated and uniquely Norton in terms of the 3 values which we have articulated, which is design, dynamism, and detail.
Right. And what would be like the retail strategy for it in India and
We'll
globally?
definitely have a differentiated retail strategy in India, covering Norton and covering possibly some of the premium TVS vehicles as well. As I said, this will help us connect with the growing middle class of India and upper middle class and people with more affluence, and with Norton's even some of the top end segments who buy sports cars and other vehicles who also buy these very high end bikes. We will connect with different retail formats that are uniquely catered to them and offer them that superior and differentiated experience.
So there'll be like more experience centers, more showrooms, specific showrooms for...
Absolutely.
How many are you targeting for India?
We'll share more soon, but I think definitely we will cover in the first phase the big cities, and then after that move on to other cities, and we definitely intend to offer the entire Norton range in India.
Speaking about electric vehicles, 25% market share in the month of May, that's what we pick up. You were the leading player, and you have been the leading player for several months now. The competition is stiff. but you're steadily growing the market. What's going to be the strategy from here on in terms of building your EV portfolio?
We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We have now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric three-wheelers and electric bicycles as well.
Okay, so if we were to ask you how many electric products altogether in FY26?
I think in FY26 we'll look at a couple of new launches. One is, of course, X has already started retail. There is an improved iQube and one more new scooter.
One more new scooter coming up. How does the market look to you currently, and are you looking at increasing capacity? What is the monthly run rate that you're looking at?
I think we are increasing capacity and the volumes have grown. At the same time now there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Right. How badly is the restriction by China on supply of rare earth magnets impacting TVS Motor Company right now in terms of production?
I think in the short term it will impact the entire industry a fair bit. As we go forward, we have to develop new solutions, develop new components, new suppliers, and really work our way through this.
So is it already, for the industry, is it already showing on the monthly numbers?
I think it will start showing soon.
Start showing soon?
Maybe in June, if not definitely in July.
No, some bodies have really sounded the alarm bells, saying that this could literally bring EV production to a grinding halt. Would you go to the extent of saying that?
It is concerning, yes, Parikshit, it is concerning.
It could bring it to a halt?
Yes.
How bad is it for the industry?
I mean, a halt is pretty bad, right?
A halt is very bad.
And it doesn't get that much worse with it.
Yeah, yeah. So we could look at a complete...
Yes, it is a significant challenge.
And how are you managing it?
Of course, like every company, we are trying to see how to de-risk. But again, there is a huge price impact which ultimately has to be borne by somebody. And then there'll be cost increases or other price increases to the customer. So all this has to be factored in, which is why I think it will be a short to medium term challenge that the industry needs to work its way out of. On one hand, we are launching products, we are committed, we have invested a lot of capex, we have seen that we have done a lot of exciting launches and our volumes have also grown. This is definitely a challenge that there's an industry and we have to work through, and over a period of time develop an ecosystem of components and R&D in India so that we bring volumes up in a way that is sustainable and in a way that's Atmanirbhar and made in India with Indian R&D, with Indian products and Indian technology and supply chain and natural resources all linked up.
Yeah. So you're expecting from June onwards it will start showing in production figures, and there'll be very significant production cuts?
Yes, there'll be cuts.
Yeah. And what kind of export growth are you targeting? And how many more countries would you like to reach out to?
We are in many countries already, and we, of course, as there are opportunities in industrialized countries, we will look at entering new markets as well, and also new segments within those markets or new ways of doing things in some of those markets. In terms of Africa, I think Africa has bottomed out and is turning around and now starting to look up. So definitely exports growth for us in the last few months, as you have seen, has already started moving up, and I think this will continue this year.
Right. How much do exports contribute as far as your total revenue is concerned, and where do you plan to take it by 2030?
Exports today are close to 30, I would say international business, because it's a question of now in some of the countries we are assembling, in some countries we'll manufacture. Future regulation may require more manufacturing in these countries. There'll be more products aimed at these markets. There are people operating or focusing on these markets, some of them in location. So I would say the international business is about 30% of our revenue, and I think it can be 40% or more by 2030.
Okay, so that's the word from TVS Motors and the supply of those magnets, the rare earth magnets from China. That is very clearly a concern for the industry when it comes to EV production. Stock has had actually pretty good numbers. The May sales numbers for TVS are good, 17% growth in overall sales. And right now down 1% because the market's mood overall is a little offbeat. Well, with that, let's move on and get the next company on the radar. Apollo Hospitals is what we're tracking now. And the company delivered quite a robust performance for the fourth quarter. It was very much in line with street estimates. Improvement was seen in margins as well as in occupancy levels. Let's talk about this performance in the outlook. We have with us Ms. Sunita Reddy, Managing Director at Apollo Hospitals, joining in. Ms. Reddy, good morning. Always a pleasure to have you on the call. And it's been a strong finish to the year. I mean, I think across parameters, whether it's occupancy, RPOB, margins, you've been above street estimates. Let's talk with, some sort of a, outlook as well. Can these levels, for instance, occupancy, we were at, I think, about 67% at the end of the fourth quarter. So do you see it kind of stabilizing here? What about RPOBs? What's your outlook?
No, I think in terms of occupancy, we're nowhere near stabilizing. There is headroom for improvement, and we are targeting between 70 to 72%. Having said that, our metro occupancy is already at 71%. So we will push metro occupancy to 75% and system-wide move to 71%.
Okay, all right. So that's at the occupancy level.
With regard to RPOB, clearly we showed a 7% increase in RPOB, and that is the trend going forward. It is a mix of tariff increase as well as case mix. So with these, as the third element of it, of course, is payer mix. So we're quite sure that we can continue with the 7% increase in RPOB.
Okay, so you'd expect a similar sort of an increase this year in FY26?
Yes.
About overall 7% in RPOB as well?
Yes.
Okay, got that, ma'am. And this increase would be, again, would it be largely tariff-led, or would it be because of the higher-end robotic, etc., those high-end surgeries?
So there was a 10% increase in volumes in the higher-end surgeries that we call Congo. And this has been reflected in the RPOB moving upwards. And going forward, it will continue to be a factor that will improve our RPOB as well as some amount of tariff increase.
Okay, got that. So 7% increase in RPOB to be expected in FY26 as well. What about the international patient business, ma'am? I mean, how did that play out in the fourth quarter and the disruption that we've been seeing in Bangladesh?
Yeah.
I mean, to what extent was it still impacting?
Yes, I think Bangladesh definitely had a 2% impact over the whole year, and which is why, international patient revenues did not meet our expectations. But going forward, we have really diversified our risk. We are looking at new markets and do believe that we can move back to 7% of total revenues in the coming year with international patients.
Okay, let's also talk about Apollo 24/7 as well as HealthCo. In 24/7, I think the GMV was up 11%, and you've guided for a break-even by the second half, I think, of the current year, FY26.
Yes.
If you could just elaborate on that, and then also your projections for HealthCo this year.
So I think HealthCo did very well because if you look at offline and online, there was a 17% growth in the offline pharmacies. More importantly, the margins grew by 20%. The EBITDA grew by 21% to 160 crores and giving us a margin of 7.8%. So this was extremely helpful. Online revenue grew to 292 crores and, it grew by 22%. And while this was not profitable because there was also an ESOP charge, net EBITDA for Apollo HealthCo came in at 36 crores and a 9 crore profit. So that is a significant part that as we move towards 1,000 crore GMV per quarter, both the digital, it will definitely become far more profitable. Right now, as a company, Apollo HealthCo is profitable. Margins are looking strong. They've, they're currently at 1.5% margin, with offline doing, extremely improving in sales. So they do about 900,000 sales per day. So volumes have really, transaction volumes have picked up, asset utilization has picked up, and of course we've added new pharmacies.
Okay, all right. So that business, you're sounding quite optimistic on that as well. Yes. On diagnostics, ma'am, the top line grew 9%. Yeah. But there was some margin pressure in the fourth quarter. So what happened there, and was it just a one-quarter phenomena? Because I think this year the street is expecting from the diagnostics business a margin improvement of as much as 300 basis points. So are those expectations well-founded?
No, I think that, the diagnostic revenue was only 198 crores for the quarter. There was an impact on two fronts. I think in terms of margin being at 9%, a significant amount of the volumes came from AHL Apollo Healthco, and therefore a slight dilution in margin. The second part of it is that they shifted from a franchisee model. They're in the process of shifting from franchisee to ownership model. And I think the results of that will play out over the next year, where you can expect to see both revenue grow as well as margin improvement.
Okay. All right. Ms. Reddy, let's talk about the CapEx plans for this year. I mean, specifically FY26, because you're putting a lot of money to work. Yes. And you've stated that it's 6,000 crores of an expansion plan over the next 3-4 years. You're adding, I think, over 4,300 beds. So specifically this year, what's the kind of CapEx outlay, and which are the geographies? I believe there could be a hospital coming up very close to us where we are, Worli in Mumbai as well.
Yes, I really want to get close to you. So
lovely.
We are looking at a 3,000 crore expansion this year, with several hospitals coming on stream. We should have at least 1,500 beds opening out. Worli is not happening, it will take, post the rains, we'll start work in Worli. But we do have, we've acquired a hospital in Bangalore, which is a 150, 180 bed hospital. We've acquired land next door, so we will have 150 beds coming this year from Bangalore. We'll have another 170 beds coming from Hyderabad, an expansion of 200 beds in Gachibowli, which is part of Hyderabad. In Kolkata, 250 beds, out of which 150 will become operational. In Delhi, in Defence Colony, about 40 beds will open out. And Gurgaon, in the last quarter of the year, 200 beds will be ready. Pune, we have 250 beds opening out. So clearly, we're looking at 1,500 beds opening out, opening by the last quarter of the year, and a capex of 3,000 crores for this year. As you know, we have free cash flows, we have money in the bank, and are adequately funded for this expansion.
Okay. Got that. Final question, Ms. Reddy, on overall sense on medical inflation. And what are you expecting this year? What kind of medical inflation should patients be ready for? And also just your thoughts. I mean, on a side note, there is a different model that, some of the industry players are trying out. I'm talking about PB Fintech. I mean, they're trying out a different healthcare foray. I mean, the idea is to try and bridge the difference in perhaps in objectives of a hospital company and an insurance company, a health insurance company. So just your thoughts on overall medical inflation and expectations on that front.
So medical inflation was at 4.5%. And I think that we're able to absorb that medical inflation. In terms of what you just mentioned, the model to really, something like a subscription model. I think that currently in Apollo Healthco, we have an insurance offering. We've tied up with 4 players. We're just launching that this year. But with this insurance product, we will be able to look after, people don't worry about how they pay for their healthcare. And I think that is the most important step. The different ways of doing this, one, of course, is a subscription model. But I think we're looking at both aspects of it. But having a digital model and taking, bringing it closer to the consumer and also showing them a way in which they can pay for healthcare, creating that environment, the ecosystem around the consumer. I think Apollo has the ability to look after communities. We have large networks, so they were ahead of the game.
Okay, that's very interesting, ma'am. And now that the earnings are out of the way, maybe we can have you back on. I mean, this requires a deeper conversation and understanding.
Yeah, it is.
Yeah, we'd love to have you back on for this one.
And looking forward to you moving closer to us.
Absolutely.
Thank you very much, ma'am. Thank you. Well, we'll take a, I think what we'll do is we'll take a, all right, I think M&M is the next conversation, right? The reported sales for the month of May, they're better than expectations for both segments, auto and tractors. The company continues to gain market share led by strong continued demand for its SUVs. My colleague Sudarshan spoke with Nalikant, CEO of Mahindra Automotive, began by asking their outlook for the month of June. Listen in.
May has been a solid month for us, both on the SUVs, on the LCV front as well. On the SUVs, we sold about 52,431 SUVs at a growth of over 21%. On the LCV, less than 3.5 tons, again, we had strong growth, 8.8% growth year on year for us. So the portfolio has had strong traction and continues to be the case across all the different models that we have, including the two new BEVs that we put out there as well. In the analyst meet in May, we had projected that we'll do mid to high teens growth on volumes on SUVs. So with these numbers and what we are seeing out in the market, we are optimistic that we'll be able to deliver on those numbers for the year.
So for the next few months, what would be the most, like 2 to 3 important triggers that you think that's going to help the sales positively?
Yeah, absolutely. So Darshan, if you look at it, last year we had 4 major launches. We had 2 major ICE launches and 2 EV launches as well. So we had the 3XO we launched in late April, early May. And we had the ROX we launched and started deliveries in October. And then in Q4, we launched both the BEVs, BE6 and XEV9e. So for us, the most important thing is capturing the demand in all of these 4. ROX, we had about 6 months of volume last year. So we get the annualized benefit this year of the full year's volume on that. XEV3X, of course, is doing quite well. And we have increased capacity, especially on the petrol front. So that gives us an additional room to increase volumes as well on that. And then the 2 XEV and the BE, we just started deliveries in late March. And we are already number 1 in terms of revenue market share. So we're seeing strong growth there as well. So key is to get these 4 models to deliver the volume growth for us while we continue to have very steady and strong traction with our Scorpio portfolio and the XEV portfolio.
I'll be coming to the market share, but before that, just I would like to talk more about EV sales, because you do mention that your utility vehicle numbers do include EV sales, but can you talk about EV monthly run rate?
Yeah, so for us, as you know, we are only an SUV player, so all our EVs are SUVs as well. And our numbers, if you look at it, we delivered very close to 4,000 vehicles last month, and we did about 3,500 or so in April as well. So we are on track to having full utilization of our operationalized capacity. And if you recollect, we have an operationalized capacity of about 5,000 to 5,000 vehicles, 5,500 vehicles. And so we are hopeful that very soon we'll come very close to utilizing the full capacity of our plant for that.
Okay, now coming to the market share. It's been a healthy gain for both, if I can see that in April and May, PV market share has jumped by 3.4% year on year. Even on monthly basis, it's up 0.4%. Even EV front, it's a gain of almost 15% YOY and 3% month on month. Any target that you have set by the end of this fiscal, what do you think would be the exit market share for both PV overall and EV front?
Yeah, so market share for us is an outcome of the traction we see with our customers on our portfolio. So we don't necessarily put out a target for what our market shares need to be. We're focused on delivering on the volume projections that we put out there, and most importantly, on delivering to the customer expectations in terms of their bookings as well. So that's really what we are focused on. Now, of course, as we see what the industry projections are and the overall numbers, if we continue to keep this kind of pace and we do mid to high teens, I would think that there's a natural conclusion that there shall be some market share. But that's not necessarily something we're chasing on an ongoing basis.
And how is this raw material cost trend looking like in this environment of where like Trump every another day is announcing tariffs on several, so many products. So how is this raw material cost looking like first? And second, any pricing action that you are planning over the next few months?
Yeah. So firstly, it's a highly dynamic situation at this point in time. And it's hard to predict what will drop at what point in time and what we need to go to. But we, of course, saw some steel price inflation that happened in the earlier part of the year. And that's something we have passed down to customers in May. So we did a series of price increases in May. And it's heartening to see the kind of volume growth we have seen despite the price increase we put out there. But going forward, while it's hard to predict, we are reasonably confident it will be a benign environment overall. And of course, if there's any disruptions on specific commodities or any specific strategic components, we continue to watch it very closely. We have a playbook we put together for COVID, and we know exactly how to operate in an environment where such black swan events happen. So we will pull that playbook and work with that.
So which is the, which market, if I talk about north, south, west, east, which is the one or two markets that are basically helping you post out such a strong set of numbers?
Yeah, so what's very helpful and heartening for us is we are seeing growth across all of the different regions in the country. North, of course, has always been a backbone of our volumes, and that continues to be strong. West and East have also been quite strong for us. If we had to point one region which has really helped us grow, at least for the last few quarters, is South. And South is traditionally an area where we have punched a little bit lower than our weight, if I may put it that way. And really that has kind of stepped up here, both on the SUV side and also on the LCV side. If you see, we had significant gains on the LCV less than 3.5 tons of market share. And a large part of that came from the traction that we are seeing with our products, especially the new product, which is Vero, in our South markets.
Great. On EV front, over the last few days, we have been hearing from some of the two-wheeler companies regarding rare earth magnet supply. And because of the disruption that they are expecting, and they believe that if the disruption continues or disruption they might face over the next few days, it might have an impact on their sales. Are you expecting the same?
Yeah, so as you pointed out, China recently implemented an end-use requirement, end-use certification for all exports of rare earth metals. So that requires additional clearance with our customs agencies. We at Mahindra, we are covered for most of our vehicles for the next couple of months in terms of existing stock, so we are comfortable there. And most of our suppliers either have applied or in the process of applying for that end-use certification already. So that's a process which is underway at this point in time. Of course, we are also deploying other de-risking strategies. We are looking at alternate materials. We are looking at sub-assembly buying from other suppliers. But we are also working very closely with the government for faster clearance of these end-use certifications as well. So it's a multi-pronged approach we're using. But for the next couple of months, we are covered.
Great, great. Now, coming to the CV segment, so your main segment, that is the LCV between 2 to 3.5 tons, there I can see that you have been posting healthy growth. Even in the month of May, you have seen a growth of 14%. But one segment that is less than 2 tons, there you have seen a decline of 18%. And in the segment of more than 3.5 tons and MNHCV, there it's just subdued growth, it's just 1%. So, by when do you see that these two segments, okay, we can consider that 2 to 3.5 tons, you might continue to see healthy growth. But overall, if I talk about CV, how do you see that overall demand looking like first? And what would be your basically industry outlook for FY26?
Yeah, so I'll limit my commentary only to the LCV less than 3.5 ton, which is the core business that we are in. Vinod runs the MTBD business, which goes beyond that. But our projections is about high single-digit growth is what we're projecting at this point in time. And there's a couple of reasons for that. One is we've had a fairly muted set of years on the LCV side for the last 2-3 years. And at some point in time, the replacement cycles need to kick in. And we're hoping this would be the year when we start to see some of the replacement cycles coming in. That should give us some volumes. Second is overall, the rural environment is improving. While there'll be a little bit of a lag in terms of from the good monsoon to what you see in LCVs, but we see that giving some kind of traction and growth for us over the next few quarters as well. And third, infrastructure as well as government sector are starting to invest as well. So that could be another area where we see some growth coming in. But like you said, relatively muted environment over the last couple of years. These triggers that I talked about should give us the growth that we're looking at, which is high single digits.
Okay, well, that is essentially the conversation with Mahindra Automotive as far as their sales numbers are concerned. Very interesting chat. Mitesh Thakkar is with us with what he'd want you to do as far as specific trades are concerned. Okay, before I go to Mitesh, the newer listings are all both coming up on your screen. AG's Vopak, I think, came up, and it's, I think, listed at a discount. It's coming up now. Let me just see where AG is. Lots of interest around this one, at least in terms of the business. Issue was subscribed about 2 times. I think 220 on AG's Vopak. And you can see both pictures coming in and the bell being rung. So I think 6.5% lower at about 220 is where the AG's Vopak listing is coming at. Schloss, which is Leela, Hotel Leela, that is also, of course, making its debut, and there as well, it's a slight discount to the issue price. So 406 is the listing price on Leela compared to the issue price of 435, and on AG's Vopak 220 compared to 235. Although AG's Vopak has come off already quite a bit from the lows, and it's at about 230 odd rupees. So yeah, I mean, normal kind of listing, decent. Once in a while, I think we'll need to have normal listings, normal days as well, which we can track. All right, let's just bring in Mitesh Thakkar now. We can't ask him about listings without price history, but he can tell us what you need to do now. Mitesh, with this kind of an open on the indices in the broader space, what's your reading and what are your trades now?
Yeah. Prashant, Union Bank is something, and I mentioned banking in the morning call as well. I think banking will do well. So Union Bank is a buy with a stop at 150 or just below it, and a target of 158 is what I'm looking at. While the other good stock is Tata Chem, which is a buy with a stop just below today's low of 880, so 879, look for a target of around 940.
Okay, that's those are the calls coming through on individual names right now. By the way, Mitesh, Reliance Power. I mean, what a move last few days, right? I mean, I think this, if you just look at the year so far, stocks up about 40%. Last month was big. The month before that was big. How is this one looking technically?
So something apparently has changed over here, Prashant. I think, I was looking at a target of 60, which is where the stock had some bottoms way back in 2014. It's right there. In case we start moving beyond that, and that still looks a good possibility and a strong one at that, I think this could be a 3-digit stock in the next few months to come by. So maybe, traders who are there, I think just hold on to this stock. Trail your stop losses to a slightly deeper basis because this is a positional kind of a call which I'm looking at. So it stopped, just below levels of 48, 47.5 is what is recommended. But I think this could be a good hold for the next few months to come.
Got that. Mitesh, thank you very much. Those are trades coming through in terms of calls as well. Time for a quick commercial break here. Manisha Gupta will be with us to focus on commodities in just a bit from now. Stay tuned. Okay, welcome back. I think we've got the market, which is down 170 points, 24,580. So things are looking sideways to lower. Let's just quickly run you through, a couple of stocks which are moving around. By the way, a lot is now, and broader markets are looking very, very vibrant, by the way, even though the index is down. So it's a healthy screen, I would say. Our power is the biggest volume-led gainer by far, by the way. AstraZeneca is coming up with a sharp 10% kind of a gain. We don't see that very often. It's a almost 9,000 rupee stock, AstraZeneca, but humongous volumes at this point. Genus Power is up about 6% or so. It's the number 3 largest volume traded name. GE Shipping is up 4%, coming up with humongous volumes, so 963. GVTND, 5% almost, big outperformer, so 4%, 4.5%. Look at Sterling Wilson Solar. That is up 7% and is back above 3%, back above the 300 rupee mark. And there's so much else. I mean, Transrail, Anand Rathi, Spark, and Azad Engineering, Quick Heal, Cosmo First, 5, 10, 15% moves here, so to speak. So we'll come back to some of these in a bit. But from equities, let's also shift focus to what's happening on the commodity side of things. Manisha is here with exactly that. Manisha, good morning.
Morning, Prashant. Thank you for that. I'll start with the crude oil prices because we've seen very strong gains come in for this one. Remember, the month of May has been on the stronger side as well, and June has started almost a couple of percentage points on the higher side. And this is coming in after 2 weeks of decline that we have seen in for the crude oil prices. Well, there has been a lot of conversation when it comes to geopolitics, to tariffs as well. But what the crude prices seem to be taking sense from right now is the OPEC Plus meeting. This was on Saturday, on 31st of May, where the OPEC Plus has decided to increase production for the month of July by 411,000 barrels per day. This is on expected lines, is the reason that the markets have reacted on the higher side here. The OPEC Plus also have said that the increase could be paused or reversed as the market conditions be. So they're quite flexible on this, and that really seems to be supporting the prices right now. Having said that, when you look at the first quarter, the global demand stands at a growth of 1.2 million barrels per day. This is higher than what the street was anticipating, given the fact that we was only talking about tariffs and China's weak demand, but the global growth has been on the stronger side. Now, going forward for the rest of 2025, the expectation is that you could be looking at higher demand overall. OPEC talks about 1.2 million barrels per day. World Bank is suggesting 1 million barrels per day of a demand growth for this year, while Goldman Sachs, IEA, JP Morgan are not so bullish. They are talking about 0.6 to 0.8 million barrels per day there. But having said that, all of them do expect demand growth going forward for the rest of 2025 there. OPEC also is projecting that this demand will continue to increase. And while we stand right now at 103 million barrel per day of a global demand, 120 is where we could be by 2050 is the view coming in from OPEC there. Interestingly, much of this demand really is coming in from Asia as per IEA. As per their survey, they say that Asia will account for 60% of this demand growth going forward, and 25% of that demand growth could come in from India alone. Let's talk about prices now. And as I was telling you, the month of April wasn't so great, but the month of May has ended on a positive side here. So while April saw 15% of a decline, May saw 11% of gains for the prices. Also, when you look at year-on-year basis for the crude oil prices, well, 2025 till now is in the negative of around 11 to 13%. But we also have seen prices continue to decline in the last couple of years as well. So the crude prices have continued to be in a negative for a third straight year. The final plate should talk about on what is the outlook for crude oil prices going forward from here. And that clearly has been revised a lot of time from many of these banks and brokerages and almost to the lower side here. $60 a barrel of an average is what the markets believe could come in from Goldman Sachs and Citi. 64 to 66 is what World Bank, pardon me, and JP Morgan seem to be talking about. Let me also remind you that in 2024, the crude average was $80 a barrel. Now, this year, we are talking about $60 to $65 a barrel. So clearly a step down in sense of prices.
All right, Manisha, thanks very much for that. Well, let's focus on some stocks now. And Mangalam is here tracking FMCG stocks. Government has slashed the import duty on crude oil, edible crude oil. Mangalam, take us through what this means.
No, that's correct. You know, sometime last September, if you noticed, there was an increase in the duty for imported palm oil prices. And as a result of which, there was a sharp inflation that we saw in palm oil prices, and the third quarter and the fourth quarter results would show that the FMCG margins had shrunk, specifically for the ones that made soap and biscuit companies, etc. Now, from the peak, we've seen a big decline of almost 25-26% in palm oil prices. Palm oil, and remember PFAD, a derivative of that, are important inputs for both food as well as soap companies. So a lot on the street were hoping for margin expansion for FMCG companies beginning first quarter, second quarter of FY26 itself. And to add to that, now there is a special benefit that is coming from the government, which comes in as a sweetener. So the duty has been reduced from 20% to 10%. So in an any way downtrending palm oil price market, a duty reduction is just a positive, and that's reflecting in the prices of names like Britannia, HUL and GCPL. On the other hand, though, we are seeing some decline in names like AWL, the erstwhile Adani Wilmar, and Patanjali Foods is seeing a mild green. But remember, these are the ones that do not stand to benefit from reducing prices scenario. Over the last couple of quarters, their EBITDA had seen a big jump because their realizations had increased. Now with palm oil prices coming down, duty is coming down, the realization for their key products, the edible oil business, may come down. So as margins for the FMCG companies which are gaining increases, the margins for these companies will reduce. So that's the sum and substance of edible crude oil and the duty reduction.
All right, Mangalam, thanks very much for that. Well, that's the FMCG pack in focus on the back of the duty reduction. Emphasis was down sharply in the morning when we started. Rima is here with details. Rima, morning.
Hi, morning. So Mint is reporting that Emphasis has lost its third largest client, that's FedEx, and FedEx approximately accounted for 8% of Emphasis revenues. Now, FedEx seems to have chosen Accenture over Emphasis for its work, and the business transition of the IT work will happen towards the end of the calendar year. As I said, FedEx is reportedly Emphasis' third largest client, so it's going to hurt if this news piece is true. Mint reached out to Emphasis. They've just responded saying that they continue to have a robust and expanding pipeline. But today, the stock is under pressure on the back of this development.
Okay, Rima, thanks very much. 3.5%. It's off the lows by a little bit, but not much. That's Emphasis with Rima. We'll take a quick commercial break here, but stay tuned for more unmatched insights and unparalleled market coverage. Keep watching. Nuvama presents CNBC-TV18 Market Central.
Welcome to CNBC-TV18 Citizens MPC. The Reserve Bank's Monetary Policy Committee meets from June 4th to June 6th. And as always, CNBC-TV18 Citizens MPC is meeting to deliberate on the issues before the Reserve Bank. I have with me Chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chenoy, Samiran Chakrabarti, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. Well, the first question has to be the just announced GDP numbers. Samiran, let me come to you. The numbers are better than what our poll threw up, what generally seems to be the market expectation. How do you think the Reserve Bank and the MPC will approach these numbers?
So obviously the numbers have been somewhat better than market expectation and our expectations. But I think the MPC will also take into consideration that part of the increase could have been because of front-loading of economic activity before the tariff set in. We have seen globally in many countries a similar trend happening in the first quarter. In Indian context also, the net exports have contributed very strongly for the quarter. And also the fact that in the early part of the year, the public capex did not happen, so it was a bit back-ended for the fiscal year. So that back-ended capex has also contributed to a much better construction growth number. So both these factors could probably not be with us all through the FY26. So maybe that's why having the same sort of growth numbers across the entire year might be difficult to predict at this point of time. So the MPC will probably consider the fact that the growth momentum has been better than what used to be a couple of quarters back, but still might be lower than the potential growth on a more sustained basis.
Okay, so it need not necessarily be a hawkish factor. Let me come to Sajid on this point. Since you are referring to the global point, Samiran, Sajid, can you parse the global ecosystem for us and how it might impinge on the MPC's thinking?
But I think if anything, the last 72 hours, with the fact that a court in the US, a trade court first paused President Trump's reciprocal tariffs, the government sought a stay, they got a stay, this matter will go to the Supreme Court. But all of this simply does is accentuate dramatically global uncertainty. I think that's been the one consistent feature of 2025. We've been living in very uncertain times. Policy uncertainty from the US, trade policy uncertainty, tariff uncertainty. And I think we're going to be living with that for the foreseeable future. The question about whether these tariffs are constitutional or not, whether the president has exceeded his powers, A, and B, even if they're struck down, there are many other provisions that the US president has under different sections of the law to reinstall them either directly or indirectly by increasing sectoral tariffs. So I think the short point is all this global uncertainty does not bode well at all for global investment. A. B, remember, we've got a lot of Chinese excess capacity here. And to the extent that the China exports to the US are directly blocked, even though there are signs that China is transshipping some of this through third countries, India will be wary that some of that excess capacity will come to India. So I think going forward, the global is clearly going to be a source of concern. I mean, the one silver lining is India seems to be making good progress on trade negotiations with the US. So hopefully that uncertainty can be put behind us. But there are two other sources of uncertainty. What happens to global growth this year? What happens to global investment this year? What happens to Chinese excess capacity here? And for me, the main transmission mechanism to India is not just through exports. It's the fact that we're all waiting for a private investment cycle to pick up. So far, the heavy lifting has been done both by public investment and the real estate sector. There's a sign that both those forces have peaked. They're going to slow in the coming year. You need private capex to replace that, and private capex will face severe global headwinds. I think that's the way the MPC will perhaps think about how the global environment, will impact India's outlook.
Okay. We have discussed growth a bit. Let me come to what the MPC's mandate is: inflation. Now, Sonal, inflation has been surprising on the downside. Will Reserve Bank in the first place lower its forecast? It is still standing at 4% for the current year.
Yes, we expect there should be a downward revision. The trajectory actually looks quite benign. So on the food side, the projections for output look favorable, and we think prices of both pulses as well as cereals like wheat will moderate going forward. There is obviously some risk on vegetable prices, in the coming months, but I think even accounting for that, food looks benign. Oil prices are down, currency seems well behaved, input costs are lower, wage costs are actually coming down, which bodes well for services inflation. So on the whole, we think FY26 CPI is actually tracking closer to 3.5%. Probably even lower than that. So we think RBI is likely and should actually lower its projection from 4% right now to a number which is closer to 3.5%. And even there, I would say risks are balanced.
Okay. Soumya, let me come to you on liquidity. The Reserve Bank has done a lot. Do you think more is called for? Or now can we assume that the liquidity instruments have been fully used?
Yeah, thanks, Lata. I think on the liquidity front, as of now, the Reserve Bank of India has done a lot, and I don't expect it to do too much. There are a couple of things which we need to watch out for. For example, after the RBI dividend announcement, I think the liquidity in the system could actually top 5 trillion or could be close to 5.5 trillion. We should be actually closer to around 2% of NDTL. So within 2% of NDTL, I think we're in a pretty comfortable zone. And the other factor is that we also need to know that there is a lot of swap transaction maturing. So maybe this will give an RBI an opportunity to retain some of the swap transactions of the liquidity which it has built up over the point of time. But one point to take note is that the Reserve Bank has been doing several types of liquidity injections. It has done a significant amount of OMO transactions. But at some point of time, it will have to rethink about the instruments, because while as a policy tool, these are all good, but OMO over a significant point of time can also impact the secondary market liquidity. So net, I think the Reserve Bank has done its bit in maintaining liquidity, and now it's the time actually to do the other small tweaks so as to keep the liquidity in surplus mode going forward.
Okay, continue to keep the liquidity in surplus mode. Dr. Sen, as the chairman, can you round up the growth inflation dynamics for us? Does it look like, there is enough room for the Reserve Bank to cut because inflation is so much below its own target, or likely to be?
Lata, there is certainly room to cut now. The environment looks benign. Although, I agree with what Sajid said about the uncertainties in the global economy, which were pretty high to begin with and are possibly higher today. But the other thing is that President Trump's big, beautiful bill should come as a booster to countries who've been able to establish some kind of a trade agreement with the US. And we may well turn out to be beneficiaries of that. So all in all, I think the environment is benign. The economy has been behaving itself. So I think the only problem is really private capex. And I think this is a situation where we should just hold steady with our rate of liquidity growth, and some cut in the repo would be called for, I think.
Okay, point taken. But it's time for us to vote. May I ask you all to take up your electronic pads and vote? The first question is very obvious. What will the MPC do to repo rates on June 6th? I'll start with Sonal, the lady. Sonal, what will they do?
25 basis point cut.
Samiran?
Yes, cut by 25 basis points.
Okay. Sajid?
25 basis point cut.
Okay. Soumya, what's your vote?
I think I would go for a 50 basis point rate cut. It's better for a better transmission.
Okay, 50. Dr. Sen, which way would you lean, sir?
25.
25. Okay, so 4:1, 25. A cut is coming regardless. But I think the more pertinent question for the market is what will be the terminal repo rate? Sonal, again, I start with you. What do you think will be the terminal rate?
Based on current conditions, 5%.
5%. So 4 cuts starting from June. Samiran?
I think it's 5.5 or below.
Okay, 5.5, playing it cautious. Sajid?
Somewhere between 5.5. Remember, overnight rates are 25 basis points below that.
So what do I take? 5/4? Because you said 5 to 5.5, I'm taking 5/4 for you. Shaumyo, your terminal repo rate?
I think I'm going with 5%.
Okay, you are at 5.5 already if there is a 50 bips cut. So 5%. Dr. Sen, this is really a divided house. Where do you stand, sir?
5.5.
5.5. You're playing it cautious. So at the moment, it is equally cut between those who want to be cautious and those who believe the Reserve Bank has a longer rope. This is going to be a very, very interesting policy. In fact, the policies to come. Thank you very much, members of the Citizens MPC, for joining me. With that, we wrap up on this the deliberations.
Britannia, Godrej Consumer and Hindustan Unilever trade higher after the government cuts basic import duty on crude edible oil from 20% to 10% to reduce prices. Apollo Hospitals trades nearly 2% higher after an in-line fourth quarter. Occupancy improves to 67%, while the company also announces a 6,000 crore rupee capex plan. Management tells CNBC-TV18 they're targeting occupancy levels of 70 to 72% going ahead. M&M trades higher as its monthly sales continue to perform and it's outperformed the peers. In Eicher Motors surges as Royal Enfield sales rise 26%. Hero MotoCorp trades under pressure after recording low single-digit growth across segments. Mahindra Automotive's management tells CNBC-TV18 their focus is on increasing volumes than market share. Niva Bhupa slips 10% after nearly 2.7% equity changes hands in a block deal worth 400 crore rupees at 83 rupees a share, which is about 11% lower than the previous close price. Schloss Bangalore, owner of Leela Hotels, makes a subdued debut on D Street, listing at about a 5% discount to its issue price. Now the stock's moved off lows, sitting with a cut of 1.5%. Tank storage terminal operator Aegis Vopak 2 makes a weak debut, listing with a discount of about 6%, but from there on it has seen some purchase, mildly in the green. You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. And as we look at it, the markets, we've seen a bit of a downtick. On the Nifty, it's down by about 150 points. And the mid-cap index is doing a tad better. As the indices at the top of your screen tell you, that the Nifty Bank 2 isn't falling as much as the frontline indices would suggest a decline. So what is it that is leading the Nifty and the Sensex lower at a time when the Nifty Bank is not falling as much? It's the export-facing sectors. We have the IT index, which is lower, and the other one is the metals index. The announcement of Trump increasing tariffs or doubling tariffs on steel and aluminum imports into the US has had its bearing on the metal stocks, all of them lower, so we'll keep an eye out on that. And the IT index too, lower by about 1.1%. However, the golden lining right now is that the Nifty's managed to hold on to 24,500. Closer to those levels, we saw some purchase, and from those lows, there has been a bit of a bounce led on the frontline index, and it's been led by the PSU banks. So we have the Nifty PSU banks, which is higher, and you have the FMCG sector, which, as we pointed out earlier, benefiting from lower duty on imports of palm oil. So that's margin positive for a lot of these food and soap makers. But let's get you some more ideas of profit. We have our colleagues at Money Control Pro joining in. Jitendra Gupta joins in with a stock.
Hi, thanks. Cummins India experienced a mixed performance in Q4 FY25, marked by short-term headwinds. While domestic challenges affected sequential performance of the company, it remains well positioned for the recovery in FY26, driven by largely global diversification and strong momentum in the exports. In the quarter ended March 2025, revenue rose by almost 6.5% on a year-on-year basis. However, domestic sales declined by 25% sequentially, impacted by policy delays and execution issues. On the other hand, we have seen exports grew by a strong 39% on a year-on-year basis, of course, because of the strong demand in the international markets. Going ahead, it expects double-digit revenue growth in FY26. Exports demand is expected to remain robust and domestic recovery is anticipated going forward. Structural drivers such as increased demand from sectors like data centers, infrastructure, logistics are expected to support growth going forward. At 65% capacity utilization, it can deliver higher growth without immediate capital expenditure. Cost optimization initiatives are ongoing, and it aims to bring higher margins going forward. Valuation-wise, stock has corrected from its peak of around 4,157 to current levels. It is currently trading at around 31 times its estimated FY27 estimated earnings. Of course, with the dividend yield of around 1.5%. Given stable growth and there is a strong momentum in the exports, a re-rating is possible going forward.
Welcome back. It will be very interesting to see if we see a bit of a bounce back on the frontline index, because one of the components that was weighing down on the index, the IT pack, is now showing signs of recovery. So Infosys, the intraday chart, comes up for you. The stock is still lower by about 2/3%, but off lows by about 1% as well. So we'll watch out for any incremental recovery in the IT pack and the impact that it will have on the overall index as well. JSW Steel is the other one, which is currently at the low point of trade with a cut of 2.5%. But we're talking about the new listing. Let's talk about that one. We have Ankur Gupta, who's the managing partner and head of real estate for Asia Pacific and Middle East at Brookfield, joining in on account of the listing of Schloss Bangalore, the company that owns and operates Leela Hotels. Thanks a lot, Ankur, for joining in. It was a pleasure speaking with you when the issue opened for subscription. And now as we speak, it's a subdued listing that we've seen. on account of a couple of factors. One, the market sentiment by and large is, on the downside in today's trading session, but also the demand for the IPO, barring the qualified institutional buyers from a retail and an HNI standpoint, was just about par for the offer that you made. The big question, however, from here on, even as there are a lot of tailwinds for the industry, you get the added benefit of lower finance costs. So basis the stock that currently is trading and the valuations that the street is ascribing, they are expecting close to 250 crores in terms of profitability by FY27. Do you think that's a realistic estimate given the 150, 160 crore savings that you will get on account of finance costs?
Hi, Mangalam. Thank you very much for having me today. A very good morning to all of your viewers. It's a momentous day today. In the path that exists in front of hospitality in India, the story of real assets in the country, and the development of India that needs to be housed in properties and companies like the Leela. It's the largest IPO ever in the history of hospitality sector in the country, 3,500 crores. Very, very grateful to a lot of investors and first-time investors. We've had sovereign funds coming in from the Middle East, from Europe, few of the largest names out there in the domestic mutual fund space. So I would say that today is a day to celebrate how far along the hospitality and the real estate and the real asset sector in India has come through. On behalf of Leela, I would say that since our March numbers that have been publicized, and you're accurate that post-listing, the finance cost will substantially reduce. More important than the finance cost reducing is the amount of access that Leela has today to capital, to partnerships, to stock, and to growth. I'll give a couple of examples. Over the last 2 months, we've advanced our program to create a Leela Palace in Mumbai. We've added another property that will soon come up in our district where we own literally the entire zip code in Powai. And we have furthered our stated objectives to take the brand global. So all in all, the sector tailwinds are clearly ahead of us. Leela was voted as the best brand in the world. Right. Very proud that an Indian brand finds global appeal. And I think today is a momentous day in all of that.
No, it is a momentous day. We take that point and we can't, disregard the journey that has been. But the question about stock markets, and you'd know this better than everyone else, and investing, as there is the journey in the future that matters a lot more than what has taken place in the past itself. So a two-part question. Once again, a repeat of what I asked you earlier. Is 250 crores on the bottom line possible by FY27? And the second part, you spoke about increasing your, hotel expansion plans, etc., opening newer places as well. Currently, as per your, red herring prospectus, you have about 3,500 keys. Over the next 2 to 3 years, what is the key addition pipeline that you have?
So I would say the board, in our first analyst call, we will issue guidance, but your numbers are fairly accurate. I would say the company should do better than that. So I can only give so much guidance right now. To your second question, we've disclosed 7 + 1, 8 hotels in the pipeline already. And as I mentioned, there are several others that the company has been working on for the past several months. So the growth ahead of the business is substantial, is superlative. And the ability to extend the brand into newer territories, repeat what has worked for the business. I would say, and I've said this in your channel, that the Leela should be thought of in comparison to any large global brand that exists today, with the added benefit of it being a truly Indian brand. Indian markets are the best in the world today, and the Leela is right front center of that story.
All right. Assuming that you actually go ahead and do a little better than what one's estimate would be, you would still be trading at around 55, 60 times 2-year forward price to earnings. What's Brookfield's own long-term plan? How are you looking at this space? Apart from Leela, you have a couple of tie-ups with a few other brands as well. That's point number one. And secondly, on Leela Residences, what's the monetization plan here?
So let me answer a couple of questions for you. In the last fiscal, which is looking back 12 months, the Leela business did an EBITDA of 700 plus crores, which means that on an EBITDA basis, which in our estimate, we got 8 times subscription from qualified institutional buyers a lot of demand in our large funds coming into our anchor allotment. So the street estimates for how to value business like this is more basis an EBITDA multiple, which I would say today at the listing price, at the IPO price, makes Leela very, very attractive on even a backward 12 months basis. On a forward 2 years basis, I would think that this business is an amazing opportunities for current investors and for more investors to come and join the story. As far as Brookfield is concerned, we've been in this journey in India for the last 15 years. Our portfolio in India today is almost 3 lakh crores. We are a long-term investor in every story. We build businesses for perpetuity and then involve and invite partners to join us to even further that.
All right. And the monetization model for Leela Residences?
So the Leela Residences is a very attractive sector. India lacks serviced apartments. As we see the proliferation of GCCs in the country, a lot of business activity, people getting more and more mobile, the need for high quality rental accommodation for senior executives has never been felt more. And the supply-demand mismatch that exists across hospitality is very massive. In this space, I would say that the supply is almost non-existent. Brookfield has a lot of experience in rental housing, serviced apartments across the world, and that's what we are planning with our first serviced apartment, Leela Residences, that's going to open up in Mumbai early part of next year. And we certainly believe that business model has a lot of tailwind behind it as well.
So as a proportion of your overall revenue, if you could give us a sense what your target is, should come from the residential business.
It's too soon to tell right now, but as I said, there is almost no competition in this space, and with more than 200 million households getting into the luxury consumption story, the demand for high quality living spaces, which are attached to workspaces, which are attached to places where people spend their time, has never been felt before. And I would also like to say that Brookfield has the experience of delivering on that business plan.
How much faster can you grow in the future than what you've grown in the past? If you could give us a sense on that.
Over the last 5 years, 5+ years, we more than tripled the business.
Yes.
With today's event, Leela has further participants from a large number of investors, public market players, large mutual funds, global financial institutions. I would like to believe that the best years are still ahead of us, and the company has a very clearly defined business plan, very healthy balance sheet, and it's playing in a sector which has very, very high demand and limited supply.
Right. Let me ask you this again, because over the last 5 years, like you said, you've tripled your business. But that's on account of a favorable base. You had, the post-COVID boom that happened as well. And a large part of that also was from the initial corrective actions that you took on the company after taking it on as well. Now, as we speak, you've made yourself a formidable base. At the same time, the trends, while they're extremely strong still, they're petering out when it comes to the pace of growth because of the high base already. So in regard of all of that has happened, do you believe that the next 5 years you are likely to triple as you have in the previous 5 years? Because you're saying that, maybe the pace continues.
I would say that, you rightly said that the last 5 years have had many events. Some of them have been favorable. A lot of them have been very unfavorable in the business. It's very easy to look back and say that COVID or the post-COVID revival helped the sector. But it's also, it shouldn't be lost on anybody that those 2 years were probably the worst years globally that the sector saw. So if in that period the business grew substantially, I would like to believe that starting, for example, today, our targets should be even higher than that. And not just our targets, our belief that this business will be substantially larger is rooted in first principles of the opportunity, of where the business prides itself, and the management team's experience, along with the board that is there to guide them, and frankly the sponsorship or the promotership, as it's called in India. So I would say this is a perfect storm for this business in the space that it exists. to grow substantially, hopefully, and most likely will outpace the growth that we saw over the last 5 years in the next several years.
Thanks a lot for that, Ankur, for joining in. Again, a momentous day, so wish you many congratulations, and hopefully you will be celebrating in one of your Leela properties itself. So that's, Schloss Bangalore, the owner and operators of the Leela. Slightly subdued in terms of listing because of the market sentiment, etc. as well. But, from the time that Ankur started speaking, there was a minor recovery in the stock price as well. A couple of details that he said which bear some importance. One, 3 years from now, or FY27, we can probably see the net profit cross over 250 crores. And the last 5 years, they've tripled their business. The next 5 years, perhaps, they could grow a lot faster as well, with important parts of the revenue coming in from newer properties that they've lined up for the next couple of years. With that, we'll slip into a short break, come back on the other side, get you more of the markets and a lot of stock-specific action. Stay with us. Watch out a couple of stocks in the broader markets. They're doing extremely well. We have Yes Bank, which has now seen a bit of a spike, currently at the high point of trade with a gain of almost 4.5%. But a few of these cement stocks are also picking pace. So we have Dalmia Bharat from the broader markets, currently about 1.7% higher, but most of the gains have come by in the last 15 minutes or so. And following suit is also Ramco Cements, which has moved higher to the high point of trade. Alongside that, we have India Cements as well, which too has seen a bit of a spike. And most of the spikes have come by on all these cement stocks in the last 15 minutes or so itself. So we have Dalmia Bharat, Ramco Cements comes up for you on the screen. And we have India Cements as well, which should come up for you on the screen in terms of an intraday chart. And actually, pull up the ones to the west as well. We have Ambuja Cement too, which has seen a bit of a spike. It opened slightly flattish, thereafter saw a bit of a dip. That dip has been bought into and currently in the green. We have the technical outlook on the market right now. Saumil Mehta of Capital Market, Mirae Asset, Sher Khan joins us now. Saumil, we're seeing the frontline indices consolidate. They've been in this 24,500 to 25,100 sort of range for the last few trading sessions. Where do you see and how do you see this range breaking? What would be the technical triggers according to you?
This range has been there since last 3 weeks, and we are on the 4th week now. I don't see much in the coming week, but however, the undertone still remains positive. So I'll be expecting a target of 25,500, 25,400 in the medium term outlook. However, in the short term, I think still this range is intact and I'll be expecting more consolidation. In the bank Nifty as well, I'll be expecting a good consolidation. However, the undertone still remains positive. Today, the PSU banks are looking great. I'll be expecting targets of around 56,100, 56,800 in the short to medium term outlook. So undertone remains positive for Nifty and bank Nifty both. We are at the lower end. The lower end is 24,500 for Nifty and 55,600, 55,500 for bank Nifty. So this is the right time to go in and buy with a good risk reward ratio. Sectors like banks and reality, two of them are looking great, and sector rotation would be the flavor at this point of time. So stock specific and sector specific would be the focus. My stocks for today would be one from the bank, one from the reality. One is IDFC first. Stop loss would be 67.50 and the target would be 70.50. A small consolidation has broken on the upsides, taking support at 20 daily moving average, which is a great sign in the medium-term outlook as well. The second one is Oberoi Realty. Same thing, consolidation break on the upside, taking support at 200 daily exponential moving average, which is a great sign in the medium-term outlook. Stop loss would be 1715 and the target would be 1820.
All right, so IDFC First Bank and Oberoi Realty are your stock picks. Is there anything you like specifically in the cement pack? Because we were talking about, just before coming to you, Ramco Cements, Dalmia Bharat, India Cements, all of them spiking a little. And it's unusual because before monsoons, you don't see any of these cement stocks spike. Is there anything chartically that suggests this move?
See, we have seen a decline in the last couple of trading sessions. Probably since last week, we've seen a decline. And now that is a small, in the very short term, a small retracement of that decline. I would not go in and buy at this point of time, only if the highs are crossed. Like, for example, Ramco Cement. I like Ramco Cement overall in the medium-term outlook. If it goes above 1015, only then I'll go in and buy. But at this point of time, avoid would be my suggestion.
All right, take that point. Thank you so much, Somil, for joining in and giving us your views on the index as well as individual stocks on the index. He believes that consolidation will continue, but it is a positive from a medium-term standpoint or the structural move for the Nifty. And as we speak, actually, the Nifty has conquered the 24,600 mark as well. So from the lows, we've seen a near 100-point recovery on the frontline index and led by some recovery from the lows in the IT pack itself. Before we slip into a short break, just pull up the intraday chart of Nykaa. The company reported a fairly good set of numbers, but maybe weakness in their fashion business is what is keeping the street on tenterhooks on that stock. So currently at the low point of trade. We'll take note of a bunch of these stocks and the market in general on the other side of this short break. Stay with us. Eternal, that's the stock on our radar right now. It's up at the high point of trade, so a big move is what we're seeing on Eternal. Remember, it has been under pressure, quick commerce related issues, but more importantly, the liquidity event when it comes to the company having capped its foreign shareholding to 49.5%, and as a result of which its exclusion from the frontline indices like MSCI as well as FTSE. By frontline, I mean frontline passive indices, and then there was a near $1 billion worth sale on account of that reject. Now that the supply event is over, maybe the street is looking at these stocks favorably. And Omex Reality is the other one, which is spiking up around 12% right now. So that's a stock that we'll keep an eye out on. Omex is higher by 12% on the broader markets, with a fair amount of volumes backing that stock as well. We spoke about Apollo Hospitals trading mildly higher after an inline set of fourth quarter numbers. The management also spoke with us earlier today. Ekta joins in to tell us more about the numbers and what she made of the management conversation. Ekta.
Well, yes, for Apollo Hospitals, it was an inline set of numbers. The Q4 occupancy improved to 67% versus 65%. The Q4 GMV was up 11% as well. And the 24/7 guidance, the Apollo 24/7 guidance of break-even is intact at Q3 to Q4 of FY26. Now, in terms of a couple of call takeaways or, a couple of management key takeaways, they have said that they are targeting 70 to 72% occupancy increasing, 10% increase in volumes of higher end surgeries has really affected or impacted the ARPOBs. So that is probably a trend we can see going forward. FY26 could see another 7% increase in ARPOBs. International revenue did not meet the expectations, but they are looking at newer markets to diversify risk. They are moving towards 1,000 crore GMV per quarter for the Apollo 24/7 business. They will begin the Worli Hospital post monsoon, and they have expansions planned in various cities: Hyderabad, Kolkata, Delhi, Gurgaon, Pune, and over around 6,000 crores in the next couple of years. But they are adequately funded when it comes to the capex lined up, especially also from internal accruals. Morgan Stanley overweight, they've cut their target price. Nomura is neutral, Citi has a buy, and Goldman Sachs has a buy as well on the stock.
All right, Ekta, thanks a lot for that. So that's about Apollo Hospitals. With that, we'll wrap up on this edition of Chartbusters. You stay tuned to CNBC TV18 for more unmatched insights and unparalleled market coverage. Keep watching. Nuvama presents CNBC TV18 Market Central.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia. And the week has begun on a muted note, at least for the large cap indices, down close to about 0.5%. The Nifty is around the 24,600 with a fall of about 135 points, while the Sensex has declined by 450 points. But it's good to see that mid-caps are, quite excited in trade still. The mid-cap index is up in the green and the advanced decline ratio is positive.
What's also good to see is the fact that the bulls are still managing to defend that 24,500 level on the downside. So that's the other good bit. We are back from the lows of the day, still down 140 points on the index, but it's still a fair bit of a recovery from the intraday low, which was around 24,524. So it's a 90-odd point recovery that we have seen from the lows of the day on the index. The PSU Bank Index, though, continues to move in a league of its own. It was the top performing sectoral index last week. It is the top performing sectoral index in today's session as well. Another 2% on the PSU Bank Index, and that is what is also contributing to the Nifty Bank and its outperformance last week, and also to the fact that the Nifty Bank is showing some semblance of outperformance in comparison to the Nifty in today's session. So 55,650 is where the Nifty Bank is, and if you could see the contributors on the Nifty more than the Nifty Bank, you would get an idea of what are the stocks that have been dragging the index lower in comparison to what have been pulling it higher. And look at M&M, HUL, SBI. So it's PSU banks, consumption in the auto names as well, but the heavyweights, Reliance, HDFC Bank, ICICI Bank is what is keeping the index under pressure. But there are some last few earnings reactions that we need to talk about. AstraZeneca is up 11.5% now, reported results on Friday. So that's the top gainer on the Nifty 500. And Niva Bupa, of course, the top loser in today's trading session after that large block deal that took place in today's trading session. And some of these smaller PSUs that were the outperformers last week are seeing some bit of profit booking now from higher levels, be it MMTC, be it ITI. Both of them are under pressure today, anywhere between 5 to 9% in today's trading session. But what is also under pressure, though, is Emphasis, and it's recovered from the opening lows, but still trading with losses of around 2.5%. Reema, what has happened here?
Well, as the Mint report suggests, that they have lost one of their big clients, FedEx. It's one of their oldest clients and third largest in size, which approximately contributes about 8% to the overall revenues. And Emphasis appears to have lost this deal to Accenture, and the business transition will happen towards the year end. So that's the reason why Emphasis. Now, the companies don't individually comment on companies or their clients, but this is what the reports are suggesting. When Mint reached out to the company, they said that, our business pipeline is robust and, pretty healthy. But they, again, not going to comment on individual clients, but the street is clearly worried, down close to about 2.5%. CNBC-TV18 has not independently verified it.
Yeah, even in their fourth quarter, at their TCV at around 390 million was a 7-quarter high, right? Yeah. So they're continuing to maintain that their deal pipeline continues to remain robust. So Emphasis, and which is why the street is taking some bit of heart from the management commentary that they had given from at the end of the fourth quarter and for the year ahead as well. So there's some recovery that we are seeing from the lows of the day. By the way, what is not seeing any recovery though from the lows is Persistent Systems. That's down 2.5%. Nykaa is now down 3% as we speak. So despite the strong results, there are concerns over a few business verticals. HSBC has gone ahead and downgraded the stock as well. So that stock is among the top losers in today's trading session. What is doing well though on the flip side are some of these smaller banking names. Karur Vysya Bank is up 5.5% among the top gainers today, and Bank of Maharashtra too trading with gains of 5.5%, and Yes Bank also trading with gains of a similar quantum. But we take a short break here on that note on Trading Hour. On the other side, we discuss all things commodities with Manisha Gupta. Welcome back. Shifting focus to the commodity space before we get back to the markets. Manisha Gupta is now joining in, and today we are focusing on gold that is seeing some rebound from lower levels, Manisha.
It is, yes, and there is some safe haven buying coming into the markets, and there is slightly risk off, as you see many of the global equity markets slightly off there. In the previous week, we saw the gold prices decline by 2%, but we have seen strength come back. It's trading nearly a percentage point on the higher side right now. And when you look at this year, we are up by 27 to 28% for the gold prices, even from where we stand. Well, there are renewed concerns between US and China trade agreement, as both the sides are now talking not so nice statements there. And then the Federal Appeals Court also has temporarily reinstated all the Trump tariffs. So all those uncertainties seem to be coming back into the markets. Also, take a look at the long-term government bond yields rising across major economies, and that has been supportive. Trump also increasing, saying that he would increase tariffs for aluminum and steel from 25 to 50% from 4th of June. Hasn't done well for the safe haven either. And then the markets also are looking at the US federal budget, which stands at around $1.9 trillion for this year, and in totality stands at around nearly $36.2 trillion. Until you see this number between that $35 to $40 trillion in sense of debt, you will see gold prices continue to rise. Yes, there will be some correction and improvements on the lower side, but those perhaps would be buying opportunities. The street is also looking at the Indian physical demand. Well, the wedding season in India seems to be winding down now. This is sowing period. Not too much of rural India also buys gold or silver right now because they're busy sowing. So this is slightly of a slack period, June and July. August is when you see festivals as well as weddings come back yet again. So the next 2 months, not so strong in sense of Indian retail buying, but in sense of prices, markets feel could continue to be very, very volatile.
Thank you very much for that. And back to the BofA Securities 2025 India Conference. From the sidelines, joining us is a very prominent figure in the Indian financial landscape, Kaku Nakate, the India's CEO at Bank of America. Surbhi is now in conversation with her. Surbhi?
Thank you so much for that from the studios. Here we are at the Bank of America Securities India Conference, and I'm in conversation with who else but the bank's India head, Kaku Nakate, a lady who needs no introduction, decades and decades of experience in the financial landscape, and many a times known as the deal-making lady of India as well. Kaku, what a pleasure to be speaking with you in person. Thank you so much for joining in. And we're having this conversation, and you're having this conference at a very, very interesting time, right? Internationally, what's happening in India. I'll come to the international piece in a bit, but let's start by understanding your reading of on-ground corporate sentiment, whether it's capex, whether it's decision-making, the so-called animal spirits. Where is India now?
So thank you for being here with us at the conference, and I would like to thank CNBC for definitely coming over. Having said that, I think India is in a sweet spot right now. Actually, if you really look at corporate earnings to GDP, it is now at 4.8%. It's the best in 16 years. So obviously the earnings and the operational efficiencies that our big corporates as well as the medium corporates have been able to get is a phenomenal story, which we all need to kind of highlight. As far as investments are concerned, I think people are getting ready to invest. There is a lot of interest being shown in supply chain manufacturing, but people are waiting for some diktats to come out clearly, really, so that, the trade can actually empower, the growth in the industry. Whatever corporates have been doing, they are definitely growing and investing in that front. But can we say that major large-scale investments are coming? Yes, it's coming in few sectors, I would say, by few, private companies. I would love to see more of that because this is India's chance to really become sooner the third largest economy. We just crossed being the fourth largest just 10 days back.
Absolutely. And it's interesting you say that because, the whole debate around private capex firing up, it's been ongoing for several years, right? And even the government seems to be giving an indication that we've done the bulk of the heavy lifting up until now. The baton needs to be handed over to the private sector. So expand on that point. Which are the large sectors where you see this happening? Is it going to be this year? Is it another couple of years down the line? And which are the pockets of activity which you clearly see on ground?
See, I think one thing we must realize that, when the current government came in, they really focused on, infrastructure investments in a big way. And now basically it's infrastructure investments which are actually slowed down compared to the budget. So, that's one headwind we are having from the government sector, where public sector is investing a little less than what is even in budget. And of course, a lot of money is also going to subsidies. So subsidies have outpaced. It's like 33% versus 25%. Now, as you know, that when you invest in capex, the payback is 3.25%, while subsidies is flat. It definitely spurs consumption, but it doesn't have a multiplier effect. So that headwind you are definitely seeing, which we can't really rule out. But on the private sector, to your point, people are enthused of really getting into the electronic sector, where there's a lot of, PLI boost, there's a lot of interest, and, we can become really suppliers to the world.
But there's a problem there now, right? That brings us to the immediate issue, because you have, the leader of the free world, so to speak, call up a large private sector American company and say, hey, you should not be making in India if you want to sell those phones to the US. So, how do you see India navigating this? How do you see companies dealing with all this uncertainty?
I'm very confident that our Commerce Minister, who's right now in midst, and we are going through the trade negotiations with US, and they do want to come up by autumn, a proper trade agreement. I think some of this will be put to rest. Having said that, you've heard the companies' answer to that, and they are the best judge on where they should be. Sure. I don't see that actually slowing down, because obviously this was a sector which was very well grown in China. There is a need globally, and we can really put to work, and it's easier to, actually take it on board. Of course, on semiconductors, which is also need of the hour, we might go step by step. We can't really cover what we have not done for many years. So I do see those. Autos, we are already doing well, but actually the slow growth globally can have an impact as we go through, but our exports will continue in a big way. I think there could be a sweet spot, yet to be a thing, is on the pharma. Because basically, if the pharma costs or the medicine costs, healthcare costs have to come down in the US, we could play a crucial role, but the policy needs to really come out. But without that, on the consumer, the demographic dividend, and basically what we have best going for every corporate is controlled inflation, right, which is never good interest rates and a decline in interest rates. And third, policies of certain states which can compel them to really come in a larger size to actually grow or, invest in sectors where India could play a leading part.
Sure, absolutely. Speaking of investments, what's the big foreign view on India against the backdrop of the world seeming to look for diversifying away from being overly concentrated on US assets, whether it's bonds or equities? Where does India fit into the scheme of things, and what do you see ahead next, say, 12 odd months?
So if you really see the last few years, the Indian markets have been resilient on account of two. One is our domestic mutual funds. They actually, the mutual fund investments, as well as the SIPs, which are as large as 3 billion a month, it has been really bringing in the resilience that were required from the market. The average retail investors have been huge. I was doing some study some time back, and I was just checking the numbers. Only in the last 15 months, we have added around 1.3 crore new investors on NSE. So that's really kept the market going. If you see the FPI flows, they have been in and out. And actually, they have been more negative than positive.
In fact, May is the last positive number. At least you've got 20,000 crores worth of total inflows, but it's been patchy so far.
And that's where I feel that, that's the upside from the market. Because coming back to the ratio that I really talked about, that if we have 4.8% of earnings to GDP, and many people used to say India has huge valuations, but actually the profit earnings have lived up to that expectation. So we have not had a PE expansion. The earnings have actually really driven that. So that's very important. And that's the point we are pointing out at the conference, that that's something the FPIs are missing out on, really noticing. And that's why, as, the geopolitical tension increases, as you really see that inflation is sticky as far as US is concerned and as far as Japan is concerned, two large economies. India has got a sweet spot with interest rates already down by 50 basis, and I do think 50 basis is more to come. This is a chance people should invest, and I hope we are able to convey that at the conference.
You see only about 50 basis points ahead from the RBI, sort of down the year?
This is for this
calendar year. For this calendar year. And how significant is the Chinese competition to India, not just in terms of manufacturing, but actually flows, because that market has a valuation comfort. There's still a trade war ongoing. But, how serious is the Chinese competition?
See, Chinese competition is here, and they have done very well in certain sectors. There are certain learnings on manufacturing. We have to actually learn from them. So I don't think that we should be worried. But you have seen last year, the MSCI emerging market investable, index at one point of time had gone up, where India had become 22% and China was lower. So the flows between these two markets will continue in this VUCA world. We can't really rule that out. But I do think that there's place for both India as well as China as far as markets are concerned.
Flows are concerned. Got that point. Now let's come to the exciting world of deals. I was looking at some stats, and it seems that FY25, the year that closed, total amount of money raised by promoter selling or PE selling, OFS, blocks, etc., it ran into some 9.4 trillion rupees. Huge sum of money that we're talking about. What have you picked up on the nature of deals, the fact that a lot of times it is insiders, whether it's promoters or PE? But is it a sign of the market's maturity, or is it an indication about where valuations are and where things are?
So on valuations, we've already touched. So I have nothing new to add. But I can say that in the last 24 months, markets have, and 21 was the highest actually. 2021 year saw the highest, raisings in the capital market. But even in the last 2 years, if you see, especially, we were roughly about 16% of the global IPOs. So that does talk a lot, that people are looking at good companies with, good problem-solving solutions to come to, invest in emerging markets. And India is clearly standing out. Private equity, and my friends at private equity have done a phenomenal job by actually encouraging promoters to sell down third generation, fourth generation, take over companies, bring the efficiencies, and then sell it down into the markets. So markets have become a lot more liquid. If you were just talking about the numbers, we raised 20 billion in the IPO market itself, which was 16% of the global IPOs. That was followed by 51 billion of follow-on secondary market blocks, etc. And then you had a QIP of around 17 billion, all in 1 year. So markets have really become, have shown the depth for new IPOs as well as new companies to look to list in India. And you know this, many people have reversed their structure from US to list in India. So I'm very, very confident that the markets here are to grow. I think what we do need to do a bit more is to attract, private credit. Private credit is a big market globally, multi-strat funds, and I picked up even talking to some friends at the conference here. Multi-strat funds are getting a lot of money into India. And that's where I feel that India can do a lot more. and come out with products lot more, because we do need infrastructure. We do need to bring down our logistics costs. We have good executed assets. So, that's something we should really focus on together all as a team.
Private credit, will watch out for those trends. Finally, Kaku, I mean, for you, you'll be passing on the baton at the bank as well. And I'm sure we'll see you around in the financial landscape. You're not going anywhere, I'm sure, in different formats and forms. What would you say would you like to be seen as maybe your legacy? And very quickly, maybe a word of advice to the next gen, whether it's in the bank, outside, general in the Indian financial services industry.
So I continue right now to be the CEO of the bank. I've completed 15 years. That was the maximum allowable from an RBI perspective. Vikram Sahu takes over from me. And, we are waiting for RBI and we have to put in the application to get RBI down the line to get him on. But having said that, I continue to remain with the bank. I will be looking at client relationships and build. And my message to everyone is that, I wish I was 20 years younger. There's lots more to offer from India. And whoever is really in that phase can contribute not only a lot to India, but also to oneself, because there's going to be really good opportunities. And we have to stop just thinking about equities alone. We need to think about how we can bring more investments to India in different forms.
Wonderful, Kaku. What a pleasant conversation, and your excitement is infectious, to say the least. Thank you so much, and wish you and the team all the very best for the conference ahead.
Thank you very much for having me here.
Thank you very much. And with that, it's back to the studios.
Thank you, Surabhi, for that conversation there with Kaku Nakhate, the India CEO at Bank of America. We take a short break here on Trading Hour. The Nifty has recovered significantly now from the lows of the day. Now under 100 points lower is where the index stands. Quick chart check and some trading ideas on the other side with Soni Patnaik of JM Financial. Stay tuned. Welcome back. Time for a quick chart check with Soni Patnaik from JM Financial Services. Soni, good morning. Thank you for joining in. And yet again, as has been the case over the last few weeks, the Nifty has managed to defend 24,500 on the downside. What are the charts indicating here for the index and for the Nifty Bank as well, and your stock recommendations for the morning?
Good morning, Harmas. Thank you for having me on the show. So I think Nifty is sort of consolidating at the beginning of this new series, 24,500, 24,400. This is the major important crucial support for June series. If that breaks, it can again retest lower support levels of 24,000. However, as long as this is holding, it may slightly see some rebound towards a 24,750, 24,800 at max. That range also holds to be quite a crucial resistance. Overall, the entire series seems to be indicating that it could be a sideways trend, not much movement in stock-specific action could, of course, perform better. There's just one silver lining is that, it's towards Bank Nifty. Possibly if Bank Nifty is able to break above 56,100 levels, you may see certain fresh highs in Bank Nifty towards 57,500 odd levels for June series. It is still holding on to very strong support of 54,500 to 54,800 for the entire series. Now that is crucial to watch. So if Bank Nifty breaks out above its resistance zone, it can also pull Nifty out of its consolidation mode as well. So as for now, I think it's better to stick to stock-specific strategies. And because we are bullish in Bank Nifty, the first recommendation also comes from that similar space. The buy recommendation officially given today is in SBI, which has given a very strong breakout. Since Friday, we've seen holding strongly above 810. So one can buy SBI at current levels, keeping a stop loss of 789, and a positional target towards 845 to 850 levels can be seen. The second officially recommendation that we've shared today would be in Uno Minda, which is a new entrant in F&O space. And it has already added 22% fresh long built-up positions today, with giving also a technical breakout. So one can buy Uno Minda in June futures, keeping a stop loss of 1,010 and a target of 1,055 to 1,065 can be seen.
Interesting there. Uno Minda, the new F&O edition there. Sony, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Take a short break. On the other side, we go back to the BofA Securities Conference and get chatting with Kunal Tayal on the other side for his views on IT, cement and real estate. Stay tuned.
fully.
Welcome back. Some statements coming in from Maruti Suzuki, and once again the company is highlighting affordability issues in the small car space. Mr. Bhargav has been very vocal about the pressure felt by buyers in the entry-level cars, and even in the month of May, the entry-level segment sales were down 13% in the month of May on a year-on-year basis. The company goes on to say the sentiment in the urban market is not positive, and they are calling for some sort of incentives to revitalize the small car segment. The stock is down close to about 0.5%. But as promised, let's go across to Nigel, who's in conversation with Kunal Tayal, the senior analyst for India IT, cement and real estate at the BofA Securities, from the sidelines of the conference. Nigel?
Hello, thanks a lot for that, Reema. Yeah, Kunal's in conversation with us. Hi, Kunal. Good to have you on the show, and good to be here at the conference as well. Kunal, let's start off with tech first. Tell us, how are you feeling about the tech sector? Plenty of uncertainty with President Trump. There are pullback of deals or delay of deals as well. For the sector on the whole, how are you feeling? What's your preference, between mid as well as large cap as of now?
Sure, Nigel, thank you for coming over to our conference. On the tech sector, firstly, look, it's been a couple of tough years for the sector. And some of our work was indicating that things were starting to change at the start of the year. Of course, lots has changed since then. Our recent work is telling us a couple of things on how it is moving since April. Number one, on the positive side, it doesn't seem like all this uncertainty has pulled down spending to the extent it was feared. So what we are getting is that obviously there is some pressure on discretionary spends, but then there are several other areas of the technology spend pie where customers are still continuing with their journeys. So that's on the positive side. So, in a manner of speaking, the dip that has transpired from, let's say, a month of March and onwards has not been as intense like was being expected in the street.
So that's good.
That's good. Conversely, there was also some hope building up that with the movement in the tariff situation, a 90-day pause, talks of a deal with the UK and China, there could be an end to the uncertainty. We are not picking that up. In fact, a lot of our findings are suggesting that the 90-day pause may actually serve to be, a phase of uncertainty for this entire duration. And if a deal were to be concluded at the end of that is when certainty could return. So in our view, what you're looking at is a slow taper off in IT spends, but the uncertainty sort of continuing for a couple more quarters.
Yeah, all right. So Kunal, just wanted to take forward a couple of those points then. In this sort of an uncertain environment, what would the preference be? Some of those large cap names, if I look at the cash flows, as a percentage of market cap, they look fairly well placed. Yeah. The problem is that there is a lot of uncertainty. However, there will be mid cap names that will grow at a faster clip. So large caps growing at an anemic pace, while mid caps growing at a faster clip. Though it comes at expensive valuations. What's the preference?
In our view, the large cap to mid cap trade-off has already played off. It's been the case for a while that mid caps have been the faster growing companies, and the markets have priced them according to that.
Okay.
Likewise is true for the large caps, where you described that the growth rate is on the lower end of the curve. And therefore, on a go-forward basis, as we are looking at investment returns, Nigel, our style is more absolute, and we are looking at very specific criteria across large and mid caps, rather than preferring any one bucket over the other. In terms of what is it that we are looking at, 3 or 4 things. Number one, we think that there are certain areas which could be called as secular winners.
Okay.
So companies that have exposure to data and analytics is one area where we think that companies with the right exposure will definitely benefit from that, first up. Second, there are companies with a well-defined right to win. So in the large caps, you have some companies which are very strong in cost takeout deals that can really help them perform better than the peer set. On the mid caps, we've seen a couple of strategies play out. Either you're very strong in sales and marketing, or then there are niche areas where, again, you have credentials which are particularly strong. And the final one is, margins is often a less focused thing in the IT sector. But again, what we find is that there is a set of companies where even in the current uncertain times, they might have scope to expand margins from the current levels, which may not apply to other companies across the sector.
Okay.
And this is our pecking order. This is our screening criteria for looking at what we favor in the sector.
So right to win, data analytics, as well as possibility of margins expanding as well. You want to give us your top picks, which all have already published out, from the tech pack itself?
I would stay with the screen that we are using, Nigel. We are not. I wouldn't be getting into the individual.
Okay, let's shift away then from tech to cement, more domestic facing.
Yes.
Cement has had a horrific FY25, if we could say the least. Volumes didn't pick up, pricing was under pressure, and profitability took a hit as well. Now there's hope that FY26 will be far better. How are you all placed on the cement pack, and what would you all prefer out there? The larger cap names who are dominating the industry, the likes of the Adani Group, Ultratech as well? Or do you think the smaller ones could relatively do better because the delta could be higher out there?
Absolutely. I mean, cement's been a very interesting sector. Like you pointed out, the volume story wasn't exactly great in FY25. Yet if you look at the stock performances for most of the companies in the sector, I'm sure you'd agree that they held up pretty well.
We're looking ahead.
Looking ahead. Exactly. So, so in terms of, therefore, what we think will be the incremental factor in the sector, we think that last year when the stocks didn't fall as much, that was because the street was looking ahead to volume sort of recovering once the new government settled in. For us, really the incremental factor is pricing, because all through last year, pricing was weak. There was not too much of a confidence on pricing power returning. I wouldn't say it is an established trend, but at least Q4 has started, a fresh round of hope.
Okay.
That after a tough 2 to 3 years on pricing front, this parameter can recover for the sector. To your question, therefore, as to what are the names that will do well, if this is the criteria, at least in our observation, pricing is a bigger leverage for the mid-cap companies on their EBITDA per ton outlooks versus the large caps.
Okay, all right, interesting. And before we let you go, let's touch a little bit about where the cement is used in the real estate space. We had the management of DLF, Mr. Tyagi, last week, and he was going all guns blazing, saying the best is yet to come. What is your take on the real estate basket? Normally, we have this 10-year cycle. The real estate developers, they say we're in the first couple of years. Analysts say in the middle years. And the bears say that we're towards the end of it. Where do you think we are?
All right. So, I put it as year 5 of the upcycle. That said, CY24 wasn't without its share of challenges. We heard that there were at least a couple of soft spots last year. Industry supply was an issue as approvals in pockets were slow to come by. And pricing was starting to rise at a very fast pace. That exactly isn't ideal for the sector. Especially you have to make the case for a 10, 12, 15-year cycle, take your pick. The good part is that both of these aspects have started to show signs of settling down. Pricing is sort of back to rising at an inflationary level, plus minus. And supply, you often hear that Bangalore was the worst hit. And the Bangalore-based companies are starting to tell you that it's starting to resolve itself out. And therefore, our expectation for the real estate sector is that on a go-forward basis, these companies should still be able to compound bookings at about 10 to 15%.
Okay.
Given the price increases that have already happened in the sector, we think that the EBITDA growth for the companies can actually be faster. And therefore, overall, we're still positive on the real estate sector.
All right. What about the Delhi NCR market or the Mumbai market? What's the preferred, or you like the mix of both?
Little bit similar to the mid-cap to large-cap on IT. The market plays are pretty well established for the street, where Delhi, it's been viewed with an element of caution that investment demand might be taking over. The other markets are considered stronger.
Yes.
And therefore, our picks are more contingent on what is the availability of land bank that developers already have at their disposal. Because remember that, I was indicating that supply has been an issue. And therefore, in our criteria or screens, developers, that have a good visibility on land parcels and therefore visibility on launching new projects for the course of next 2 to 3 years stand to benefit the most.
All right, Kunal, it's been a pleasure hearing your thoughts. Thanks a lot for joining in and speaking to us here on CNBC-TV18. Well, guys, we got a little bit of a view on tech, on real estate, as well as on cement. Rima, a little bit for you, a little bit for me. Back to you in the studios.
And indeed, and for real estate, we're in year 5, but the EBITDA growth is going to look up from here on with the pricing power, the pricing increases that we've seen, and I think bookings compounding at about 10 to 15%. That should also hold. Interesting conversation coming through on all the sectors. Get into a break. On the other side, we'll talk more on markets. This time, we'll invite Anirudh Garg from Inba Asset PMS.
Welcome back. On to market conversations now with Anirudh Garg from Invasset PMS, who is joining in. Anirudh, good morning. Thank you for joining in. I was looking at your fact sheet and your Invasset Leaders Fund, and one of your top holdings here is Welspun Corp. And Welspun Corp had a very, very good quarter this time around, and their commentary too being bullish. The stock did well after its results. What do you see in Welspun Corp going ahead? Has it run its course, or the best is yet to come for the company? And if you could share an overall sectoral bit for Welspun Corp and its peers as well.
Yeah, hi. Thank you. Thank you for having me. So I think Welspun Corp was one of our tactical picks. We were tracking the company for a very long period of time. But somewhere now I feel that I think it's running ahead of its expectations and what we had in mind. So we have trimmed our holdings in Welspun Corp a bit.
And where have you added your holdings in the recent times, Anirudh? If you could share those.
Sure. So I think let's talk from a point of view, what sectors do we like going forward in the future? So we are, I think, proponents of relative change. By relative change, I mean that an advantage that a company, sector, or a group that has today did not have earlier. So we are very vocal, and we openly like the stock market infrastructure sector. I think this is somewhere a lot of shift has happened, and these are permanent shifts that take a lot of time, from the FD culture to the equity culture. And somewhere I believe all these participants who are well positioned in the stock market infrastructure space, be it an exchange, be it a depository, be it a good broker or an AMC, I think they're all poised for a good growth from here. So we are, one of our largest holdings is in this sector. Apart from that, we are also bullish on the capex sector in India. I think the capex run is still underway. So anything related to PSU capex like railways, defense infrastructure, or power, or maybe some specialized private capex areas, maybe like hospitals, or maybe something like all these electronic equipment manufacturers is something we like. Apart of them, real estate, public sector banks, private sector banks. I think the worst for India is over. We are at 7.4% growth, and 2.01 lakh crores of GST collections. And going forward, also we feel that there are going to be a couple of more rate cuts in the very near future. So I think India is very well poised for the next couple of years from here.
Got that. Anirudh, hi, morning. I was just looking, I think as of 31st March, Fortis is your biggest holding, but you also have significant holding in PG Electroplast, so that seems to be the play in the entire EMS. And the other one is Indian Hotels. Now, PG Electroplast, if you could just, compare it, say, vis-a-vis a Dixon, why PG Electroplast? What is its right to win from here on? It's already done well. I think in the last 3 years, the stock return is close to about 150%. So, a fair amount of the returns are already there now. What from here? And even Indian Hotels, we have a new, kid on the block, Hotel Leela's. So that's the other choice for investors to play the hotel theme. Have you analyzed Hotel Leela?
Yeah.
And how would it compare with Indian Hotels?
No. So I am not particularly a fan of Hotel Leela. I think not much is left on the table here. When it comes to EMS services like PG Electroplast, our portfolio has gone through a significant change in the last couple of months, and we generally have stages under which a lot of, maybe say 70-80% of the portfolio is changed when we look for the growth, when our growth stage activates. So here, all these stocks that we are talking about, be it Welspun, be it PG Electroplast, we don't hold them in our portfolio going forward. We have added, as I told you, more of stock market infrastructure and capital expenditure names in our portfolio.
So by stock market infrastructure, would CAMS be one of those? CAMS, CDSL, or even BSC for the likes?
Yeah, absolutely. Why not? They're all established in whatever they're doing. And I think barring a couple of internal sectors in between, they're all like monopolies, and there is still a lot for the newer players to catch up. So yes, wherever you find opportunity, maybe a CAMS, maybe a BSC or a CDSL, I think they're all the names that you mentioned are worth giving a try.
So which are the ones that are not worth giving a try, Anirudh? What are the sectors that you're avoiding right now, or ones that you dislike? Other than the ones, of course, that you mentioned that you have trimmed your allocations or you have exited.
Yeah. So I clearly do not like the auto sector from here. I think there is a huge transition going on in the auto sector. And generally, the demand cycle that is there in an auto, it's a 5 to 6 year demand cycle. And I think the demand cycle is played out. And now there'll be more inventories. People will not be switching their cars anymore. And as you were rightly mentioning in the show earlier, that the company is also feeling, because as other things get expensive, the pricing pressures also arise. So somewhere we feel that these companies will not be the flavor for us for the next couple of years at least. Auto sector is something that I'm bearish on. Also, I do not like, everything is growth versus whatever. What is your growth versus what multiples are you getting at? When I look at IT, when I look at FMCG, when I look at consumption, it's somewhere I feel that these sectors have a problem with growth, due to which the multiples that they're commanding right now are not affordable. I think this is a phase where the market will be awarding growth and growth only. So we are just focusing on where the growth can be possible.
Thank you, Anirudh, for joining in with your thoughts on individual stocks. Growth is the key parameter they're looking for. Get into a break. On the other side, we'll get you excerpts from our exclusive conversation with the Air India CEO, Campbell Wilson, on the other side.
Welcome back. Now in an exclusive conversation with CNBC-TV18 Shireen Bhan, Air India CEO Campbell Wilson says that the airline has increased its international footprint by 25% and also outlines the plans for 2 new airports in Navi Mumbai and in Jewar. Listen into a slice of that conversation.
What is India's share of global traffic going through India, and what is the headroom for growth? I mean, what should we aspire for over the next 5 years?
Well, look, the reality is it's very, very low at the moment. Air India, despite being 92 years old and carrying the national name, really only flies to 40-something destinations around the world, 42 at the moment. Countries with much, much smaller population base fly to double, triple that number. India should be able to support well more than 100 non-stop destinations by Indian carriers. So that then allows for connectivity between those flights. We have most recently started to restructure our network so that people traveling from Europe to Australia can connect within a couple of hours at Delhi. In the past, they used to take 12 or 18 hours to connect. And as a consequence of these changes, we've seen a number of international connecting passengers go from basically 0 to about 10% of our load in the last 3 years.
Okay.
For India, the great thing is that it's a nice to have, not a must have. We're always going to have huge traffic to and from India. We can augment it with people transiting across India, which allows us to add more spokes to our network, more frequency to the network, provide more choice for Indian travellers, and also then provide more employment for Indian people and businesses. So the upside really is enormous because we're only scratching the surface at the moment.
Well, speaking of the upside, your aspiration to be an Indian airline with the Indian heart but servicing global markets, and you talked about 40-odd international destinations. I would imagine that aircraft delivery continues to be the key constraint. What should we realistically then expect in terms of expansion of your international operations?
So over the past 3 years, Air India has gone from less than 100 operating aircraft to more than 300. We've increased the international footprint by 25%. So there has been some significant progress already. That was largely from aircraft that had already been manufactured that were able to get at short notice. What we're now waiting for is the first of the 470 aircraft that we had purchased that are being manufactured for us to start being delivered in earnest, and that is going to happen in 2026 and beyond. That is when the next step change in our expansion will take place, particularly internationally, because it will see a more than doubling of our wide-body aircraft fleet from 70 to well over 140. And so that really will allow us to connect the far-flung destinations of the world, North America, Europe, Australasia, and of course more into the Middle East and Africa, and really offer for the first time a true international network of density and breadth from India, and not just from Delhi, obviously from Mumbai, from Bangalore, and there are many other opportunities as well.
Let's then talk about the opportunities that open up with the Navi Mumbai airport coming in and the Jewar airport coming in as well. Jewar, of course, after Navi Mumbai. What will this result in terms of moving traffic, of where passengers are going to be boarding their flights from, and what is it going to mean specifically as far as Air India and the Air India group is concerned?
Well, we continue to have discussions with all of the airport operators, and we're very interested at these new airports that are being developed, not just in Navi Mumbai and Jewar. In the case of Navi Mumbai, it's probably the most imminent new opening. And so we have been in discussions about what capacity we'll operate from there. It's a little bit more complex in our case because we're a hub operator. We bring people into an airport and disperse on the rest of our network. So we need to be careful which flights we might move from the existing airport to the new airport so we don't weaken the hub. But clearly we want to be present in Navi Mumbai. It's a good airport, it's a good geography, it will have its own catchment. And so we'll be making some announcements to that effect relatively soon. In the case of Jewar, we think it's quite a different catchment. Again, we want to be present in that market, but it's probably going to be additions rather than any transfers from the Indira Gandhi international operation.
Okay, so additions for Jewar, but as far as the Navi Mumbai airport is concerned, you are going to have to reconfigure current operations and current connectivity. What percentage do you see moving from the current Mumbai airport infrastructure to Navi Mumbai?
Well, I won't speak specifically for Air India Group, but as it's been communicated to us by the operator, they want to do some redevelopment work on one of their existing terminals, which reduces their overall airport capacity by, I believe, around 20–25%. And so I believe that's around the proportion of traffic that they want to shift from the existing airport to Navi Mumbai whilst they're doing this redevelopment work.
Okay. How challenging is the environment today? Crude is still relatively benign. We haven't actually seen any significant moves on the upside as far as crude is concerned. But outside of that, there have been many of these operational challenges that we just spoke of. What does that mean in terms of operating costs for you? What does it mean in terms of your ability to be able to curtail losses? You brought down losses quite significantly to about 4,500 crores from over 11,000 crore rupees year on year. All of this impacts your ability to cut losses?
Well, I mean, we're very happy to see a marginal reduction in the price of fuel. It's about 40% of our cost, so it is significant. We continue to make good progress in improving revenues. We've more than doubled revenues in the last couple of years. We've tripled cargo revenues over the past 3 years. And in terms of costs, we've put a lot of investment into the business to improve premises, product, IT systems, whole gamut of things. That will take a while to pay off, and we sized that investment to support an airline that is much larger than the one we have today. So all of these investments and improvements and cost reductions that we're now underway, now taking, will lead to a much stronger financial position, but it's with the long term in mind, not something that we're doing as a band-aid or quick fix.
An exclusive conversation there with Campbell Wilson of Air India. But that we call time on this edition of Trading Hour. We leave you with the Nifty 100 points lower off the lows of the day. The broader market's doing fairly okay for themselves as well. So some dip buying coming in and the bulls managing to defend that mark of 24,500 on the downside, at least for now. But stay tuned for more unmatched insights and unparalleled market coverage. Keep watching. Nuvama presents CNBC TV18 Market Central.
Escalation of trade tension between US and China and widening of Russia-Ukraine conflict weigh on sentiment. Despite a strong fourth quarter GDP show, metals and consumer durables are big losers, while realty and FMCG eke out gains.
China's ban on rare earth magnets will start to hurt EV output in the coming months and may even lead to a production halt if not resolved, says TVS Motors MD Sudarshan Venu. He wants India to develop its own EV ecosystem.
Stocks of food and soap players like Britannia, Godrej Consumer and HUL perk up in trade on a cut in import duty on edible oils from 20% to 10%. The reduction in prices may hurt AWL Agri and Patanjali Foods.
Stocks of steel and aluminium makers take a dip after US President Donald Trump doubles tariffs on the metals to 50%. The souring of trade relations with China only adds to concerns.
India's GDP data springs a pleasant surprise. Growth in Q4 accelerates to 7.4%, the highest in a year. Growth in FY25, which is at 6.5%, is the slowest in 3 years, but in line with the government's estimates.
Very good afternoon. You're watching a halftime report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Manglam Balu. Well, it's turning out to be a session where it's definitely a mixed start, Manglam, to the week. You know, we have the Nifty as well as the Sensex, which is under pressure. But the mid-caps are showing some amount of resilience at this point in time. So the mid-cap index is faring a little better with a gain of around 0.2%, but definitely come off the day's high there as well. It's a lot about specific stocks in today's trading session. We have stocks in focus such as Apollo Hospitals reacting to what would be a massive capex plan that the company is planning going forward. We have Vodafone Idea, which is responding to its numbers. Nykaa as well, which is in focus on account of that. Ipca Labs as well as AstraZeneca from the pharma MNC space. That stock has spiked up around 12% post its Q4 numbers. So it's an active screen, you'd have to say, in terms of specific stocks, but we could be wanting more when it comes to the frontline indices. Hi, Mantha.
Hi, Ekta. There are a couple of silver linings that we're seeing in the frontline index as well. The Nifty is currently down by about 100 points, which implies that it has recovered nearly 125 points from the lows of today's trading session. The range that the street was working with in terms of support coming in at around 24,500 has played out in today's trading session. There are more number of stocks which are advancing than the number of stocks which are declining, even though the share is split right down the middle, but still marginally higher on the green line versus the red line. And we have the Nifty Bank, which is outperforming as well, just under the flat line right now as we speak, telling you that domestic data isn't as bad. In fact, it is fairly good. We have the PSU banks doing a lot better. What the Nifty has been buoyed lower by is the Nifty IT as well as the metals pack, which of course is more export facing. But the important news that took place over the weekend was the one that came in from the pharmaceutical space, Ekta, the one that the Delhi High Court has restrained pharmaceutical companies like Dr. Reddy's and OneSource Specialty from selling semaglutide in the domestic market.
Yes, absolutely. So that's the big news which, took place over the weekend, or rather on Thursday, Friday, and it sort of made the circles and made news over the weekend. Like you mentioned that, now what is taking place is that the Delhi High Court has restrained Dr. Reddy's and OneSource from selling semaglutide, which is obviously the blockbuster weight loss and type 2 diabetes drug in the domestic market. Now, the order is in lieu of a patent infringement suit, which was filed against Dr. Reddy's and OneSource by Novo Nordisk. Novo Nordisk alleged that Dr. Reddy's and OneSource are importing large quantities of semaglutide API into India to manufacture and export formulations, and the Indian Patent Act basically prevents making, using, offering for sale, selling, exporting or importing of the drug. The court, however, interestingly, has not barred Indian companies from manufacturing and exporting the drug. The next hearing is on the 19th of August, and it's going to be something that the street is going to be watching quite closely, because remember that Canada goes off patent on the 26th of Jan, or rather in January 2026, and hence it'll be important to see whether these two companies can continue manufacturing for at least the Canadian markets. To discuss this from more of a legal standpoint, we have with us Rajeshwari Hariharan, who's the counsel at the Delhi High Court, joining in. Rajeshwari, hi, thank you very much for taking the time out. If you could just start by giving us a basic brief of the case. Okay, I think there's been a little bit of a disconnect. But, Mangalam, a couple of key things which emerged from the details of this case is that generally you have this confidentiality in terms of who is your API supplier, or who are you supplying to in terms of a client. So now we know that Dr. Reddy's and OneSource have signed a contract, and both of them are in the race in some form or manner. We also know that OneSource has multiple other customers when it comes to semaglutide. So Dr. Reddy's being one of them gives you a sense in terms of the kind of customers that we can probably expect OneSource to have. Separately, like I mentioned, the big question is about manufacturing for exports. While domestic markets is important, the point is that on the day of the launch of a domestic market for semaglutide, you will at least have 25 companies launching the drug. And you will at least have a price erosion of 75% immediately. So the real money is not really in the domestic market. It is an ancillary market for many of the companies. The real money is probably in the Canadian market, which is one of the larger markets after North America. So that is going off patent in Jan of 2026. And once that goes off patent, that's where, companies such as Dr. Reddy's and others would probably look to launch. But nonetheless, we do have Rajeshwari back with us. Rajeshwari, I hope we've got you back on a better line. Thanks very much for taking the time out. If you could just start by giving us a brief on this case.
So, as you said, this is a case which is filed by Novo Nordisk against Reddy's and OneSource. And in this case, Reddy's has accused OneSource and Reddy's of patent infringement. Semaglutide is a drug, which is a 5-mg which acts on the body and helps the pancreas to secrete a lot of insulin at the right time, and therefore you are able to do weight loss. So it's a very, very important drug for weight loss. And this product is not yet available in India from any of the generic companies. The main patent is set to expire in March of 2026. But before that, the patent expires in Canada in January 26. So therefore, all eyes are on the Canadian market. And therefore, it's the aim of all companies to keep exporting the drug. Now, if you go and see the order which is passed against Reddy's, when the matter came up, I think Reddy's just gave an undertaking that they will continue to export the drug because they've just recently got the license to export the drug. They are already manufacturing the drug from around April of this year, the April of 25. And therefore, they are permitted by the court to export the drug. However, they are not able to sell the drug in India. They can only manufacture and keep it, which means that eventually when the patent expires in Canada in 26, they will be able to launch the product because in Canada the patent, the patent will be off. And similarly, in March 26, when the patent is off in India, they would be in a position to launch. They already have sufficient material which they can eventually launch in India. There are other patents of semaglutide. They all go up to 2040, but the important molecule patent will go off in 26.
Okay, all right, got it. So the two important molecule patents will expire in 2026. Now, the key point is, like I was telling Mangalam Rajeshwari, there will be multiple companies that will launch in the Indian market in March 2026. So the real game, or the real money rather, would be to launch in the Canadian markets. Does this order in any way prevent manufacturing for the export markets?
So for the other players, there are two buckets. There are two different kinds of situations. So if there are players who are already manufacturing the drug, they probably will be in the same position as Reddy's. For those who have not started manufacturing at all, I think Novo will come to the court with a fresh case, and maybe the court will injunct them from manufacturing at all because they haven't started manufacturing as such.
Okay, so what I mean to say is, will Dr. Reddy's and OneSource be able to launch in January 2026 in Canada?
I think they will be able to manufacture and put it in Canada in 26 because they are now allowed to export. They're already allowed to manufacture. So they can use the product in order to sell the product in Canada.
Okay, all right. What about the other companies now? Like you mentioned, is that a question mark? Will Novo Nordisk move against any other company which could be already manufacturing and preparing for its launch in Canada simply because it violates the Indian Patent Act, considering that you're manufacturing in India right now?
Yeah, sure. So I do expect Novo to move against the other companies as well. They will file a case. I mean, they should be filing a case against other companies who will be violating the patent. And if those companies are already manufacturing the drug, then they will stand in the same position as Reddy's. However, if they are not manufacturing the drug as yet, and they just have plans, they may be barred from manufacturing this in toto until March 26. Because in India, manufacturing by itself is an act of infringement.
Okay, so manufacturing itself is an act of infringement. So that means that maybe this case is yet not closed. There could be an appeal filed by Novo Nordisk. There is another hearing on the 19th of August. Is this a precarious situation for OneSource as well as Dr. Reddy's at this point?
Absolutely. It's a very precarious position because this order is more tilted towards Reddy's and OneSource. It permits them to stockpile the drug, which I am very sure that Novo will not be very happy with. The whole idea was to prevent them from manufacturing and to prevent them from exporting the drug because both are acts of infringement. And this order has not achieved that effect.
Okay, all right, Rajeshwari. Well, this is definitely an evolving story, so we're going to get you back on as and when the developments take place. So that is, however, important news, important perspective coming in on this important court case, which we will be tracking. Rajeshwari, thanks very much for joining in and giving us all of that perspective. Well, the next hearing is on the 19th of August. It could be a situation to watch for OneSource as well as Dr. Reddy's, and whether or not they could continue to manufacture for export markets. As of now, it seems as they can, but what happens going forward from Novo Nordisk's side would be something that the street would be watching quite closely. Well, we need to take a short break, but while we do that, this is important news. We're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m.
Welcome back. Now the Nifty is moving closer towards the 24,700 mark. So the recovery continues for the market from the lows. As we speak, a couple of stocks which are doing well include the realty sector. So the realty index should come up for you. That's at the high point of trade, and that's led higher by DLF, Godrej Properties, Macrotech Developers, all of them spiking right now. So the realty index was one of the few that was actually doing well in today's trading session, and that continues to accelerate ahead even as we see an up move in all of these names. Let's go across to Nigel now, who's in conversation with Neha Manpuria, who is the Senior Analyst, India Pharmaceuticals and Healthcare at BofA Securities. This from the sidelines of the BofA Securities 2025 India Conference. Nigel.
Well, thanks a lot for that, Mangalam. I'll take the discussion that you all were having ahead on the pharma space itself. And Neha joins us on the show from the BofA conference. Thanks a lot, Neha, for joining in.
Thanks, Nigel.
Well, most discussion points nowadays revolve around President Trump. So let's start off with that first.
Sure.
You know, what's the probability that we see Trump's tariffs on generic drugs? And as of now, what is the street ready for? What have they factored in terms of the numbers ahead?
So you're right. Obviously, a lot of discussion is around what President Trump would do on tariff, non-tariff, actions on pharma. Now, sticking to tariffs, I think there are a couple of things that we need to keep in mind. One, remember that there's an official 232 investigation that the U.S. has launched to understand the national security risk of having so much dependence on countries outside of the U.S. So I don't think the idea of tariff for pharma is as much about, revenue potential for the U.S. government. I think it's more about national security, that you have dependence of antibiotic drugs or basic drugs on other countries. So I think the way this could go down is probably you could have, tariffs for different countries. It could be different for branded and generic, or it could even come down to companies based on whether you have manufacturing in the US, how much manufacturing that you have.
Yes.
Probability, I mean, you must have heard most Indian companies, everybody's expecting some action, probably June, July, based on our US healthcare policy analyst as well. They believe that, you'd probably hear something around this, in the near term. Your second question, what the street is prepared for.
Yes.
I mean, we have seen the street recover, especially the pharma stocks recover after the initial knee-jerk reaction when the tariff noise, started.
Yeah, the tariff is no longer scaring them, at least as of now, because the dips get bought into. But what are they penciled in?
So from a stock price perspective, obviously you're building in no tariffs or very little tariffs.
Okay.
I think it also, for generics specifically, there is a lot of discussion about, how the margins for generics, particularly your commodity generics, are very low, probably less than, 15% for your commodity generics. So if you have even a 10% tariff, you don't have that much room to make money. So that could lead to, discontinuations and shortages in the US.
Yes.
So there is a lot of discussion about, particularly for commodity generics, do you pass on that tariff, to the distributors and the wholesalers who capture a larger portion of the value chain of the, profitability in the generics. And I think that's why that, low or no tariff scenario, that even if, let's say, there is a 10% tariff, you probably are able to pass that on, which limits the earnings impact for pharma companies that are focused on the US.
All right, so a 10% tariff could be digestible by the street, at least as of now. Something above that could be a bit of a shock, and it could be viewed negatively.
I think more than being viewed negatively, it's also about the repercussions it could have on the US, pharma industry in terms of price increases because you have to pass it on, or drug shortages because you see exits.
All right, but what kind of strategies can Indian pharma companies, adopt to try to, digest these US tariffs? We must be having a couple of aces up our sleeve, right? If you could tell us the way out.
I think in terms of options, obviously, the straightforward one is, setting up more capacity in the US, but that takes time.
Yes.
It does not happen overnight. It will take you 24 months or more to get that facility up and running, get all the approvals, do the site transfers, etc. So it's not an overnight thing.
Yes.
Then there's also the question of, okay, I produce these drugs in the US which are higher priced, but who buys those drugs? So you need to have the government saying that, okay, I will give you incentives to offset the higher cost. So that's one. The second, like I mentioned, is the pass-through.
Yeah.
You have your wholesalers and distributors who are making more margins, so you pass through part of that impact to them, through higher pricing. So there are options, but I guess it will all boil down to what's the tariff, your discussions, the discussion that companies have with the customers as well as the regulators in terms of what incentive they're ready to provide to actually set up a facility in the US.
Okay, all right. Interesting times then. Let's come back home then. Let's talk about the hospital space. You have the Adani Group that's announced their plans that they want to be part of the hospital industry. For my core sector, cement, I've seen them come in there. Yeah. People thought it would be very, very disruptive. May not be as much as what we anticipated. Now, given that they're looking to get into the hospital chain or the industry, how do you view it? Is it positive for the industry? Is it a big risk that someone is coming with that much of muscle power? Your take?
I think, Nigel, we have to remember here that, details are very limited on that announcement. I mean, what we have heard is probably a few hospitals in Mumbai at the moment. And given that both of us are from Mumbai, we know that we need more hospitals, right? And even more so when you go to tier 2 and tier 3 towns in India. So I think demand is not a problem. Obviously, the question is, how much of this capacity actually comes through? Where does it come through? So, if you look at the Mumbai, micro market, there is need for more organized chain, and you're seeing that by more and more companies announcing capex plans here. Yeah. So, again, we'll need to see timelines of this expansion. Do they have a larger plan in place? So this is just a one-off, announcement that they've made. Limited details to actually, give any color.
So we'll have to wait by to hear from the Adani Group itself. But I'm just looking at, we've been speaking to a lot of companies, a lot of the hospital groups in the past quarter, say the month of May itself. And a lot of them, one pressing point besides the profitability, etc., was that we are setting up high number of beds. We know the scope for penetration is huge here in India. But if you see high number of beds coming in, will it limit their profitability? EBITDA per bed could take a bit of a knock. Margins could pull back a little bit. How do you view this play out?
I think this is one of the big discussion points when it comes to hospitals. You're going into expansionary cycle for the industry as against the last few years, which has been about consolidation phase, right? You've not seen as much bed expansion. Again, here, a couple of things. One, if you look at bed expansion, it's again focused on a couple of markets. You're seeing more in Bangalore, Delhi, Kolkata, probably Mumbai. So it's not like there's bed expansion everywhere. Second, it's staggered. A lot of the bed expansion has been announced as capacity numbers. If I'm announcing a 300 bed capacity, does not mean I switch on 300 beds on day one. So you try to calibrate your bed addition to limit the impact that it would have on margins. Third, there are also specific companies that have announced brownfield expansion, where your incremental EBITDA tends to be much higher than versus the pure greenfield. So I think we also need to look at those nuances. So if you actually then come down, you probably don't see a very large margin impact, at least for the next 2 years for the entire sector, because of how these bed expansion is planned, and also from the recent experiences in terms of how commissioning of the new bed has been done. It's been more calibrated versus all in one go.
So you don't see it as a big risk. There are a lot of queries about this, but you don't believe, at least as of now, it will be done in a staggered manner, and you don't believe it's that big a risk to the hospital.
That's correct. At least for the near term.
Well, Neha, thanks a lot for joining in. We'll keep in mind, tariffs up to 10% could be digestible. Something more than that could be a bit negative. A lot of supply coming in there. We'll wait by for Adani's plans with regard to the hospital chains. And also you believe that the fresh supply that's coming in there may not be very, very negative for the profitability. Thanks a lot, and wishing you all the best for the conference. Well, guys, that's it from Neha with regard to the pharma and the hospital space. Back to you guys in the studio.
Okay, all right. Thanks, Nigel, for that. Definitely a rare space when it comes to pharmaceuticals. Neha Manpuria of BofA there. We need to take a short break with the news that we have some amount of pressure in terms of the Nifty, but no accelerated losses at this point in time. In fact, we have the Bank Nifty, which could probably turn a little into the green as we speak. Mid-cap index still holding up with a gain of around 0.3%. We'll take a short break. Sudeep Shah from SBI Securities will join in with some trading calls.
Welcome back. You're watching us here on Halftime Report. Let's take note of how the market is behaving right now at midday when it comes to the F&O pack. If you look at the indices today, it's the Nifty which has seen a massive recovery, almost 150 points from today's low. And that's led by some recovery that we've seen from the lows in the IT pack. Metals are under pressure still, but the Nifty Bank is doing fairly well. The other indices that are doing well also include the likes of FMCG, which is powering the index ahead, and we have the broader markets which are outperforming too. However, even as the market recovers from lows, we still are not out of the woods. That's what the India VIX is suggesting, up around 6.5%. But option writers are fairly active at 24,600 for both the call and the put. Around 200 rupees for the 24,600 put, telling you 24,400 comes the support. But at the same time, 24,600 call equally active for a premium of 250 rupees, telling you around 24,850 you would see some bit of supply coming by. A lot of stocks in focus. We were speaking about how PSU banks are doing well. PNB, Union Bank seeing long positions being added. Godrej Consumer from the FMCG pack doing well as well. A couple of these capital market plays, CDSL, CAMS, are also seeing a fair amount of short covering. And we have long unwinding in names like Nykaa and IIFL Finance. So that's something that we'll watch out for too, Ekta.
Okay, all right, Mangalam. Thanks very much for that. We now have Sudeep Shah from SBI Securities who's joining in with his call on the market. Sudeep, hi, welcome to the show. Well, definitely a mixed picture this Monday morning. What would you recommend in terms of a strategy both for the index as well as specific stocks?
See, what we feel is that early morning profit booking today, which we witnessed in Nifty, was more of because of the 4 or 5 large caps that fell very fast in the first half an hour. But overall, if you see the broader markets, we've seen a decent amount of buying in the broader markets. And from a Nifty standpoint, 24,500, 24,550, we feel will act as a very important support zone. And markets at first, in the first few days, could be range bound between 24,500 and 24,800 with a positive bias. And about 24,800, we feel that this rally would extend up to 25,100, 25,200. And within both the indices, we feel Bank Nifty is more stronger with 55,200 possibly acting as a support. Until this support zone holds, we could see this rally in Bank Nifty going up to 56,300, 56,600. Couple of stocks are on our radar. The first one being CAMS. Now, we've seen these capital market participants showing good traction, CDSL having moved 6-7%. But post CDSL, this stock CAMS where we are seeing a decent action today, as well as the stock is now crossing its intermediate resistance of 4120, 4125, which was there in April. So from here, there's a good base building that has already happened, and the stock is headed towards 4,400, 4,550 on the upside, and can be bought with a stop loss at 4,000 on the downside. The second stock that is there on our radar is Bank of Baroda. Now here, with all the PSU banks, within this particular stock, Bank of Baroda, there was a sharp cut till 215, but consequently the rally also has been equally sharper. And if you see the weekly charts, we feel that this stock is headed towards 265 to 270 on the upside, and can be bought with a stop loss at 246.
All right, Sudeep, thanks a lot for that. Those are a couple of stocks. Just keep an eye out on Tata Motors, though. Tata Motors' stock had been slightly under pressure on account of, the weakness that we've seen in their monthly numbers. But last few minutes, there has been a bit of a spike, and that's perhaps on account of commentary coming in from Bloomberg. This is the commentary is attributed to Bloomberg. It's coming from the minister saying that Tesla may perhaps not be looking at manufacturing in India. If that were to happen, then that is competition positive from Tata Motors, because the news of Tesla's entry into India had sent some selling, or had set some selling in Tata Motors. If that is not happening, then it would be positive for Tata Motors. But take a short break. On the other side, we do have the management of Greenlam Industries joining in to discuss their fourth quarter numbers. Stay with us. Welcome back. You're watching us here on Halftime Report. Greenlam Industries reported a tepid set of fourth quarter numbers. We are now joined by Saurabh Mittal, who's the MD and CEO of the company, joining in. Saurabh, it was expected that way, largely because, one, the environment wasn't fairly conducive. Secondly, margins were compressed, and the net profit obviously was buoyed down by other expenses, higher depreciation, higher finance costs on account of your, particle board plant that came on stream during this quarter as well. The question is FY26. As you stand right now at the start of this year, what are your targets for this year when it comes to revenues and margins across all your verticals?
So for FY26, we should be looking at 18 to 20% of top line growth. And laminates obviously is our core business. So we expect growth coming across all our verticals: laminates, veneers and allied, plywood, and particle boards. So all the businesses should do well in FY26. Particle boards, our sense is, we probably will still have some EBITDA losses in FY26. Plywood, we should have reduced EBITDA losses. Even in FY25, sales have doubled over FY24, and EBITDA losses have come out. And laminates, we expect improvements in margins. And veneers and allied categories also, we expect improvements in margins.
18 to 28% growth is something that you started out FY25 with as well, and eventually ended up doing 11.4%. So what gives you the confidence this time around that it is a little more achievable than what it was the last year?
So you're right. FY25, we started out with 18-20% top line growth, and we ended up with about 11.3, 11.4%. So clearly in the second half of FY25, growth did slow down. I think in H1, we were running pretty okay. And also the particle board factory got delayed by a few months. That also added to the initial guidance or expectation revenue growth, and which didn't materialize at a later point. So as far as this year is concerned, all our factories are up and running. The chipboard factory has started in Andhra Pradesh. At least we are free from the manufacturing side. The entire focus will be on building sales and building revenues for the business. In FY25, we also opened several international subsidiaries. We expanded our warehouse in certain European markets. So I think last year, despite the challenges, even at 11.4%, 11.3% growth, I think we've done well versus the market. We've done that. We've grown the business. We've nearly maintained gross margins. We have had some reduction in EBITDA margins. We've maintained price points. We've maintained working capital discipline. Our debtors periods have been under control. Our working capital days have come down. So just I think with the efforts we've taken last year on building markets, building products, having the factories up and running, we seem confident to be able to achieve 18-20% growth in FY26. That's how it looks right now. Yeah, but our effort has been to maintain that growth over several years.
Okay, all right. Saurabh, you did mention for your plywoods business, your losses would be lesser. That's right. That's right. And for your particle boards business, the pressure is probably going to still continue. Right. So can you just give us a sense in terms of the EBIT? What will we see in terms of losses for both of these businesses separately?
Right. So I can't give an exact number, but clearly plywood in FY25, we doubled sales. And we expect good growth coming in FY26 also. And EBITDA losses should come down. Particle boards, break-even comes at nearly 50% utilization. And our sense as of now is that we may not be able to achieve 50% utilization in FY26, although the first 2 months, things are going in a good direction in the month of April and May. So I can't give an exact number because it depends on how things pan out in the year. Where do raw material costs, end up with? But clearly, the volumes and the business will grow, but EBITDA losses will be there. That's our sense in particle boards.
And on veneers, you did about 5.4% in the previous quarter. The fourth quarter, that came down to about 3.8%. Right. You've said that steady state volumes or margins in this business could be around 10 to 12%. Right. By when do you reach there?
So, our endeavor is to do that the earliest. So last year, clearly the EBITDA losses, came down across verticals. The door business grew last year. The flooring was growing very well in the first half of the year. Second half of the year, it kind of slowed down. So obviously, we're not losing any money anymore in that business. So there is complete attempt towards building the business to that 10-12% EBITDA margin levels.
Okay. You do have debt which is fluctuating between around 950 odd to 1,000 odd crores.
That's right.
Give us a sense in terms of where that would probably be by the end of next fiscal.
So our sense is on the debt side, we probably will be in a similar band, maybe a bit lower than what it is right now, because we still have certain capexes to be completed of the new plants. And with the expanded revenue, we might have some working capital investment also coming in, assuming we grow 18-20%. So our sense is it'll be plus minus maybe 50 crores, 75 crores. So maybe slightly on the lower side, obviously, more minus than plus. Yeah.
All right. And what about working capital days? You've managed to improve that to about 55 in the end of this year, by the end of this year.
Right.
Is there any more room here, or do you think this about 45 to 55 days is what is a normalized level for you now?
So it depends on where our volumes, kind of reach up. Our sense is the more we sell, the better we collect, because the debtor period is about 22 odd days. And as we expand, as we kind of settle our new businesses, there could be some more improvement. But my sense is this year, we may not see much improvement coming on the working capital cycle. I think we'll be able to hopefully maintain, the 55 odd days, maybe a few days here and there. So I think it'll take some more time for us to really give you a clear picture on where the working capital days can be. But our attempt always has been, to run a very disciplined working capital model with controlled inventory, control outstanding.
Is any further capex on your mind right now? Because FY25 was close to 2,500 crores. I suppose even if you do 20%, the next year you get to about 3,000 crores. You said that peak revenue potential for the company is 4,000 crores. So maybe by FY28, you will be running out of capacity. Have you planned for that?
So on the revenue side, with the investments we've already done, we can achieve about 4,000, 4,200 kind of revenues in the business. On the capex for FY26, we'll just be completing the open capex we have in Andhra Pradesh and Tamil Nadu, and some routine capex we'll be needing, in FY26. As we move ahead to FY27, 28, we've said that in the past we have opportunities to do multiple brownfield expansions in our Gujarat and Andhra Pradesh factory as far as laminates is concerned. For chipboard, I think we have 2-3 years of capacity available till we reach a certain utilization level. For veneers, etc., also we don't need more capacities the next 2 to 3 years. So really, I think as we see things now, for FY26, our plans are more or less clear. Moving ahead, as far as laminates is concerned, we can do brownfield. For other categories, you are aware that we have got a large piece of land in Uttar Pradesh. So that probably, at some point, we'll think of on when we can start to work there, but not in FY26.
Take that point. Thank you so much for joining in, Saurabh. Wish you good luck for FY26, and hopefully you do get to that 18 to 20% revenue growth as you've guided for the start of this year. Unfortunately, you couldn't last year itself. But with that, we'll simply do a short break. As we do that, here's some good news for our viewers. The India business news leader, which is CNBC-TV18, is now just a click away. It is on the new app, the CNBC-TV18 all-new app, which gives you instant access to breaking news, in-depth articles, and financial world updates, all of them at your fingertips. You can download the CNBC-TV18 app from either the Apple Store or the Google Play Store, or just scan the QR code, which is up for you on the screen.
Welcome back. Well, restriction on rare earth magnets could bring production to a halt, says TVS Motors MD Sudarshan Venu. He also adds that there could be cost increases for the customer. In fact, our colleague Parikshit Luthra caught up with Sudarshan Venu and began by asking about their EV roadmap and how they plan to navigate the rare earth magnet crisis. Listen in.
We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We have now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric three-wheelers and electric bicycles as well.
Okay, so if we were to ask you how many electric products altogether in FY26?
I think in FY26 we'll look at a couple of new launches. One is, of course, X has already started retail. There is an improved iQube and one more new scooter.
One more new scooter coming up. How does the market look to you currently, and are you looking at increasing capacity? What is the monthly run rate that you're looking at?
I think we are increasing capacity and the volumes have grown. At the same time now there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Right. How badly is the restriction by China on supply of rare earth magnets impacting TVS Motor Company right now in terms of production?
I think in the short term it will impact the entire industry a fair bit. As we go forward, we have to develop new solutions, develop new components, new suppliers, and really work our way through this.
So is it already, for the industry, is it already showing on the monthly numbers?
I think it will start showing soon.
Start showing soon?
Maybe in June, if not definitely in July.
You know, some bodies have really sounded the alarm bells, saying that this could literally bring EV production to a grinding halt. Would you go to the extent of saying that?
It is concerning, yes, Parikshit, it is concerning.
It could bring it to a halt?
Yes.
How bad is it for the industry?
I mean, a halt is pretty bad, right?
A halt is very bad.
And it doesn't get that much worse with it.
Yeah, yeah. So we could look at a complete...
Yes, it is a significant challenge.
And how are you managing it at...
Of course, like every company, we are trying to see how to de-risk. But again, there is a huge price impact, which ultimately has to be borne by somebody. And then there'll be cost increases or other price increases to the customer. So all this has to be factored in, which is why I think it will be a medium-term, short to medium-term challenge that the industry needs to work its way out of. On one hand, we are launching products, we are committed, we have invested a lot of capex. You have seen that we have done a lot of exciting launches and our volumes have also grown. This is definitely a challenge that there's an industry and we have to work through, and over a period of time develop an ecosystem of components and R&D in India so that we bring volumes up in a way that is sustainable and in a way that's Atmanirbhar and made in India with Indian R&D, with Indian products and Indian technology and supply chain and natural resources all linked up.
Yeah. So you're expecting from June onwards it will start showing in production figures, and there'll be very significant production cuts?
Yes, there'll be cuts.
Yeah.
Okay, and you can catch this full exclusive conversation today at 5 p.m. only on CNBC-TV18. Time for a short break, but on the other side, Manisha Gupta joins in with Kunal Shah from Nirmal Bank. Welcome back. Well, for the markets, it's picking up a little bit of pace for the mid-cap index. So it's up around 0.5%, you would have to say, for the mid-cap index. Even the Nifty, in fact, is flattened out a little bit. So maybe it's showing some signs of probably turning into the green, just about lower by around 22 odd points. I just want to point out AstraZeneca. We spoke about it briefly some time ago. That stock is up around 11.5%, doing well on the back of its Q4 numbers. If you just look at the numbers this time around, it's been a huge turnaround on a year-on-year basis. Revenue is up 25% year-on-year. EBITDA is up around 74%. Margins have improved to 18% versus 13%, and a profit growth of around 47% year-on-year. So that's what's the performance like for AstraZeneca. Sequentially as well, there's been a good jump in terms of the profit and the EBITDA of around 12% year-on-year in terms of absolute terms. Remember that there's some positive news globally also with regards to AstraZeneca's drug, one of their cancer drugs globally, and that could have a possible positive ripple effect on the Indian stock as well. And that's probably giving it further momentum in today's trading session, 8,891 odd rupees for AstraZeneca. But let's go across to Manisha Gupta now. She's tracking the commodity space for us. Manisha.
Thank you so much for that, Ekta. And joining us on the show now is Kunal Shah from Nirmal Bang. Kunal, hi. And the markets seem to be really reacting to the weekend news, really, where the President Trump has spoken about increasing tariffs on aluminum and steel effective 4th of June. And this is up by nearly 50% right now. The immediate effect has been that we've seen prices decline for aluminum and steel both. How would you look at the near term? Is this a knee-jerk reaction? And how would you look at longer-term implications for this?
Okay. I think Kunal Shah is joining in just a bit. But Manisha, in the meantime, if you can just give us an update in terms of the commodity space and what you're tracking today.
Well, metals really, Ekta, because this is an area that the street did not see coming perhaps. 25% of a duty is something that aluminum and steel both have seen already. The expectations really have been that as the tariff conversations go, we'll perhaps see this also easing off in the next 3 months or 90 days therein. But what we have seen instead is that you've seen the duties go up from 25% to 50% at this point in time. So there is a price decline that we have seen. If India, or rather if US is looking of producing more of aluminum and steel going forward, then we perhaps will see China looking for other markets. Kunal is with us now. Kunal, so if US is going to be producing all of these metals, including aluminum and steel, where do you see China then dumping its metals?
Well, I think the kind of import numbers which, so roughly US imports are about 4 million tons of aluminum. And I think that number cannot be dumped across in the globe. Because if you see, barring countries like India, where the demand growth is very strong, in rest part of the world, the demand growth is in a single digit. So I believe going forward, China will left with no option but to cut the production of excess capacity and production of aluminum. So they have to weed out the excess capacity, because dumping, they know what has been the policy of India. We've seen in the case of steel, we've seen in case of aluminum. So if there is a dumping going on, I think the ministry is going to take a call. Even in case of steel, we've seen anti-dumping duty coming in. So if further dumping takes place, we will see the anti-dumping duty going up to the extent of another 10 to 15%. So I believe that the global market, ex-US, will witness surplus because of this. And that surplus had to be weed out by China by cutting their excess capacity and the production. So in a shorter term, there may be some glut building in the global economy. But going forward, China will left with no option but to cut production.
Kunal, in the initial conversations and statements as well, we saw a huge disparity when it came to LME markets and then again the US markets. Do you see a similar kind of scenario rise yet again?
Yes. See, in this kind of scenario, because of tariff, you take any commodity and there is a possibility where there can be a disconnection between the spot market and the futures market. That is the reality. Because when you talk about 50% tariff, what's going to happen if I'm going to need copper or I'm going to need aluminum? There is a shortage. So if I import it, I have to pay 50% tariff. Okay, so I will try to procure material before Wednesday as much as possible. So there can be a possibility that the spot market can get tighter in a shorter term, and you may see a big short squeeze also in futures. So that kind of scenario. So earlier the prices were moving as per the traditional demand and supply scenario. We saw the similar thing happening in gold, where we've seen a big squeeze taking place, and because of the tariff fear, there was a mad rush in spot market to buy gold. Yeah, US market. So same thing we can expect going forward in case of aluminum. The automakers or the key component users of aluminum, if they want to procure the aluminum, because the capacity, US has ample of excess capacity in case of aluminum, okay? But to get all these capacities on stream and start producing aluminum and steel to the extent that their import is totally weed out, that's not going to be possible in near term. So I think there is a possibility that the spot market can get very tight before we actually experience the glut. So I'm not expecting a big crash in prices.
Sure. Kunal, how would you look at the Indian market impact? Of course, there are some companies that have reacted today with the international exposure they're in. But for Indian markets, does this mean anything at all? Or do you think there's going to be a minimal, if any, impact at all?
So first of all, we have to accept that it's a multipolar world, and this is going to remain. We are going to remain we are not going back to the globalization. We are going to remain multipolar. The geopolitical escalation across the globe has been rising. And now when you talk about the supply side shock, because of all this scenario, are going to be real. So as of now, I don't see any major impact on the Indian steel producers or Indian, because I think the policy of government is very clear. So whenever government has sense, there is a possibility also of a sharp dumping taking place in India in case of any metals. They have reacted quite swiftly. So they have taken 3 months, 4 months, but their stance is very clear. So even this time, we are not the major, the only fear India has is of the dumping. And I think that the ministry will take care of.
Okay, all right, Manisha as well as Kunal, thanks very much for joining and taking us through the commodity space. Well, we need to wrap up on halftime report. Stay tuned for more unmatched insights and unparalleled market coverage. Keep watching. Nuvama presents CNBC-TV18 Market Central.
The Indian markets have opened with cuts but have recovered from the lows, even as escalation of trade tensions between the US and China and widening of the Russia-Ukraine conflict weigh on sentiment despite a strong fourth quarter GDP show. Metals and consumer durables are the big losers, while realty and FMCG are the ones eking out gains. China's ban on rare earth magnets will start to hurt electric vehicle output in the coming months and may even lead to a production halt if not resolved, says TVS Motors Managing Director Sudarshan Venu. He wants India to develop its own EV ecosystem. Shares of food and soaps players like Britannia, Godrej Consumer and HUL have risen on a cut in import duty on edible oils from 20% to 10%. The reduction in prices may hurt AWL Agri and Patanjali Foods. Stocks of steel and aluminum makers have taken a dip after US President Donald Trump doubles tariffs on the metals to 50%. The souring of trade relations with China is only adding to the concerns. And India's GDP data has sprung a pleasant surprise. Growth in the fourth quarter accelerated to 7.4%, the highest in a year. Growth in FY25 is at 6.5%, which is the slowest in 3 years, but in line with what the government had anticipated. Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Fatakia. It's the first trading day of what is a new month for our markets and, of course, for the calendar as well. And it has been a significant recovery from the lows of the day for the benchmark index. The Nifty has almost moved into the green now from the intraday lows of 24,524. It's a near 200-point recovery that the index has seen from those levels, convincingly defending that level on the downside yet again, and is now set to move into the green. Of course, we've been saying this from the morning that positive domestic cues, negative global cues, but it seems that the markets are now looking to pay attention to the positive domestic cues, be it the positive GDP growth numbers that came in on Friday, the GST collection numbers that came in over the weekend, and of course, the anticipation of more rate cuts from the RBI. Of course, the rate cut, according to consensus estimates, is almost a done deal. The only question is how much will the central bank choose to bite the bait, and a part of that recovery has been led by the Nifty Bank. Remember, the Nifty was an underperformer last week despite the Nifty Bank doing well. The Nifty Bank now has moved into the green and is now heading towards that congestion zone of 55,800 to 55,900, where it has found resistance all through last week. The top performer today has been the PSU Bank Index, was the top performer on Friday as well, and is building on to those gains as we speak. 2.5% higher on the PSU Bank Index at the highest point of the day, and led by most of the smaller PSU names, be it Union Bank, Bank of Maharashtra, Canara Bank, all of them doing very well for themselves. And a lot of these FMCG players too, be it the likes of Britannia and the likes, have done well for themselves after that edible oils import duty cut off the highs of the day, but still holding on to the gains. Of course, the big news point from the weekend and earlier this morning has been the auto sales numbers, and they have also come in for the month of May, and it's been a mixed picture, if you could call it that. And Sudarshan will tell us whether it was a mixed picture or not. Sudarshan.
So majority of the companies have reported sales either it was in line with estimates or slightly higher than estimates if you exclude 2 or 3 companies like Hero MotoCorp, Tata Motors and Hyundai. So we'll start with the company which have reported a strong set of numbers and is amongst the top Nifty gainers, and that is Mahindra & Mahindra. For Mahindra & Mahindra, both auto and tractor segment sales have been better than estimate. Here total sales were up 17%, was led by SUV, for which sales were up 21%. Even tractor sales were up more than 10%. Also, companies saying that advancement of early monsoon is going to help tractor sales further in coming months. Coming to Maruti Suzuki, total sales were largely in line with estimates, while domestic has been a drag, and also entry-level segment, their entry-level segment sales have declined 13%, but good performance by exports has helped company report in-line sales of numbers. Coming to Hyundai Motor, sales were much below estimates. Total sales were down 8%, and it was mainly because of domestic sales, which have fallen more than 11%. For Tata Motors, all the segments have seen a decline except bus segment, and total sales were down almost 9%. Coming to Ashok Leyland, which is a pure CV play, here sales were much better than estimates. Total sales have risen 5%, led by M&HCV, for which sales have increased 11%. Even LCV sales were higher by 5%. Now coming to two-wheelers, two companies which have been outperforming for the last few months, and even the month of May, these two companies have outperformed, and those are TVS Motor and Eicher Motors. So we'll start with TVS Motor. All the segments have seen a growth more than 14%. Here total sales were up 17%. Two-wheeler sales increased by 16% and exports were up 22%. Here EV sales have increased by 50% in the month of May, but company is saying that there might be a disruption in the supply of rare earth magnet that can have an impact on EV sales in near to medium term. For Eicher Motors, sales were much better than estimates, and mainly because of increased contribution of exports, for which export sales in the month of May have increased by 82% and total sales were up 26%. Bajaj Auto, largely in line with estimate, total sales increased by 8%, while domestic sales were flat. But for Bajaj Auto also, what has helped is export segment, and here export sales were up 22%. Last is Hero MotoCorp. It has been underperforming its peers. Even in the month of May, it has underperformed. Sales were largely below estimates. All the segments of Hero MotoCorp have seen a low single-digit growth. Total sales were up 2%. Motorcycle sales were up 1%. Domestic sales have increased by 2%. And here, like all the other companies were reporting healthy growth in exports, but for Hero MotoCorp, exports also were flat. So largely in line to slightly better for most of the companies, except few like Tata Motors and this one, Hero MotoCorp.
Indeed. Sudarshan, thanks a lot for that. The bottom line of the May auto sales numbers, excluding a few like Tata Motors and Hero MotoCorp, most of them have either reported numbers that were in line with expectations or slightly better than that. In fact, we spoke to Mahindra Automotive's CEO, who said that the company is more focused on increasing volumes than its market share. Listen into what he had to say.
Market share for us is an outcome of the traction we see with our customers on our portfolio. So we don't necessarily put out a target for what our market shares need to be. We are focused on delivering on the volume projections that we put out there, and most importantly, on delivering to the customer expectations in terms of their bookings as well. So that's really what we are focused on. Now, of course, as we see what the industry projections are and the overall numbers, if we continue to keep this kind of pace and we do mid to high teens, I would think that there's a natural conclusion that there shall be some market share. But that's not necessarily something we're chasing on an ongoing basis.
An issue that has been plaguing the auto space has been this issue of the export curbs of rare earth magnets by China. And in fact, Parikshit did speak to TVS Motors, Sudarshan Venu, on their EV lineup and the potential supply chain headwinds in this regard going forward. Listen into what he had to say.
We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We have now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric three-wheelers and electric bicycles as well. At the same time, now there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Sudarshan Venu there in an exclusive conversation with Parikshit. Now, while speaking at a press conference, the Minister of Heavy Industries, H.D. Kumaraswamy, said that he does not expect Tesla to manufacture in India. Listen in.
Tesla, we are not actually expected from them. They have only to start 2 showrooms. They are not interested in manufacturing in India.
H.D. Kumaraswamy there on whether Tesla would manufacture in India or not. But on to a CNBC-TV18 exclusive then. My colleague Shireen Bhan caught up with Air India CEO Campbell Wilson on the sidelines of the IATA meeting in New Delhi. He spoke on the company's expansion plans and a lot more.
By 2027, what is the expected fleet size likely to be if everything is on schedule?
Well, I don't think we've put an exact number to it, but we have 308 aircraft operating at the moment. We have 540 odd yet to be delivered. Most of those will come before the end of the decade, so clearly there's going to be a significant expansion, a doubling or thereabouts.
Outside of this is going to be one big change, but outside of this big regulatory change, what are the other sort of developments that you will have to factor in that could have significant bearings on the operations of the airline?
I don't see anything new coming down the path that we're not already aware of. Sustainability clearly is a big focus of the industry, internationally as well as domestically. We've got our plans in place to be compliant and to consume more sustainable aviation fuel, in addition to deploying more fuel-efficient aircraft. There are some changes we would like to see with respect to taxation and the way taxation is applied on, say, operating leases.
The hike in user development fee across the big airports, is that likely to be a dampener? Are you worried about that?
Anything that adds cost to travel clearly at the margin means that there might be less of it. But this is a regulated process. We are consulted during the regulation of user charges. We might not like the outcome of those, but...
is it too high, you think?
You ask an airline, of course it's too high. Of course it's every cost that we incur is too high. Ultimately it has to be...
do you believe that this could impact traffic?
Well, as I say, at the margin it does. We operate in a business where airlines operate with very low margins.
Take a short break here on Business Lunch. More news and updates continue on the other side. Welcome back. Now, Commerce and Industries Minister Piyush Goyal commenced his 3-day official visit to France on Sunday. My colleague Abhimanyu caught up with him on the ongoing FTA discussions. Here's a slice of that conversation.
We never have timelines when we discuss trade agreements. But we certainly have guidance from our leaders. Her Excellency Ms. von der Leyen, the EU President, and Honorable Prime Minister Narendra Modi ji had met during the historic visit of all the EU commissioners to India in February. And I think you'll remember it was the only time in history that the entire European Union Commission has visited a country. It's like the whole cabinet going to another country. And they had guided us that we should conclude a free trade agreement before the end of calendar 25. My good friend Marosh and I are hoping to do better than that.
Now, uncertainty continues to persist over the potential trade talks between the United States and China. The U.S. National Economic Council Director Kevin Hassett spoke to ABC News and said that he expected U.S. President Donald Trump and Chinese Premier Xi Jinping to have talks as soon as this week. However, a specific date for talks between the two leaders has not yet been set. Now, on an optimistic note, he also said that the expectation is that both sides have expressed a willingness to talk. Now, the U.S. Trade Representative Jamieson Greer comments about the ongoing halt in trade talks between the U.S. and China and how China's actions are concerning. He also hints at a possible call between President Trump and Chinese President Xi Jinping.
You know, I speak to him nearly daily basis, as do his other advisors, and we've been very focused on monitoring Chinese compliance, or in this case, non-compliance, with the agreement. And we're very concerned with it. We moved, as the president just said, very quickly. No one can deny that. The United States did exactly what it was supposed to do, and the Chinese are slow rolling their compliance, which is completely unacceptable and has to be addressed. The Treasury Secretary, you know, his characterization is accurate, of course. I would say that, you know, conversations and calls continue at lower levels, but ultimately the nature of the things we're talking about, it does require some leader-to-leader understandings.
Now, the U.S. Trade Representative also touched upon the recent legal battle faced by the Trump administration with respect to the tariff imposition. Listen.
We have a very strong case. Congress clearly delegated to the president the ability to take action when there's a national emergency. We've declared a national emergency. We've taken action. We have a stay from the circuit court right now. All the other countries I'm dealing with in negotiations are treating this as just kind of a bump in the road rather than any fundamental change. So I feel pretty confident about the case, and if the case, you know, goes the other way, we have other tools as well.
Now, former Kansas Fed President Esther George says that while tariffs could be a concerning factor, the country's fiscal situation should be the key focus.
I'd be surprised if inflation is going to move down much at all, Andrew. That would be my own forecast, and I'll tell you why. We focus a lot on these tariffs, and certainly they could have the potential to be an accelerant to inflation. But I look more at our fiscal situation right now, and I do not see areas where ongoing downward pressure on inflation, other than the Fed continuing to hold its policy stance, is going to make much progress toward the Fed's 2% goal. So I think, again, when you hear policymakers focused on keeping inflation expectations well anchored, which is essential in this environment, it doesn't suggest to me that in a near-term or even medium-term forecast, you'd be talking about cutting rates.
Now, just a day before the proposed peace talks between the warring countries, Russia and Ukraine ramped up war efforts against each other. Take a look at this detailed report.
Russia and Ukraine sharply ramped up their war 1 day before proposed peace talks were to take place. Several people were killed after 2 bridges were blown up in Russian regions bordering Ukraine, Russian officials said on Sunday, though no one has claimed responsibility yet. One was a road bridge in the Bryansk region. It collapsed as a train carrying 388 people was passing underneath, derailing the train and crushing some carriages. Separately, videos obtained by Reuters were said to show recordings of Ukrainian drone strikes on Russian airfields in the northern Murmansk region and Siberia, in the first such attack so far from the front lines. Reuters was able to verify the locations of the recordings, but not the dates. A Ukrainian intelligence official said some 40 Russian warplanes were struck in attacks on several bases. Russia's defense ministry said several military aircraft were hit. Meanwhile, Russia launched more than 470 drones at Ukraine overnight, the Ukrainian Air Force said, the highest nightly total of the war so far. The southeastern city of Zaporizhia was among the areas hit. And the commander of Ukraine's land forces resigned on Sunday after a lethal Russian missile strike on a military training facility. The attacks came on the eve of a second round of direct talks in Turkey proposed by Russia. Ukrainian President Volodymyr Zelensky confirmed on Sunday his country's delegation will be led by Defense Minister Rustem Umerov, who attended the May 16 talks. It follows days of uncertainty over whether or not Ukraine would even show up. In a social media post, Zelensky outlined Ukraine's positions for the negotiations. It includes a complete and unconditional ceasefire, the release of prisoners, the return of abducted children, as well as preparations for a meeting at the highest level. According to a document seen by Reuters, the Ukrainians will present a proposed roadmap to end the war that details these conditions during Monday's talks with Russia.
Continuing with updates from West Asia, an Israeli attack near an aid distribution point run by a private US-based group has killed at least 31 people in Gaza over the weekend, while the warring parties exchanged blame over a faltering effort to secure a ceasefire. Take a look at this report.
Injured Palestinians were rushed to Nasser Hospital in Khan Yunis on Sunday after a deadly Israeli attack near an aid distribution point run by a private US-backed group, local health authorities said. The Palestinian Red Crescent, affiliated with the International Red Cross, said its medical teams recovered bodies of over 20 Palestinians near an aid collection site in Rafah, while local health authorities said more bodies were delivered to Nasser Hospital. Arafat Siam lost his brother in the attack. He says he had gone to get food for his children when he was shot by Israelis. This is unfair, he said. What they are doing is unfair. Israel's military said it was looking into reports Palestinians had been shot at an aid site, but that it was unaware of injuries caused by military fire. The aid distribution sites are operated by the Gaza Humanitarian Foundation, or GHF. The group denied anyone was killed or injured near their site in Rafah and accused Hamas of making false reports. The GHF, whose funding source is unclear, is backed by the US and Israeli governments and bypasses traditional relief groups. Widely criticised, UN officials say its aid plans would only lead to the forced relocation of Palestinians and incite more violence. Sunday's incident happened as Israel and Hamas traded blame for the faltering of a new Arab and US mediation attempt. The aim was to secure a temporary ceasefire and the release of Israeli hostages held in Gaza by Hamas in exchange for Palestinians in Israeli jails. Hamas said on Saturday it was seeking amendments to the US-backed ceasefire proposal, but President Donald Trump's envoy rejected the group's response as totally unacceptable.
Now, shifting focus, then, a suspect is in custody after what the FBI called a targeted act of violence at Boulder in Colorado. Witnesses say that the suspect used a makeshift flamethrower and Molotov cocktails during a march in support of Israeli hostages. The incident left 8 people injured. The suspect was allegedly heard yelling "Free Palestine" during the attack. An FBI special agent said that it was clear that this is a targeted act of violence and is being investigated as an act of terrorism. We'll take a short break. More news and updates on the other side. Stay tuned. In some weather updates then from the northeast, at least 30 people have died across Assam, Tripura, Manipur, Sikkim and Arunachal Pradesh as the northeast continues to reel under heavy rainfall. The Indian Army, Assam Rifles and local volunteers are carrying out rescue operations. Around 1,300 families have been shifted to relief camps as several try to navigate the inundated paths. The rain has led to severe waterlogging. Now, the roads were submerged, disrupting daily life and causing distress to residents. Now, the latest IMD warning shows a red alert for the West Tripura region. On to some sporting action then. Punjab Kings captain Shreyas Iyer led his team to a strong 5-wicket win over the Mumbai Indians in the second qualifier for the IPL finals. Mumbai batted first after a rain-delayed start of play and set a target of 204 runs for the Punjab Kings. Shreyas Iyer led the chase for the Punjab Kings, scoring 87 of just 41 deliveries as Punjab chased down the target with 1 over to spare. They will now face Royal Challengers of Bengaluru in the final tomorrow. And with that, it's a wrap on this edition of Business Lunch. We leave you with the Nifty still 35 points lower, but well above the mark of 24,700. Now a significant recovery from the day's low. Mid-cap radar on the other side, but stay tuned for more unmatched insights and unparalleled market coverage. Keep watching. Nuvama presents CNBC-TV18 Market Central.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Doria and with me is Vivek Iyer. Well, good afternoon to you, Vivek. You know, we've seen a good recovery from the day's lowest point. It's about 175 to 200 basis points recovery from the day's low. And the midcap end of the market, that is doing quite well in today's trading session.
That's right. Good afternoon, Bamakshi. So starting off, the week on what is essentially quite a positive set of cues, especially as far as the broader end of the markets, even as the benchmark indices stay quite subdued and muted. We have a lot lined up on the show, a management interaction as well. So let's start off with the top headlines. Market comes off lows even as escalation of trade tension between USA and China, along with widening of Russia-Ukraine conflict, weigh on sentiment despite a strong Q4 GDP show. Metals and IT are the big losers, while realty and PSU banks eke out gains. Mid caps outperform.
Emphasis under pressure after Mint reports that the company has lost one of its oldest clients, FedEx, to Accenture. The business arrangements likely to end by year-end.
FEM, industry is up over 7% after the company reports a healthy set of Q4 numbers. Revenue and EBITDA see double-digit growth, while margins remain flat on a year-on-year basis.
Inox Wind under pressure after their Q4 numbers. Order inflow falls 35% compared to last year. Novama says FY25 execution came in at 705 megawatts, below management expectations of 800 megawatts.
Niva Bupa slips nearly 10% in trade after 2.7% of total equity changed hands in a block deal worth 391 crore rupees at 83 rupees a share.
Well, we're managing to hold about the 24,700 mark for now. The Nifty for now is trading with a cut of 0.2%, but we've seen very good recovery coming in during the course of this trading session. The mid-cap end of the market is also holding up quite well. We have the advance decline ratio, which is largely in favor of the advances, and resultantly, your portfolios feel a lot better. The mid-cap end of the market is gaining, with posting a gain of around 0.6%. As far as some sectoral indices are concerned, it's the PSU Bank, which is doing well ahead of the RBI MPC outcome on Friday. The Nifty Jewelry Pack is also holding up quite well. What's not doing too well is the Nifty Metal Pack as well as the Nifty IT space. But let's move on to our special segment then, Mid-Cap Movers. We now have Hormas to take us through all the mid-caps that are moving around in trade. Good afternoon to you, Hormas. The mid-cap end of the market is doing quite well.
Indeed. Good afternoon, Vamakshi. And portfolios would definitely be feeling some bit of comfort. And even after that recovery that we have seen on the benchmark index from the lows of the day. So start off with the gainers then from the broader markets, and AstraZeneca is one of them. The final few earnings reactions that we are seeing 13% higher now on the stock after some very strong results. Brigade Enterprises has moved to the highs of the day, is reflective in the surge seen in the realty space. And Sterling and Wilson too, building on to gains from Friday, another 6% added to today's trade as well. But PSU Banks, best performers on Friday, best performers today as well. And look at all of these names, UCO Bank, IOB, the smaller names, and of course the bigger names like Bank of Maharashtra too, trading with gains of anywhere between 4 to 7% in today's trading session. Some of the other stocks that have done well today are the capital marketplace. And look at CDSL, the stock is now up 25% in the last 1 month, heading towards its record high levels. CAMS too with gains of 5%, Anand Rathi Wealth doing well for itself, and the other linked names as well are doing fairly well in today's session. Some of the other volume buzzers in today's session, Crompton as the other one has moved into the red, but is doing well on volumes. KFin Tech is the other one, and Godrej Consumer, the FMCG names that were doing well today are some of these, and Godrej Consumers is one of them. And lastly, stocks that are bucking the trend, Niva Bupa at one point was down 13 to 14%, still down 10%. The smaller PSUs that were the outperformers of last week are seeing some profit booking today, be it MMTC or ITI, and Nykaa has now moved to the lowest point of the day as an earnings reaction, 4.5% lower on that stock as well. Back to you guys.
Thank you so much, Hormaz. That was a comprehensive list of movers as far as the broader end of the markets are concerned. Well, moving on, it's a good time to welcome Richard Jain from Motilal Oswal Financial Services for a quick technical check on the market. Good afternoon, Richard. Thank you so much for joining us. What do you make of the markets at the current levels? Nifty largely flat.
Yeah, hi, very good afternoon to both of you. I think market breadth is speaking more than what the indices are showing, because we can see that last 2 or 3 trading sessions the market has seen some pullback move from the highs. But the market breadth has not seen any kind of significant negativity. So overall buying interest lies more in the broader markets rather than the index itself. But on the index too, if you look at the positional structures, then 24,450, 24,500 has been the support during last time also when we witnessed such dips. So I think we are trading right now near those support levels only. So price-wise downside seems to be limited from here on. Maybe it's just a time-wise correction since last 1 week that we are going through, in which we do not expect 450, 500 range to get breached soon. So for the index, it remains a buy on dip market. Use these declines as a buying opportunity. But as I said, the market breadth is showing more than what the index is showing. So since the market breadth overall is positive, we think that in this such time-wise corrective phase, going with a stock-specific approach provides better opportunities.
Well, thanks for that, Richard. Hi, good afternoon. This is Vamakshi joining in. So it's a buy on dips market as you're suggesting, but what should we buy? What are your top stock recommendations?
Yeah, good afternoon, Amakshi. So a couple of sectors, which are looking quite positive from current levels. One is realty, which has seen a gradual up move over last few days, and still the volumes are improving in many of the realty stocks. So DLF is one stock which we are preferring even at current levels, where a gradual high top, high bottom structure can be seen. Short-term traders can look for buying opportunities here with stock below 790 for potential targets around 845. And PSU banking is another space where we have seen a good breakout since Friday later half. Today, the follow-up move is also there with stocks witnessing quite good price volume action in PSU banking space, and we believe that the kind of momentum these stocks have seen, I think maybe going ahead, there would be a good outperformance in the PSU banking basket compared to maybe private sector banks. So within the PSU space, Indian Bank is one stock which has given a breakout before above its previous swing highs. The volumes are good. Stock is trading around its 52-week high levels as well. So Indian Bank also traders can look to buy with stop loss below 625 for potential targets around 660.
Okay, thank you so much, Ruchit, for joining us and giving us the technical levels on the markets as well as your individual stock-specific calls. Well, before we slip into a short break, we are excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset at Global Lens at 8:30 p.m.
Welcome back. You're watching Midcap Radar on CNBC TV 18. Pull up the chart for Indian Bank. We've been highlighting that PSU banks have been doing exceptionally well in today's trading session. Indian Bank is up almost 4% today and has managed to hit an all-time high. We also have been highlighting over the course of the last week how all of these capital good plays have been doing. Pull up the chart for GE Vernova TND. The stock as of now is up almost 2%. It has been doing quite well over the last couple of sessions. In fact, in the last 7 days, the stock has surged by almost 10% at an all-time high today. Along with it is also Hitachi Energy. Of course, it has slipped in the red. It is trading with a cut of almost 0.4%. But nevertheless, that stock has also managed to do quite well. In the last 7 days, it's up almost 17%. And lastly, put the spotlight on BSE along with other capital market plays. This stock has managed to reach a fresh record high in today's session as well, up almost 1% today. But moving on then, let's also focus in on J&K India. The management is joining us now on the show. ratio, the company's revenue fell almost 16%, while margins contracted too. To discuss the quarter gone by and the outlook for FY26, we are now being joined by Deepak Bharuka, who is the whole-time director and CEO at J&K India. Well, Mr. Bharuka, good afternoon. This is Vamakshi joining in. Well, FY25 was not such a great year for the company, but what's your outlook looking at FY26?
Good afternoon, Vamakshi. Definitely, year 26 is we are quite hopeful considering the orders in hand. We are aiming at around 40 to 50% growth in the revenue. And if you see, we expect a couple of percent better margins and EBITDA for year 26. And definitely on the demand side, domestic as well as international demand, we see it's a robust demand we are seeing, which is expected to come in the next year, 4 quarter or something. And we are quite hopeful this 26 will be very good year for us.
And you saw a 1% decline in your revenues this time around for FY25. So what is driving the kind of confidence that you're seeing, 40 to 50% uptick in revenue? Where is this growth largely going to come from? Is most of your order book going to get executed in FY26 as well? And what about the order inflow then? Because that has been weak over the last 3 quarters at least.
So if you see, Amakshi, we have order backlog of 1082 crore, 1082 crore. And last year, our order inflow was 933 crore. If you see by even a conservative estimate, most of our orders, 80% of them are supposed to be executed in this financial year. And from there, we are expecting we definitely will have 40 to 50% growth on the revenue side.
Understood that. So with the current order book, you're saying that FY26, you can see a 40 to 50% growth as far as FY26 is concerned. So that, is the visibility that you're getting from the current order book. But order inflow remains a bit of a concern, especially FY25, it appears to have been quite muted. So going into FY26, how does the order prospect pipeline look like? What is the typical win percentage for you? And at the end of FY26, where do you see the order book at?
See, I'll just correct you slightly. Our FY25 on order book, we did very well. If you see, our order book was 933 crore, which is compared to the year before that was almost 4 times more than what we did year before that. Definitely, order book was not a concern. Concern was, yes, on the revenue side, we
understand the majority of the orders you booked were in H1 and H2 was slightly slower, especially in terms of tendering, right?
See, if you see,
so the momentum didn't sustain in the second half.
Yeah. So on quarter, it is not fair to compare the order book. Yes, year on year, definitely we can compare. If you see the order bid pipeline, we have almost 4,000 crore plus bid pipeline. We are already quoted for some of 3-4 big orders which are likely to be materialized in the next 2 to 3 months time. And if you talk about the win percentage was typically, historically, we get around 30% of our order. I mean, hitting rate strike rate is around 30. And that gives a confidence that our order book is definitely going to be better than the last year.
So if we just, do a back of the envelope calculation, 4,000 crore is the pipeline. If you're expecting a 30%, strike rate, 1,200 crores is the order inflow that you're penciling in for FY26?
Yeah, exactly. A figure around that. If you see some of this will get materialized in this financial year. Some might go to the next financial year. But more or less, your back of the envelope calculations are correct. And that is what we are anticipating in this financial year.
And how much of this order book that would come through in this financial year would account for domestics? How much would it be from the exports?
If you see in this year, as we had in the last year, we see this order book will be more dominated by the domestic projects. If you see a lot of some of the PSU projects which are going for the expansion are going to give us good order inflow in this year. But next year we are expecting more on the export front. We are likely to do well on the order booking. But this year it will be dominated more by the domestic order booking.
Okay, Mr. Baruka, the other thing what you want to understand is out of the 4,000 crore order prospect pipeline that you mentioned, renewable energy, how much does that account, or is it kept separately? And what has been the progress as far as executing orders for that particular segment is concerned? And secondly, we want to understand EBITDA margins. You've guided for 100 to 200 basis points improvement in FY26. Is that accurate?
Yeah, that is on EBITDA guideline. You are right. What we have given the estimate is a couple of percent more than what we did last year. Now coming back to the renewable energy, we have executed some of the EPC project in a solar. We are doing India's first CBG based on-site hydrogen generation plant for one of our PSU client, which is expected to be commissioned in another 3 to 4 months' time. And we are also involved in bidding for many CBG projects, then electrolyzer-based hydrogen plants and green hydrogen refueling stations. And we are also partnering with the electrolyzer manufacturers to provide the end-to-end EPC solution plus O&M support for the green hydrogen plants. So last 2-3 years, if you see, this green hydrogen has been a little sluggish, but considering the bid pipeline we are having or the projects which are coming from the PSU, we are quite bullish on this green hydrogen market in the next year or two to grow exponentially.
Mr. Baruka, if you could emphasize a little bit more as to, you mentioned you do both EPC as well as O&M services as far as green hydrogen is concerned. So what is the EBITDA margin differential between both of the services? Typically O&M slightly longer period and much better margins. Is that an accurate reflection?
See, no, in our case, it does not reflect accurately because when we quote together single. Okay. So O&M is not above 40. Generally, we are more up on the EPC base. This is first time we are quoting on the O&M services because tender requirement is along with the O&M only you can quote. So if we see, we are more on the engineering and supply market. O&M is now this PSU's client, particularly they are coming O&M as a part of the single tender. So margin percentage will not be able to comment specifically on O&M and supply part, but more or less it's the same what we do in overall business.
Sure, and let's look at some of your numbers. Then trade receivables actually increased by 50% this time around, and when we look at your net cash flow as well from operations, that is still in the negative territory, same as where it was last year. So when do you expect the the situation with respect to trade receivables to normalize, and what would you guide as far as the working capital is concerned?
See, if you see the trade receivable, they are mainly, our 80% business in the last year, revenue, if you see, has come from the PSUs. And yes, there are some delays in the receivables, particularly when you work with the PSUs. But if you see this year, our 80% of the revenue is going to come from the private client, and their receivable situation is much better. As far as working capital is concerned, of course, our requirement of working capital is increasing day by day. It is mainly because of the new order inflow of the last year, what we had, and this year, what we are anticipating. So we are making, but as of now, we find we have enough capacity to take care of the working capital for all our ongoing projects and the future orders we are expecting.
Sure, and what about your cash flow then? Will we see that become positive this year, as you're expecting very good growth in the revenue and better working capital cycle as well? So will that be positive this year?
Yeah, definitely we will be very close to being positive. We may take a year or so to become exactly positive, but then yes, in next couple of quarters we will see a significant improvement in our cash flow.
And your employee expenses have actually declined by almost 88% on a year-on-year basis, 78% sequentially in Q4. So can you help us understand what actually led to this sharp fall? I understand there was some ESOP related, the ESOP was stopped or something like that in the fourth quarter. So can you elaborate on this, and what would be your employee cost as a percentage of revenue going into FY26?
See, if you see, we have basically, because we as a management, we felt that the results were not up to the expectations. We have deferred the increments, which from the employees' costs, we are given now some new targets to the employees, and definitely that has reduced our employee costs in the last financial year. But of course, that's not something which is really bothering us. We will have employee costs similar to this, irrespective of the order or revenue, because see, when it comes to the engineering or procurement or project management, our employee cost does not go up in the same proportion as our revenue. So as we are expecting a higher revenue in this year, our employee costs may not move by that same percentage. Like if we are expecting 40-50%, our employee cost is likely to move up by maybe around 15 to 20%.
Understand that. Thank you so much, sir, for joining us, giving us a sense of how exactly business panned out as far as Q4 is concerned and the outlook for FY26. Thanks once again. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back to Midcap Radar. Well, one stock from the broad end of the markets that I've been looking at quite closely actually has been Inox Wind. Now, this particular stock, remember, manufactures WTGs, that is wind turbine generators. And last week, you saw the results of Suzlon coming by that were very, very encouraging. In fact, Suzlon, for the first time ever, managed to give a guidance where they see 60% growth across all of the key categories or all of the key parameters that analysts talk, especially in terms of the execution. But very interestingly, Inox Wind this time around, while when you're looking and comparing the numbers on a year-on-year basis, it is very, very strong. In fact, optically, if you're looking at the revenues has gone up almost 2.5 times. EBITDA 2, in line with the kind of execution that the company has improved on a year-on-year basis, is up almost 2.6 times. Margins up almost 80 basis points on this larger base, and profitability up almost 5 times on a year-on-year basis. Order book, however, a bit of a concern on a year-on-year basis, on a sequential basis, has moderated. So, order book on a sequential basis, at almost 3.2 gigawatt versus you had almost 3.32 gigawatt sequentially. When you're looking at the order inflows, FY25 order inflows came in at 1.5 gigawatt, and FY24 the order inflows were higher. That is something that is a bit of a concern, indicating that on-ground ordering momentum has remained quite muted. Now, along with that, look at the execution as far as FY25 is concerned. FY25, the execution stood at a little over 700 megawatt. FY24, it was much lower, just around 376 megawatt. But what's actually happened was that, in fact, at the end of Q3, we had the management on our channel, and they had indicated to us that they should end the year with an execution of close to 800 megawatt. However, that is something that has not happened, and the miss in execution, increase in receivables is something that the street is looking at with a bit of concern, especially given the fact that the stock has seen a significant rally going into this particular set of results. But what's the good part? The good part is that the company has maintained its FY26 execution guidance at close to 1200 megawatt, almost 1.2 gigawatt, and FY27 order execution guidance of close to 2 gigawatt or 2000 megawatt. Nuvama has written a note, post the results. They're saying that it's a modest execution in Q4 FY25. 236 megawatt is what the company managed. They had a much higher estimate of close to 281 megawatt. So Q4, the company has moderated in terms of execution, and FY25 execution was lower than what the management themselves indicated, which is why, Vamakshi, today you're looking at Inox Wind. Suzlon went up 10% post results. Inox Wind is down almost 5% even as we speak, near the day's lowest point.
Absolutely, Vivek. So optically, if I understand that correct, the numbers were looking good, but it's a concern as far as the order book and
meeting the own management guidance is concerned.
Exactly. And some other counters that I'd like to highlight on the back of their numbers is VM Industries. We mentioned that at the beginning of the show. Right now, the stock is trading close to the day's highest point. In fact, in the last 1 month itself, the stock has seen a very good run-up of almost 21%. Genus Power is one other counter, trading at 420 thereabouts. Genus Power is the counter that I'm talking about. It's seeing a good uptick of almost 6% today. Keep in mind that over the last 1 month, the stock has seen a very good run-up. If you pull up the chart for 1 month for Genus Power, you will see how much the stock has moved. It's up as much as 48% in the last 1 month. DB Realty is one other counter, that is Valor Estates now, is also has reported its numbers over the weekend, and the stock is doing quite well. But on the flip side, when you look at the numbers that came through from Puravankara, it's we are seeing almost an 8% cut as far as the stock is concerned. For now, when you look at the entire mid-cap space, it is holding up quite well, up almost 0.6%. But that's a wrap on Mid-Cap Radar. Stay tuned for more unmatched insights and unparalleled market coverage. Keep watching. Nuvama presents CNBC TV18 Market Central. Don't go anywhere, because your stocks comes up next.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, markets have recovered from the day's lowest point, but Nifty is still trading with cuts of almost 1/10 to 2/10% in today's trading session, even as of now. What's the outperformance, and where the outperformance today that we're seeing coming in is from the broader end of the market. So yes, mid-cap and the small cap managing to hold on to gains. Look at the mid-cap right now, right? 0.6% of gain is what we're seeing for the mid-cap. Nifty Bank, that's also trading with a positive bias. So 1/10 to 2/10% of gain that I've seen coming in for the Nifty Bank as well. So market setup, yes, recovered from the day's lowest point in terms of the Nifty 50 as well as the Sensex. Broader end of the markets continue to do well. And in terms of sectors that we should look at today, we have PSU banks also that is managing to hold on to very good gains. So obviously the banking pack, and in that specifically PSU banks, that is doing well. All these PSU banks are managing to hold on to gains. Realty, Nifty Realty is also among the top sectoral gainers, so keep an eye out on that front as well. And FMCG, today that is also chirped up in the trading session. So a lot of news flows that is coming in. We have the last day of earnings season, so some of those earnings that are being reported, which is keeping some of the broader end of the markets in the trading session on the positive bias as well. But this is a show where we solve all your stock-related queries, and to do just that, today we're joined by Ashish Kyal of Wave Strategy Advisors as well as Gaurang Shah of Geojit Financial Services to solve all those stock-related doubts. Gaurang as well as Ashish, good afternoon, and thank you so much for joining with us on the show. Ashish, before we start with the queries, a quick check in terms of the levels for this week. What are we keeping an eye out on? Today, we are seeing that recovery coming in. Overall, global cues were not that exciting. Asian market also had opened up in the red. What are we watching out for now in the Indian market front?
Hi, afternoon to you and all the viewers. If you look at the overall trend, market has been moving in a very broad range since almost 8 to 10 days or more than that now. The lower end of the range is around 24,480, which it is protecting. The upper end of the range is around 24,900, so it's not going anywhere. So it's essentially buy on dips right now. And overall, we are expecting markets to again move towards the upper end of the range, which is around 24,880. And specific stock action has continued. So even in this kind of a movement, we can clearly see the outperformance coming from small cap space, and then the stocks has outperformed. So overall, the undertone is still bullish. I think if 24,900 is broken out positionally, we should reach towards 25,300 eventually.
Okay, surely keeping an eye out on those levels over there. But let's get started with the queries for today. The first query we have is coming in from Hema Roop, who is writing to us from Bangalore. Holding 130 shares of Kalyan Jewellers, price is 171 rupees per share. Long-term investor wants to know whether to hold or sell. Ashish, what's your view coming in for Kalyan Jewellers? What are we watching out for? Given that numbers this time in Q4 were also strong, so the performance seems to be fine. But levels that one should keep an eye out on, and they bought it at 171. So does it make sense that they continue to hold this, or maybe just get out of the stock right now?
See, first of all, I would like to congratulate, because holding from 171 the stock all the way, it's commendable, because people do not usually hold on to the multi-bagger stock. Having said that, Kalyan Jewellers has shown a very steep cut. If you check in the month of January, from around 800 levels, went to the low of around 400. Now showing an attempt to bounce back. So my suggestion would be to possibly partial profit book here, since the entry is pretty decent. Book around 50% of the profit, and remaining continue to trail it with a stop loss on the downside at around 515. On the upside, the stock has potential to reach towards the level of 650 again. And that is where we can look out for booking the profit of the remaining position.
Okay, that's the view coming in there from Kalyan Jewellers. Moving on to the next query for today. This is coming from Ravi Kumar. He's also writing to us from Bangalore. He's holding 250 shares of IndusInd Bank. Price is 830 rupees per share. So making some bit of a loss on this one. He's worried about the current, updates that we have in terms of news flows, those accounting fraud scenarios, obviously the change and rejig in terms of management also that we've seen coming in. So he wants to know whether he should switch to another bank or stay invested in this one. Gaurang, your view on the fundamental front for this one. What should they be doing, right? Because right now everyone is worried about IndusInd Bank. I'm sure he's just one of these investors who's there. What should they do? Should they stay or look at another bank?
Thank you, Vinny, for having me on the show. Good afternoon to you, Ashish, and all the viewers of CNBC-TV18. Well, I do agree with what you mentioned, Vinny, that there was a lot that happened in the bank. especially with that 1,900 crore plus derivative loss. Appropriate steps were taken, though the disclosures were given out to the market later on. The market got the sense of it much earlier. Post that, we had, I believe, 3 outside audit agencies doing a forensic audit, and they have come out with a recommendation. RBI also did what it needed to be done. And then, of course, after that, we had 5 individuals who were blacklisted from participating into any kind of market activity and dealing into the shares of IndusInd Bank. As a disclosure, our research team has a hold recommendation. The good part about the current situation is that post the loss of 1,950 crores and the correction, the bank has managed to recoup those losses. And his investment level is not far away from where the stock is trading. You held on to the stock in the bad times. I think possibly you will say much better time. Maybe the impact of derivative loss could reflect in the first quarter as well, this new financial year. But post that, I think there should be a better time. Currently, our fundamental team has a hold recommendation on the stock. So continue to hold.
Okay, hold recommendation on the fundamental front. Yes, near term, maybe some bit of that impact that you could see coming in, but otherwise, it's fine, and hold is the recommendation there from Gaurang. Ashish, your view on the technicals, is it similar? Should the investor continue to hold on the technical front as well?
Yes, I think so, because the stock post the chaotic sell-off that we saw on 12th of March formed a low. And since then, it has been trying to recover. So the overall trend, it has filled the gap also, which it created on the downside. And there is a possibility that it might consolidate. So the time horizon has to be extended at least for more than one and a half year. And then we can expect the stock to continue to move back on the upside. So there is an immediate hurdle, which is the gap area at around 925. And if that is crossed, we can expect the positive trend to continue. So my recommendation is hold over here and expecting 925 over near term. And on the downside, the support for the stock is at 750.
Okay, keep an eye on those levels over there for IndusInd Bank on the technical front as well. Next query for today is coming from Vijay, who's writing to us from Mumbai. He's holding 4,500 shares of ITC. Average price is 290 rupees per share. He's a long-term investor, wants to know the prospect of the stocks for the next 3 years. Gaurang, your view coming in, right? As of now, so far, we've seen numbers this time, mixed set of numbers. But ITC, we saw BAT also selling stake in the recent time as well. Overall, 3-year perspective on ITC, where should we see it headed? You know, there was a time where it was stuck at 200 and then didn't move. Is it going to be stuck at 400 and 450 range now? Or, you know, in the next 3 years, we could see a sharper move coming in?
Well, honestly, Vinny, I think, first of all, the investment is at a very comfortable zone. The number of shares that the investor is holding is also a decent quantity. Last week, we had British American Tobacco BAT offloading some of the stake in the market, and that's why we saw the stock reeling under the weather. But my sense is that rather looking at it from a large entity exiting the stock, on the flip side, somebody else has also bought it. So that's the positive that I'll take home. In terms of the sector, I think FMCG sector is going to do extremely well. We had an early monsoon, a week in advance. Expectation is that good monsoon will translate into good spending capacities for semi-urban and rural India, which will support the top line and bottom line for the FMCG companies. We have a buy/hold recommendation from our research team from a long-term point of view.
Okay. Buy or hold is the recommendation there for the long-term point of view. So, viewer, you can continue to hold this as well. On the technicals, Ashish, your view. Are you going to be reading about that 400, 500 mark that it's been roaming in, or what should you watch out for?
See, ITC has a tendency to be stuck at a place for quite some time when everyone gives up and then it starts trending strongly in one direction. So my suggestion would be continue to hold here. The stock has been hovering around that 400, 420 mark for quite some time. And eventually it should move higher back towards 475 level. So over short term, we can expect the consolidation to continue. But post that, maybe after a month or so, we can expect the uptrend to resume, because it has been some time since around September last year that the stock has moved in a very broad range of around 440 and 410 levels. So from here, there is an upside potential which has opened up for 475 levels. Hold is the recommendation.
Okay, hold as a recommendation. It's moved up to around that 475 is what one could watch out for also as a level over there for ITC. Let's move on to the next query, and that's coming from Anil, who's writing to us from Bangalore. He's holding 25 shares of Interglobe Aviation, purchase at a price of 5,300 rupees per share. Right now, the stock is trading at the similar buy price as well. Wants to know the outlook of the stock going forward. Gaurang, good set of numbers were reported by Interglobe Aviation. There was no complaining in terms of that. You know, they're making a lot of changes also in terms of aircraft groundings, the engine problems that they had. That is clearly seeing a bit of a resolution coming in. Outlook for Interglobe Aviation.
So I think the issues with Pratt & Whitney engines, P&W engines, is now slowly become a thing of the past. Before the resolution was found for the technical glitch with the Pratt & Whitney engines, earlier it was difficult, but slowly large number of aircrafts which were frozen on the ground because of technical issues is now coming back to the flying fleet. One thing, Vinny, for the aviation sector, especially for an airline company, the more hours the aircraft is in the air, it is making money for the company. The more number of hours it is on the ground, it is incurring expenses. So good to see this. I was reading a report last week. Quite a few aircrafts have again come back to the flying squadron. They are adding new aircrafts either in terms of dry or wet lease. We've been maintaining a positive stance for a very, very long time on Interglobe. Some of the other triggers for the aviation sector, like Interglobe, we have new airports starting commercial operations in Navi Mumbai. Next year, we will have the Jewar airports commencing operations, and likewise, regional connectivity under Udan 1 and 2 should also augur well for this sector. Hold and buy is the recommendation from our research team on Interglobe Aviation.
Okay. And Ashish, your view coming in on Interglobe Aviation, my point is that, you know, when you look at it in Jan, it was just around that 4,000 mark in the beginning of Jan. And now today it's 5,300. So last 5 months, we have seen that up move come for the stock, 20-30% uptick there. What should the viewer do now? Does it make sense? Because the level that he's bought it at is quite high compared to what we've seen. Do you still expect an upside on the technical level?
See, overall, from 4,000, the journey started and it then concluded at around 5,600 on a temporary basis. So from there, we are seeing some kind of a profit booking. The high which was made was in April 2025, around that zone of 5,600. And since then, it formed a double top, consolidating there. And there is no sign of negative momentum as of now. So my take is continue to hold on over here. There is potential if the stock manages to again reverse and fill the gap which created 4-5 days back around 5,436. We can expect it to move back higher towards the level of 5,800. So the overall undertone is still bullish. 5,800 is the target. And on the downside, the support for the stock is going to be around 5,300 levels.
Okay, keep an eye out on those levels over there for Interglobe Aviation. Hold coming in both on the fundamentals and the technical front. But on that note, we're going to slip into a very short break. And as we slip into the break, we are excited to unveil our brand new global business news channel, this all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back to Your Stocks on CNBC TV18. We still have with us Ashish Kyal as well as Gaurang Shah to answer all your stock-related queries. So let's keep it going then. This next query is coming from A. Subramanian, who's writing to us from Chennai. He's holding 100 shares of Sula Vineyards, and this is at a price of 643 rupees per share. Wants to know whether to hold or look to sell this one. And they've reported the numbers also. You know, when they reported the numbers, it was a bit of a muted performance that came in this time as well. Stock is currently trading at 295 rupees per share. The buying price is very high. Ashish, you know, what should the viewer do? This is, I think, at the highest point around when that stock was at around the 650 levels that the viewer seems to have bought it. So now what should they do with this one? Hold or sell?
See, the movement of the stock has been on the downside after it made a high of around 600, 650. That's a very high level that he bought, and he has been holding on to it. The stock has corrected more than 50% from there. The overall undertone still remains on the downside. So my suggestion would be it's better to be out from something like this. And instead of Sula, it's better to be invested into some other stocks, which can be something like Indian hotels or some other stock. And overall, there is no, even if you look at short term, since around 7-8 days, the stock has been forming constantly red candles. There is no buying emerging from lower levels as well. So the overall undertone is bearish. It's better to be exiting from here.
Okay, better to exit from here. That's a word coming in from Ashish. Let's move on to the next query for today. This is coming from, the next query is on Vatak Wabag is what we're talking about. And it's coming from Vishal, who's writing to us from Dubai. He's holding 80 shares of Vatak Wabag, and this is at a price of 663 rupees per share, making a profit on this one. Stock is currently at 1,642. Wants to know whether it's a right time to add more stocks. He's a long-term investor, not looking to sell. So Gaurang, you know, Vatak Wabag has given a very good return in the last couple of years as well. Specifically, fundamentals, does it merit holding the stock, or actually adding the stock is what the viewer wants to know.
Honestly, first of all, congratulations to him. He's making almost about 80,000 rupees on 60 shares that he bought at 660, 670 of VATech or Vatak Wabag. This realization should have come much earlier. If you had bought it at 680, the stock gave you an opportunity at higher levels. But nevertheless, let me give a prudent disclosure over your first, Vinny. Our research team has a buy coverage on Vatak Wabag, stroke accumulate coverage. This company operates in water-related challenges. It has operations in water waste management and desalinization of water. It's a company based out of Chennai. Very strong fundamentals, and in fact, last 1 year to 1.5 years, this company was able to bag orders consistently quarter over quarter, and it has got great capability in terms of execution, the order book. We have accumulate stroke hold stance. So yeah, I mean, if you are looking at adding to the stock, I think you should definitely do that.
Okay, can look to add at this level as well. Good stock, good company coming in there as well. And, you know, they've seen good growth also overall. Their commentary also hasn't been bad. When I was looking at Q4 flashes also that are coming in, you know, good commentary so far that they've given to CNBC TV18 as well. But on the technicals, Ashish, does it still merit adding more? Or would you just say, wait out, you'll see some bit of a correction, then add?
See, the overall stock is in a bull trend. And after a consolidation or the correction that we saw, it formed a double bottom near around 1250, showed a very strong breakout from there. The stock, my suggestion is stock has already run up from 1250, currently at 1640 levels. It's better to use some kind of a dip, maybe any kind of a dip towards 1540 or 1550 would be an ideal level where you can look out to add, and then aiming for 1900 and above levels. See, the overall medium to long term trend is still intact on the upside. Use any kind of dip as a buying opportunity for the upside target of 1900 and beyond.
Okay, keep an eye out on those levels over there for Vatak Wabag or Vatak Wabag. Let's move on to the next query for today. Sulochana is writing to us from Kolkata. 200 shares of Praj Industries is what they're holding at a price of 500 rupees per share. She's asking if she can hold the stock for another year. Praj Industries, your view, Gaurang, on this one?
So, Vinny, I'll keep my comments restricted to the sector and the opportunity that lies. So, ethanol has been a big story for this company. But over the last 6 months, there is some kind of stagnation on the stock. In terms of blending of ethanol into petrol and diesel by oil marketing companies, mandated is about 20%, but we are hardly doing 5%. Last 3 years, there have been consistent price hike in terms of per liter of ethanol prices, and the order book of the company looks decent enough. But I think it has got into a stagnation, stage, Praj Industries. Won't give specifics since my research team does not have any clear recommendation on this one.
Okay. And Ashish, your view for Praj on technicals?
See, Praj Industries made a high of around 867 levels in the month of December 2024. Since then, it has corrected very sharply. And it has broken the previous support level, which was 490. It's just trading around that zone right now. So my suggestion would be possibly to exit from here and use pullback to exit. There is over short term possible that it can move towards 520, 528 levels. So use that pullback as an exit. And on the downside, the immediate support for the stock is around 465.
Okay, keep an eye out on those levels over there for Praj Industries. Next query, Dheeraj is writing to us from Mysore. He is holding 48 shares of Gujarat Fluoro. This is at a price of 3,797 rupees. Wants to know whether he should hold for 1 month or look to sell. Short-term query, just a 1 month time period that they're talking about. Ashish, your view on the charts and technicals?
See, if you're looking at 1 month perspective, over the past 3 days, the stock has moved from 4,000 levels now to around 3,570, has shown short-term correction. So my take is over the near term, there is a possibility the stock might move down from here towards the level of 3,350, which is the prior support. So it's better to exit now. There is no pullback. Even today, it's not showing any kind of a pullback after a steep correction in the previous day. So better to be out from at the current levels.
Okay, better to get out at the current levels. That's a view coming in there on the stock over there. So viewer, Gujarat Fluoro, better to get out. It's a short-term 1 month time period. So that is very short time period. So yes, look to sell the stock. That is what is Gujarat Fluoro about. But with that, we are absolutely out of time on this edition of Your Stocks in CNBC TV18. So thank you so much, Gaurang, as well as Ashish, for joining in with us. And thank you so much, our viewers, for sending us your queries. Keep sending us your queries and we will get them answered Monday, Wednesday, Friday at 2 p.m. with our experts who will solve all your stock-related queries. But that's a wrap on Your Stocks. Stay tuned in for more unmatched insights and unparalleled market coverage. Keep watching Nuvama presents CNBC TV18 Market Central. Up next, now you have closing bell to take you through the action forward.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
As of now, what we're seeing for the Asian markets, nothing exciting that has come up in today's trading session.
The resistance is at 55,695 to 55,875.
Do you see a scenario where three telcos do exist?
24,633 is where the Nifty is starting out.
Done a lot of exciting launches and our volumes have also grown.
Revenues did not meet our expectations, but going forward, we have really diversified our risk.
Listing price on Leela compared to the issue price of 435 and on AG's Wopac 220 compared to 235.
Mid-cap index is up in the green and the advanced decline ratio is positive.
The benchmark indices stay quite subdued and muted.
Well, that is the day so far, and markets, by the way, are not doing very much. It's pretty directionless. There was direction in the morning, it was down. But now we're down 40 points, so which is kind of how we open, neither here nor there. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant with me, my colleagues Reema and Surbhi. Guys, hi, afternoon.
Hi. The direction's changed, right? It's moving up now. The low today was 24,526.
Yeah.
So from that level, it's been a near 200-point recovery as we've climbed above that 24,700 mark.
Yeah, you know, we had Matt Orton from Raymond James in the morning, and I think his view kind of echoes with everybody because he's saying beyond all this uncertainty of tariff, who's saying what to whom, and China has apparently retaliated, saying we're not happy with what you're doing with our tech sector, etc. Beyond all that, markets feel that every dip is a buying opportunity and you keep marching higher. Maybe, I mean, that's what we're seeing in India as well.
No, absolutely. The direction has been up. Just one thing though, guys, if you look at the one noticeable thing which stands out is that IVs have shot up, which essentially means that, and these are, by the way, weekly straddles we're looking at, essentially over the next 1 week, I mean, the options market is telling you that there is a 500-point move coming on the Nifty. Up or down, we don't know. But that is the only kind of, in a way, if you want to call it signal, whatever, but that seems to be one of the few kind of sort of noticeable things. Otherwise, I mean, it's a market which is, I mean, how do you assess it? We're off the lows, we were down as well. But it is, otherwise there's no real big signal to take away, to read and build on what we're seeing right now in terms of indications for the next couple of days. But IVs have shot up, so keep that in mind. One of the lesser talked about things, I think, is this entire Russia-Ukraine. I mean, you know, the war's gone on there for 3 years. It's not really mattered for financial markets. When it started, it did in 2022 immediately. But then, you know, every week we get headlines, but it's not really market for financial markets. But over the weekend, if you see, there has been significant escalation from Ukraine with regards to hitting targets inside of Russia. This is new because, I mean, the West has essentially told Ukraine, has given the go-ahead that you can use our weapons and strike deep inside Russian territory. It's not happened in the last 3 years. So, you know, that's the other question. Are we entering a new phase of the Russia-Ukraine war? I think we're going to hear more about this over the next few days or so. Russia will retaliate, and I think that perhaps keeps uncertainty, at least near term, a little elevated as well. Otherwise, I mean, it's very, very stock specific, which is going to be the focus here over the next 60 minutes. Guys.
Okay, so let's straight away get to the last hour trades then. Mitesh Thakkar is now joining in with a few closing strategies. Mitesh, what have you made of the day so far? Subdued in the benchmark indices, but mid-caps are holding up pretty well. The mid-cap index is up 0.5%.
So I think, on the index, again, it's still a market is contracting, but I think what is interesting is the Bank Nifty. In the last movement, which started from 49,000, the Bank Nifty kind of rallied straight to about levels of 55,750, 800. We're right there. I think let us move beyond that, and once that happens, the Bank Nifty could propel the Nifty higher, and the Bank Nifty could then head towards 56,400, 500. So very positive setup, but I'm just waiting for the confirmation to come on the 2-hour charts. Once that happens, maybe, you know, we'll start going long on the Nifty as well. But for the time being, waiting for the Bank Nifty to get past 55,800 and maybe close above it. On the stock side, I have AU Bank as a recommendation. That's a buy. Keep a stop below levels of 704. Look for a target of around 740 on the upside. And the other stock which I like is Britannia. That's also a stock which is seeing good price setup. I had a big breakout. It's given a pullback in the last few hours, so the entry point is slightly refined. Keep a stop below 55.45 here and look for targets of around 57.20.
Right, got that. Madesh, thanks very much. Yeah, indeed, Britannia and a couple of other FMCG names. They're having a good session this afternoon. And we will get to the fundamental cues that could be behind that in just a bit as well. Deepan Mehta, director at Elixir Equities, is with us. Deepan, good afternoon. Thanks so much for joining. And actually, let me get your sense on this. Obviously, we know that under ownership is one thing that's working in favor of the FMCG pack. But beyond that, I mean, do you see any reason to shift ownership? Would you be a buyer, say, in any of the frontline names, FMCG?
Yeah, Subhi, good afternoon, and thank you for having me on your show. No, I think we are negative on FMCG. And of course, there'll be cyclical upswings, and because they've underperformed and fresh money may come into those counters. But I think a lot of investors are stuck in FMCG stocks. They've been holding these stocks for 15, 20, 30 years or so. And last few years, these stocks have stagnated, returns have stagnated. And I think that any upswing in FMCG, the traditional FMCG stocks, is a good exit opportunity. I wouldn't want to buy any of these companies at all. There are a few niche FMCG companies like, say, Volatile Industries is there, or Zydus Wellness is there, which is into segments which are not yet mature. There's, of course, Varun Beverages also, if you could call it an FMCG company. But apart from these 3 or 4 very unique businesses, by and large, the companies into the typical FMCG products like toothpaste, detergents, hair oils, I would say generally avoid them completely. Of course, but Gillette came with a good set of numbers, and one needs to just understand whether it is something has changed over there, or it is just a one-time kind of a good quarter.
Apollo Hospitals is holding up in the green. It's come off from the highs, but still up close to about 0.5%. Good set of numbers. EBITDA was a beat. They've planned some aggressive hotel addition for FY26. Your thoughts on the hospital space, not hospitality, and in that Apollo Hospitals in particular?
First, a disclosure, we are invested in Apollo Hospitals. It's been a multi-bagger stock for us, and company continues to perform exceptionally well. Mind you, in this particular quarter, despite hardly adding any new beds, the core the core hospital business has done very well. The online pharmaceutical distribution business still makes losses, and once that breaks even, that could add an alpha to the profits of the company. The only disappointment was that Apollo Health and Lifestyle Limited, which is into diagnostics and smaller clinics and smaller healthcare facilities. I thought the growth rates over there were pretty tepid. I think they're about low double digit or so. So maybe if that also was to improve, then it could get into a good, could be a good growth engine for the company. But yes, I think they are expanding their bed capacity by almost 30-40% over the next 24 months or so. So I know that sounds great, but looking at the track record of the company, whenever a new hospital goes on stream, typically, the operating profit margins do get compressed. So I expect soft performance for next maybe 6 months, 12 months or so. But the long-term prospects are great. But again, valuation is extremely expensive.
Apollo Hospitals, valuations becomes a cause of concern. We actually did, catch up with Ms. Sunita Reddy to discuss what was a very solid quarter for the company. On the fourth quarter numbers, they have met expectations on almost all parameters. She did share her the company's plans going forward, including all the capex they're doing, 3,000 crores of capex being put to work this year. Take a look.
We are targeting between 70 to 72%. Having said that, our metro occupancy is already at 71%. So we will push metro occupancy to 75% and system-wide move to 71%. With regard to ARPOB, clearly we showed a 7% increase in ARPOB, and that is the trend going forward. It is a mix of tariff increase as well as case mix. So with these, as the third element of it, of course, is payer mix. So we're quite sure that we can continue with the 7% increase in ARPOB. Net EBITDA for Apollo Healthco came in at 36 crores and a 9 crore profit. So that is a significant part that as we move towards 1,000 crore GMV per quarter, both the digital, it will definitely become far more profitable. Right now, as a company, Apollo Healthco is profitable. Margins are looking strong. They've, they're currently at 1.5% margin.
That's Apollo Hospitals for you. The other big movers are in the auto space. So, for instance, Hero MotoCorp is your top loser on the way up. You've got M&M going strong. So, to compile all the auto sales numbers for the month of May, Sudarshan now joins in. Sudarshan.
So besides few companies, most of the auto companies have reported sales for the month of May, and those sales are looking largely in line or better than estimates. So we'll start first with M&M, which is amongst top Nifty gainers. And for M&M, both auto and tractor segment sales have been better than estimates. Total auto sales were up 17%. SUV sales have increased 21%. And because of the continued outperformance by SUV, M&M continues to outperform the peers. Even tractor segment sales were up 10%. For Maruti, sales were largely in line with estimates, and it's helped mainly because of sharp increase in exports. For Maruti, compact segment remains under pressure. Even domestic sales, it was just basically domestic sales have fallen 5%. Hyundai Motor sales were below estimates. It has reported decline in the sales of 11%, while exports for Hyundai have increased by 3%. For Tata Motors, except bus, all the other segments have seen a decline, and that's the reason sales were below estimates. Ashok Leyland, which is a pure C play, sales were much better than estimates. Total sales have risen 5%, led by M&HCV segment, which has seen an increase of 11%, and LCV sales were higher by 5% as well. Now coming to two-wheelers, two companies that have been outperforming for the last few months, and in the month of May also they have outperformed. Those are TVS Motor and Eicher Motors. For TVS Motors, all the segments have seen an increase of more than 14%. Total sales were up 17%. Two-wheeler sales have increased by 16%. EV sales have moved higher by 50%. But for EV sales, companies saying there might be a disruption of supply in rare earth magnet, and that may impact EV sales in near to medium term. For Eicher Motors, sales were much better than estimates. Up to 350cc segment sales were higher by 26%, and above 350cc sales were up 16%. Exports too, contribution of exports have been increasing continuously every month, and for the month of May, sales for exports have increased by 82%. Bajaj Auto sales were largely in line. Domestic sales were under pressure. It was almost flat, while exports have increased by 22%. Hero Moto, it has been underperforming peers. In the month of May also, sales were below expectations. Total sales have increased by 2%. Motorcycle sales was up 1%. Domestic sales were up 2%, while exports were flat. So apart from Hero MotoCorp and Tata Motors and also Hyundai, most of the auto companies have reported sales for the month of May, which were largely in line or much better than estimates.
Thank you very much for that. We spoke to Mahindra Automotive CEO, who said the company is more focused on increasing volume than market share. Listen in.
Market share for us is an outcome of the traction we see with our customers on our portfolio. So we don't necessarily put out a target for what our market shares need to be. We are focused on delivering on the volume projections that we put out there, and most importantly, on delivering to the customer expectations in terms of their bookings as well. So that's really what we are focused on. Now, of course, as we see what the industry projections are and the overall numbers, if we continue to keep this kind of pace and we do mid to high teens, I would think that there's a natural conclusion that there shall be some market share. But that's not necessarily something we're chasing on an ongoing basis.
All right, that was the word coming in from Mahindra Automotive. And staying with the auto space, our colleague Parikshit caught up with TVS Motors' Sudarshan Venu on the company's EV lineup and potential supply chain headwinds going forward as this rare magnets issue continues to be a big impediment for the EV sector.
We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We are now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric three-wheelers and electric bicycles as well. At the same time now, there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
That's an interesting and important comment there. Now, while speaking at a press conference, Minister of Heavy Industries, Mr. H.D. Kumaraswamy, said he doesn't expect Tesla to manufacture in India. Listen in.
Tesla, we are not actually expected from them. They have only to start 2 showrooms. They are not interested in manufacturing in India.
Okay, so this is a statement that was made by Mr. Kumaraswamy today, and this goes back to, a story that our colleague Parikshit has done in the past about the way forward for, India's approach to EVs and allowing imports. And there are certain reports indicating that there could be some sort of a new policy for this in terms of how much manufacturing the companies, any foreign companies, doing in India in lieu of the imports that are being allowed, the tariffs that will be levied. And in that context, to that question from the press about whether Tesla will make in India or not, that was a statement from the minister. Let's go back to Deepan. Deepan, autos, it's the same story, right? So if TVS is doing well, it's continuing to do well. If M&M is doing well, it continues to do well. But then we are not seeing flashes of brilliance, too many of them at least, elsewhere. Anything you'd recommend buying right now? Two-wheelers, four-wheelers?
You missed out Eicher Motors.
Eicher Motors, yes, I stand corrected. I was just coming to two-wheelers. Yeah, two-wheelers relatively better. Even Bajaj's sales are better.
For TVS, I think the best-in-class numbers, again, it's a disclosure, we are invested in it, have been so for the last several years or so. Very good set of numbers, quarterly, monthly figures from Eicher Motors. 82% higher revenues, I think that's quite phenomenal and does open up new opportunities for Eicher Motors. Just rewind back 12, 24 months ago, there was so much of uncertainty around Eicher Motors stock because of emergence of competition. But now it is clear that the competition has come and Eicher Motors still has maintained or increased its market share. So that takes out one level of uncertainty around the stock. The category as a whole within the two-wheeler space is doing exceptionally well and growing in terms of its size within the two-wheeler industry. And mind you, with rural expected to pick up because of better monsoons, I'm pretty certain that Eicher Motors will have the best ever year in FY26, and we remain very positive on the stock. But look, our views are biased because of our long position in the stock.
M&M? Do you hold M&M?
Hold M&M as well. I think we seem to have got the auto pack right. So you hold M&M as well, and I think that also a phenomenal set of numbers. And mind you, when tractor does well, the company's performance improves significantly because that's a very high ROE business and that's got higher profit margins also. So I'm particularly pleased about the 10% increase in tractors. And again, I think it's a great play on monsoons. Tractor sales can improve even further from these levels if you have a good monsoon.
Absolutely, highest margin there as far as tractors go. Deepan, I was looking at Cosmo first. Actually, we've been looking at it go up for the last 15 days now. And 3 years, Deepan, really 3 years, sideways, nothing. And then 1 month it doubles. That is last month. It's just a absolutely crazy move here. Any thoughts?
No, Prashant, this is what happens in mid-cap stocks. For 2-3 years, they don't go anywhere. And then suddenly, the performance improves, something changes, some structural changes take place, or there's a cyclical upswing. and you see the stock doing well. But that's also true for SRF, which also is into film manufacturing, one of India's largest plastic film manufacturing company, very high value-added product over there. And SRF numbers also have been pretty decent. Last, I think, 2-3 years, they were being pegged down because of the film business not doing well, as was the case with Cosmo, but that's also done very well. But really, within this space, the company to watch is this Garware Technical Films. And that's been a quiet performer. It's been a multi-bagger stock last 4-5 years or so, and is looking at exports also very seriously. And now with a lot more glass being used in architecture, their films are going to find even more application. And as the premiumization takes place within the auto industry, there are some great products for even covering the body of the car to prevent to kind of keep the paint from being rusted, or to keep it, I would say, in its original condition. So that's a great stock. We missed it, but very good performance from there as well. And I would rate it amongst the best kind of a film company within India.
Garware Technical. Okay, interesting.
Isn't this the company which also makes nets, which are used for fishing sports?
This is the wrong company. I got the name wrong. This is Garware Polyester. Earlier it was called Garware Polyester. Now it is called, I think, Garware Films or something. I'm sorry, I got the name wrong. But that also is into sun control films and other kind of products which are related.
Garware High Tech Films. That's
that's Garware High Tech Films.
That's the name of the stock. Currently quoting at almost 4,600 bucks. Got that, Dipan? Interesting name coming in over there. Let's actually put the spotlight on Nykaa. Going back to consumer names, Nykaa, well, it looked like the numbers are pretty okay, but the stock has been trading under pressure throughout the day. In fact, it's down almost 4.5%. Let's go across to Mangalam to understand what the issues could be, if any. Mangalam?
Well, as far as the reported numbers are concerned, there wasn't much issue. If you look at just, the company on a basis of 24% revenue growth, 40% EBITDA growth, margins expanding 100 basis points, and the net profit on a favorable base growing by over 110%. But if you look at the internals, the growth has been driven entirely by the beauty and wellness business. So if you look at their beauty business, out there the revenue has grown over 20%. You have the EBITDA growing over 30% as well. And there has been a margin expansion. However, what the street does not like is that it is only concentrated on, the growth is concentrated by the beauty business. I was looking through a couple of brokerage notes as well. They said that the fashion business has been struggling for a bit. This time around as well, the revenues grew by just 10%, and out there was no, visibility on that turning into profits anytime soon as well. Remember when Nykaa had earlier listed, the story was that the beauty business will continue to grow at a steady state with margins expanding out there, whereas fashion will be the growth driver. Here, fashion is not the growth driver. Beauty itself is doing both growth as well as the margin expansion business. So maybe the street would have liked the fashion business to do a tad better, because that is a larger total addressable market for Nykaa more than beauty itself. But having said that, these numbers are nothing really to complain about, especially from the beauty end, at a time when competition is intensifying from Tira, etc. But I think the street is taking note of what's taking place in the fashion business, and as a result of which the stock is selling off a little bit.
Okay, all right. So maybe it's the fashion business not firing up as much as the beauty business. Maybe that could be one issue with the market. Got that, Mangalam? Thanks for that. Still down 4% on Nykaa. Dipan, let me toss this to you. Any interest? Fashion, beauty, or both?
No. Nykaa has been a disappointment, and I don't even know what the road to solid profitability is. I think if you strip off the other income, net, I'm pretty certain the company is maybe making a loss also. So look, I'm out of Nykaa. I had invested in the company through its IPO. But some of the business and the kind of dynamics don't make sense, especially at these valuations. So it's an avoid for me. And this new age companies, one has got to be a bit careful what businesses you get into, especially, if it's like a business like Nykaa. Look what happened in Ola Electric also, so where it's physical goods that you have to manage, although it's a platform, it doesn't really, deliver great returns over a long period of time.
what about Swiggy and Eternal? Over the weekend, we got those pictures of Zepto's Dharavi warehouse, the dark store, where there was a gross violation of all the hygiene rules. And now it appears that the state, Food and Drug Administration is planning to inspect the facilities of all quick commerce companies. So do you think this is going to have an impact on the listed share price?
Look, I don't know whether it is a one-off situation or, these companies have been cutting corners. One can't really say. But we remain positive on that particular space and Eternal in particular as a disclosure. But our holding period has got extended and investors should expect that these companies will take longer to go into solid profitability. But end of the day, unlike Nykaa and Ola and some of the other new age businesses, it's a platform business. And so they have great operating leverages. And eventually, at some point of time, even the quick commerce business will start to contribute positively and solidly, as has been the case with the food delivery business. And I completely agree with the management strategy of investing even further heavily, like kind of doubling down on quick commerce to take on the competition so that their market shares are maintained. So very positive on the space, but you need to be invested for a long period of time. 3 years, 5 years, 10 years, who knows, before you can get some solid outperformance in this particular segment.
Rima, I don't know if have you ever looked inside a dark store? I have a dark store near where I stay. It's actually close by. Yeah. And out of just curiosity, this is some time back, I don't know about now, but I did. And it's open, the people are going in and out. So it's basically just time, right? And what the Maharashtra FDA found, and I'm not naming which dark store this was, the company it was, but the point is it's absolute frenzy. By the time you order on your app, right, the order gets there, somebody has to find the shelf where it is on, pick it up, come to the counter right on, pack it if you ask for packaging or whatever, and then you got to rush out. And this is happening, thousands. So I don't know how much of what they found is, I think there's some specifics in terms of what they have found, etc. But I think it's just the nature of the business. It's chaos. It's just, has to be chaos, right? Because we've got to get from there to wherever we are in.
But I think in this case, something that was not taken well at all by the authorities was things like fungus and all of that. Just the lack of hygiene. Chaos and items not stacked up properly on shelves, not marked.
Yeah, because there's no time. I mean, you got to, you just...
First in, first out.
Yeah, absolutely. And so I think time has got a fair bit. And of course, there may be other stuff as well. But time, I think, is the big one. Deepan, thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. We're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 in the evening. Please. Okay, welcome back. Vikas Khemani is now with us, founder, Carnelian Asset Management and Advisors. Vikas, good afternoon. Good to have you with us here. Interesting backdrop behind you, dimly lit, looking nice. How are things, Vikas? What have you been up to? What's top of mind? And you ask around and you talk to people. Everybody's very focused on their stocks, whoever you speak with, and that's the way it should be, I guess. But everyone also complains there's nothing new, which is, the new thing is not. One is finding it difficult. Maybe because stuff has run up, valuations are high. What you already own, you own, and you're bullish about it. Is that a broad frame of mind you find yourself also in?
I think there cannot be better than that, Prashant. Just think about it. This clearly shows that there is a continuity of the growth. If I own certain stocks and continuity of the growth is there despite short-term challenges, that's fine. I mean, you don't have to find something new every now and then. And I think that's the beauty of the India story, that India is going to compound, has been compounding, is going to compound sustainably for the next 10, 15 years. And if that's the case, why to interrupt compounding? Why to interrupt what's working well for you? Unless you are a short-term trader. So from a long-term perspective, as much as I would like to tell you every week new, but I have nothing new to tell you, right? Because it will be boring, same stuff, that India story is good, structural is well placed. The sector which are planned leveraging Indian economy, export story, manufacturing story, all will do well. So within that, obviously, you keep looking for stocks all the time. But from long-term investor perspective, we don't really churn very often, and you constantly keep on looking for. And frankly speaking, as much as the market has talked about in the last 3-4 months, I mean, we haven't made really significant change in our portfolio. We have added few stocks. I mean that's a part of the normal course. But despite such a big up and down happening, at least we haven't made significant change. We took knock in the portfolio performance. It's come back. So I mean, that's the beauty of the market, right? That's the beauty of India's story.
So one theme which you've been very bullish about is manufacturing. You've called it a decadal opportunity, a structural theme. So that stays. But within that, as you said, you do make churns in your portfolio. Some stocks are out, some new additions come through. Do you want to take us through the churn within the micros in the manufacturing theme at this juncture where the risk reward is favorable?
Okay, look, I don't want to go into stock specific, but I can definitely tell you, some segments we've been kind of, adding chemicals in the space where we've added in the recent past. Especially the agrochemical looks pretty decent. CDMO space we've been adding for the last 1.5 years, and I think that seems to be now doing well. But that continues to remain, very large opportunity for us. Within auto ancillary, some interesting companies are there which are looking pretty interesting. With garmenting has been doing very well. You can find interesting opportunity there. Within that, capital goods is a very interesting segment where we are seeing a structural growth story. So manufacturing is actually, the thing is that it's very broad based. Whatever sits between import, substitution, export oriented opportunity, you tend to find that. Yeah, the only thing which we don't tend to kind of, we don't buy companies which are outrageously expensive, trading at 100p, and they might do well. Look, it's not my place to, criticize any valuation. It's just that it's not in our comfort zone. And when things change, they kind of tend to take a very big knock. And that is where we've been kind of, trying to stay in a sweet spot where PEG ratio is between 1 to 1.3 kind of things. And that's the kind of journey we've been kind of playing, and that you are able to find interesting ideas in that. Yeah. And we are fully invested. So it's not that, we have some small amount of cash. We have full investments, and we are fully convinced about the story.
Oh, well, and that's the art and science of it, isn't it, Vikas? To find those right companies with the right prospects at the right price, and you guys have been doing it for so long. So tell us what's exciting. I mean, as you go about looking for these interesting stories, particularly within manufacturing, because manufacturing is a very, very large set. Last couple of months, what have you had your eye on? I know you won't name stocks, but just some sense of what is exciting you at this point.
I just said that, right? Like, chemicals is what we've, added its recent past. And, very interesting part, Surabhi, is that, as the markets are broadening, very often you say newer opportunities, the segment which you would not think that, are part of the story ends up being, part of it. And then there are, like, within the manufacturing, there are enabler sectors. Like, we invested in a company which makes the factories, so prefab and PEB buildings, so pre-manufactured buildings. So right now, today I met a company which is also doing same thing, but they are exporting. I would never think that PB can be exported, but today I found that they're also exporting. So I mean, constantly, India is such a broad market that you every day find an interesting idea which you otherwise would not think is possible. So, and that's what I keep calling it a transformative journey, because in India, in the depths of India, many companies are building businesses which are size and scale, and that is where there's a significant alpha creation opportunity as well. Like I said, some of the segments which we mentioned, we continue to remain overweight, and we keep buying stocks in that.
In chemicals specifically, because it's again very wide, and depending on which chemical and which supply chain you're looking at, the outcomes can vary. What is it that you like more? Is it the pharma API guys? Is it the fluorochemistry guys?
Pharma APIs, of course, has been our, especially has been very a large holding for us for quite some time. But other than that, we own SRF as a large holding in our portfolio. We own Aarti Industries in our portfolio. These are also focused partly, especially in the agrochemical space, apart from, and they are specialty chemical companies. So, very diverse client base, highly motivated business, tech. So those are the, 2-3 names which we own in our portfolio.
And you see the earnings pick up, because the thing is that last couple of quarters, because of various supply, sometimes oversupply issues in the market, earnings have been a little volatile. But what do you see ahead, say next 1-2 years?
Again, like I said, we like the capabilities of the company. We think the earning growth will pick up from here. There was the inventory stocking which happened, about in last 18 months or 24 months, and that has got cleared. And as the inventory restocking happens, these companies can have significant growth.
Okay, Vikas, so we leave the conversation here for now. Thank you very much for joining in. Slip into a break on that note. On the other side, we'll get you a few BTST calls coming in from Mitesh. Welcome back. You're watching Closing Bell, coming live from the CNBC-TV18 Motilal Oswal studio. The Nifty is trying to get back into the green, so is the Sensex. So just down close to about 12 to 13 points. Things are getting interesting after about 3 o'clock. Some of the stocks where you are seeing buying coming through, I think Dr. Reddy's, Ultratech Cement trying to cut the losses. Tata Consumer is up nearly 1.5%. Bajaj Finserv is up half. Eternal 2 has ticked higher, 1.25%. But amongst the heavyweights, I think it's ICICI Bank. We should get that up. That's up close to about 0.5%. Mitesh is now back with us for a few BTST calls. Mitesh?
I do in fact have Eternal on my list. BTST here, the target 239 for a 246 kind of a target for tomorrow. And the other one is Adani Transmission Gas Limited, which is ATGL. That's for BTST as well. People stop just below levels of 685 here, with targets of 710.
Okay, thank you very much for that. Let's talk about Inox Wind that's trading with cuts after reporting the Q4 numbers. Last of the earnings print coming through. Vivek joins in with the details.
Well, that's right. Especially after the results of very strong results of Suzlon and the kind of guidance that the management gave, 60% growth guidance across most of the key parameters. All eyes were on Inox Wind. Inox Wind, well, the numbers didn't disappoint. Execution, how kind of missed the mark as far as what the management had guided at the end of Q3. But let's have a look at the numbers themselves. Numbers themselves on a year-on-year basis, very strong. Revenues higher by almost 2.5 times. Profitability higher by 2.6 times. EBITDA margins improving by almost 80 basis points. And profitability higher 5 times. And this is on a very muted base as far as FY24 was concerned. But let's have a look at what exactly is keeping the stock quite subdued in the session today. At the company had guided for an execution of close to 800 megawatt for FY25. But despite a very, very strong Q3 as well as Q4, the company at the end of FY25 managed to do an execution or a delivery of close to 705 megawatt. Again, a miss as to what the company themselves had guided, which is what has kept the street quite worried. Along with that, increase in receivables seen in line with other infra companies is also something that the street is awaiting more clarity from. The other blip has been the fact that the order book accretion has been quite muted in the quarter gone by. Order book currently at 3.2 gigawatt. On a sequential basis, it's dipped from 3.32 gigawatt last quarter or at the end of Q3. FY25 order inflows at just around 1.5 gigawatt. Remember, FY24, the company managed to get order inflows of close to 2.4 gigawatt. Again, raising concerns as to whether there is on-ground tendering activity happening as far as the wind sector is concerned. Now, however, the good part is that the company has maintained its guidance as far as execution is concerned for FY26 as well as FY27. FY26, the company maintains its guidance of 1200 megawatt or 1.2 gigawatt. And for FY27, they're targeting a very strong execution of close to 2 gigawatt. However, post the miss as far as the execution in FY25 is concerned, all eyes will be on whether the company can go ahead and execute what they're saying in FY26 and 27.
Thank you very much for that. Amrish Baliga is now with us on the show. Amrish, before we get chatting about today's big movers, the stock that you like is Praj Industries. Tell us about that and why now?
Yeah, I mean, I've been recommending Praj, I think, for the last 2 decades, and it's been a while now. I've not recommended this, and I think after close to 2 or 3 years, I'm recommending the stock again. Praj has been the leader in ethanol blending program globally, and they have about 10% of the global capacity. Domestic share is about 65%. If you look at the last 3 years, the revenue CAGR, it's been about 39%. EBITDA CAGR is about 51%. But lately, the earnings, have been a bit disappointing. So because of which we've seen a decent correction. And I think that's a good buying opportunity because the order backlog is about 4,350 crores, which is more than 1 year's revenue. Although we are running a bit short of the target on compressed biogas plants, but that's slowly gaining traction. And that's the big opportunity for Praj. And even in green hydrogen, they would be an important player. It's a future-ready company, expecting a 30% growth over the next 3 years, CAGR. And the management is confident of about 10,000 crore top line by 2030, with about 50% of that would be export revenues. So I'm expecting a EPS of about 28 for FY27. And with that, my target is 620 in the next 9 to 12 months.
Okay, no, absolutely. And as Amrish says, he's kind of sort of recommended this for a long time now. That is Praj Industries. It's a thematic It's been a thematic idea for a lot of people for a long time. By the way, look at the market now. It has come up. There is a bit of a swing higher which has happened starting 245. You know, we were at about 24,660 and we've basically moved up about 90 points. What's the time now? Okay, so about 20 minutes, we've moved up about 90 odd points or so. That's the sharp swing up, and I think we should be back in the positive zone. Almost, right? I think we did. So 24,750 was the close yesterday. Yeah, we did actually come into the green for just a little bit, but we were flat, almost in the green. So quite a bit of a recovery. The low today has been made at 24,526. So this is interesting stuff, which seems to be going on. Well, let's play out a quick soundbite. This is Kaku Nakate of Bank of America Merrill Lynch from the sidelines of the conference, Bank of America India conference. Listen in.
Now, as you know, that when you invest in capex, the payback is 3.25%, while subsidies is flat. It definitely spurs consumption, but it doesn't have a multiplier effect. So that headwind you are definitely seeing, which we can't really rule out. But on the private sector, to your point, people are enthused of really getting into the electronic sector, where there's a lot of, PLI boost, there's a lot of interest, and, we can become really suppliers to the world. If the pharma costs or the medicine costs, healthcare costs have to come down in the US, we could play a crucial role, but the policy needs to really come out. But without that, on the consumer, the demographic dividend, and basically what we have best going for every corporate is controlled inflation, right, which is never good interest rates and a decline in interest rates. And third, policies of certain states which can compel them to really come in a larger size to actually grow or invest in sectors where India could play a leading part. If we have 4.8% of earnings to GDP, and many people used to say India has huge valuations, but actually the profit earnings have lived up to that expectation. So we have not had a PE expansion. The earnings have actually really driven that. So that's very important. And that's the point we are pointing out at the conference, that that's something the FPIs are missing out on.
Okay, interesting conversation there. Let's run you through some of the big movers, stocks which are moving up. We spoke about Bajaj Finserv. Some tech names are now pushing higher. So Tech Mahindra is cutting its losses. Infosys now down only about 0.5%. TCS is trying to get back in the green. So tech is pulling up. You've got Eternal, which is up more than 1.5%. Eicher Motors, where the numbers look good, stock is holding up in the green. The top gainer today continues to be Adani Ports. Adani Ports is higher in trade. In fact, I think a couple of the Adani Group stocks are looking up. Even Adani Power is up close to about 2%. Amrish, in the auto pack, at this juncture, which stock would you recommend buying? I remember in the past, I think Hero MotoCorp, you found the risk reward fairly attractive. Does that stay, or do you look now, considering TVS has also been doing very well, the performance has been good, would you look to add TVS Motors to the basket?
No, see, I mean, when you're looking at two-wheelers, you should have both Hero MotoCorp as well as TVS, and to a certain extent, surely Eicher. And when we're talking of auto overall, when you're talking of four-wheelers, LCVs, and surely tractors and SUVs, then I think the stock one should be looking to buy is Mahindra and Mahindra. Because, their new EV launch, which they had recently, I think that's been extremely successful. And I think that is what will change the face of Mahindra and Mahindra, just like what Scorpio did close to about 2 decades back. I mean, that completely changed the way people looked at M&M. I think the latest EV offering is what will do the same thing to M&M going ahead.
Yes Bank, do you know what's happening? 8% up. Look at the volumes on Yes Bank. And the other one is CDSL. That's been a rocket stock. What did we miss in these two?
Yes Bank, like I've been bullish on the stock for a while, but surely I didn't expect this sort of a move because whatever said and done, I mean, there's no open offer for this investment by Mitsui. But I think what has changed is that it's no longer that question mark is not there in Yes Bank, and it'll be seen now as more of a foreign bank backed by Mitsui. So I think this can still move up further. In fact, I mean, I had a price target of about 36 over the next 18 months to 24 months. But this move from 2021 onwards till the current levels is not what I expected right now. I thought it'll happen over a period of time.
So you can still buy because your target price is 36, but the time horizon should be about 1.5 to 2 years from here.
Absolutely, absolutely.
And CDSL? Is there any news flow?
CDSL at these levels, I'm finding it a bit, expensive. I mean, we've already seen the stock move decently well. Although, yes, I mean, it is backed by numbers. But then from here on, I mean, for it to move another 15-20% would be a bit difficult, at least in the near future. So I would surely wait for a correction to buy into CDSL.
Okay. All right. So that's the view on CDSL and on Yes Bank. Yes Bank indeed has done really well today. Actually, so is the market. I mean, it's a very good recovery at a time when US futures are still down between 0.5% to 0.75%. I mean, the headline index has come back. Mid caps are doing really well. Yeah, so not a bad way to start the week, actually. We do have to take a very quick break. And as we take that break, here's some good news coming in for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. You can get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or from Google Play. You can also, of course, scan the QR code, which is coming up on your screen.
Okay, welcome back. That's basically what you have. So the market, after teasing green for just about a couple of seconds, actually maybe a minute or so, back down in the red, but nothing really to worry. Now let's just bring you an exclusive conversation. I spoke with George Yeo, who was the former foreign minister of Singapore. I mean, I think one of the most astute watchers of global affairs out of Asia. Really an insider in terms of some of these geopolitics and relations between important big powers. I spoke to him about a variety of issues and just want to sort of tease out a few points that he made. One, of course, about Trump's negotiating style. And, of course, the second is about India and China and why cooperation is a must and essential. Listen in.
No, in the real world, governments play an important role in terms of infrastructure, regulations, education, tax policies, and so on. So you can't avoid governments needing to have a view of economic development, both for the long term and for the short term. For the short term, partly out of electoral considerations, but for the long term because people are affected. The problem is this: it's not whether or not you have industrial policy, it is how you carry out industrial policy. If you are too dirigists and you go into details, you end up helping certain groups, entrenched groups, to collect rents, and you lead to corruption. So industrial policy should be broad enough to ensure that within specific sectors, there is competition, and that you're not favoring one group of individuals or one company over another. Well, Trump, we all know, is a bully. And he believes that bullying is a very good negotiating tactic. So before he talks to you, he wraps you up. Then he softens you. Then you will agree readily to his demands. Then he put his arm around you and you say you're a wonderful friend. You feel so warm inside. And that's how he deals. This is his method. Now, he can do that to small countries like Panama, maybe even to Singapore. But he can't do that to China. He can't do that to Russia or to Europe or to India. What is Trump's preoccupation? It is the coming midterms election. If he doesn't maintain Republican control of both houses, the second half of his presidential term will be a write-off. So you can be sure that whatever he does, whatever his tactics, his preoccupation is ensuring a good midterm elections for the Republican Party and for himself. And if tariffs remain high and the cost of living for ordinary Americans go up, he'll be in trouble. So I think before the middle of next year, things will come down because he will need to get the ground supporting him again. But he must have had enough victories to convince them that MAGA is an ongoing concern.
All right, so that's a big global view coming in on how geopolitics and a lot of these trade discussions are center stage for markets at this point. A small dip, by the way, as we are getting set for the close, about 77 points, 75 points lower once again. But otherwise, the mid-cap index continues to do fairly well. Ambrish, finally, before we let you go today, we've discussed one stock. Anything else in the mid-cap space that's caught your fancy, where you've really liked the numbers, outlier numbers, where a buy perhaps could even be warranted?
I mean, the other stock is into specialty chemicals, like a company like Archean Chemicals. They are the largest exporters of bromine and industrial salt. I mean, 29 global customers in 13 countries, 38 domestic customers. And now, in fact, they've gone in for an expansion. And I think that is what will play out in FY26 and FY27. In fact, the margins had come down, but I expect the margins to get back to that 40-50% range. They had come down to about 26% recently. So overall, if you're talking of FY27, I'm expecting a EPS of close to about 45. And with this, my price target for Archean Chemicals is 780.
Okay. All right. Archean Chemicals, another stock of choice for Ambrish. Good conversation this afternoon, Ambrish. Thank you very much for joining in. We look forward to the next one. Well, we're down to the last 2 odd minutes of the day closing out. If you look at the Asian picture, we're in sync with some of our neighborhood markets. For instance, the Hang Seng, after falling 2.5% in the morning, finally ended with a drop of about 0.5%. If you're looking at Europe right now, again, the cuts are between 0.25% to 0.5%. Ditto for US futures, at least at this juncture. And we have been more or less in sync with that. 0.3% lower is where the Nifty is going to end. So let's talk about the weak hands then. Weakness in some of the global-facing names, particularly metals, of course, for obvious reasons. JSW Steel about 2% lower. Tata Steel about 1.2% lower. And let's see where Hindalco has ended. Hindalco down about 0.5% as well. So metal is definitely a weak spot. Beyond that, Tata Motors, Hero Moto, Bajaj Auto, not a great day for auto stocks today. Banks have been muddling along. Bank Nifty is better than Nifty. Bank Nifty's managed a positive close, a close in the green. But some of its main constituents like HDFC Bank down about 0.5%. If I look at ICICI Bank, that's the one that's been a counterweight. And SBI has managed a very, very small green tinge on it. Speaking of green, for the Nifty on the upside, M&M following those good sales numbers for May, up about 1.5%. And then the consumer space looked quite okay. Eternal, Tata Consumer, HUL, Nestle, Asian Paints, ITC. So largely a consumer-driven day on the green side, but still not enough. 60 lower on the Nifty as we're playing out. But the story on the broader market is much, much better. The mid-cap index is up 0.5% as we're ready to close out. Some interesting names. By the way, IOB in the dying moments of trade is surging 6%. There is Karur Vysya Bank, these tier 2 banks, 7.5% on the upside. And then, of course, there's Yes Bank with the excitement around the Sumitomo Group checking in. 8% up on that stock as well. AstraZeneca on numbers, 16% up on AstraZeneca today. Spark, Sun Pharma, Advanced Research having a good session. Imagica World, the numbers I remember this quarter weren't that great, but anyway, from the small cap arena, 8% up on Imagica as well, so not too bad out there. The disappointments of the day would be Inox Wind on numbers, 5% lower. Nykaa is lower despite the decent numbers, down about 4.5% as well. And then the listings of the day. Actually, let's look at AG's Vopak, 3% up, so positive start. Schloss, which is the Leela Hotels, is down 0.25% on day one. Okay, so the bell has gone, and that's where we take your leave. That's day one of the week done. Another range-bound session. So wrap on this edition of Closing Bell. Thank you so much for watching, but do stay tuned. We have more market insights and updates coming up in Markets Forward coming up next. Nuvama presents CNBC-TV18's Market Central.
Global cues weigh on sentiment as the Nifty and the Sensex end with mild cuts. Broader markets outperform. The mid-cap index soars over 0.5%. Banks also fare well.
Automobile sales threw up a mixed bag in May. Maruti meets estimates, M&M outperforms peers, but Hyundai and Tata Motors missed the mark. Two-wheeler sales are also mixed. TVS and Eicher Motors beating estimates, and Hero Motor sales is below estimates.
Stocks of steel and aluminium makers take a dip after US President Donald Trump doubles tariff on metals to 50%. The souring of trade relations with China only adds to concerns. Hello and welcome to a fresh new edition of Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I'm Reema Tendulkar and with me is Ekta Batra. Hi, Ekta.
Hi, Reema. Yes, absolutely. Well, today was quite an exciting day of trade, you'd have to say. But before that, let's tell you that we have got you covered for the next 20 minutes with all the big news and the key developments on the Lal Street, the top corporate voices and events to track. Let's, in fact, kick off the day with the market action. Well, Reema, quite an exciting day of trade.
Indeed, but by the end of it, we're still very much range. The Nifty's range between the 24,500 mark, even the intraday low today was 24,526. But what was heartening was that recovery that we saw in the middle part of the session and the spike towards the close of trade. On adjustment, the Nifty is closing largely flat, but above the 24,700 mark. Mid-caps and small-caps outperformed. The mid-cap index was up nearly 0.6%. The small-cap index was up close to about 0.5%. And we had a positive advanced decline ratio. Sectorally, the losers today, we'll talk more about it, was metals, IT also on the back foot. But on the way up, FMCG and realty came in for some amount of buying.
Okay, well, yes, absolutely. In terms of a couple of key indices which lost out in today's trading session was the Nifty IT index, which was a bit weak today. We had a couple of others such as the Nifty Metal, which was down around 0.7% as well. But on the other hand, just watch out for what took place with the India VIX, which spiked up around 6.7% in today's trade. And the Nifty PSU Bank Index also, which went home in the green. So overall, it was a mixed day. It was range bound for the frontline indices. The mid-caps, however, did better today. The Bank Nifty also managing to pick up pace. But let's tell you what we have for you in store today. We start with the top movers and shakers of the day with Vivek. Auto sales were mixed bag in May. Maruti met expectations while M&M outperformed. FMCG stocks also saw a lift after the government slashed import duty on crude edible oil from 20% to 10% to help rein in prices. Stay tuned. We'll bring you that and more in just a bit. Last but not the least, we delve into the key market events to watch out for tomorrow's trading session as well. All right, well, on to our first segment of the day. Vivek is standing by from the big wall with all of the top stocks and movers of the day. Vivek, over to you.
Well, thank you so much for that. Another session where you actually saw the broader end of the markets outperform. Market breadth was quite strong. And in fact, like you've been mentioning since the start of the show, it was actually the FMCG pack amongst the top gainers in today's trading session. Like you mentioned, crude edible oil, the import duty there was cut in half. And if you look at some of the stocks, especially that benefit from that particular element being as a key raw material input, look at names like Scottish Consumer, Britannia, both up over almost 2% in the session today. Tata Consumer Products too managed to end in the green. The other set of stocks that did quite well was the entire PSU banking pack. A lot of positive news flow coming in over there. Look at some of the names here. Bank of Maharashtra up over 6.5%. Indian Bank, one of the strongest movers. This particular stock was on good volumes as well. IRB, Union Bank, Central Bank of India, all of these stocks managed to end with strong gains today. From the pharma pack, you saw AstraZeneca, one of the last stocks in the pharma space, to go ahead and declare its results. The top NSE 500 gainer, up 17%, highest volumes in quite some time as far as AstraZeneca was concerned. And the realty pack, remember, on 6th, you do have expectations of rate cut coming in, and the entire realty pack, moving up in anticipation of a rate cut. Brigade Enterprises, the top gainer, almost 7.5% higher for that particular name. From the broader end of the markets, one from the auto tank space, FM Industries, very good set of numbers. Q4 was strong. That stock ended higher by almost 10%. Amongst the list of laggards, Nykaa, despite what was a very encouraging Q4, this particular stock saw quite a bit of a sell-off, almost 5% lower here. IT pack, like you mentioned in the start of the show, the entire pack did see some selling pressure at higher levels, and Emphasis, one of the top laggards there, almost 2.5% lower. Inox Wind, this particular stock, had moved up higher after the very strong results of Suzlon, but an execution miss as far as FY25 is concerned led to a bit of a sell-off, 5% lower for Inox Wind. And lastly, very large block deal happened in Niva Bupa, but the stock didn't recover after that. In fact, last couple of trading sessions, this stock has lost almost 12 to 15%, and Niva Bupa today down 10% in the session.
Thank you very much for that big block deal weighing, as Vivek said, on Niva Bupa. Ambrish Baliga and Jay Thakkar of ICICI Securities are with us on the show. Ambrish, thank you for waiting back. And Jay, welcome to the Markets Forward. The start of the week was fairly quiet and we're still ranged. So on individual stocks, can you tell us 1-2 stocks that would be on your watch list for tomorrow?
Good afternoon to you, Rima and Ekta. Well, definitely, we see the momentum is quite in favor of the PSU banking pack and overall banks. Banking and financials are doing good. Apart from that, Nifty reality is also expected to do good in anticipation of a decent rate cut this time around. I mean, anticipate 50 basis, but I think that the minimum 25 basis is definitely coming, and hence we are seeing this kind of momentum coming in the Nifty reality, Nifty banking, or maybe financial services. Hence, I would say that from the PSU stocks, Bank of India, I mean, that is one stock which I think Rima is likely to continue its uptrend because it has given a good breakout and we have seen a good long build-up happening here as well. So it can reach towards 135, 140 levels, at least in the near term. HDFC Bank, from the private sector bank, I think the consolidation more or less has been done. It's been consolidating within a triangular pattern. We have seen a long build-up here. The FIs are also increasing the stake here. I mean, since past 2 quarters, if we see, then, this is one stock from the private sector bank wherein the FIs have increased their stake. So this stock is also likely to provide a breakout. It was down today, but then 2000, 2050 are the levels which I am looking out for in HDFC Bank, and Ramco Cements is one stock because I think that overall infra and realty likely to gain. Then the cement pack is also likely to gain. So I think 1050, 1100 is the levels which one can look out for in Ramco Cements when this construction materials is likely to do good. And the final stock will be Loda. Nifty Realty, as I said, is likely to do good. So 1475, 1500 are the levels to watch out for. I mean, macro tech developers or Loda is also expected to do good, in this week.
Okay, well, Ambrish, hi, welcome to the show. Well, we do have the RBI monetary policy at the end of the week. What is your sense in terms of what we could expect, especially post the GDP numbers? And do you think that would probably be quite a determinant for the markets?
Yeah, because you look at the GDP numbers, you look at the inflation data. I think the market is expecting a 25 basis points, including myself. So I think that's what we should see. In case it's higher, it would be really surprising. But I think 25 basis points is what the market is discounting already for.
Got that. Let's talk about auto sales. Auto sales for the month of May are out. It's a mixed bag. Sudarshan is here with the details.
So except a few, most of the companies have either reported sales that were largely in line or higher than estimates. In the four-wheeler space, M&M continues to outperform the peers. It's both the segments, auto and tractor segment, have reported sales that were better than estimates. For Maruti, sales were largely in line with estimates, while domestic sales have seen a decline. Exports have seen a healthy growth. A reason of domestic sales seeing a fall because the entry-level segment has seen a decline of almost 13%. Next is Hyundai Motor. Like Maruti, here also domestic sales remain a drag and overall sales were largely below estimates. Domestic sales have fallen 11%, while exports have seen a minor increase of 3%. For Tata Motors, sales were much below estimates. Except bus segment, all the segments have seen a decline. Ashok Leyland, which is a pure CV play, it has reported sales that were much better than estimates, led by M&HCV segment. Total sales have seen an increase of 5%. M&HCV sales were higher by 11%. Even LCV sales have increased by 5%. In the two-wheeler space, two companies that have been outperforming over the last few months, even in the month of May, these two companies, TVS Motor and Eicher Motors, have outperformed the peers. For TVS Motors, all the segments have seen a growth of at least 14% or more than that. Total sales were up 17%. two-wheeler sales have increased by 16% and electric vehicle sales were higher by 50%. But on the electric vehicle, company is saying that there might be a disruption in the supply of rare earth magnet and that may impact EV sales in near to medium term. For Eicher Motors too, sales were much better than estimates. Total sales have increased by 26%. Sales with engine capacity up to 350cc have increased by 28% and above 350cc segment sales were higher by 16%. And export contribution for Eicher has been increasing every month, and because of that, export sales also have increased, and that was a healthy increase of almost 82%. For Bajaj Auto, sales were largely in line with estimates. Total sales were higher by 8%. Domestic sales were flat, while export has seen a healthy growth of 22%. One company in the two-wheeler space that has been underperforming the peers is Hero MotoCorp. Even in the month of May, its total sales were much below estimates. Total sales were just higher by 2%. Motorcycle sales increased by 1%. Domestic sales were up 2% and export sales were flat. So if in one line I have to say about the May auto sales, it was not a bad month considering the challenging environment.
Okay, all right, Sudarshan. Thanks very much for that. So mixed bag for the month of May, but we did speak to Mahindra's automotive CEO who said the company is more focused on increasing volume than market share. Take a look.
Market share for us is an outcome of the traction we see with our customers on our portfolio. So we don't necessarily put out a target for what our market shares need to be. We are focused on delivering on the volume projections that we put out there, and most importantly, on delivering to the customer expectations in terms of their bookings as well. So that's really what we are focused on. Now, of course, as we see what the industry projections are and the overall numbers, if we continue to keep this kind of pace and we do mid to high teens, I would think that there's a natural conclusion that there shall be some market share. But that's not necessarily something we're chasing on an ongoing basis.
Staying with auto, Parikshit also caught up with TVS Motors' Sudarshan Venu on their EV lineup and the key headwinds for the sector in EV industry. Listen in.
We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We have now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric three-wheelers and electric bicycles as well. At the same time now, there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Okay, all right. So that's on the auto space. But Jen, just wanted your thoughts a little bit in terms of the top movers this afternoon. In terms of stocks, we had Adani Ports, which really topped the list up 2.5%. And along with that, M&M as well, which was up around 1.6%. So what would your view be on both of these counters?
Well, see, definitely, Adani Ports, I would say that Ekta is likely to do better from here on as well. In fact, we have a positive view on almost all of the Adani group names because we are seeing good short covering happening out there. And as far as Adani Ports is concerned, in fact, this is one stock wherein we are seeing good long build-up. We are seeing continuously high tops, high bottom. The momentum has been positive at most of the degrees from daily to weekly, monthly charts. So I think that this stock is likely to head towards the upper end of the range, which has been around 1550, 1600 levels. And going forward, I mean, this calendar year or financial year overall should be good for Adani group of stocks. They have corrected quite a lot and started to reverse, especially Adani Ports has been one of the outperformer. Is likely to perform well. M&M, I mean, this has been one of the outperformer Ekta in the auto pack so far. Overall, in the rise as well as in the fall, it did not fall much as compared to other stocks. But I think that, M&M now is stuck in a range. I mean, until 3,200 levels aren't taken off on the upside, it might just consolidate here. So my view on M&M would be that if at all you get a breakout about 3,200, you will get the momentum, and thereafter you can ride the same. Else, you would see some profit booking at the high levels, and the stock might consolidate within a broader range of say 2,800, 2,900 to 3,200. However, for the medium to long term outlook is positive. I mean, rate cut is also likely to benefit the auto names going forward. So auto, realty, all of these are likely to perform going forward. But in the short term, 3,200 level is the near-term resistance.
Got that. Let's talk about the FMCG stocks. Names like Britannia, Godrej Consumer, HUL were up in trade, and they got a bit of a shot in the arm after a cut in the import duty on edible oils. From 20%, it's brought down to 10%. Manglam is here with the winners and losers. Manglam?
Well, that's correct. Sometime last September, if you noticed, there was an increase in the duty for imported palm oil prices, and as a result of which there was a sharp inflation that we saw in palm oil prices, and the third quarter and the fourth quarter results would show that the FMCG margins had shrunk, specifically for the ones that made soap and biscuit companies, etc. Now, from the peak, we've seen a big decline of almost 25-26% in palm oil prices. Palm oil, and remember PFAD, a derivative of that, are important inputs for both food as well as soap companies. So a lot on the street were hoping for margin expansion for FMCG companies beginning first quarter, second quarter of FY26 itself. And to add to that, now there is a special benefit that is coming from the government, which comes in as a sweetener. So the duty has been reduced from 20% to 10%. So in an anyway downtrending palm oil price market, a duty reduction is just a positive, and that's reflecting in the prices of names like Britannia, HUL and GCPL. On the other hand, though, we are seeing some decline in names like AWL, the erstwhile Adani Wilmar, and Patanjali Foods is seeing a mild green. But remember, these are the ones that do not stand to benefit from reducing prices scenario. Over the last couple of quarters, their EBITDA had seen a big jump because their realizations had increased. Now with palm oil prices coming down, duties coming down, the realization for their key products, the edible oil business, may come down. So as margins for the FMCG companies which are gaining increases, the margins for these companies will reduce. So that's the sum and substance of edible crude oil and the duty reduction.
Okay. All right. Amrish, what would your view be on this edible duty oil relief and the impact on FMCG companies?
Yeah, so clearly it is positive for the FMCG companies, especially which are into snacks, as well as the ones into soaps. So stocks like Bikaji, Pratap Snacks, Britannia, HUL, Godrej Consumer, I think all of them will benefit. So I think at the same time, with the sort of monsoons we are looking at now, I think this should also increase the demand for FMCG. So overall, I think one has to be bullish on FMCG at least for the next couple of months.
Got that. Technically, do you want to weigh in with your thoughts right now, Jay, on the FMCG pack, the stocks that Manglam spoke about, HUL, Britannia, GCPL, Patanjali?
Sure. I mean, Rima, see, most of the FMCG names are underperforming right now, the overall market, and they've got into the consolidation. I mean, we have through the result season as well. And, the stocks are more or less trading quite sideways, I would say. I mean, even if you look at the Nifty FMCG index, that's been trading within a range of, say, 55,000 to 58,000. And that's a 3,000 points range. And I think still some consolidation is pending. I mean, there was one stock, I mean, ITC, which had actually post-result gone up, had hinted some breakout. But then, we saw the stake sale by back, and the stock eventually corrected and went down. So net the index is trading sideways, and I think most of these stocks are likely to underperform going forward. Definitely, if monsoon is good, which is likely to be, then it's going to benefit this sector, and the stocks are likely to perform going forward. But at least for a month or so, at least in June series, I think one sector which one should keep in mind is the banking, realty, or all the rate sensitive stocks as of now. I mean, they would be in flavor. FMCG might pick up if at all there is some negative surprise out there from the point of view of defensive, not right now.
Okay, rate sensitive should be on top of the agenda, and we've got the RBI MPC this week itself. So the action will continue in these names. Amrish, we had 2 new listings today. One of them is Schloss Bangalore, the owner of Hotel Leela Resorts and Palaces. Quite, in fact, it's a flat close. They managed to recover the early losses. And the other one is Aegis Vopak. Have you studied either? And, if someone's not participated in the IPO, they're still getting it pretty much at the issue price.
Yeah, I mean, clearly, the demand for the IPO was very low, especially from the HNI, the non-institutional side of the market, because, the IPO is very decently expensive. They're not cheap. So, I wouldn't recommend buying at this point of time, although, something like Leela could be a good long-term bet. But, I think I would wait for a correction before buying into it.
Okay, all right, fair enough. Well, Jay, talking about recent listings, a fairly new company, Nykaa, came out with its numbers today. What would you do with it chartically?
Well, see, technically, definitely there has been a clear breakdown in today's trading session. We have seen a good correction coming in the stock. The monthly momentum has been positive. We have seen the stock witnessing some short covering, but then the overall performance has been quite on the negative side only. I would say that if at all there is a correction till the levels of 180, 175, it would be a good point to enter. That would favor a good risk reward for going long as well. So buy on dip should be the strategy on Nykaa. If it falls below another say 10% odd, it would be a good medium to long term bet.
Gentlemen, thank you very much, Amrish and Jeff, for joining us. With that, we'll get into a break. On the other side, top corporate voices lined up. Along with that, the key market events to watch out for. Stay tuned. Welcome back. You're watching Markets Forward, and these are the top corporate voices that we had on our channel today. Apollo Hospitals right on top, gained over 1%. Speaking to CNBC-TV18, top boss Sunita Reddy said Apollo Hospitals is targeting an occupancy rate of 70 to 72%, with metro occupancy pegged even higher at 75%, which is currently around 70%. She also pointed out that Apollo Hospitals is moving towards a GMV of 1,000 crore rupees per quarter. She emphasized the company is profitable and has strong margins.
All right, and meanwhile, Ankur Gupta of Schloss, the parent company of the Leela Hotels, said that they are targeting a profit or a PAT of 250 crore rupees by FY27. He also expects the company to grow by over threefold in the next 5 years. That's not all. Ankur Gupta also said that they plan to start monetizing the residences business from FY26. All right, and before we wrap, we'll bring you some of the key events to watch out for in terms of tomorrow's trading session. Vamakshi is here with more.
Well, Ekta, tomorrow we'll be keeping an eye out from as far as the economic cues are concerned. We'll be watching out for the Europe CPI data as well as the US JOLTS job openings. Of course, the Korean markets will be shut, in tomorrow's trading session. But apart from that, as far as specific stocks are concerned, keep an eye out on Yes Bank. There is a board meeting that is scheduled tomorrow. They will be considering fundraising plans. Apart from that, keep an eye out on Tata Motors as well. We will be watching out for the Harrier EV launch. As far as some other stocks are concerned, Nuvama Wealth goes ex-dividend. They will be paying an interim dividend of 69 rupees per share. So Nuvama Wealth goes ex-dividend as well as L&T. And lastly, keep an eye out on ProStarm Info Systems. This is a new kid on the block that will be listing tomorrow. So those were some of the important events that you need to watch out for.
Thank you very much. And that brings us to a close in this edition of Markets Forward. We'll be back with more news and updates on the other side. Stay tuned.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Global markets decline after President Trump decides to double steel tariffs. The Sensex and the Nifty back home end with March losses. Mid-caps outperformed. The Nifty Bank hits a record high just about. In a rare interview, Sudarshan Venu of TVS Motor says China curbing exports of rare earth magnets could bring the Indian EV industry to a halt. Calls for developing a self-reliant supply ecosystem. That's an exclusive. Automobile sales throw up a mixed bag in May. Maruti meets estimates. M&M outperforms peers, but Hyundai and Tata Motors missed the mark. Two-wheeler sales are also mixed. TVS and Eicher beat estimates. Hero Motor sales below expectations. Heavy Industries Minister H.D. Kumaraswamy says Elon Musk Tesla is not interested in manufacturing in India and only wants to open showrooms for now. CNBC-TV18 had reported in March that Tesla has no plans to make in India just yet. President Trump and Musk have raised concerns about India's import duties.
It is approximately 5,000 crores, upwards of 5,000 crores.
It's approximately. Now we're obviously working to reduce the impact by whatever means we can. But yes, that's a ballpark figure.
Air India's CEO Campbell Wilson estimates 5,000 crore rupee hit if Pakistan's airspace remains closed for a year. Promises to double capacity over the next decade. Warns user development fee at some airports is too high and could impact demand. That's an exclusive. The top two foreign airlines operating in India call for easing of restrictions on market access. The CEOs of Emirates and Etihad say restrictions on seat capacity on flights to the Gulf is only hurting Indian travellers. That's a CNBC-TV18 exclusive. At least 32 people killed as northeast India grapples with devastating floods and landslides. 3 people are dead, 6 security personnel missing after a landslide hit a military camp in Sikkim. Over 130 wild animals killed at the Kaziranga National Park. Russia launches air attacks on Ukraine, killing at least 5 people. This after Ukraine claimed to have destroyed 40 Russian bomber aircraft with a drone attack. Officials from both nations set to meet in Istanbul today for a second round of direct peace talks in the last 3 years. Israeli forces kill over 50 people in Gaza overnight, destroys the only dialysis center in the enclave. The UN aid groups hit out against the attack on Palestinians waiting for food outside a US-backed aid site on Sunday. Israel military denies its involvement. 19-year-old reigning world champion Gukesh beats chess legend Magnus Carlsen in the 6th round of the Norway Open. Carlsen bangs the board in frustration after a blunder cost him the game. All of that and more coming up for you, but straight to the day's market action. Global markets declining in trade after US President Trump announced plans to double steel tariffs. The Sensex and the Nifty ended with marginal losses. They did recover coming off their lows. A sharp recovery is what we saw in the second half of trade. So down 34 at close, the Sensex down 77 points. The Nifty Bank and the mid-cap index closed smartly in the green, almost a 400-point higher on the Nifty mid-cap, and the Nifty Bank closing about 100 points higher today. So that was the story for the markets. Now, the RBI's Monetary Policy Committee will meet on the 4th of June and a decision on rates will be announced on the 6th of June. CNBC-TV18 Citizens Monetary Policy Committee unanimously expects a rate cut, with one member even predicting a 50 basis point cut. Let's take a look.
What will the MPC do to repo rates on June 6th? I'll start with Sonal, the lady. Sonal, what will they do?
25 basis point cut.
Samiran?
Yes, cut by 25 basis points.
Okay. Sajid?
25 basis point cut.
Okay. Shaumya, what's your vote?
I think I would go for a 50 basis point rate cut. It's better for a better transmission.
Okay, 50. Dr. Sen, which way would you lean, sir?
25.
25. Okay, so 4:1, 25. A cut is coming regardless.
Well, a cut is coming. Will it be 25 or will it be 50? Stay tuned to CNBC TV18 on the 6th of June to find out. Now, India's GST revenue collections crossed the 2 lakh crore rupee mark for the second consecutive month. The 2.01 lakh crore mop up in the month of May is an increase of 16% compared to the same month last year. The year-on-year growth was led by a 25% hike in GST collected from imports, which came in at over 51,000 crore rupees, and a 13% hike in the mop-up from domestic transactions, so strong GST collections there. Now, the Chinese government has pushed back against the Trump administration's allegations that Beijing had failed to comply with the trade agreement reached in Geneva last month. Instead, China has now accused Washington of breaching the deal terms. US's decisions to hike export curbs on semiconductor design software, along with the pushback against Chinese students, have drawn Beijing's ire. Meanwhile, the Trump administration may be miffed with China for not softening its grip on rare earth exports. The Chinese Commerce Ministry said that Beijing will take measures to safeguard its rights if the US decides to press ahead with actions that could be detrimental to China. Commerce Minister Piyush Goyal has commenced his 5-day official visit to Europe. Goyal's visit will aim to strengthen bilateral economic ties and boost momentum on the ongoing India-EU FTA negotiations. The Commerce Minister also met with top executives of leading French firms like VCAT and Total Energy ahead of the India-France CEO Forum. Speaking to CNBC TV18, Goyal said that India and the EU are working towards finalizing the FTA by the end of 2025 or even earlier.
We never have timelines when we discuss trade agreements, but we certainly have guidance from our leaders. During the historic visit of all the EU commissioners to India in February, and I think you'll remember it was the only time in history that the entire European Union Commission has visited a country. It's like the whole cabinet going to another country. And they had guided us that we should conclude a free trade agreement before the end of calendar 25. My good friend Marosh and I are hoping to do better than that.
Well, that is the Commerce Minister in France on the ongoing India-EU FTA negotiations. The Indian government has notified guidelines for a new scheme to promote electric vehicle manufacturing in India and attract top global companies. Parikshit is standing by with the details. Parikshit, the CNBC-TV18 news break that you broke is now confirmed. The guidelines have been issued by the government in line with what we were reporting. Take us through the final contours of what has been announced, the kind of benefits that companies can expect.
Well, the important thing over here is that this will not just be for greenfield or brand new EV manufacturing projects. Existing players who are looking to make brownfield investments or expand plant capacity for electric vehicle manufacturing, looking to set up a dedicated line, will also be eligible for incentives. So the baseline is very clear. You have to commit to an investment of 4,150 crores over a 5-year period to set up manufacturing in India. If you do that, if you give that guarantee to the government of India, if you apply and give and furnish the guarantee, then you will be allowed to bring in 8,000 vehicles per year at 15% import duty. Currently, if you put together all the duties, then the tax that is there on fully built electric vehicles or fully built cars is around 100%. Your duty would immediately come down to 15% if you avail of this scheme. But this is only for cars costing $35,000 US or above. Just for context, $35,000 is almost like the base price of a Tesla in the US. So we are expecting cars of that range to come in. Has Tesla showed interest? No, they haven't showed interest in manufacturing in India. In fact, they haven't been attending meetings in the run-up to the notification of guidelines of the scheme either. Companies like VinFast have shown interest. There are certain German automakers which have shown interest, Korean automakers, but now is when the application window really opens up for a year period. Let's see whether they apply. At the same time, we're also picking up that the companies which apply must achieve a 25% domestic value addition within 3 years of setting up operations in India and 50% domestic value addition by the 5th year of operations. In case they're not able to meet those goals, or they fall short of manufacturing in India, then that bank guarantee can also be encashed by the government. However, the penalty procedure has not been outlined as yet, but this indeed is a big move. So the government believing that there is clear interest in EV manufacturing in India, despite the FTAs that the government is signing. Let's see how the scheme takes off.
Yes, we will have to wait to see. But as Parikshit was pointing out, what is clear now is that the incentives, the benefits will be open not just for fresh manufacturing capacity, i.e. greenfield, but also brownfield. And of course, we will be allowed to bring in completely built units, but there is a cap of 8,000 cars per year. And of course, that minimum investment requirement of 4,150 crores. But taking forward what Parikshit said, Tesla so far has not been interested in manufacturing in India. In fact, the Heavy Industries Minister H.D. Kumaraswamy said Elon Musk Tesla is not interested in Make in India and only wants to open showrooms so far. CNBC-TV18 had reported on the 13th of March that Tesla does not have plans to make in India just yet. US President Donald Trump had claimed it would be unfair to the US if Tesla manufactures in India. Speaking to Fox News earlier in the year, Trump called India's import duties too high and said it was impossible to sell a car in India. Trump went on to say, and I quote again, if Elon Musk built the factory in India, that's okay, but that's unfair to us. It's very unfair, end of quote. Minister Kumaraswamy said several European companies, including Mercedes-Benz and Skoda, along with companies like Hyundai, have shown interest in setting up manufacturing units in India. Take a look.
Tesla, we are not actually expected from them. They have only to start two showrooms. They are not interested in manufacturing in India.
Well, that is the minister saying Tesla is not expected to make in India. They are, however, looking to sell in India. When that starts is the question. Staying with the auto sector, TVS MD Sudarshan Venu has said the EV industry has been facing major supply chain disruptions after China banned the export of rare earth magnets. Speaking exclusively to Parikshit, Venu added that this could have a negative impact on the industry in the short term. He said that India must work on developing a self-reliant supply chain of EV components. TVS is planning to expand its EV portfolio with a third scooter that is expected expected to be launched later this fiscal. Venu also laid out the roadmap for launching Norton bikes in India. Take a look.
At the same time, now there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading two-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis. We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We have now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric three-wheelers and electric bicycles as well.
You can catch that conversation with Sudarshan Venu, Managing Director, TVS Motors, at 5 and 7:30 p.m. right here on CNBC TV18. From one big newsmaker to another, Air India CEO Campbell Wilson has estimated a 5,000 crore rupee hit if Pakistan's airspace remains closed for a year. Speaking to CNBC TV18, CEO Campbell Wilson has promised to double capacity over the next decade. However, he did warn of high user development fee being too high at some airports, which he did say could impact demand. Let's take a look.
Let's talk about the Pak airspace closure, because the closure came in on the 24th of April. That's well ahead of Operation Sindoor. Now, from an operational perspective, you said you cannot carry a full payload at this point in time. Take me through what that's actually meant in terms of operations, flight cancellations, rerouting. What is all of that meant for Air India?
Well, so domestically, a number of airports were closed.
Yes.
13 cities that Air India Group operated to, we had to cease operations. Unfortunately, that affected some 70-odd thousand people, nearly 1,000 flights. And we assisted people very quickly to get to their destinations as best we could. That was something completely beyond our control. On the international side, once the airspace was closed, we needed to take a different route. And that meant longer flying times to Europe and to North America. And in some cases for North America, it meant having to make an en route refueling stop in order to reach the destination. That was... We adjusted to that very quickly. I think we managed to minimize the disruption to customers quite well. And then very quickly we looked at how do we optimize the operation so that we can continue to operate the connectivity and the customer proposition that people have selected us for. So most of our flights now have been reinstated to non-stop. Sometimes.
And how you managed to do that?
So that's sometimes with a reduction in the payload that we carry, whether it's the amount of cargo we carry or a reduction in the number of seats that we fill.
So how many seats have you had to drop, as well as what's the decline as far as carrying of cargo is concerned?
So it's very route specific, and it even depends on the wind and weather conditions on a particular day.
But typically to North America?
So on some routes, it's 0. On some routes, as much as 20 or 30 seats.
If the airspace closure were to extend for a year, it could cost Air India upwards of 5,000 crore rupees, or approximately 5,000 crore rupees. And that's the estimate that has been given to the government in the many meetings that have taken place with the government on this issue so far. Is that accurate?
Yes, we were asked to give a ballpark cost of what this would be for us, and so we provided a number.
So it is approximately 5,000 crores, upwards of 5,000 crores?
It's approximately. Now we're obviously working to reduce the impact by whatever means we can. But yes, that's a ballpark figure.
The hike in user development fee across the big airports, is that likely to be a dampener? Are you worried about that?
Anything that adds cost to travel, clearly at the margin, means that there might be less of it. But this is a regulated process. We are consulted during the regulation of user charges. We might not like the outcome of those, but...
is it too high, you think?
You ask an airline, of course it's too high. Of course it's every cost that we incur is too high. Ultimately it has to be...
do you believe that this could impact traffic?
Well, as I say, at the margin it does. We operate in a business where airlines operate with very low margins. And so we pass on most of the cost increase to the consumer.
Well, that's Campbell Wilson. You can catch that entire conversation with Air India's CEO at 5:30 and 9:30 p.m. right here on CNBC TV18. And more from aviation. Indigo is doubling down on its strategy to expand its international footprint. The Indian carrier has signed an MOU with Airbus to buy 30 additional wide-body aircraft. In April 2024, the airline had ordered 30 A350 wide-body planes from Airbus, and it had the option to order 70 more. The latest move takes Indigo's total wide-body order to 60 planes. The International Air Transport Association, or IATA, is expecting airlines around the world to report $36 billion in profits this year. IATA is holding its annual general meeting in India. This is the first time in the last 43 years that the IATA summit is being held here in India. The AGM is being held in India. The association's chief economist is gung-ho on Indian aviation. Take a look.
I think India is really holding up a shining example to countries around the world by expressing conviction in the fact that air transportation is actually a growth multiplier. We are not getting the airplanes that were ordered previously. There's a historically large backlog of planes and the longest waiting times ever. And this is capping, our capacity to serve not only the passengers and the cargo clients of our industry directly, but also the wider economy.
And more aviation. The top 2 foreign airlines operating in India have called for easing of restrictions on market access. The CEOs of Emirates and Etihad Airlines have said that restrictions on seat capacity on flights to the Gulf are hurting Indian travellers.
And the Indian economy, certainly under this government, has moved ahead quite at pace, where it's trying to engage in the global economy in a much more measured way, but more expansive way than it ever did before. But to do that, part of the equation of getting that right is you've got to have access in and out of your country. So the wealth multiplier that is created by air access is known to most countries. It doesn't make any sense to me to kind of restrict that, and the Indian population suffers as a result of that. So if you want to open your country, if you want it to be a main player in the global economy, certain things have got to be done to make that work.
I think countries are starting to think differently about capacity and about constraints. Because if the constraint is the plane, there is a fight. Countries are fighting to get flights, fighting, paying subsidies and paying incentives. So I think India is going to open up for more seats in the future because there are no planes. And then if you don't open up, you're not going to get those planes. You see what I mean? So I'm excited about the future. And when India gives us a little bit more seats, we're going to be adding more capacity. And if we don't get that soon, we're going to be adding other places.
Well, plenty of action there in Indian aviation. We'll head into a break, but up next, at least 32 people killed as northeast India grapples with devastating floods and landslides. More when we return. At least 32 people have been killed as northeast India grapples with devastating floods and landslides triggered by relentless rainfall. Assam has been amongst the worst hit. 9 fatalities have been reported across the state so far. 10 major rivers, including the Brahmaputra, above danger levels. Approximately 3 lakh people across 19 districts have been affected. Over 130 wild animals have been killed at the Kaziranga National Park. In Manipur, close to 20,000 residents have been impacted, approximately 3,000 homes damaged due to overflowing rivers and breached embankments. 47 landslides have been reported across various parts of the state in the last 4 days. 3 people are dead, 6 security personnel missing after a landslide hit a military camp in Sikkim. Over 1,000 tourists who were stranded in Mangan district have been safely evacuated. The IMD has forecast that heavy rainfall will continue in the coming days, urging residents to remain vigilant. Preeti Priyadarshi gets us the latest from Guwahati.
Arunachal Pradesh, Mizoram, Manipur, and also along with that Tripura. All of these states are very much devastated. Along with Assam, we have mentioned already a lot of people have been affected. Over 3,60,000 people have been affected in Assam itself. And this is the current in the river Brahmaputra. We are trying to show you the scale. This is the scale which was yesterday a little bit lower, and now it has gone up to a lot of length. A lot of water is increasing in the river, and the river Brahmaputra is currently having a lot of current. And the most affected districts are Dibrugarh, Lakhimpur, Golaghat. A lot of people have lost their lives in those districts. NDRF, SDRF, and all kind of rescue operations from Army to Air Force. Everyone is deployed. The authorities are ready, but somehow the ratio of the people being affected by this flood and the rescue operations are never coming closer, it supposes. And still, the authorities are trying their best to provide relief camps, to rescue, to go for rescue operations. And it has been stated that for the coming days also, red alerts is being served for the entire state of Assam and the entire northeast.
Well, monsoon fury there across the northeast. In a quick check of some of the other headlines we're tracking today, shares of luxury hospitality chain Schloss Bangalore, which operates under the Leela brand, erased listing losses to close at its IPO price. The stock listed at a discount of 7% on the exchanges today. The company debuted with a market cap of over 13,500 crores. And speaking of listings, shares of Aegis Vopak Terminals made a week debut on the bourses, listing 6% below its listing price. The company's 2,800 crore rupee IPO was subscribed more than 2 times on the final day of bidding. The Delhi High Court has restrained Dr. Reddy's from selling semaglutide in India after a patent infringement plea by Ozempic maker Novo Nordisk. Semaglutide is an anti-diabetic medication used for long-term weight management. Dr. Reddy's supplier, OneSource Specialty, has also been restrained from selling the drug. However, the court has not barred the companies from manufacturing or exporting the drug. Pharma and medical device marketing has once again come under the scanner. Government sources tell CNBC-TV18 that the Health Ministry has issued an order banning the entry of medical representatives to government hospitals. As per a copy of the order accessed by CNBC-TV18, medical reps have been asked to share recent advances in retreatments, drugs and devices through email or digital media. Sources say the move is aimed at preventing gifts or monetary grant offers to doctors. Maharashtra's Food and Drug Administration has deepened its crackdown on quick commerce companies. This comes after FDA officials conducted a surprise inspection at Zepto's Dharavi dark store and found unhygienic conditions. Zepto's license for that dark store has been suspended. Shilpa joins us now with more. Shilpa, take us through the steps taken by the Maharashtra FDA and the impact on quick commerce companies.
Well, hygiene conditions in all the quick commerce stores are now under the scanner. And like you mentioned, it started with Zepto's license for the Dharavi dark store being suspended by the Maharashtra FDA. And this was after an inspection revealed multiple violations. There was fungal growth seen on some food items. Products were stored near stagnant water. Cold storage temperatures weren't as per standards. The floor was wet and filthy. And food items were found scattered and stored in an unsanitary way. Even expired products they were not clearly separated from non-expired stock. And this is a store that just received a license about 3 months ago in May. Now, in a statement, Zepto says that it has launched an internal review and that it is working closely with authorities to ensure full compliance. Zepto says that it's committed to fixing the lapses, strengthening its processes, and is taking all necessary corrective measures to resume the operations as soon as possible. Meanwhile, Maharashtra's FDA has widened the lens. It's not just about Zepto. Food safety officers have been directed to inspect the dark stores of all quick commerce players, including Blinkit and Instamart. And they've also been asked to issue notices to these platforms to follow hygiene and food safety norms. And any violations, we're told, will lead to improvement notices or even license suspensions. So yes, while quick commerce is expanding fast, it's also facing growing regulatory scrutiny. Back to you.
Shilpa, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Welcome to CNBC-TV18 Citizens MPC. The Reserve Bank's Monetary Policy Committee meets from June 4th to June 6th. And as always, CNBC-TV18 Citizens MPC is meeting to deliberate on the issues before the Reserve Bank. I have with me Chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chenoy, Samiran Chakrabarti, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. Well, the first question has to be the just announced GDP numbers. Samiran, let me come to you. The numbers are better than what our poll threw up, what generally seems to be the market expectation. How do you think the Reserve Bank and the MPC will approach these numbers?
So obviously the numbers have been somewhat better than market expectation and our expectations. But I think the MPC will also take into consideration that part of the increase could have been because of front-loading of economic activity before the tariff set in. We have seen globally in many countries a similar trend happening in the first quarter. In Indian context also, the net exports have contributed very strongly for the quarter. And also the fact that in the early part of the year, the public capex did not happen, so it was a bit back-ended for the fiscal year. So that back-ended capex has also contributed to a much better construction growth number. So both these factors could probably not be with us all through the FY26. So maybe that's why having the same sort of growth numbers across the entire year might be difficult to predict at this point of time. So the MPC will probably consider the fact that the growth momentum has been better than what used to be a couple of quarters back, but still might be lower than the potential growth on a more sustained basis.
Okay, so it need not necessarily be a hawkish factor. Let me come to Sajid on this point. Since you are referring to the global point, Samiran, Sajid, can you parse the global ecosystem for us and how it might impinge on the MPC's thinking?
But I think if anything, the last 72 hours with the fact that a court in the US, a trade court first paused President Trump's reciprocal tariffs, The government sought a stay. They got a stay. This matter will go to the Supreme Court. But all of this simply does is accentuate dramatically global uncertainty. I think that's been the one consistent feature of 2025. We've been living in very uncertain times. Policy uncertainty from the US, trade policy uncertainty, tariff uncertainty. And I think we're going to be living with that for the foreseeable future. The question about whether these tariffs are constitutional or not, whether the president has exceeded his powers, A, and B, even if they're struck down, there are many other provisions that the US president has under different sections of the law to reinstall them either directly or indirectly by increasing sectoral tariffs. So I think the short point is all this global uncertainty does not bode well at all for global investment. A. B, remember, we've got a lot of Chinese excess capacity here. And to the extent that the China exports to the US are directly blocked, even though there are signs that China is transshipping some of this through third countries, India will be wary that some of that excess capacity will come to India. So I think going forward, the global is clearly going to be a source of concern. I mean, the one silver lining is India seems to be making good progress on trade negotiations with the US. So hopefully that uncertainty can be put behind us. But there are two other sources of uncertainty. What happens to global growth this year? What happens to global investment this year? What happens to Chinese excess capacity here? And for me, the main transmission mechanism to India is not just through exports. It's the fact that we're all waiting for a private investment cycle to pick up. So far, the heavy lifting has been done both by public investment and the real estate sector. There's a sign that both those forces have peaked. They're going to slow in the coming year. You need private capex to replace that. And private capex will face severe global headwinds. I think that's the way the MPC will perhaps think about how the global environment, will impact India's outlook.
Okay. We have discussed growth a bit. Let me come to what the MPC's mandate is: inflation. Now, Sonal, inflation has been surprising on the downside. Will Reserve Bank in the first place lower its forecast? It is still standing at 4% for the current year.
Yes, we expect there should be a downward revision. The trajectory actually looks quite benign. So on the food side, the projections for output look favorable, and we think prices of both pulses as well as cereals like wheat will moderate going forward. There is obviously some risk on vegetable prices, in the coming months, but I think even accounting for that, food looks benign. Oil prices are down, currency seems well behaved, input costs are lower, wage costs are actually coming down, which bodes well for services inflation. So on the whole, we think FY26 CPI is actually tracking closer to 3.5%. Probably even lower than that. So we think RBI is likely and should actually lower its projection from 4% right now to a number which is closer to 3.5%. And even there, I would say risks are balanced.
Okay. Soumya, let me come to you on liquidity. The Reserve Bank has done a lot. Do you think more is called for? Or now can we assume that the liquidity instruments have been fully used?
Yeah, thanks, Lata. I think on the liquidity front, as of now, the Reserve Bank of India has done a lot, and I don't expect it to do too much. There are a couple of things which we need to watch out for. For example, after the RBI dividend announcement, I think the liquidity in the system could actually top 5 trillion or could be close to 5.5 trillion. We should be actually closer to around 2% of NDTL. So within 2% of NDTL, I think we're in a pretty comfortable zone. And the other factor is that we also need to know that there is a lot of swap transaction maturing. So maybe this will give an RBI an opportunity to retain some of the swap transactions of the liquidity which it has built up over the point of time. But one point to take note is that the Reserve Bank has been doing several types of liquidity injections. It has done a significant amount of OMO transactions. But at some point of time, it will have to rethink about the instruments, because while as a policy tool, these are all good, but OMO over a significant point of time can also impact the secondary market liquidity. So net, I think the Reserve Bank has done its bit in maintaining liquidity, and now it's the time actually to do the other small tweaks so as to keep the liquidity in surplus mode going forward.
Okay, continue to keep the liquidity in surplus mode. Dr. Sen, as the chairman, can you round up the growth inflation dynamics for us? Does it look like, there is enough room for the Reserve Bank to cut because inflation is so much below its own target or likely to be?
Lata, there is certainly room to cut now. The environment looks benign, although, I agree with what Sajid said about the uncertainties in the global economy, which were pretty high to begin with and are possibly higher today. But the other thing is that President Trump's big, beautiful bill should come as a booster to countries who've been able to establish some kind of a trade agreement with the US. And we may well turn out to be beneficiaries of that. So all in all, I think the environment is benign. The economy has been behaving itself. So I think the only problem is really private capex. And I think this is a situation where we should just hold steady with our rate of liquidity growth, and some cut in the repo would be called for, I think.
Okay. Point taken. I have to take a quick break, but I have to discuss the rate transmission itself has not been as good. How will global disinflation work out? All those factors to my guests after the break. Welcome back to CNBC-TV18 Citizens MPC deliberations. I have been speaking with the chairman of our MPC, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chinoy, Samiran Chakrabarti and Sunal Verma. Gentlemen and Sunal, thanks for your patience for waiting on. Before I went to the break, I was worrying about the transmission of rate cuts. The 0.5% cut has certainly not come into the deposit side and lending side, where it is connected to external benchmarks, it has been passed on. Samiran, is there anything you will expect from the RBI to push this on? More liquidity in any other way?
So the first tranche of the transmission happens through the money market and the short end of the yield curve, where it seems to be that it has already happened. Most of the overnight rates are now even below the SDF rate. If you look at the 3-month T-bill auction that just happened, that had happened at closer to 5.6, which is almost 15 basis points below the SDF rate. So in some sense, there is ample liquidity in the system for the money market and the short end of the curve to come down. In fact, even the short end of the credit curve, the CD rate, etc., that has also come down. So in our view, the RBI can be a bit patient now to see this transmitting into deposit and lending rates with a lag. Monetary policy typically does it because of certain market microstructure issues. At this point, putting more liquidity into the system might just make the overnight rates go lower, but might not immediately translate into bank deposit and lending rates. You have to also keep in mind that this is the so-called lean season of activity. So clearly, there's not enough incentive for the system to move in the lean season compared to what it will happen during the busy season.
Okay, so we live in hope that things will get better transmitted in the months to come. Sajid, I wanted to ask you about another global angle. How will disinflation work? We are sitting pretty on inflation, but there are two views on global disinflation. One was expecting that goods can't be shipped to the US, so they will make they'll move around in Asia itself and push prices down. But increasingly, at least the RBI's annual report says that they are worried that global disinflation will peter out and there may be an inflationary factor. How do you parse the situation?
Well, I think one has to separate what's going to happen in the US with what's going to happen outside the US, because the US, I think a global trade war is sometimes a misnomer. This is the center country imposing a lot of tariffs on the rest of the world. Our sense is that, the President Trump will find a way to keep tariffs in double digits, that there are, as I said, several different ways in which he can do this, even if the current reciprocal tariff is disallowed. And if you end up with US tariffs around 15-16%, which is where we expect it will be, this is a 6-fold increase over last year. Remember, the US entered this process with 2.3% tariff, it will go to 15%. That's going to be a significant increase in the price level, and therefore year-on-year inflation in the US. So you can expect in the next 2 or 3 quarters that US inflation will go up, because of these higher tariffs, and that's going to squeeze purchasing power. And because of that, we don't think the Fed will only cut by December or further out. But remember, when the US is introducing frictions and there are less exports from countries going to the US because of those frictions, that global production has to go somewhere else. And so we see this as a situation where the rest of the world actually benefits from disinflation because you've got this production that has to be redirected. And China is a classic case in point. Now, a lot will depend on whether China succeeds in transshipment. Right now, what you've seen is one interesting statistic is the entire decline in Chinese exports to the US between Jan and April is offset by an increase in Chinese exports to the rest of Asia. Some of that's getting transshipped to the US, and that will give China an end market. But if it doesn't, guess what? Those Chinese goods are going to flood Asia, flood the rest of the world, and be disinflationary in nature. So that, in conjunction with lower energy prices, should be disinflationary.
Sajid said it very quickly. The expectation is that this year, the average inflation for us is between 3.5 and 4. That's the poll I got. Do you think next year this will be repeatable, considering that you're seeing, global disinflation?
I think hard to predict where things will be next year. This year, I would just say, yes, we're between 3.5 and 4, but in a way, it represents the best of the best, right? Because you benefit from lower energy prices and global disinflation. You won't have those benefits again in 2026, year on year. And so think of inflation picking up from here into 2026.
Okay. Then that brings me squarely to what I wanted to ask Soumya. How should the Reserve Bank think of, inflation plus the real rate, the positive real rate? Should it look at, say, it's going to be 3.5, if they cut their inflation forecast and you add, their positive real rate of 1.5%, 150 basis, they should come down to 5. But can they do that? Will they do that? Should they do that?
Yeah. No, I think, Lata, that's a fair question. As of now, I think if I get into the minds of the RBI, the neutral rate is somewhere between 1.4 to 1.9%. But in an economy which is currently a little bit slower, I think this neutral rate should have adjusted downwards. And also my sense is that the inflation numbers this year is going to materially surprise on the downside, assuming there are no adverse food price shocks. So any number between 3.5 to 3.6% as of today looks a real possibility. If 3.35% or 3.6% is the average inflation number throughout the rest of the year, and even if I assuming that 1.4% remains the neutral rate, I think at least a repo rate of close to 5% looks the real possibility at this point of time. The only thing we need to consider is that the uncertainty, because uncertainty is now the new certainty in the market. So we have to be prepared for that. But my sense is that, and also the core inflation, if you look at the number excluding the gold, and this has been highlighted also by the RBI, is also running pretty much lower than 3.5%. So in all probabilities, inflation numbers for the first time is looking extremely benign. Please remember that next year, first quarter, the inflation numbers may show a little bit uptick because of a base effect. So taking all these factors into consideration, I think the Reserve Bank should now use the opportunity to cut rates. And one small point, Lata, I want to add is that in a rate cut cycle, the liabilities always are slower to adjust than the asset. But this is for the first time, if you look into the bank deposit rates, 50 basis point rate has been cut. If you look from all banks across the spectrum, 20 to 70 basis point deposit rates have been cut. So I think, so basically deposit rates cut actually has been higher than the 50 basis point cut for some of the banks.
Yeah, but then they had also charged a lot more because of peculiar circumstances. But your point is very well taken. Let me come to the stance. The Reserve Bank changed its stance to accommodative, but importantly, that was not voted on, if you remember. Anyway, since the stance is not voted on, Sonal, what do you think? How should the Reserve Bank guide the market?
Yeah, that's the interesting bit because we have seen both policy rate cuts as well as fairly aggressive action from the RBI on liquidity so far. And I think the big focus now for the RBI is ensuring policy transmission takes place. Therefore, it's not just the 25 basis point cut and the accommodative stance. I think there are two additional things that can be done to enhance transmission. One is to keep the forward guidance open in terms of the direction of policy easing, i.e., a clear communication that we remain in an easing cycle. And of course, policy will be dependent on data, but that inflation is aligned to the target and output gap is slightly negative. So clear guidance on policy. And I think second is the communication on liquidity, which the governor has guided for a surplus liquidity and reiterating that adequate liquidity will be maintained, more actions coming through to enhance this transmission. So while a 25 cut is expected, I think more accommodative guidance on rates and liquidity can enhance policy transmission.
Okay, Chairman Sen, the market is kind of more or less decided that one cut will come. But, the real confusion in the market is how much more can the Reserve Bank cut? Because inflation is at 3.5. What do you think the Reserve Bank should guide? Should it guide that it will, go the whole hog, cut another, take the repo rate all the way to 4%? Or should it be cautious in the way it guides? What should it tell the market?
No, it should be very careful. Look, we are in a situation where I don't think investments will respond very, very strongly to any rate cut. There is too much uncertainty in the world as things stand. Now, in a situation like that, you may want to keep some arrows in your quiver and look for a more opportune time. You need the environment to become a little more predictable than it is today. Needlessly early cut in the rates may actually just not have the effect, and then you run out of instruments to use. And that's something I think the RBI will be aware of, that the normal methods of transmission are going to have limited impact given the level of uncertainties we have as of now. So I am feeling that they will cut, if for no other reason it is symbolically important, but I think they will leave arrows in the quiver.
Okay, that sounds like very sage advice, sir. I'm sure the Reserve Bank is listening. But it's time for us to vote. May I ask you all to take up your electronic pads and vote? The first question is very obvious. What will the MPC do to repo rates on June 6th? I'll start with Sonal, the lady. Sonal, what will they do?
25 basis point cut.
Samiran?
Yes, cut by 25 basis points.
Okay. Sajid?
25 basis point cut.
Okay. Xiaomyo, what's your vote?
I think I would go for a 50 basis point rate cut. It's better for a better transmission.
Okay, 50. Dr. Sen, which way would you lean, sir?
25.
25. Okay, so 4:1, 25. A cut is coming regardless. But I think the more pertinent question for the market is, what will be the terminal repo rate? Sonal, again, I start with you. What do you think will be the terminal rate?
Based on current conditions, 5%.
5%. So 4 cuts starting from June. Samiran?
I think it's 5.5 or below.
Okay, 5.5, playing it cautious. Sajid?
Somewhere between 5.5. Remember, overnight rates are 25 basis points below that.
So what do I take? 5/4? Because you said 5 to 5.5, I'm taking 5/4 for you. Xiaomyo, your terminal repo rate?
I think I'm going with 5%.
Okay, you are at 5.5 already if there is a 50 bips cut. So 5%. Dr. Sen, this is really a divided house. Where do you stand, sir?
5.5.
5.5. You're playing it cautious. So at the moment, it is equally cut between those who want to be cautious and those who believe the Reserve Bank has a longer rope. This is going to be a very, very interesting policy. In fact, the policies to come. Thank you very much, members of the Citizens MPC, for joining me. With that, we wrap up on this the deliberations.
TVS Motor Company is today one of India's largest two-wheeler manufacturers. In fact, it is the third largest two-wheeler manufacturer in the country and fourth largest globally by volume. The company has a market cap of $16 billion, present in over 80 countries. They are the leading EV player by market share. Joining us right now to speak about the company's global strategy at their headquarters here in Singapore is the company's Managing Director, Sudarshan Venu. Sudarshan Venu, thank you so much for joining us here at your Singapore office. Things have been good as far as EV sales and overall push towards premiumization and export growth is concerned. You've now spent 12 years with the company, 3 years as Managing Director. What would be your biggest achievements or milestones as you would like to list it out for us?
I think it's a collective achievement, Parikshit. It's really the vision and values that my father has started TVS Motors with a huge focus on quality, customer satisfaction in product and technology. And that is the basis on which we have grown, and that is the basis on which we have to continue to grow and do exciting things in the future. I think there's a very passionate team who are excited about the future, and as we have said in our LRP, and to transform the quality of life of our customers. So that is really the focus.
I would like to speak about your international strategy, and I think Norton fits into that very well. You're coming up with the Norton India launch very soon. Could you give us a sense of when is that expected, and what are we really expecting in terms of those big bikes which are coming into India?
Norton will launch towards the end of this year and will start phasing in the products towards the end of this year and early next year. I think I mentioned 6 products before, 4 of which will be available for the summer of 2026 in the 4 European markets of UK, plus France, Germany, Italy, and Spain, as also, of course, in India. So this is where I think we are heading towards by starting off with the launch of the 4-cylinder superbike at EICMA, and then we will also share the remaining 3 products soon at EICMA or soon after, which will be available in the market early 2026. They are all in advanced stages of development. I think we have a good leadership team now at Norton with the 2 executive directors, Arnie and Neviho. Supporting them are very good designers, engineers, and a lot of homegrown talent from TVS in India, which I think brings a great mix in terms of the Britishness and the uniqueness of Norton, while leveraging the capabilities of TVS and also offering opportunities for our talent to grow.
Right. So there's a lot of competition in the premium space in India as well, in the 350 to 500cc space. And 650 is a space which Royal Enfield has been leading. Could you give us a sense of where your bikes would be playing, in which segment, and how many bikes will the Indian consumer be able to reach out to in India?
I think we will start, as I said, with the 1200cc superbike. We will have other smaller offerings as well. But we will draw a line on how we ensure we keep Norton Premium, keep it in the luxury space, and offer bikes that are uniquely differentiated and uniquely Norton in terms of the 3 values which we have articulated, which is design, dynamism, and detail.
Right. And what will be like the retail strategy for it in India and
We'll
globally?
definitely have a differentiated retail strategy in India, covering Norton and covering possibly some of the premium TVS vehicles as well. As I said, this will help us connect with the growing middle class of India and upper middle class and people with more affluence, and with Norton's even some of the top end segments who buy sports cars and other vehicles who also buy these very high end bikes. We will connect with different retail formats that are uniquely catered to them and offer them that superior and differentiated experience.
So there'll be like more experience centers, more showrooms, specific
Definitely.
showrooms for...
Absolutely.
How many are you targeting for India?
We'll share more soon, but I think definitely we will cover in the first phase the big cities, and then after that move on to other cities, and we definitely intend to offer the entire Norton range in India.
Okay, and initially the sales would be only in India and UK, or are you targeting
As
exports?
I said, it is India, UK, and the 4 large European markets initially.
Okay, and are these going to be manufactured here in India, or they're going to be exported in the first phase?
There is manufacturing in the UK, and there is going to be manufacturing in India as well. Some of the models will be made with greater value-added content in India, and some with greater value-added content locally.
Right. So what's been your...
And I think this India-UK FTA also helps both ways in terms of ensuring that components and kits and things from our side can go to UK and sub-assemblies, but also ensuring that the fully built vehicles can come into India.
So you can take benefit of the lower tariff regime.
Definitely, and I really applaud that it has happened it's good for many sectors of the economy.
Yeah.
It's good for us as well.
Okay, could you give us a ballpark figure on how much you are putting behind launching the Norton in India and in global markets, both in terms of R&D, manufacturing, and the marketing plan?
I think really luxury differentiated brand has to be built the right way. So that is really a focus for us. We will start with a capacity of close to 10,000 vehicles and with the 4 models going up to 6 models. So I think really the focus is on ensuring that the brand philosophy is delivered, the vehicles that live up to it, the retail and communication which clearly shows the brand experience and delights customers and resonates with them. So that is really the focus in the first phase, Parikshit.
Right. So Norton, of course, is a big focus area for you, and it's been an interesting ride so far since you acquired the company. As we stay with your international focus, your partnership with BMW, it's been holding strong. Both companies have also developed an EV together. Where is the partnership currently, and how do you plan to expand on it?
I think we did first the single cylinder, the 310 family. Then came the EV, and now is the 2-cylinder family, which BMW has shown their version at last year's EICMA. And you will see Norton and TVS versions using similar platform in the coming months.
Okay.
So that is where I think the relationship is headed.
Right. Speaking about electric vehicles, 25% market share in the month of May. That's what we pick up. You were the leading player, and you have been the leading player for several months now. The competition is stiff, but you're steadily growing the market. What's going to be the strategy from here on in terms of building your EV portfolio?
We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We have now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric 3-wheelers and electric bicycles as well.
Okay, so if we were to ask you how many electric products altogether in FY26?
I think in FY26 we'll look at a couple of new launches. One is, of course, X has already started retail. There is an improved iQube and one more new scooter.
One more new scooter coming up. How does the market look to you currently, and are you looking at increasing capacity? What is the monthly run rate that you're looking at?
I think we are increasing capacity and the volumes have grown. At the same time now there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading 2-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Right. How badly is the restriction by China on supply of rare earth magnets impacting TVS Motor Company right now in terms of production?
I think in the short term it will impact the entire industry a fair bit. As we go forward, we have to develop new solutions, develop new components, new suppliers, and really work our way through this.
So is it already, for the industry, is it already showing on the monthly numbers?
I think it will start showing soon.
It'll start showing soon?
Maybe in June, if not definitely in July.
No, some bodies have really sounded the alarm bells, saying that this could literally bring EV production to a grinding halt. Would you go to the extent of saying that?
It is concerning, yes, Parikshit, it is concerning.
It could bring it to a halt?
Yes.
How bad is it for the industry?
I mean, a halt is pretty bad, right?
A halt is very bad.
And it doesn't get that much worse with it.
Yeah. So we could look at a complete
Yes, it is a significant challenge.
And how are you managing it at TVS?
Of course, like every company, we are trying to see how to de-risk, to import assemblies instead of importing the magnets alone. But again, there is a huge price impact which ultimately has to be borne by somebody. And then there'll be cost increases or other price increases to the customer. So all this has to be factored in, which is why I think it will be a short to medium term challenge that the industry needs to work its way out of. On one hand, we are launching products, we are committed, we have invested a lot of capex. You have seen that we have done a lot of exciting launches and our volumes have also grown. This is definitely a challenge that there's an industry and we have to work through, and over a period of time develop an ecosystem of components and R&D in India so that we bring volumes up in a way that is sustainable and in a way that's Atmanirbhar and made in India with Indian R&D, with Indian products and Indian technology and supply chain and natural resources all linked up.
Yeah. So you're expecting from June onwards it will start showing in production figures, and there'll be very significant production cuts?
Yes, there'll be cuts.
Yeah. As an industry,
we'll all do our best to mitigate it, of course.
Exactly. But on an industry level, I know it's very difficult to give us a sense of what's happening at TVS. At an industry level, what could be the production cut or decline that you expect?
As some of the industry bodies like CM have said, and some others industry leaders have also said, it will be significant. It
will be significant.
And it will change from month to month, so we'll have to work our way through this over a period.
So the availability is a question, and the pricing will also go up, I'm guessing. Yeah. Very significant concerns there. The other issue on the PM eDrive scheme, we have been seeing the FAME scheme continuing since 2015, two versions of that. You've got the PM eDrive scheme. Now the scheme comes to an end next year. Are you ready for a zero subsidy scenario?
I think the government has done a lot to encourage EVs, and of course over a period of time these subsidies have to be phased down in every industry. So as it ends, then the industry will have to continue to develop new ways of reducing costs, new ways of being competitive. I think the supply chain issue is important, so that as we build out of this, you build a supply chain that's resilient.
That's what the government, of course, needs to do.
It's not just the government, the industry, the suppliers, the OEMs, everybody has to work together.
Right. Now speaking about...
Government has done a lot already.
Yeah.
This new challenge is there. We'll all have to face it, and I'm sure we'll overcome it as well.
Right. Have you been able to identify new suppliers around the world to de-risk your strategy?
Yes, that's going on as we speak, and we'll share more as the situation progresses.
Great. On the electric three-wheeler plan, recently we saw TVS Motor Company launching products in the cargo space, in the passenger space. How is that going, and how would you like to increase your market share, your monthly production when it comes to electric three-wheelers?
Electric three-wheeler of ours has been very well received. We are also launching a CNG three-wheeler for cargo and passenger applications during the course of this year. As you know, we've done better in three-wheelers outside India. Hopefully with these launches, we'll continue to grow abroad and in India as well.
Right. The partnership with Hyundai, we saw some future concepts developed by Hyundai and TVS, and we believe that TVS was mulling manufacturing and retailing those in India and global markets. How far have things progressed?
Things are progressing. I think the concept is a really cool concept, and we'll share more with you at the right time.
But are we expecting a launch this year, maybe?
We'll share more with you at the right time.
Okay. Let me speak to you more about the domestic market right now. We've seen your market share grow to 18 to 19% from 16 to 17%. What would be your ambition for FY26?
See, our ambition is always to launch exciting products to delight customers, and then market share is a resultant. So I would like to say that we are launching exciting products. We're focusing on enhancing the customer experience to continue our focus on the core TVS values of quality, customer satisfaction, innovation, and tech. And you'll see some exciting new products from us this year, including a premium scooter.
Right. Could you give us a sense of how many more products? Because as you have in the India market, you need to keep exciting the customer.
So I've said 3 two-wheelers, and then we have the CNG three-wheeler as well.
Welcome back. You're watching CNBC TV18 and we are in exclusive conversation with Sudarshan Venu, Managing Director of TVS Motor Company at the company's headquarters here in Singapore.
On the electric bicycle front, there was a period during COVID where you were literally on an acquisition spree with electric bicycles and electric bicycle companies. Are you planning to now expand that plan, get them to India? What would be the strategy going forward?
Rather than spree, I think we bought a couple because the rest of them were reported as an acquisition, but they were really shops or some technology that we had bought. Now we have integrated everything. I think there is a bit of a supply glut in Europe on electric bicycles in the past couple of years, which has impacted the industry and us as well. We have developed new products now, which means that the greater portion of our sales from our new products, which we are developing, is increasing. We are also developing specifically for India with a dynamic young team, a new e-bike, which we will launch in India because the European cost point is, of course, quite different. So together with this, we have consolidated our presence in Europe. We will expand further with the new products. We will launch in India. And as in India, adoption will start as well, more for leisure. And in Europe, I think both for mobility and for a bit of leisure, as the industry comes out of it, we will aim to break even and start getting returns.
Okay. E-bike launch in India when?
This year.
This year itself. Okay. Speak to you about the domestic sentiment once again. Between rural and urban, how does the sentiment look and what would be the ratio of growth that one can expect?
I think the sentiment is similar because today you see cities are also expanding. Of course, with a good monsoon, rural sentiment can be better than in going forward. So I think also you see now many cities are expanding quite a bit, and this sort of mega city is also creating new demand on the periphery. What may have been rural area is actually part of a sort of mega city. So there's a whole urbanization is blurring the lines. And I also think with digital communication and things, the customer patterns of behavior are beginning to be more similar to each other.
Right. So when there are challenges, of course, at home, and because of
recent times, urban growth has been a bit better. But of course, with the monsoon, we'll know how it is going to play out in rural areas as well.
Would you say that having a diversified strategy, especially for your exports also, is going to be important? What kind of export growth are you targeting? And how many more countries would you like to reach out to?
We are in many countries already. And we, of course, as there are opportunities in industrialized countries, we will look at entering new markets as well. And also new segments within those markets or new ways of doing things in some of those markets. In terms of Africa, I think Africa has bottomed out and is turning around and now starting to look up. So definitely exports growth for us in the last few months, as you have seen, has already started moving up. And I think this will continue this year.
Right. How much do exports contribute as far as your total revenue is concerned, and where do you plan to take it by 2030?
Exports today are close to, I would say, international business, because it's a question of now in some of the countries we are assembling, in some countries we'll manufacture. Future regulation may require more manufacturing in these countries. There'll be more products aimed at these markets. There are people operating or focusing on these markets, some of them in location. So I would say the international business is about 30% of our revenue, and I think it can be 40% or more by 2030.
Right. Speaking about TVS Credit, I believe that takes away a lot of your time as well. You've added 14 lakh new customers. Your book size is 26,647 crores. What is the kind of growth you're targeting with in FY26 with TVS Credit?
I think, yes, TVS Credit has taken time. We've invested significantly as a group in financial services and lending. We'll also look at other opportunities as we progress. On the lending side, I think we have a good customer base. We have increased that customer base through home credit. Combined, the loans is about 30 to 33,000 crores. I think we will definitely look to grow that this year. 55% of our customers are new to credit. So it's very interesting opportunity to bring them into organized credit and also grow with them as their needs grow and their demands grow and they want more products and more services. So that is something which we look forward as India's financial penetration increases in the next 10-15 years to ride with them. In that context, we are launching gold loans. We are launching, of course, three-wheeler loans, and we will also look at LAP this year. It's over 1,000 crores of PBT last year for the group, and is definitely something we are looking to grow. Last year, credit growth was a bit muted because we had kept credit tight, and I think in some parts of urban India there was a bit of over leverage across the system, as you know. As we believe, so we tightened credit. I think as growth is there and momentum comes, we will definitely look at growing the credit book by 15+% this year.
Sudarshan, about TVS Holding, could you give us a sense of the companies under the TVS Holding group right now?
TVS Holdings today owns, of course, the shares of TVS Motors and also directly owns Home Credit. Lending, as you know, in addition to the 2- and 3-wheeler business, is an important focus area for the group. So we are continuing to grow, invest and grow in both these areas. And we could possibly consider an adjacency like insurance.
Okay. I would also like to ask you about the succession plan with aligned ownership that was approved by the TVS Holding Group. As a result, we've seen reports which say that Sudarshan Venu and your father are significant beneficial owners. What does this mean for the growth of TVS as a company and also your role going forward?
I'm very grateful to my father for the succession planning and for the responsibility and opportunity. I'm also truly grateful and for his continuous advice and guidance, which I really value and cherish. So it's really special. I think these declarations are there, and the group continues to focus on the core values and the sectors that we are in and how to grow.
And this was important not just for you, Sudarshan, but for your entire family as well. I think that do you believe that that entire plan has now been executed in a very successful manner?
I'm just very thankful for the way things are, and it's always good to have clarity and focus on the future and how to really do something that benefits customers, employees, shareholders, and the whole community at large.
Give us a sense of what's driving you, in terms of growing your business in the next few years. Some of probably the learnings from your father, some of your own instincts. What do you want to bring to the table in terms of growing the brand over the next 10 to 15 years?
I think of course, the learning from my father is most important, and I'm really thankful, and I continue to learn from him every day. I'm also thankful to our chairman, Sir Ralph, for all the energy and passion and tech that I've got from him and been inspired by him. I think we are in a unique moment in India where Indian companies are really growing global, particularly in our sector. And secondly, where we have huge amount of growth in India as well, which we are capitalizing on, of course, in 2-wheelers and 3-wheelers, but also in automotives and financial services. So I think we have that opportunity. And also with a large 2-wheeler market, you see particularly Bajaj and us going global. This is a unique and now they've done a great move of buying KTM as well, which they had worked on earlier and done successfully and now taken control. So I think it's a great opportunity for Indian companies to really go global. And in our sector, if we can do that, and also as a group, capitalize on opportunities like lending within India and scale those, I think it's a very exciting time over the next 5-10 years, as you mentioned, or more. And so to leverage the TVS focus on customers, quality and technology and make a difference in these chosen sectors would be amazing.
Right. In terms of the total growth that you are expecting in FY26, how much would that be, Sudarshan, considering the current challenges?
I think we are looking at double-digit growth, both in revenue and volume terms. So that's our goal.
All right. Thanks.
And of course, to grow faster than the industry.
Going faster than the industry. Okay, Sudarshan, let's have some rapid-fire questions with you. Let's begin by asking you about your favorite motorcycle.
The new Norton Superbike, which is coming soon, Parikshit.
Okay. Motorcycle, which is not from the TVS Motor Company Group.
BMW, KTM, and of course, Ducati.
All right. What do you do in your personal time? What's your go-to thing?
Just hang out a bit with my family and friends.
Okay. Favorite riding spot around the world?
The Alps in the German side.
Okay. Favorite book?
During COVID, I read some excellent books which Professor Ramcharan suggested, including Ride of a Lifetime, some of the Jim Collins books. I really enjoyed those.
Okay. Favorite food item?
Dosa.
Okay. Favorite businessman?
My father.
All right. One value you really live by and you look for when you're hiring somebody?
I think hiring people is more than just one simple thing. And I think people have so many attributes, and TVS has its own values and culture. So it's important to understand the fit, the capabilities they bring, and of course the opportunity we can give. So I see it as an important decision both for us and for the individual. So it's difficult to simplify in one word.
All right. Thanks very much, Sudarshan, for talking to us,
Parikshit.
taking out time for us here in Singapore. That brings us to the end of this special interview with the Managing Director of TVS Motor Company, Sudarshan Venu. Thank you for watching. Goodbye.
Hello and welcome to the CNBC TV18 program On the Record with me, Shireen Bhan. After 42 years, IATA is holding its AGM in India, and of course all eyes will be on the Indian aviation story, the robustness of it as well as the future. To talk to us about the flight path for Indian aviation as well as the recent turbulence that we are seeing, joining me now is Air India's Campbell Wilson. Campbell, always a pleasure. Many thanks for joining us here on CNBC TV18. Let me start by talking to you about the IATA AGM. It's a 42-year gap that the AGM is now being held in India. You're, of course, not playing host. It's the other airline, Indigo, that's playing the host this time around. But I would imagine that, you know, global aviation companies are going to be here in India to really suss out the opportunity and the market potential. What's the pitch going to be?
Well, goodness, I think the fact that everyone is here is a recognition that people already see the market potential and the growth and the future Air India. You know, it's true to say that there truly is an air about India at the moment. And it's not just the privatization of Air India or the world record orders that ourselves and others in the ecosystem have made. It's the potential. It's already the third largest domestic travel market in the world by air, but it's got a propensity to travel of 1/5 that of China. So the upside potential is absolutely enormous. From an international perspective, it's already a large market, but very underserved by Indian airlines. And so the upside of the Indian airlines realizing a more normal market share is huge. Then, of course, there's the geographic opportunity of people not just traveling to and from India, but traveling through India. You know, it's amazing the number of people that fly over top of India every single year and connect around the sides. You know, bringing that business to connect in India supports Indian jobs, supports Indian cabin crew, Indian ground handlers, Indian engineers, Indian tourism, connects Indian business. And so really this is an opportunity now to really center the world's gravity of aviation onto Indian soil.
Easier said than done, right? I mean, this aspiration of making India the hub for global traffic has been an aspiration that's been on the table for a while now. Many things have changed, especially on the infrastructure side. How real is that possibility today?
I think it's very real. Obviously, as you mentioned, the airport infrastructure side with the concession and the development of very world-class terminals in a number of cities. The privatization of Air India got sort of the monster out of the middle from an economic perspective and has opened up huge investment in fleet and capacity and all of the supporting infrastructure that the airline requires. We've seen improvement with things like Digi-Yatra. If we see that extended to the international market, it makes transit travel much more convenient and people coming into India able to have a much smoother experience than they might have done in the past. There's clearly a lot more that can be done. If we look at other competing hubs around the world, you know, they've taken another step forward with respect to convenience and customer service. But the good news is that they have done it. It's an example for us to learn from, bring back, apply here, and there's no reason why India cannot and enjoy the benefits thereof.
You know, just for the perspective of our viewers who are watching this, where do we currently find ourselves in this opportunity that you speak of? What is India's share of global traffic going through India? And what is the headroom for growth? I mean, what should we aspire for over the next 5 years?
Well, look, the reality is it's very, very low at the moment. Air India, despite being 92 years old and carrying the national aim, really only flies to 40-something destinations around the world, 42 at the moment. Countries with much, much smaller population base fly to double, triple that number. India should be able to support well more than 100 non-stop destinations by Indian carriers. So that then allows for connectivity between those flights. We have most recently started to restructure our network so that people travelling from Europe to Australia can connect within a couple of hours at Delhi. In the past, they used to take 12 or 18 hours to connect. And as a consequence of these changes, we've seen a number of international connecting passengers go from basically zero to about 10% of our load in the last 3 years.
Okay.
For India, the great thing is that it's a nice to have, not a must have. We're always going to have huge traffic to and from India. We can augment it with people transiting across India, which allows us to add more spokes to our network, more frequency to the network, provide more choice for Indian travellers, and also then provide more employment for Indian people and businesses. So the upside really is enormous because we're only scratching the surface at the moment.
Well, speaking of the upside, you know, your aspiration to be an Indian airline with the Indian heart but servicing global markets, and you talked about 40-odd international destinations.
I would imagine that aircraft delivery continues to be the key constraint. What should we realistically then expect in terms of expansion of your international operations?
So over the past 3 years, Air India has gone from less than 100 operating aircraft to more than 300. We've increased the international footprint by 25%. So there has been some significant progress already. That was largely from aircraft that had already been manufactured that were able to get at short notice. What we're now waiting for is the first of the 470 aircraft that we had purchased that are being manufactured for us to start being delivered in earnest, and that is going to happen in 2026 and beyond. That is when the next step change in our expansion will take place, particularly internationally, because it will see a more than doubling of our wide-body aircraft fleet from 70 to well over 140. And so that really will allow us to connect the far-flung destinations of the world, North America, Europe, Australasia, and of course more into the Middle East and Africa, and really offer for the first time a true international network of density and breadth from India, and not just from Delhi, obviously from Mumbai, from Bangalore, and there are many other opportunities as well.
Well, so we have to wait for 2026, but let me get an update from you on where things currently stand as far as your discussions with both Boeing as well as Airbus are concerned. There were reports suggesting that because of the back and forth between the US and China on tariffs, that there was going to be at least 10 aircraft available for Air India, and potentially Air India Express was talking to Boeing for that. Is there any progress on that?
Well, I think relations have normalized a little bit between the US and China, so we don't see the opportunity quite so open as it might have been. Maybe that's a good thing for the world, not necessarily a good thing for us. But clearly the pace of expansion is contingent on the speed of deliveries and whether they're line fit or made available from others. We continue to pursue all opportunities. We're always talking to the manufacturers about what might become available.
So if the China 10 aircraft that was on the table is no longer on the table, what visibility do you have both from Boeing as well as Airbus? Last time we spoke about the delays. Has there been any improvement in the supply chain issues that both manufacturers were facing, which gives you more clarity on what the delivery schedule is likely to be?
Yeah, so there has been improvement in the supply chain, and there's many parts of the supply chain, whether it's seats, engines, fuselage components, other components on an aircraft. So I think we've seen improvement across the board in all of those areas. It does mean that the manufacturers are sounding more confident about the delivery dates that they've committed to. It's probably not going to be the case that they can bring them any earlier, but the likelihood of them being pushed later seems to be receding, which is good news.
So by 2027, what is the expected fleet size likely to be if everything is on schedule?
Well, I don't think we've put an exact number to it, but we have 308 aircraft operating at the moment. We have 540 odd yet to be delivered. Most of those will come before the end of the decade, so clearly there's going to be a significant expansion, a doubling or thereabouts.
Since we are talking about current developments, let me ask you about what's happening in the US at this point in time. We've seen a double-digit decline in international arrivals, 15% lower from the UK, 20+% lower from Germany, Canada, similar story, South Korea, similar story. What does it look like from India at this point in time in terms of Indian traffic to the US? Are you seeing a visible decline?
At this juncture, no, but there are a lot of moving parts. For example, some of the airspace restrictions that we presently have to operate around mean that we can't carry a full passenger load on some of our non-stop flights. And so that has had an impact on the number of people we're able to uplift, which is completely independent than any concern about economics or immigration or tariffs. So because there are so many moving parts, we can't isolate any one thing. But at this juncture, we don't think that there's been a significant impact in the underlying demand, in part because so many of the people that we're carrying are visiting friends and relatives, and that typically is quite robust.
But are you concerned about, for instance, the grey that's emerging now as far as student visas are concerned? Is that potentially a cause for concern?
I think it has to be. Anytime there is uncertainty, we have to be concerned, and it can be uncertainty across any number of dimensions. We operate in a business which, in some respects, is discretionary travel. People have a choice about where they travel to. The ease of travel in terms of visa and other dimensions is a factor in people's thinking. So anything that causes uncertainty means that we we're monitoring closely.
So let's talk about the park airspace closure, because the closure came in on the 24th of April. That's well ahead of Operation Sindoor. Now, from an operational perspective, you said you cannot carry a full payload at this point in time. Take me through what that's actually meant in terms of operations, flight cancellations, rerouting. What is all of that meant for Air India?
Well, so domestically, a number of airports were closed.
Yes.
13 cities that Air India group operated to, we had to cease operations. Unfortunately, that affected some 70-odd thousand people, nearly 1,000 flights, and we assisted people very quickly to get to their destinations as best we could. That was something completely beyond our control. On the international side, once the airspace was closed, we needed to take a different route. And that meant longer flying times to Europe and to North America. And in some cases for North America, it meant having to make an en route refueling stop in order to reach the destination. That was, we adjusted to that very quickly. I think we managed to minimize the disruption to customers quite well. And then very quickly we looked at how do we optimize the operation so that we can continue to operate the connectivity and the customer proposition that people have selected us for. So most of our flights now have been reinstated to non-stop. Sometimes.
And how you managed to do that?
So that's sometimes with a reduction in the payload that we carry, whether it's the amount of cargo we carry or a reduction in the number of seats that we fill.
So how many seats have you had to drop, as well as what's the decline as far as carrying of cargo is concerned?
So it's very route specific, and it even depends on the wind and weather conditions on a particular day.
But typically to North America?
So on some routes, it's zero. On some routes, as much as 20 or 30 seats. But
20 or 30 seats?
Yes, so it is significant, but the point is that we've been able to sustain non-stop service, which is the key reason that people are flying us, the key competitive proposition. On a couple of routes, we are taking an en route refueling stop. That's typically a very short refueling stop of 45 to 60 minutes, certainly much shorter than it would typically be if you got off an aircraft, did a transit experience and got on another one. So I think the elapsed time remains very, very competitive, but it's just not quite as convenient as it was before, so therefore a little bit frustrating for the consumer, clearly a little bit frustrating for us, and obviously it adds cost to the operation.
I'll get to the cost part in just a second, but have you had to cancel any flights? Are you re-looking at some of the destinations that you're flying to on account of the closure?
No, so we haven't cancelled any flights thus far. Depending on how things go and the extent to which wind conditions mean that flights become more difficult to viably operate, we may take a few tactical cuts here and there, but the intention is to maintain the operation as robustly as we can.
So let's talk about costs now, because it's been widely reported that if the airspace closure were to extend for a year, it could cost Air India upwards of 5,000 crore rupees, or approximately 5,000 crore rupees, and that's the estimate that has been given to the government in the many meetings that have taken place with the government on this issue so far. Is that accurate?
Yes, we were asked to give a ballpark cost of what this would be for us, and so we provided a number.
So it is approximately 5,000 crores, upwards of 5,000 crores?
It's approximately. Now we're obviously working to reduce the impact by whatever means we can. But yes, that's a ballpark figure.
If it were to continue for a year. In the previous instance when we did see the park airspace closure, and that was about a period of about 3 months or so, what was the impact then? What kind of a hit did you take then?
That was before my time, so I don't have those numbers off the top of my head.
Sure.
But yes, I mean, it's a significant cost.
So what is the way forward now? We don't know how long the airspace closure will last. Where do conversations with the government lie? Again, widely reported that there was talk around a possible bailout package, some sort of a subsidy, some kind of government support and intervention. Are any of those things moving forward?
No, I think, just to be clear, we were asked to provide a ballpark cost of what the impact would be. We have had a number of discussions with government on how we might mitigate those costs and make travel more convenient for people, whether it be fuel taxes or other things that we can do that provide some mitigation. But we're not in any active negotiations or discussions with anyone. Obviously, the government is going to take the positions they'll take from a geopolitical perspective, and we'll adjust accordingly.
So what kind of support would you then be hopeful of in a scenario like this?
We're a business that needs to operate. We try and operate on our own 2 feet. We're adjusting our operations to be as viable as we can, notwithstanding challenging circumstances, and we'll continue to do that.
But what would the ask be specifically? I mean, I'm sure that there has been a list of things that the industry, not just Air India, but industry has put forward to the government, to seek some sort of intervention at this point in time. Could you list that out for us?
I think it's probably better that any such discussions happen behind closed doors and not through the media.
Let's talk about some of the other developments that have taken place. There has been the revocation of the security clearance for the ground handling operator Celebi, and that has impacted operations across 8 or 9 airports at this point in time. Have you seen that impact operations for you specifically?
So there's been a fairly smooth transition to alternate providers. So there hasn't been a disruption to us or our customers, at least at the airports that we serve. The transitions like this are never completely easy, but I think it's been very well handled in this case.
Since we are talking about Celebi, again, widely reported that Air India did reach out to the government about Indigo's wet lease with Turkish Airlines. Is that accurate?
No, I think we quite categorically refuted that allegation. It's not our place to comment on business relationships such as that. The government will make their own call.
Let's then talk about the opportunities that open up with the Navi Mumbai airport coming in and the Jewar airport coming in as well. Jewar, of course, after Navi Mumbai. What will this result in terms of moving traffic, of where passengers are going to be boarding their flights from, and what is it going to mean specifically as far as Air India and the Air India group is concerned?
Well, we continue to have discussions with all of the airport operators, and we're very interested at these new airports that are being developed, not just in Navi Mumbai and Jewar. In the case of Navi Mumbai, it's probably the most imminent new opening. And so we have been in discussions about what capacity we'll operate from there. It's a little bit more complex in our case because we're a hub operator. We bring people into an airport and disperse on the rest of our network. So we need to be careful which flights we might move from the existing airport to the new airport so we don't weaken the hub. But clearly we want to be present in Navi Mumbai. It's a good airport, it's a good geography, it will have its own catchment. And so we'll be making some announcements to that effect relatively soon. In the case of Jewar, we think it's quite a different catchment. Again, we want to be present in that market, but it's probably going to be additions rather than any transfers from the Indira Gandhi international operation.
Okay, so additions for Jewar, but as far as the Navi Mumbai airport is concerned, you are going to have to reconfigure current operations and current connectivity. What percentage do you see moving from the current Mumbai airport infrastructure to Navi Mumbai?
Well, I won't speak specifically for Air India Group, but as it's been communicated to us by the operator, they want to do some redevelopment work on one of their existing terminals, which reduces their overall airport capacity by, I believe, around 20–25%. And so I believe that's around the proportion of traffic that they want to shift from the existing airport to Navi Mumbai whilst they're doing this redevelopment work.
Okay. How challenging is the environment today? Crude is still relatively benign. We haven't actually seen any significant moves on the upside as far as crude is concerned. But outside of that, there have been many of these operational challenges that we just spoke of. What does that mean in terms of operating costs for you? What does it mean in terms of your ability to be able to curtail losses? You brought down losses quite significantly to about 4,500 crores from over 11,000 crore rupees year on year. All of this impacts your ability to cut losses?
Well, I mean, we're very happy to see a marginal reduction in the price of fuel. It's about 40% of our cost, so it is significant. We continue to make good progress in improving revenues. We've more than doubled revenues in the last couple of years. We've tripled cargo revenues over the past 3 years. And in terms of costs, we've put a lot of investment into the business to improve premises, product, IT systems, whole gamut of things. That will take a while to pay off, and we sized that investment to support an airline that is much larger than the one we have today. So all of these investments and improvements and cost reductions that we're now underway, now taking, will lead to a much stronger financial position, but it's with the long term in mind, not something that we're doing as a band-aid or quick fix.
But on the cost reduction side, I mean, is there room for you to be able to bring down costs even further, especially with the use of technology and, what you've been able to do on that front? How much more can you eke out in terms of cost?
I think we can make quite significant progress on cost reduction. There's a story that needs to be told here, because when we took over Air India, it had suffered from many decades of underinvestment in aircraft and systems and premises and product and support infrastructure. And it was a business that was in quite a significant risk of collapse. The average age of employees was 54, for example. There were 30 aircraft on the ground for want of spare parts. So we had to stabilize the ship through significant, fast investment. Then we had to quickly prepare the business for growth. We've gone from less than 100 aircraft to 300 aircraft in operation in under 3 years. Nearly an aircraft a week being added to the operation. And then with aspirations to grow very much bigger with this 470 aircraft order. So we had to go from stabilization to preparation for the future, sufficiency, and now efficiency. And so we're very much now in that efficiency phase of making all of the investments that we've made over the past few years starting to pay off, both in revenue generation as well as in the cost of operation. And so it's a 5-year transformation. We're targeting that end of 5 years to bring all of these together. And so I think, as you've rightly said, the world-class global airline with an Indian heart should be visible by then.
The transformation plan, Vihan, and it is a 5-year plan, as you talk about. One of the metrics there was a 30% market share. You're edging closer to that, almost to 27%.
Yes.
On the many milestones that you've chalked out for yourself in terms of where you want to be at the end of 5 years, at the end of Vihan, where do you feel the most confident of being able to achieve those numbers and those metrics?
I'm confident on all of them, to be honest. Over the past 3 years, I think we've done all of the heavy lifting of what was necessary to do behind the scenes. Merging of the 4 airlines, upgrading the physical premises, upgrading completely the IT infrastructure, onboarding 15,000 new staff with new skills and capabilities, 6,000 staff leaving us mostly voluntarily, improving the service proposition, improving the operations, our commercial capabilities, our HR capabilities. And the evidence is really starting to show. For the last quarter of the last financial year, which was the first quarter post-merger, Air India achieved record OTP, and it achieved an on-time performance higher than what Vistara was achieving. It achieved record Net Promoter Score, higher than what Vistara had been achieving. For the first quarter of this financial year, it's gone up even further in both respects. The new Air India is now visible on the A350s serving London, Heathrow and New York. It has an NPS well above 60. And really, everyone I talk to is quite blown away that this is the new Air India. Over the next 2 years, as we refit the legacy fleet and bring the rest of the fleet up to that standard, the new Air India, hopefully, is going to be something that people experience on every flight, every day.
You talked about the refit, and the last time we spoke, that was going through its own challenges, and there were delays there, both in terms of time as well as in terms of cost overrun. Has there been any improvement? What's the latest there as far as the retrofit is concerned?
So on the narrow-body side, we're 3/4 of the way through the full-service fleet. We should complete the refit of the narrow-body aircraft by the end of this year.
Okay.
And already we're deploying the refitted or Vistara aircraft on the main metro routes, on which we now have 50% market share. So I think we've made good progress on the domestic side. On the wide-body side, which serve the long-haul international routes, about 35% of the aircraft have been upgraded. The first of the legacy aircraft goes into the hangar next month to undergo a complete refit. Once that aircraft is certified by October or so this year, we'll be able to put 2 or 3 aircraft every month through the refit program until all are complete. That will take until 2027 or thereabouts, but we have good line of sight now, good confidence, and really it's a mechanical process to bring things to closure.
Okay, so that's still another 2 years on before we actually see the retrofit program being complete.
Yes, but every month you will see more and more aircraft with the refitted product into service. So it's going to be a progressive thing.
You talked about the new Air India. Give me a sense of what's changed as far as people is concerned. The average age, was well over 50, and what is it today?
So it was of non-flying staff, it was 54 when we took over. It's now about 35.
Okay.
For cabin crew, it was in the high 40s. It's now 29. So a significant generational
Significantly
change.
Younger airline.
Yes. The erstwhile Air India had not recruited for nearly 20 years, at least for non-flying staff, in part because it was shrinking, in part because there were cost constraints. And so, just culturally, experientially, people with contemporary understanding of aviation, the erstwhile Air Indians had done a wonderful job in keeping the airline flying under some of the most difficult circumstances imaginable, and have done a wonderful job in transitioning to a very, very different work environment and imparting their knowledge to new colleagues. But an organisation needs to continue to have new blood and new ideas in order to survive and prosper.
Yeah.
And so we've been able to do that over the past 3 years. And the fact that people have come together so well, I think, is in part testament, 1, to trust in Tata, 2, to love for the Air India brand and name, which most people was their first flying experience, and 3, to be part of this mission of restoring a 92-year-old company that really carries the flag of India still, to represent India around the world in the way that today's India wants to be represented. And so I think many people see this as much as a mission as it is a job, and that's why it's so wonderful to be part of it, and I'm so honoured to be part of it, because we really do think we're doing something more than just turning around a company. We're doing something that has a national significance.
You talk about this being a mission and not just a job for you. So at this point in time, what are the projects or the tasks that you find yourself in mission mode on specifically?
Mission mode. Well, it's evolved over the course of the last 3 years simply because the nature of the task has been different. And, as I say, going from stabilization to sufficiency, now efficiency. My principal focus is now on consistency and on making sure we're performing as a business, whether it's from an operational perspective, a financial perspective, or customer service. The retrofit program is clearly number one in doing that from a customer perspective. But the robustness of our operations, making sure that we're operating consistently, reliably, is still consuming a lot of time. We're making good progress, but we've got some way to go there too. But look, I'm very, very confident about the future of Air India, and I think that I hope the rest of India can get behind us, because we are going to be flying your flag around the world for many years to come.
Well, with that, it is time for us to wrap up this edition of On the Record. From all of us here on the team for now, goodbye. Many thanks for watching. Do stay tuned. The news will continue right here on CNBC TV18.
India is hosting the world's most important aviation summit, the IATA Annual General Meeting 2025 in Delhi after 42 years, and the mood is cautiously optimistic. IATA has revised its 2025 outlook, so the global aviation industry is expected to post $36 billion in profits in 2025, which is much higher than $32 billion that it posted in 2024, but it is less than what IATA projected as $36.6 billion earlier. The key concern is on aircraft deliveries. IATA is expecting only 1692 aircraft to be delivered in 2025. That's 26% lower than what IATA expected last year. 17,000 aircraft in the backlog, with some airline customers looking at a waiting period of 14 years. We spoke to IATA Chief Economist Mary Thompson, and she is very positive about India. She said India is a shining example to the world of how aviation can be used as a growth multiplier. But she also sounded an alarm, saying that aircraft deliveries are not just hurting airlines, but are also curtailing economic growth.
It's not just a question of our share of GDP. It's also a question of how much our industry can improve other industries' share. That's where we have a multiplier effect that I think is unique among industries. And clearly, this is being expressed in India's economic policies, India's drive to develop more airports and use this economic policy for the good of the Indian population.
So this surge in India's aviation boom, airlines placing large orders, the travel demand booming, has happened in the last few years. How is IATA seeing this?
Well, we think that for sure this will cement India's position as the third aviation market, and I think India will rival China in terms of being the second aviation market. And there are, of course, geographical aspects that work in India's favor. It's a large country with a large population, a population that has now surpassed China's population in numbers. So that also suggests this growth potential in the Indian domestic market. And if we look at the US by comparison, much smaller but still a large domestic market, yeah, we see the same thing, that air transportation systems that have the benefit of a large domestic market tend to do really well.
How much time will it take for India to surpass China's aviation industry? Because they are too large. They are, I think there are 4,000 aircraft totally in China. And so how much road does India have to cover to reach there?
Yes, I can't unfortunately give you a year prediction, but I do think that pursuing this policy will keep India at the forefront, in the top three of global aviation markets, and that is, not only good for India, it's good for the rest of the world as well. So we are grateful to the Indian government for this enlightened economic policy. I believe that if countries all across the world were to understand that this is a top-level governmental growth and economic development strategy and not a small industrial policy strategy, then we get the right policies. If we get those policies, then that will accelerate the advancement of the Indian air transport market.
Talking about Indian airlines placing large orders, orders have been placed, but as IATA says, manufacturers are letting airlines down, and the projection that IATA has for 2025 has also been lowered to over 1,600 planes. So how many of those 1,600 planes are likely to come to India?
I wish I had that number available for you. I don't really, I'm afraid. But that's clearly a problem for the whole global air transportation industry, that we are not getting the airplanes that were ordered previously. There's a historically large backlog of planes and the longest waiting times ever. And this is capping, our capacity to serve not only the passengers and the cargo clients of our industry directly, but also the wider economy.
Emirates President Sir Tim Clark did not mince words. Speaking on the restrictions on the India-UAE seat capacity, he said that the restrictions currently are suppressing demand, and which is what is keeping airfares much higher. And he's urging the Indian government to deploy more seats on the India-UAE routes. Speaking on the capacity crunch, he says Emirates could be twice the size of what it is currently if not for the current aircraft delivery delays. And he also added that it is not cost but capacity shortage that is hurting airlines.
Surprisingly, and I speak not only for Emirates but the airline group as a whole, apart from the North American and Canadian situation, demand is very strong. Given the difficulties, socioeconomic, geopolitical, etc. But demand for travel is as strong as it was this time last year and the year before. So I'm kind of fairly optimistic if we can get through all of this, and that there aren't major disruptions to the global economy, that things will continue as they are, I should say. The fuel is down, yields are up, so it's for the first time in our we have the opportunity to actually make a decent return on our investment. Doesn't happen often in our business, but nevertheless, things are looking good at the moment. But hey ho, anything can happen.
How are you seeing traffic coming from India? Have any patterns changed?
No, not at all. I think we have to suffer. Our biggest single problem is dealing with the demand for the seats that we have, because they've been restricted for 10 years. And yet the demand for India, certainly to places like Dubai, has grown exponentially. So that's a high-class problem, actually. And, of course, it means that the fares are going to be that much higher because supply is restricted. The Indian market in the last 20 or 30 years has really transformed itself into a very robust, both inwards and outwards. And the Indian economy, certainly under this government, has moved ahead quite at pace, where it's trying to engage in the global economy in a much more measured way, but more expansive way than it ever did before. But to do that, part of the equation of getting that right is you've got to have access in and out of your country. So the wealth multiplier that is created by air access is known to most countries. It doesn't make any sense to me to kind of restrict that, and the Indian population suffers as a result of that. So if you want to open your country, if you want it to be a main player in the global economy, certain things have got to be done to make that work. After all, the Indian economy has expanded in all sorts of areas successfully. So air transport needs to be part of that.
Since we are talking about India, Indian carriers are expanding internationally. And since we already have a restriction on seats, do you see the share that you have on the Indian traffic getting impacted there?
It's always a question of the restrictions on what will happen to Emirates. What the Indian carriers need to concentrate really on is doing the thing that they could do very easily, which is open up their global markets. If this has an effect on Emirates, so be it. But after all, Emirates has been restricted for 10 years. We've grown our business globally. We are much larger than we were when those restrictions were put in place. In fact, last year we had the highest profits we've ever made. That's without India contributing as much as it used to. So clearly the global markets are there for all, and there's no reason why the Indian carriers, whether it be Indigo or Air India, shouldn't be able to make a go of it without having to worry about whether they go over Dubai or not. The fact is that Dubai is a very, very significant market in itself. And if you talk to the Indian population and the Indian carriers themselves, with their hands on the heart, they'll say it's probably the most potent external market city that they have on the network. And all we've done is suppress it. So if today we had where we need to be, instead of having between Dubai and India 65,000 seats in each direction per week, today that could be more than 2.5 times the size of that. Think what the Indian carriers would get out of that. Huge amounts. And that would fuel the income they need to make the investments they need for large aircraft and to go further. And have they got the capability of doing it? Yes, they have. So
from 65,000, where should it be for the time being?
You know, on the rate we were growing, it would be 200,000 now. That's where it would be.
That's the potential.
Oh, yeah, easily.
Yes.
And you'd fill that as well. And the Indian carriers would get 100,000 of those instead of 33. And they would do very well out of it. More points into India for everybody. So, you know, with more capacity, better products, etc. Honestly, it's a no-brainer.
There's always been resistance from the Indian side. You've mentioned this in the past conversations as well. Any more talks with the Indian government that you're having?
I'm not aware of that at the moment. I just hope it's not just about Dubai and Emirates, etc. It's about the other carriers, whether it be the European carriers, the Asian carriers. They all want a piece more in India. Equally, the Indian carriers want access to their markets, but you won't get that if you restrict access to your own. So maybe the powers that be here in this country will kind of realize that at some point we've got to give ground on this. And after all, why are they doing it? Why would they? Is this to protect Air India? Is it to protect? But protection is the worst form of subsidy, if you can call it that. It doesn't do the carriers any favors because they become very complacent in the way they go about their business. There's absolutely no reason why Air India, Indigo, whoever, shouldn't be 4 times the size it is today. And as you can see, these great plans that Air India has put in place, hundreds of airplanes come into play, they realize the potential.
So we spoke about orders placed by Indigo and Air India, but while the demand has bounced back, there is shortage of supply. How bad is it?
It's chronic. It really is chronic. I mean, it's all very well for us to make these huge orders, hundreds and hundreds, but at the back of your mind, you know that they can't even get certain aircraft out of the door by the end of next year, they being the manufacturers. So these are very aspirational orders, and we all face it. We're hugely competitive, but we talk about the difficulties of getting the assets we need, both in terms of the new assets and then be able to support them in the supply chain. And it's the biggest single common factor of concern that the airline industry has is this.
So definitely it is constraining capacity expansion, but how are you then managing and mitigating these issues?
Well, because a lot of the aeroplanes that we were going to retire, we retained. Secondly, we refurbished them completely. So as you would do a hotel, we gutted them and are rebuilding the interiors. That's going on as we speak. We've got 220 aircraft going through that, from the 380s to the 777s. Into those aeroplanes are coming new products. Premium economy, the new business class cabin, the upgraded first class cabin, new bar on the 380, etc. So we were able to stabilize the line. So whereas they were coming out, the new aircraft were coming in, they didn't come in, so we just kept going. So the fleet has been in and around 260 for a year or so now. Now we have a line of 350s coming in, 65 of those. We've got 6 already. They're not exactly on time, but they're helping. So we can manage. But as I've often said, Emirates could be twice the size it is today had we had everything that we needed in place. The demand is that strong.
Yeah. OEMs definitely blame the supply chain issues. But when you talked about refurbishment, how is it being funded? Is it Emirates, or are you taking compensation? There were reports that you're taking compensation.
No. Look, in the end, the most important thing is you've got to refurbish them. We have $5.5 billion allocated to that of our own cash. And to be quite honest, if you penalise the supply chain through punitive damages, you'll just push them out of business completely. There has to be a grown-up conversation when it's all over as to the effect it's had on the business. But in the end, you've got to get on with the job. There's no point sort of sitting back saying, how can I get $10 from him so I can pay $10 to her for whatever it may be. It doesn't work like that. You've got to take control, recognise the shortfall of all these things and get it going, which is what we've done.
So what is the outlook for 2025 in terms of delivery of planes? How much are you expecting?
Well, we were meant to have about 17 350s coming in the course of this year. We've got 6 so far. If we get the 17, I'll be surprised. But hopefully, you never know, things may work out, and then a stream of 777s the back end of next year or the beginning of the following year. Can we manage? Of course we can manage. The network is robust, it's strong, it's profitable.
Etihad CEO Antonaldo Neves is dealing with similar frustration. Despite robust demand, Etihad is stuck at 176 flights per week, and he warns that if India doesn't open up, they will deploy the capacity elsewhere in Europe and Asia.
We have this network that is, I would say, very balanced. Every time we have a political uncertainty on one side, the other side does better. It compensates one for the other. So I would say that as of now, we don't see any kind of issues in our forward booking curves.
So how are things in India then? Last time we spoke, we were at 176 flights. Are we still there?
We are, because we cannot add more flights.
Yeah.
But the news is that now the Indian carriers also, they cannot add more because they have used all the traffic rights available. Because last time we spoke, the Indian carriers were not there yet. And you see how they're doing well, right? Now, I mean, our competition is flying more destinations from India to Abu Dhabi than we're flying to India. Right?
So since capacity for you is restricted here, what other ways are you exploring then to tap the demand, the rising demand in India?
We're adding a lot in Europe and in Southeast Asia. So
but nothing in India.
No, because we can't. But that's what I think is going to change, right? Because reality is, what is the most scarce resource in the aviation industry today? Airplanes.
Capacity.
Airplanes.
Yeah. So that is going to be my next question.
So there's a fight for capacity, right?
IATA also has projected that 2025 deliveries will be about 1,600 plus, suggesting that capacity expansion is going to be constrained for many airlines. How bad it is going to be for you?
No, actually it's going to be good for us, right? Because if I don't get seats in India, I'm going to put that capacity somewhere else, right? So we're in a good position. My point is, I think countries are starting to think differently about capacity and about constraints. Because if the constraint is the plane, there is a fight. Countries are fighting to get flights. Fighting, paying subsidies and paying incentives. So I think India is going to open up for more seats in the future because there are no planes.
There are no planes.
And then if you don't open up, you're not going to get those planes. You see what I mean? So I'm excited about the future. And when India gives us a little bit more seats, we're going to be adding more capacity. And if we don't get that soon, we're going to be adding other places. And we fly to Southeast Asia, we fly to China, we fly to Europe, we fly to the Middle East, a lot of flying in the Middle East. So it's a good market.
So what is your current operating fleet currently, and what is
about 100 planes?
So what is your expectation then from the delivery perspective in 2025? How many aircraft are you expecting?
We still have about 20 planes to come. So we're going to be getting about one plane every week for the next 6 months.
Egypt Air Chairman and CEO Ahmed Adil is bullish on India and wants to deploy more capacity on Indian routes. He said that the current India-Egypt bilateral air traffic rights stands at 60% utilization and he wants to take that to 100%. He also spoke about the ambition of expanding into the North American markets.
Well, India is a very important market for us in Egypt Air. We have flights to New Delhi and we have flights to Mumbai. We have 4 flights weekly to New Delhi and we are looking to expand that and increase the capacity.
Okay, so how much of the bilateral air traffic rights are you utilizing currently?
We are utilizing almost 60 to 70% of the bilateral agreement and we're looking to utilize 100%, of course, when we receive our new aircrafts.
Okay, I was about to ask you about capacity because flying more will require you to have more planes. So where do you stand in terms of delivery of aircraft?
We are very excited. We are expected to receive 50 new aircrafts starting December 2025 all through 2026. And we have extended the lease on 5 of our 777-300ERs for another 18 months. So we should be good in capacity starting first quarter of 2026.
So what will that take your fleet to? What is your current operating fleet?
We are now at 65 aircrafts.
Which is a mix of?
Excuse me?
It's a mix of?
It's a mix of Boeing and Airbus aircrafts. So we have 320s and 321s, and we have 777-300s and 787s. And 737 NGs.
And what you have ordered includes?
We have firm order of 10 350-900s and 18 737 Maxes.
Okay, so you want to fly more ultra long haul and long haul?
Yes, we want to fly. We want to expand our network in capacity, frequency, and opening new routes.
How are you seeing the overall aviation market globally? You are seeing more uncertainties. Are there any markets where you're seeing problems?
Well, right now we are very bullish on the aviation market. We are seeing growth in the Egyptian market in the next year and 2 years, so all through 2027. We have seen growth in the past 2 years. We did very well in the past 2 years, and in this fiscal year we are expecting to do even better. So we are very excited.
In 2025, what does Egypt Air has to offer in terms of new destinations, new flights?
Well, we are not opening new destinations in 2025 because, as I mentioned to you, we are awaiting the delivery of our aircrafts to exercise all our options in the network. But we have very good movement in and out of Egypt, so we are happy with this year.
Okay. Are you focusing on any markets in the long term?
Well, in the long term, we will be focusing on the North American market. So we're looking to also increase our capacity and frequency in North American markets. And when we receive all of our fleet, the wide-body aircrafts, we are looking into opening new points there.
In terms of uncertainties, geopolitical uncertainties, what is your view on how it impacts aviation, global aviation, customer confidence in flying? We also had many air accidents this year. The start of the year was not very good for the aviation industry. Plus there are geopolitical conflicts, there is weather-related uncertainties. Do you think the vulnerability index has gone up for airlines?
Well, as you mentioned, about aircraft accidents, aviation is still the safest means of transportation in the world. So I understand that people get startled when they hear about accidents, but still the rate is very, very safe. So this is on that side. On the side of geopolitical disturbances or the volatility in the aviation industry, as you know, the aviation industry has proven its resilience throughout the years. So we are very confident that it will maintain its resilience, and it will, whatever problems happen, we know we can deal with it and come out stronger.
So the message from IATA AGM 2025 is clear. Airlines are seeing demand return and profits grow, but they are being held back by aircraft shortages and market access restrictions. So while India is being celebrated as a model for aviation-led economic growth, leaders are calling for bold reforms and open skies. In Delhi, with video journalist Balbir Singh, this is Madiha Mujabar for CNBC TV18.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always Ritu Singh. These are the top headlines from the startup world. B2B e-commerce platform Udaan announces the closure of its Series G round at $114 million. This round was led by M&G Investments and Lightspeed, with participation from other existing and new investors. The fresh capital will be deployed to strengthen Udaan's category and customer footprint with a focus on its FMCG business. D2C men's fashion wear brand Snitch bags 340 crore rupees. The fundraise was led by 361 Asset with participation from Ravi Modi. Will use the funds to fuel expansion and increase its retail footprint. Pepperfry gets 43 crore rupees from existing investors like Norwest Venture Partners and Goldman Sachs. The infusion follows a previous $23 million round in 2022. While revenue declined in FY24, the company has narrowed its losses and postponed its IPO plans, focusing on growth and profitability amidst competition from major e-commerce companies. A new BCG QE report reveals fintech is entering its strongest phase yet, with 21% revenue growth, rising profitability and AI-led disruption driving the next wave of innovation and global expansion. Maharashtra's FDA revoked Zepto's food license in Mumbai's Dharavi, cites non-compliance with food safety standards after a surprise inspection. Those were the headlines that we're tracking for you this evening. But on what's brewing today, Maharashtra's Food and Drug Administration has deepened its crackdown on quick commerce companies. This comes after FDA officials conducted a surprise inspection at Zepto's Dharavi dark store and found unhygienic conditions. Zepto's license for that dark store has now been suspended. Shilpa Ranipeta joins us now with the details. Shilpa, take us through the steps taken by the Maharashtra Food and Drug Administration and the sort of, impact it has on quick commerce companies going forward.
Well, hygiene conditions in all the quick commerce stores are now under the scanner. And like you mentioned, it started with Zepto's license for the Dharavi dark store being suspended by the Maharashtra FDA. And this was after an inspection revealed multiple violations. There was fungal growth seen on some food items. Products were stored near stagnant water. Cold storage temperatures weren't as per standards. The floor was wet and filthy. And food items were found scattered and stored in an unsanitary way. Even expired products they were not clearly separated from non-expired stock. And this is a store that just received a license about 3 months ago in May. Now, in a statement, Zepto says that it has launched an internal review and that it is working closely with authorities to ensure full compliance. Zepto says that it's committed to fixing the lapses, strengthening its processes, and is taking all necessary corrective measures to resume the operations as soon as possible. Meanwhile, Maharashtra's FDA has widened the lens. It's not just about Zepto. Food safety officers have been directed to inspect the dark stores of all quick commerce players, including Blinkit and Instamart, and they've also been asked to issue notices to these platforms to follow hygiene and food safety norms, and any violations, we're told, will lead to improvement notices or even license suspensions. So yes, while quick commerce is expanding fast, it's also facing growing regulatory scrutiny. Back to you.
All right, Shilpa, many thanks for those details. Now, a bold new bet on Bharat's startup potential. US-based venture firm Expert Dojo has launched a dedicated India cohort, pledging $100,000 each to over 10 early-stage startups. With a $15 million India-focused fund in play, the accelerator aims to go beyond just capital, offering global investor access, hands-on mentorship, and a clear path to Series A. From AI to EVs, urban hubs to remote corners, Expert Dojo is hunting for India's next breakout stories. So what's the game plan behind this ambitious push? Let's find out. Joining me now on the show is Ashutosh Kumar Jha, the general partner at Expert Dojo. Ashutosh, thank you so much for taking time out and being here with us on Startup Street. Before we get into who you're going to invest into, if you could sort of explain to us what inspired Expert Dojo to sort of launch an India-dedicated cohort at this time. What unique opportunity does the Indian startup ecosystem present that made this the right moment for focused investment?
First of all, thank you so much for inviting me here. It's a pleasure. So really appreciate it. A little bit about the background of Expert Dojo. We are based in California. We have invested in close to 300 companies worldwide. And our inception year was 2019, and since then we have been investing $50,000 to $100,000 as first check, and then follow-on investment up to $1 million sector agnostically. And then from our US-based fund, we have invested in close to 30 companies, not close to, but exactly 30 companies in India. Sector agnostically, to name a few of our portfolio company in India, Beehive Co-working Space is one of them, Mugafi, based in Delhi, Consumer AI, and all those companies that were based out here in India. So talking about, to answer your questions regarding what inspired us exactly to launch our cohort, because, India has been, like for a long time as a back office for a lot of like IT-based companies, even though the stats that you see in the US, like a lot of CTOs used to be Indian or Indian origin, but now the things is a paradigm shift. We as an Indian, we are becoming the executives, rather than CTO, the Indians becoming the CEOs in the United States. And same is happening here in India as well. Like literally, we are no more we are no more the, what do you call it, like the back office of the IT companies. We are the strategic hub, the R&D hubs and stuff like that. So the kind of things happening in India, it's crazy. That inspires us a lot to kind of open our first office space outside the US, that is in India. So we thought, okay, this is the right time and right opportunity. And the people are saying this decade is for India, but we believe this century is for India. So here we are at the right timing and right opportunity to invest a lot.
Absolutely. India's startup ecosystem is prime for investment right now. But if you could sort of explain to us, how does this cohort differ from traditional accelerators and early stage funding programs that are already existing in India? Beyond the capital, what hands-on support will startups actually receive?
Well, a lot of discussion these days is popping up that venture capital model is broke. And then we don't say ourselves as a VC. We call ourselves as a growth hacker first, VC second. So we don't just write check. Check is the first thing. Of course, we believe in you, take the money. But what we come up with is the strategic support, the growth support that we provide hands-on. We have built a relationship with millions of dollars of perks and discounts provider, service provider, mentors, and all of these things will be there. It's just not the check. Our main mode is to kind of hand-holding. We don't believe in a spray and pray model. Once we put the money, our follow-on investment opportunity is $1 million later on, right? Sorry, can you hear me okay?
Yes, absolutely. Continue. Go on.
Okay. So first check, 100K, follow-on $1 million. That we give up to 3 years of the first check. So you see, we don't diligence the company just for 1 month. Technically, we touch point on the company from numbers to personal connection for 3 years. And then our main mode is to put $1 million. And when you get the $1 million, when you are kind of growing at 200% year-over-year and stuff like that, the growth that we're going to support. And then every 6 months, we do the audit on the companies and all. So we are kind of a little bit different from the existing funds out there. We do a lot of growth support, like help them with GTM, scalability and stuff. With our India fund plan specifically, our mode is to kind of not just put the capital locally here, but after investment, we want to take our companies to the US. So we're building the Indo-US investment landscape, if you see.
So you're building in India for the world is what you're saying over here.
Of course. That's our intent.
And as you pointed out, you've committed this $100,000 each to about 10 plus startups, right? What are the key criteria you'll be evaluating while selecting these founders? Have you sort of, identified any firms that are looking exciting for you? And when will the deployment start?
The first the cohort that we are thinking of to invest this into the 10 companies is going to be in the end of August or mid-August. And then we are already actively seeing the companies, like in last couple of days, we spoke to pretty much 50 plus companies already, and we are still speaking. So we are expecting around 500 to 600 companies that we're going to speak with before we make the decision, the 10 companies that we're going to invest in. And then what was your other question, by the way?
I was just wondering when you're going to start the deployment, and how do you select these companies? Like, what are you looking for in the founders?
So at early stage, as you just asked, valuation and all those, fancy number doesn't really matter to us. We make decision based on the founder's market fit. Why you are the right founder to make the right company. So it's founder's first mentality that we come up with, and then if you're the right person who can make this amazing company go. If you're a bad executor, then take the money from us. So yeah, the founder's first mentality is something that we basically focus on.
Sure, and you mentioned that you have a sector agnostic approach, but you are looking at verticals like AI, EV, and SaaS. If you could sort of take us through why these are the sectors that excite you out here in India?
Well, as I mentioned earlier, you go to any Indian families, there is one engineer who's either coming out or applying for an engineer degree, right? And if you have seen the pattern, a lot of engineering colleges are now putting very specific computer science courses like AI, blockchain, and stuff like that. So what India is getting ready for is like the next revolution. Like we are getting so much having so much deep expertise in the sector specific thing, like AI, specifically if you mentioned that we have that expertise to build in, right? And AI is going nowhere. If you're not using AI, if you're not having any use case of AI in your workspace, you're lagging, you're falling apart, falling behind, right? So we thought of, okay, like let's go ahead with this, now in any, even though we are sector agnostic, but AI also can be used sector agnostically as well. So let's say whatever you are building, if you have any AI segment and stuff, our focus is not just the AI, but sector agnostic, as I mentioned earlier, but then anything that is tech and very easily scalable, that can be done by using something called AI. And blockchain and stuff. So we specifically very much interested in any intersection of sectors like AI and blockchain and stuff like that.
Right. And India's tier 2 and tier 3 cities are seeing a surge in entrepreneurship, right? How is your fund sort of positioned to support founders from these regions, as they call it, the Bharat opportunity?
Well, historically, if you have seen our data, like whatever the investment that we did, we had no biases that the companies should register in Bangalore or Delhi or Pune and stuff like that. Our companies came from Bihar. Our companies came from Jaipur. Our companies are based in Bangalore. Our companies are based in Delhi, right? So we have done that unconsciously. But right now, our approach is we're going to have we have a scout program as well. We have our scouts are like hunting for the deals from tier 2, tier 3, tier 4 places as well. So we are going to decentralize in India as well when it comes to finding those companies, have someone locally represent expertise in that state and bring those deals. So we definitely see next unicorns are coming not out of just Bangalore or Delhi or Pune, but of course, tier 2 cities, what's happening here in India, the kind of development that we are seeing and the rise in the entrepreneurship.
Absolutely. It's a big opportunity there in the tier 2 and 3 cities. All right, Ashutosh, thank you so much for taking time out and being here with us on Startup Street. And moving on, entrepreneur and wellness enthusiast Meera Kapoor has launched her second entrepreneurial venture, bringing ancient healing and advanced healing practices under one city roof. CNBC-TV18's Rachna Dhanrajani caught up with her at Dhun, Mumbai's first in-city wellness center, to find out why she believes that true self-care shouldn't require a vacation. Take a look.
In the middle of Mumbai's buzzing Bandra neighborhood, a quiet sanctuary has opened its door. This initiative by Meera Kapoor is an attempt to redefine what wellness can look like in a city that never sleeps. Ayurvedic treatments to treatments like cryotherapy and infrared bed, Dhun Wellness tries to bring the ancient and the advanced all under one roof. Thank you so much, Meera, for joining us on CNBC-TV18. We're here at the launch of Dhun Wellness, located in the heart of Bandra. Tell us more about it. Tell us the initiative. Tell us the idea and the vision behind it.
So welcome to Dhun. Dhun is the first in-city wellness center of Mumbai. The idea behind creating Dhun is for people and urban dwellers to be able to experience deep care and healing, preventative health care, right in the comfort of their own homes, integrate it into their lifestyle instead of just having the fleeting results of a getaway or a resort. So we have 5 pillars. We have wellness programs, body therapies, longevity, healing and Ayurveda, all under one roof.
Awesome. Was there a personal epiphany that you had that you need to do this, or what was the trigger or the encouragement that led to the foundation of this?
I think I've been someone who's listened to her body. I've always adopted alternative medical practices to find my balance. And I've done an annual gut cleanse for the last 7 or 8 years. However, because I have young kids and I've had my kids are now 9 and 7, I could never move out of the city to do that. So I found a hack. You know, I would get the kit, the medicines, the therapist. I would do it at home for the last 7 or 8 years. But I felt like there needs to be a place like this in the city because there are more people like me. There are more people who want to get better, get well, harmonize with their body, and feel like they can do it consistently over a period of time in the city.
Right. Apart from the geographical aspect of it, that it's right in the middle of the city, how would you say Dhun Wellness sort of differentiates itself from other wellness centers?
You know, typically, if we look at healthcare, either we're going into conventional scientific healthcare with respect to hospitals that's focused on disease management, or you're looking at an aesthetic space like a salon or a very typical spa. There is no place that brings the following together: in-city, luxury, and holistic. You have 2 out of the 3. Dhun Wellness has all 3. So you're able to use a cryotherapy chamber in the same place as you're able to get a Nadi Pariksha done, in the same place that you're able to do a 7-day women's health program. So the key differentiator here is that it is holistic wellness under one roof with visiting masters like a medical therapy management practitioner who would look at your nutritional deficiencies, supplements, give you a program for that, a Japanese facial master who would come in for a week, help you with sculpting, lymphatic drainage, reflexology. So it's almost like a holding house of global talent, accessible to you, and all different modalities of healing.
Right. What is it that you're trying to do differently to capture the market share here? Because at the end of the day, we're looking at it from a business perspective as well.
Absolutely. So I think having all these different verticals under one roof is the key differentiator that we have. Creating a space and a community where you can engage with like-minded individuals as well as like-minded practitioners. Always having an inflow of different doctors, different experts, as well as the membership programs that we have that enable you to be consistent at Dhun. So with respect to the market, it's 4.5 lakh crore is the size of this wellness market in India. And I think it's got very strong tailwinds. There are people who are looking to find places like this. And I wanted to create this place, and Bombay is not the first one. We're going to have many more.
I'm sure people would be waiting as soon as you open the doors, which will be very soon. But thank you so much, Meera, for speaking.
Thank you for having me.
With ancient rituals and cutting-edge technology, this space is a reminder that wellness is more than luxury. It's a way of being, and that's perhaps what Meera Kapoor's vision is with this preventative and recovery-focused wellness center. This is Dhun. I am Rachna Dhanrajani for CNBC-TV18.
On that note, it is time for us to head into a short break. But coming up next, fintech-focused global venture fund QED Investors is looking to double down on India with investments over $250 to $300 million in the region over the next 5 years. A special conversation with its founder on the other side. Stay tuned.
our Investor Eye Corner today, we've got fintech-focused global venture capital firm QED Investors that's looking to double down on India, which remains one of its most important markets in the Asia-Pacific region. The VC has invested just under $220 million across Asia, which is primarily in India, and expects to deploy an additional $250 to $300 million in the region in the next 5 years. Globally, QED has $4.5 billion under management with more than 30 unicorns in its portfolio. It has backed Indian startups like OneCar, Jupiter, Upswing, and Refine. Nigel Morris, the co-founder and managing partner of QED Investors, joins us now to break down the investment playbook and the India strategy. Nigel, many thanks for joining us here on CNBC-TV18. India, of course, has been a core focus for QED in Asia. Start by giving us a sense of how much of this $220 million has been deployed in India across how many fintechs, and what kind of potential do you see for further investment here?
That's a great question, Ritu. Thank you for having me. We've invested about $220 million over the last 5 years here in the APAC region in general. We've invested in companies like OneCard, Refine, Jupiter. We've made about 11 investments all in all over these last 4 or 5 years. And as we look forward, we don't really allocate a certain number of dollars to the region, but we'd expect to invest 250 to 300 million over the next 5 years. I mean, that's subject to horse racing the ideas in this region against ideas in Latin America, against Nigeria, against the UK and the US, and the global stage.
All right, with more than $220 million deployed in Asia and plans to double that in 5 years, what are the sectors or sub-themes within fintech like embedded finance, insurtech or wealth tech are you most bullish on when it comes to India?
So you hit on a number of the major themes there. Look, so QED is all about financial services. That's all we do. So that would be wealth management, insurance, it would be payments, it'll be lending, it would be crypto, it would be banking as a service, it would be embedded finance. So we look across the full vista of all of those ideas. We tend to invest at the early stage, so it'll be seed and A, although we now have a growth fund, which enables us to get into the B to C stage. So we're interested in all of those areas. As we look at India specifically, we find ourselves really drawn to embedded finance, which we think is really powerful. We see that credit card penetration in India is extremely low. It's in the low single digits. And of course, we're drawn to the macro phenomenon that is quintessentially India of 6 and 7% GDP, the largest population in the world now, and of course, a digitally enabled, young, educated population of about 80 million people that now have earnings over $10,000 a year. So we're really long on the opportunities that exist in India, and of course, the talent pool is amazing. The tech is phenomenal. A progressive regulator. There's just lots of things to really like.
Well, Nigel, as you just said, QED has traditionally focused on early stage fintechs, but it is now actively participating in Series B and C rounds here. What will the average check size look like, and what really triggered this strategic shift?
Look, we're in our second growth fund. We had our first growth fund that was started about 4 years ago. And the logic was really simple. It was to take the top quartile of our early stage companies and be able to double down and invest in the best companies that we've already seen through our early stage fund. And about 2/3, 3/4 of the investment dollars that we have in the growth fund are follow-on investments from our early stage. So we really are taking advantage of asymmetric information. We know the companies, we've seen them go through the thick and thin, we've seen them be able to compete in the marketplace, and we have the opportunity, because of the relationships that we've built with the companies, to be able to add a bit more capital and have a bit more ownership. So it's a logical extension of the QED business model. The average check size would be about $20 million, usually without a follow-on. So there'll be something in that region. And look, we're looking for companies that are beating the rule of 40, who are at the B and C stage, who are profitable or darn near profitable, where they have grown-up management teams and really good governance and fantastic unit economics and net promoter scores that you would really feel great about. and companies that have really shown that they have that product market fit and they're now scaling rapidly. And, you know, we were able to take 18 of our portfolio companies off to New York about 2 months ago, where we gave them a boot camp workshop on how to go public. And the fact that we've been able to follow our companies into the B and C stage gives us permission, in a sense, to be able to start to talk to them about what an IPO exit might look like.
Nigel, finally, let me ask you then about exits. Looking ahead, is QED hoping for a few large exits from its fintech portfolio or a broader portfolio of category-defining companies?
Look, we have a duty to our LPs to give them a solid return, and we're very focused now on looking to get liquidity out of our portfolio. We have not seen many IPOs, particularly in the US, for the last 3 years. There were not something like 60 IPOs in the US in fintech land in 2021, and there's been a very few number in the last couple of 3 years. We, by the way, have seen eToro go public. Circle is about to go public. Klarna maybe by the summer, we see just a whole range of really now very advantaged, grown-up, durable business models that are going public in the US. That will create some liquidity in the system, which I think our LPs will really appreciate. I'm a passionate believer, Ritu, that fintech actually levels the playing field, creates more transparency, enables consumers and small businesses to be empowered. Our investments in companies like Nubank and Credit Karma, in Klarna, these are companies that have changed the face of financial services worldwide. And it's just fantastic to be able to invest in so many talented entrepreneurs who are actually half of my age and twice as clever as me, who are actually going out and building these wonderful businesses.
Our focus today is on iPhone maker Apple's strategy amidst a rebalancing of world trade. US President Donald Trump recently threatened to impose a tariff of 25% on Apple if the company does not make iPhones in the US. But there's a chance that the company may choose to continue to make the phones outside of America and pay the tariff. Let's break down the maths that could support this rationale. Currently, most parts are made in or near China. Chips are made in Taiwan. iPhone screens and memory chips come from South Korea. Japan provides camera systems and the batteries are made in China. About $550 is the bill that Apple foots for the components of an iPhone 16 Pro as per Tech Insights. In a pre-tariff scenario, Apple would be left with a profit margin of around $450 if the iPhone costs around $1,000. Even if you remove the cost incurred for the assembly and testing, advertising and services like iCloud, Apple will still be left with a good margin. Now, in case a 25% tariff is applicable, the profit goes down by $100. That's still a better price to pay than the heavy investment and time required to shift manufacturing of iPhones to the US. As Wedbush Securities estimates that a $30 billion investment will be needed over 3 years just to make 10% of iPhones in the US. It also won't be easy to replicate the complicated production systems that have existed in Asia for years. The Wedbush analyst expects that the cost of an iPhone in US will be much more than the current price, almost triple. Not just that, cost of assembling an iPhone in China or India is a mere $30 when compared to an estimated $390 in the US. Also, Apple will still have to import many components which will likely face tariffs. In 2017, Tim Cook had said that companies manufacturing in China, because of the skill and the quantity of skill in one location and the type of skill it is. But that's not to say that Apple hasn't been shifting its reliance away from China.
Apple currently produces nearly 15% of all iPhones in India and is looking to increase that number over the next few quarters. As per data from Canalys, US iPhones shipped from India in April surged 76% year-on-year, while shipments from China slumped. While many signs point out that it might not make business sense for Apple to make iPhones in US, a book named Apple in China by Patrick McGee throws the spotlight on the tech giant. McGee reported on Apple from 2019 to 2023 for the Financial Times. In his book, he talks about how for years Apple was allowed to exploit China. And then we saw China exploiting Apple in turn, almost making it impossible for the tech giant to extract itself from the country. The book says that Apple, having invested billions of dollars on infrastructure and training to make Chinese factories unparalleled, has little choice but to comply with Beijing. Patrick McGee is joining us on the show to discuss this. Patrick, thank you very much for taking out time here for CNBC-TV18, our new show, Global Lens. Apple has been in focus. Give us a sense of when you believe there was a turning point in Apple's China story. Did it all boil down to the Consumer Day in 2013?
Yeah, my book begins, the prologue begins with March 2013, really significant time, even if you're not an Apple watcher, because you'll know that's when Xi Jinping ascended to the presidency. Apple was attacked within 36 hours of Xi ascending to the presidency, and they're attacked for warranty differences of all things. And this is later in my book, the political awakening for Apple, because at the time they had been the most successful operator in China and the most successful retail business in China, with more than $20 billion of revenue at the time. And so the book really, the thesis is that Apple sort of hires or names key people to live in the country for the first time and really get to know the provincial officials, the federal officials, the culture of China, and really come up with a strategy to tell China, we're not exploiting.
All the smartphone giants that we see out of China and Beijing coming out now, do you feel Apple has had a hand in building China as an innovation powerhouse today?
Yeah, I mean, let me just say that this is a 400-page book, and that is the wild conclusion. It's difficult to sort of make the case in 15-second sound bites, right? But let's just say that Huawei's founder has referred to Apple as the teacher. And the smartphone industry in China would not exist the way it is without literal plane loads of Apple engineers for the last quarter century flying into China essentially on a daily basis. I mean, United Airlines actually leaked this in 2019, 50 first-class seats every day coming from San Francisco, where these engineers would go across the country. So they play an absolutely instrumental role, but they're not single-handedly doing this, right? The Taiwanese entrepreneurs, people like Terry Guo from Foxconn, they were in China since the late 1980s. Really helping build up the country. My point is that if you look at the investment dollars Apple was putting in, or if you understand that Apple is the largest client of a TSMC, of a Foxconn, then you begin to see that the influence of Apple on China has been huge.
How do you think things started changing for Apple after Xi Jinping took over? You've written and observed, and there's a whole chapter in your book as to how things started changing in the Chinese media, about how the Chinese media started talking about the arrogance of Apple as a company, how it's a time to pay back as well. Do you feel that Xi Jinping was upset with Apple in a way, and that somehow changed the relationship between Apple and China?
Yeah, absolutely. I mean, it wasn't necessarily the case that a strong man was going to lead China. And in the decade prior, which is really when Apple consolidates production, I mean, China is kind of a multinational playground where they can sort of skirt around rules and do everything that's needed. So what happens when Xi Jinping comes into office is he advocates in China for China policies, and companies are threatened, with antitrust investigations and directly told, quote, if you put up a fight, we will double or triple your fine. I talk about things getting so bad for Qualcomm, the California chip designer, that their chief negotiator sleeps on the plane at the airport rather than staying in a hotel, and nobody else from the company will go to China because they worry about being kidnapped. I mean, the climate in the first term of Xi Jinping being in office is really threatening for Western companies, and nobody is more vulnerable than Apple because nobody was as successful as Apple.
Right. Could you give us a sense of how closely connected is Apple with China currently? And do you feel that when it comes to Xi Jinping, considering that Xi Jinping has met tech giants, top tech CEOs over the past few months, such as the CEOs of Nvidia, also Apple, also Tesla. Does it mean somehow that Xi Jinping's outlook towards companies like Apple has now changed? He wants them to continue investing in the China story, or do you feel that the relationship is still very much the same, tense?
Well, what I would say is that, Xi Jinping and Apple, broadly speaking, have aligned interests, meaning that China really offers Apple a lot of great manufacturing and automation and a flexible workforce, a talented workforce. And so if Apple wants to continue making products at 35%, 40% margins, they would, of course, love to continue having their consolidation into China. And Xi Jinping would love nothing more than that as well, because engendered in how Apple designs and makes their products is a process of technology transfer that greatly benefits the recipient country, in this case, China. One reason I would say I'm so excited to speak to you is that I think India has an unprecedented opportunity here to be part of this and to rival China. I mean, every company that has deep exposure to China is basically looking to India to be the China +1 program, right? They want India to be the rival. They want India to be plan B. Apple is one of these countries, and I don't see enough being done on the part of India to really take advantage of that opportunity.
Right. Do you feel, Patrick, that this is exactly the reason why Apple wants to invest more in the Indian market? There have been reports how Apple wants to start making all phones for the US market in India itself. Is this the reason, the tense environment, the unpredictable environment that they work in China?
So yes and no. So Apple's been making iPhones in India since 2017, but that was just about tariffs, right? So Narendra Modi had put tariffs on smartphones coming from China, I think around 20% or so. And so when Apple looked at India and saw the next big growth market, right? 8% GDP growth, obviously emerging middle class, 1.5 billion people, the next great population boom, really began investing in India to build iPhones just to avoid the tariffs, right? I'm distinguishing avoiding tariffs from de-risking from China, which I don't think you see any evidence for. Then what happens is Shanghai goes into lockdown, right? COVID lockdown in 2022. This is the first time that the government, local officials, had made a decision in China that was absolutely at odds with Apple's interests. And that is when Plan B, Let's Make in India, really gets some acceleration. Again, that's less about de-risking from China seeing it as an authoritarian regime and more like we just need a plan B for assembly. The only other point I would say is not enough investment is happening. You might say, oh, there's a new factory that needs 30,000 people. Dormitories are being built by Foxconn. That is not enough. That is not nearly the scale that something like China has. So in China, for instance, I point out using some internal documents that a company called Beal Crystal, they play a role in the glass for the iPhone. I mean, they had 72,000 people just working on Apple products. And that was more people than 14 factories in India working on Apple products.
So how would you explain Donald Trump's current stance and threats to Tim Cook that you better start making phones in America or I'll impose 25% tariff? Is there somewhere a feeling that this relationship with China has started hurting American companies, hurting the American economy? It endangers America's status as a superpower in the long run?
Well, it's a complicated question, so let me see how I can attack it. I mean, I think the most obvious thing is for Apple to be making much, much bigger investments in India, right? The depth and the breadth of the supply chain, not just assembly. It's not just Foxconn. You need hundreds of factories. And I think India would be so wise to get up on this opportunity because Apple really is the great teacher. It would be nothing better for India's manufacturing sector than to have Cupertino's best training armies of workers in India to sort of take advantage of iPhone production and then use those skills to build up the rest of the electronics industry. So that would be fantastic. The problem, of course, is that Trump doesn't want that. And this is to some extent Tim Cook's own problem in the making because Apple explicitly has said we are investing $500 billion into the United States. And the implication, not stated directly, but the implication is that we are reshoring things like iPhone production to America. And Trump has sort of bought the bait there. And so after that investment several months ago, he doesn't understand why aren't there more factories being built. And there's a sleight of hand on Apple's part because they're not investing $500 billion in the sense of reshoring reshoring production, they're investing it in other ways. My best theory is that they're counting buybacks and dividends, which is not at all an investment in manufacturing. It's just money to shareholders. But because that hasn't been explained to Trump, he sort of doesn't understand the disconnect between these wild number being invested in America and basically no plants being built. And so that he's sort of taken that out, in a sense, on Tim Cook and perhaps on India.
Right. But do you feel that Apple can even go ahead and build a factory for phones in America? Is that even possible?
The short answer is that it's not possible. The nuanced answer is that Tim Cook is under such pressure to do that, that he might have to make some sort of piecemeal gesture that would indicate some number of phones is being made in America. But it's not the sort of thing that would stand up to scrutiny. And if you understand MAGA, the Make America Great crowd, I mean, it wouldn't make a lot of sense, because who's going to work in these factories? I mean, frankly, the only sort of viable population that would work 12-hour days at the sort of hours that Apple needs would really be like, people crossing the border from Honduras. In other words, the very people that Donald Trump doesn't want in the country. These are not the sort of jobs that like Americans are going to go do. So it's really just a contradiction in terms. And then you have to understand there is no such thing as an Apple manufacturing facility, right? So it's not even a matter of convincing Tim Cook. Tim Cook has to convince Foxconn. Tim Cook has to convince Luxshare or all these other companies, perhaps dozens of factories. And they would all know that business-wise, none of this makes any sense. So there's a real disconnect there. And I don't know when Donald Trump is going to understand it, but at the moment, I don't think he does at all.
All right. Finally, do you feel that Apple has been able to diversify away from China to a significant extent? And will they ever be able to extricate themselves or decouple from China? And because the reason why I'm asking you this, successive US governments over the last 10 years have been looking at a decoupling from China. That's not happened. Will Apple be able to disconnect itself, or is it too legally intertwined with the Chinese economy?
So the first thing to understand is that the standard narrative is that Apple is sort of rapidly diversifying from China and has been for the last 10 years. The reality is really quite the opposite. So the real estate of the iPhone, if you think of what's inside the iPhone, that's increasingly Chinese. And even the Taiwanese, the American companies that have been so instrumental to building Apple's presence over the last 20 years, they're being squeezed out in favor of what is called the red supply chain. So companies like Luxshare, Gore-Tex, BYD, Wingtech, they're very much taking over the assembly of iPhones that used to be done by Pegatron, Wistron, and Foxconn to some degree. I mean, one of the reasons Foxconn is moving to India is Apple is pushing them kicking and screaming and basically saying, like, your business in China isn't going to survive at the market volumes that you've had because we need, for political reasons, to be giving more orders to the red supply chain. I'm only mentioning the assembly giants. This is down the road in terms of the components within the iPhone. And because they're so consolidated, they're so exposed, so vulnerable to China, any big moves that they are wanting to make to India can just be blocked with a stroke of a pen, right? Machinery built in China that should go to Indian production factories. No, not going to happen. If Xi Jinping doesn't want it to. Experiential know-how in the minds of thousands of Chinese people that would be needed to help India build its production lines. Yeah, we're just not going to give them visas, Xi Jinping will say. So they're in a real bind. But if you understand sort of how significant it is to have Apple in your country, then you can understand that it's a real bargaining chip. And if Narendra Modi and the top Indian officials are really on to what a presence it is to have Apple, then it should be part of the political discussions.
Okay, thank you so much, Patrick McGee, for joining us here on Global Lens, giving us your view on the Apple-China story and how the company will possibly never be able to extricate itself away from China. Thanks once again. Our focus today is on Israel-India relations. As we know, the Israel-Hamas war has been on for over 600 days, and this has come with a cost to the Israeli economy. What is the Israel government's outlook to boost growth and development, and also have closer ties with allies like India in the midst of this war that is raging in Gaza? Joining us right now to talk about all of this is Shmuel Abramson, who is the chief economist of the Israeli government. Shmuel, thank you so much for being with us here on Global Lens.
Thank you, Parikshit. Pleasure to be here.
Let me begin by asking you about the state of the Israeli economy right now. The offensive in Gaza is only
increasing, it's becoming more fierce. What would be your outlook for the growth of the economy this year?
So our outlook for this year is positive, is actually very positive. It's roughly around 4% of GDP growth, after also positive growth last year. So what we do see in the economy is that despite the, of course, very clear challenges of the war and uncertainty, and by the way, not only in Israel, global uncertainty that we are facing, we are still seeing very, very healthy economic activity. And this also is reflected in our growth projections for this year.
Right. S&P, almost 24 to 48 hours back, has gone on to say that they will not be able to upgrade the sovereign credit ratings for Israel till the war in Gaza is on, until the time this uncertainty continues. How do you respond to that, and how do you look at the fundamentals of growth in the Israeli economy right now?
So I think it's fairly understood. We as economists never like uncertainty, and when we see uncertainty, then we prefer to wait and see how things unfold, and that's okay. That said, and if you read also what S&P and other credit rating agencies write about Israel, you will learn that the Israeli economy has exceptional strong fundamentals, and that's part of the reason that we are able to weather this period in our country also very strongly economically. So the very, very solid fundamentals are there, and they're very evident. And you see that also in the way that investors see Israel, with the stock markets trading at record levels. You see the currency super strong and so forth.
I'd like to ask you about defense spending. What's the kind of uptick or increase in defense spending that we are going to see in 2025 by the Israeli government compared to 2024?
So in 2025, we will see a one-time uptick, which is natural when you have exceptional needs. The way the government dealt with it is by bringing in a very professional committee that will really think and plan what the exact needs. We're very, very keen in Israel on fiscal discipline over the years. This is one of our sources of strength. So there will be a one-time increase, but we also have a plan for decreasing back the levels of defense expenditure as percent of GDP. Naturally, there are short-term needs, and we have to succeed in this war and end it in order for enable future growth for the whole economy and the whole region.
Right. So when you say there will be a one-time increase, one-time uptick, what will be the total quantum that we're looking at?
We're talking about 3-4% of GDP in 2025, which is a one-time increase. In the medium run, we're talking about 1% GDP increase, but these increases are not indexed to GDP, meaning that when we will have growth, and good growth we hope, in the day after, there's tremendous opportunities for the economy, then the defense spending as percent of GDP will keep on going down, as we had in previous years.
Right. You're here in India. Give us a sense of what brings you here to New Delhi, what are the kind of meetings you're going to have, and what is it that you seek to achieve?
So first of all, I would say I'm delighted to be in this incredible country, in India. We are here in order to strengthen the ties between our two amazing countries. There are tremendous opportunities, also in the short run, but also in the long run, between our two countries. In many ways, we're also complementary. India, by its size and innovation and very, very good spirit and leadership, and Israel is looking forward to be part of this very exciting Indian story and contribute also as a partner to your success. We have various areas of cooperation that we see. We're talking about technological cooperation. We're talking about support in areas of agriculture, areas of water management, talking about cybersecurity, defense technologies, and really the sky is the limit in the way we can partner.
Right. In terms of areas that you would be most interested in, or Israeli government would be most interested in for future cooperation, what would those be?
So, as I said, anything that's involving innovation. So it spans across various sectors. It comes from the agriculture, technological innovations, water technologies, and of course cybersecurity, defense spending that we both countries face substantial defense challenges, but also create opportunity for us to work together on those issues.
Right. I'd like to ask you about the progress on the India-Israel FTA. We have been talking about it. We have been negotiating that. Where are we with the negotiations currently, and by when do you think we'll be able to conclude things?
So there's a set of economic agreements that we're discussing with the Indian government. I would say we don't, things take time, and it's natural. We see also the whole world negotiating, right, with the United States, and we're all involved in negotiation. I think that we will definitely see progress in some of the agreements in the future months, and it's going to span a lot of areas of activity, economic activity, financial, economic, trade, and so forth, investments, so forth.
So when you say we are working on a number of economic agreements, if you could break this down for us, are we looking at an interim trade deal, an early trade deal? How would you describe this economic agreement to our viewers?
We're discussing agreements that are related to investments, to creating a better investment environment and more stable investment environment, both for Indians investors in Israel and Israeli investors in India. That's one thing. In addition, we want to create a set of agreements that basically base the bilateral relations between different government agencies that can partner on various issues, from fintech to development to financial regulation and so forth. So we're talking about really a set of...
Right. But any timeline that you can give to us on the trade deal itself?
So I think it will be premature at this point to say, but I would believe it's sooner than later.
Within this year?
So some agreements definitely this year. I don't know about the whole agreement, because these things take time. We all understand the whole world is very busy negotiating a lot of deals, so I don't want to put the timeline for the whole FTA, but for specific parts of it or for specific related agreements, we definitely, I believe, will see it within months.
You heard Israel's chief economist and their outlook on growth. We'll get you much more in the days to come.
Our focus today is on iPhone maker Apple's strategy amidst a rebalancing of world trade. US President Donald Trump recently threatened to impose a tariff of 25% on Apple if the company does not make iPhones in the US. But there's a chance that the company may choose to continue to make the phones outside of America and pay the tariff. Let's break down the maths that could support this rationale. Currently, most parts are made in or near China. Chips are made in Taiwan. iPhone screens and memory chips come from South Korea. Japan provides camera systems, and the batteries are made in China. About $550 is the bill that Apple foots for the components of an iPhone 16 Pro, as per Tech Insights. In a pre-tariff scenario, Apple would be left with a profit margin of around $450 if the iPhone costs around $1,000. Even if you remove the cost incurred for the assembly and testing, advertising and services like iCloud, Apple will still be left with a good margin. Now, in case a 25% tariff is applicable, the profit goes down by $100. That's still a better price to pay than the heavy investment and time required to shift manufacturing of iPhones to the US. As Wedbush Securities estimates that a $30 billion investment will be needed over 3 years just to make 10% of iPhones in the US. It also won't be easy to replicate the complicated production systems that have existed in Asia for years. The Wedbush analyst expects that the cost of an iPhone in US will be much more than the current price, almost triple. Not just that, cost of assembling an iPhone in China or India is a mere $30 when compared to an estimated $390 in the US. Also, Apple will still have to import many components which will likely face tariffs. In 2017, Tim Cook had said that companies manufacturing in China, because of the skill and the quantity of skill in one location and the type of skill it is. But that's not to say that Apple hasn't been shifting its reliance away from China. Apple currently produces nearly 15% of all iPhones in India and is looking to increase that number over the next few quarters. As per data from Canalys, US iPhones shipped from India in April surged 76% year-on-year, while shipments from China slumped. While many signs point out that it might not make business sense for Apple to make iPhones in US, a book named Apple in China by Patrick McGee throws the spotlight on the tech giant. McGee reported on Apple from 2019 to 2023 for the Financial Times. In his book, he talks about how for years Apple was allowed to exploit China. And then we saw China exploiting Apple in turn, almost making it impossible for the tech giant to extract itself from the country. The book says that Apple, having invested billions of dollars on infrastructure and training to make Chinese factories unparalleled, has little choice but to comply with Beijing. Patrick McGee is joining us on the show to discuss this. Patrick, thank you very much for taking out time here for CNBC-TV18, our new show Global Lens. Apple has been in focus. Give us a sense of when you believe there was a turning point in Apple's China story. Did it all boil down to the Consumer Day in 2013?
Yeah, my book begins, the prologue begins with March 2013, really significant time, even if you're not an Apple watcher, because you'll know that's when Xi Jinping ascended to the presidency. Apple was attacked within 36 hours of Xi ascending to the presidency, and they're attacked for warranty differences of all things. And this is later in my book, the political awakening for Apple, because at the time they had been the most successful operator in China and the most successful retail business in China, with more than $20 billion of revenue at the time. And so the book really, the thesis is that Apple sort of hires or names key people to live in.
TVS Motor Company is today one of India's largest two-wheeler manufacturers. In fact, it is the third largest two-wheeler manufacturer in the country and fourth largest globally by volume. The company has a market cap of $16 billion US, present in over 80 countries. They are the leading EV player by market share. Joining us right now to speak about the company's global strategy at their headquarters here in Singapore is the company's Managing Director, Sudarshan Venu. Sudarshan Venu, thank you so much for joining us here at your Singapore office. Things have been good as far as EV sales and overall push towards premiumization and export growth is concerned. You've now spent 12 years with the company, 3 years as Managing Director. What would be your biggest achievements or milestones as you would like to list it out for us?
I think it's a collective achievement, Parikshit. It's really the vision and values that my father has started TVS Motors with a huge focus on quality, customer satisfaction in product and technology. And that is the basis on which we have grown, and that is the basis on which we have to continue to grow and do exciting things in the future. I think there's a very passionate team who are excited about the future, and as we have said in our LRP, and to transform the quality of life of our customers. So that is really the focus.
I would like to speak about your international strategy, and I think Norton fits into that very well. You're coming up with the Norton India launch very soon. Could you give us a sense of when is that expected, and what are we really expecting in terms of those big bikes which are coming into India?
Norton will launch towards the end of this year and will start phasing in the products towards the end of this year and early next year. I think I have mentioned 6 products before, 4 of which will be available for the summer of 2026 in the 4 European markets of UK, plus France, Germany, Italy, and Spain, as also, of course, in India. So this is where I think we are heading towards by starting off with the launch of the 4-cylinder superbike at EICMA, and then we will also share the remaining 3 products soon at EICMA or soon after, which will be available in the market early 2026. They are all in advanced stages of development. I think we have a good leadership team now at Norton with the 2 executive directors, Arnie and Neviho. Supporting them are very good designers, engineers, and a lot of homegrown talent from TVS in India, which I think brings a great mix in terms of the Britishness and the uniqueness of Norton, while leveraging the capabilities of TVS and also offering opportunities for our talent to grow.
Right. So there's a lot of competition in the premium space in India as well, in the 350 to 500cc space. And 650 is a space which Royal Enfield has been leading. Could you give us a sense of where your bikes would be playing, in which segment, and how many bikes will the Indian consumer be able to reach out to in India?
I think we will start, as I said, with the 1200cc superbike. We will have other smaller offerings as well, but we will draw a line on how we ensure we keep Norton Premium, keep it in the luxury space, and offer bikes that are uniquely differentiated and uniquely Norton in terms of the 3 values which we have articulated, which is design, dynamism, and detail.
Right. And what will be like the retail strategy for it in India and
We'll
globally?
definitely have a differentiated retail strategy in India, covering Norton and covering possibly some of the premium TVS vehicles as well. As I said, this will help us connect with the growing middle class of India and upper middle class and people with more affluence, and with Norton's even some of the top end segments who buy sports cars and other vehicles who also buy these very high end bikes. We will connect with different retail formats that are uniquely catered to them and offer them that superior and differentiated experience.
So there'll be like more experience centers, more showrooms, specific showrooms for...
Absolutely.
How many are you targeting for India?
We'll share more soon, but I think definitely we will cover in the first phase the big cities, and then after that move on to other cities, and we definitely intend to offer the entire Norton range in India.
Okay, and initially the sales would be only in India and UK, or are you targeting
As I said, it is India, UK, and the 4 large European markets initially.
Okay, and are these going to be manufactured here in India, or they're going to be exported in the first phase?
There is manufacturing in the UK, and there is going to be manufacturing in India as well. Some of the models will be made with greater value-added content in India and some with greater value-added content locally.
Right. So what's been your...
And I think this India-UK FTA also helps both ways in terms of ensuring that components and kits and things from our side can go to UK and sub-assemblies, but also ensuring that the fully built vehicles can come into India.
So you can take benefit of the lower tariff regime.
Definitely, and I really applaud that it has happened it's good for many sectors of the economy.
Yeah.
It's good for us as well.
Okay, could you give us a ballpark figure on how much you are putting behind launching the Norton in India and in global markets, both in terms of R&D, manufacturing, and the marketing plan?
I think really luxury differentiated brand has to be built the right way. So that is really a focus for us. We will start with a capacity of close to 10,000 vehicles and with the 4 models going up to 6 models. So I think really the focus is on ensuring that the brand philosophy is delivered, the vehicles that live up to it, the retail and communication which clearly shows the brand experience and delights customers and resonates with them. So that is really the focus in the first phase for each.
Right. So Norton, of course, is a big focus area for you, and it's been an interesting ride so far since you acquired the company. As we stay with your international focus, your partnership with BMW, it's been holding strong. Both companies have also developed an EV together. Where is the partnership currently, and how do you plan to expand on it?
I think we did first the single cylinder, the 310 family, then came the EV, and now is the 2-cylinder family, which BMW has shown their version at last year's EICMA. And you will see Norton and TVS versions using similar platform in the coming months. Okay. So that is where I think the relationship is headed.
Right. Speaking about electric vehicles, 25% market share in the month of May. That's what we pick up. You were the leading player, and you have been the leading player for several months now. The competition is stiff, but you're steadily growing the market. What's going to be the strategy from here on in terms of building your EV portfolio?
We are committed to building all segments in EV that we believe make sense. And so we have the TVS iQube, which of course has done well. We have now started retail of the TVS X, which is sort of a flagship scooter, which shows the capabilities of what we can do in terms of technology and materials and really creating a fantastic riding experience. And you're resonating with the young customers in terms of connectivity, in terms of use of advanced materials, in terms of design. We're also launching another electric scooter this year. And we've done the One Make Electric Racing Championship and also the electric 3-wheelers and electric bicycles as well.
Okay, so if we were to ask you how many electric products altogether in FY26?
I think in FY26 we'll look at a couple of new launches. One is, of course, X has already started retail. There is an improved iQube and one more new scooter.
One more new scooter coming up. How does the market look to you currently, and are you looking at increasing capacity? What is the monthly run rate that you're looking at?
I think we are increasing capacity and the volumes have grown. At the same time now there is this whole supply chain challenge in terms of China banning the export of rare earth, high rare earth HRE magnets, which are actually very important for our motors and other parts of the EVs. So this EV supply chain disruption is certainly going to pose a short to medium term challenge. And I think as India plans its EV strategy and EV plan, the adoption will have to be phased in or phased up, along with developing an Atmanirbhar supply chain in India, where India, as the world's leading 2-wheeler market, which has produced 3 of the top 5 companies by volume globally, has its own supply chain, its own R&D, its own capability, and EV is really built on that basis.
Right. How badly is the restriction by China on supply of rare earth magnets impacting TVS Motor Company right now in terms of production?
I think in the short term it will impact the entire industry a fair bit. As we go forward, we have to develop new solutions, develop new components, new suppliers, and really work our way through this.
So is it already, for the industry, is it already showing on the monthly numbers?
I think it will start showing soon.
It'll start showing soon?
Maybe in June, if not definitely in July.
No, some bodies have really sounded the alarm bells, saying that this could literally bring EV production to a grinding halt. Would you go to the extent of saying that?
It is concerning, yes, Parikshit, it is concerning.
It could bring it to a halt?
Yes.
How bad is it for the industry?
I mean, a halt is pretty bad, right?
A halt is very bad.
And it doesn't get that much worse with.
Yeah. So we could look at a complete
Yes, it is a significant challenge.
And how are you managing it at TVS?
Of course, like every company, we are trying to see how to de-risk, to import assemblies instead of importing the magnets alone. But again, there is a huge price impact which ultimately has to be borne by somebody. And then there'll be cost increases or other price increases to the customer. So all this has to be factored in, which is why I think it will be a medium-term, short to medium-term challenge that the industry needs to work its way out of. On one hand, we are launching products, we are committed, we have invested a lot of capex. You have seen that we have done a lot of exciting launches and our volumes have also grown. This is definitely a challenge that there's an industry and we have to work through, and over a period of time develop an ecosystem of components and R&D in India so that we bring volumes up in a way that is sustainable and in a way that's Atmanirbhar and made in India with Indian R&D, with Indian products and Indian technology and supply chain and natural resources all linked up.
Yeah. So you're expecting from June onwards it'll start showing in production figures, and there'll be very significant production cuts?
Yes, there'll be cuts.
Yeah. As an industry,
we'll all do our best to mitigate it, of course.
Exactly. But on an industry level, I know it's very difficult to give us a sense of what's happening at TVS. At an industry level, what could be the production cut or decline that you expect?
As some of the industry bodies like SIAM have said, and some others industry leaders have also said, it will be significant.
It will be significant.
And it will change from month to month, so we'll have to work our way through this over a period.
So the availability is a question and the pricing will also go up, I'm guessing. Yeah. Very significant concerns there. The other issue on the PM eDrive scheme, we have been seeing the FAME scheme continuing since 2015, two versions of that. You've got the PM eDrive scheme. Now the scheme comes to an end next year. Are you ready for a zero subsidy scenario?
I think the government has done a lot to encourage EVs, and of course over a period of time these subsidies have to be phased down in every industry. So as it ends, then the industry will have to continue to develop new ways of reducing costs, new ways of being competitive. I think the supply chain issue is important, so that as we build out of this, you build a supply chain that's resilient.
That's what the government, of course, needs to do.
It's not just the government, the industry, the suppliers, the OEMs, everybody has to work together.
Right. Now speaking about...
Government has done a lot already.
Yeah.
This new challenge is there. We'll all have to face it, and I'm sure we'll overcome it as well.
Right. Have you been able to identify new suppliers around the world to de-risk your strategy?
Yes, that's going on as we speak, and we'll share more as the situation progresses.
Great. On the electric three-wheeler plan, recently we saw TVS Motor Company launching products in the cargo space, in the passenger space. How is that going, and how would you like to increase your market share, your monthly production when it comes to electric three-wheelers?
Electric three-wheeler of ours has been very well received. We are also launching a CNG three-wheeler for cargo and passenger applications during the course of this year. As you know, we've done better in three-wheelers outside India. Hopefully with these launches, we'll continue to grow abroad and in India as well.
Right. The partnership with Hyundai, we saw some future concepts developed by Hyundai and TVS, and we believe that TVS was mulling manufacturing and retailing those in India and global markets. How far have things progressed?
Things are progressing. I think the concept is a really cool concept, and we'll share more with you at the right time.
But are we expecting a launch this year, maybe?
We'll share more with you at the right time.
Okay. Let me speak to you more about the domestic market right now. We've seen your market share grow to 18 to 19%, from 16 to 17%. What would be your ambition for FY26?
See, our ambition is always to launch exciting products to delight customers, and then market share is a resultant. So I would like to say that we are launching exciting products. We're focusing on enhancing the customer experience to continue our focus on the core TVS values of quality, customer satisfaction, innovation, and tech. And you'll see some exciting new products from us this year, including a premium scooter.
Right. Could you give us a sense of how many more products? Because as you have in the India market, you need to keep exciting the customer.
So I've said 3 two-wheelers, and then we have the CNG three-wheeler as well.
Welcome back. You're watching CNBC TV18 and we are in exclusive conversation with Sudarshan Venu, Managing Director of TVS Motor Company at the company's headquarters here in Singapore.
On the electric bicycle front, there was a period during COVID where you were literally on an acquisition spree with electric bicycles and electric bicycle companies. Are you planning to now expand that plan, get them to India? What would be the strategy going forward?
Rather than spree, I think we bought a couple because the rest of them were reported as an acquisition, but they were really shops or some technology that we had bought. Now we have integrated everything. I think there is a bit of a supply glut in Europe on electric bicycles in the past couple of years, which has impacted the industry and us as well. We have developed new products now, which means that the greater portion of our sales from our new products, which we are developing, is increasing. We are also developing specifically for India with a dynamic young team, a new e-bike, which we will launch in India because the European cost point is, of course, quite different. So together with this, we have consolidated our presence in Europe. We will expand further with the new products. We will launch in India. And as in India, adoption will start as well, more for leisure. And in Europe, I think both for mobility and for a bit of leisure, as the industry comes out of it, we will aim to break even and start getting returns.
Okay. E-bike launch in India when?
This year.
This year itself. Okay. Speak to you about the domestic sentiment once again. Between rural and urban, how does the sentiment look and what would be the ratio of growth that one can expect?
I think the sentiment is similar because today you see cities are also expanding. Of course, with a good monsoon, rural sentiment can be better than in going forward. So I think also you see now many cities are expanding quite a bit, and this sort of mega city is also creating new demand on the periphery. What may have been rural area is actually part of a sort of mega city. So there's a whole urbanization is blurring the lines. And I also think with digital communication and things, the customer patterns of behavior are beginning to be more similar to each other.
Right. So when there are challenges, of course, at home, and because of
recent times, urban growth has been a bit better. But of course, with the monsoon, we'll know how it is going to play out in rural areas as well.
Would you say that having a diversified strategy, especially for your exports also, is going to be important? What kind of export growth are you targeting? And how many more countries would you like to reach out to?
We are in many countries already. And we, of course, as there are opportunities in industrialized countries, we will look at entering new markets as well. And also new segments within those markets or new ways of doing things in some of those markets. In terms of Africa, I think